Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam that let you customize your own review program to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured, professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you're going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as diagnostic exams, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of the computer-based exam, including multiple choice and simulation questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you'll have the confidence and knowledge to pass it, guaranteed.
Hello, and welcome to the Bisk CPA Review and our coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette, and I'll be your instructor for this class. And in this class, we're going to be covering several topics that are hit in the financial exam. We're going to be talking about the proper accounting for inventory, fixed assets, and also intangibles. Before we start the class, I just want to say a word about the best way to use this class. The important thing is to try to avoid just sitting back passively watching the class. Try to be an active participant. Take good notes. Later in the class, when we go to problems, the important thing will be to shut the class down. Do the problems yourself. Get your answers before you come back and do the problems with me. I think you find if you do these simple things, you get much more out of this class, and of course it's what we both want. So try to be an active participant as we go through this class. Let's begin by talking about the proper accounting for inventory. You know that inventory is a major asset on the balance sheet, and the accounting for inventory is a pretty large topic. So the first thing I'd like to do is try to knock it down to size just a little bit. And I think this will help. Try to remember that if you're in the exam and you get questions on accounting for inventory, remember that any question on accounting for inventory, one way or another, has to fall into one of three topics. Let's just list them down. It's either going to be topic number one, which is costing, the original costing of merchandise. Topic number two, measurement, the measurement of inventory. Or number three, valuation. And in this class, when I say valuation, I'm talking about the proper valuation of the ending inventory. But really, any question on inventory accounting, one way or another, is going to fall into one of those three topics: costing, measuring, or valuing inventory. Let's talk about costing, the original costing of merchandise. Now, you certainly know that the primary basis of accounting for inventory is historical cost. But I want you to remember that when we say historical cost for merchandise. Over and above the cash price you pay for the inventory, you must capitalize to inventory all the costs you incur to bring that merchandise into a condition and location for sale. And that's known as the condition and location for sale rule. Because you always want to remember, that's what we mean by the historical cost for merchandise. Over and above the cash price you pay for merchandise. Obviously, the cash price you pay for merchandise will be capitalized to the inventory account. But over and above the cash price you pay for merchandise, you must capitalize to inventory all the costs that you incur to bring that merchandise into a condition and location for sale. So, things like purchasing costs, handling costs, warehousing costs, all these costs get capitalized to inventory. And don't forget freight in. Transportation in is part of the cost of merchandise, not freight out. Freight out is a selling expense. It belongs below gross profit. So don't make a sloppy mistake. But freight in, transportation in is part of the cost of merchandise. We must capitalize to inventory all the costs we incur to bring that merchandise into a condition and location for sale. Now, while it's true that the primary basis of accounting for inventory is historical cost, also remember that ultimately inventory will be carried on the balance sheet at its original cost or its market value, whatever's lower. So, yeah, the primary basis of accounting for inventory is historical cost, no question. But in the final analysis, inventory would be carried on the balance sheet at its original cost or its market value, whatever's lower. Going in the exam, you have to know how to apply lower of cost of market to your inventory. And I'll tell you what makes this a little complicated. When you apply lower of cost of market to inventory, you have to know what market is. Now, normally, market is just replacement cost. But that's not necessarily true with inventory because there's a ceiling. And market can never be higher than the ceiling. And there's also a floor. And market can never be below the floor. And that's what complicates the process. So let me give you some definitions, and you have to know these definitions. Let me define the ceiling. Now, as I say, there's a ceiling, and market can never be higher than the ceiling. The ceiling is called net realizable value. That's what they call the ceiling, net realizable value, and it is defined as the selling price for the product minus the normal costs to complete and sell the item. Again, the ceiling, net realizable value, is defined as the selling price minus the normal costs to complete and sell the item, what they sometimes call disposal costs. But that'll give you your ceiling. If you take the selling price minus the normal costs to complete and sell the item minus normal disposal costs, that will give you net realizable value. That is the ceiling, and market can never be higher than that. Now, the floor, and there's no fancy name for it, it's called the floor or the bottom. The floor is defined as that ceiling, net realizable value, minus a normal gross profit on sale. That's how you define the floor. It is that ceiling, net realizable value, minus a normal gross profit on sale. That'll give you the floor. Market can never be below that amount. So that's what complicates this. When you try to apply lower of cost of market to your merchandise, as I say, market is not necessarily replacement cost because you've got the ceiling and you've also got the floor. Let's do some problems. If you look in your viewer's guide, you'll see we have products A, B, C, and D. Let's apply lower of cost of market to these products. If you look at product A, the historical cost is $2.50 a unit. The replacement cost is $2.60 a unit. The normal selling price is $4. Normal disposal costs $1 a unit. And the normal gross profit margin is 70 cents per unit. So let's apply lower of cost of market to product A. Well, the first thing you want to do is calculate the ceiling. Now remember, the ceiling is called net realizable value, and it would be defined as that selling price, $4 a unit, minus normal disposal costs, $1. Let's agree that the ceiling for product A would be $3. The floor would be that ceiling, net realizable value, $3, minus a normal gross profit on sale, in this case 70 cents. So the floor would be $2.30 per unit. All right, so step one, we calculate the ceiling. Step two, we calculate the floor. All right, now step three. you have to look at three numbers. Notice the threes go together. When I get to step 3, I have to look at three numbers. I have to look at the replacement cost, $2.60 a unit, the ceiling, which is $3 a unit, the floor, which is $2.30 a unit. I look at those three numbers, and you have to remember that whatever number's in the middle is your market. Just remember, middle number is always market. Now, the number in the middle here would be $2.60. That's the middle number. You might want to circle it and put a little M there. That's your market. M stands for middle, M stands for market. But the middle number is always market. All right, now one last step. The last step is to say it is the lower of cost, historical cost, which is $2.50 a unit, or market, which I now know is $2.60. What would I do? I stay at cost. The answer would be $2.50 because cost is lower. Cost is lower than market. So I simply would stay at cost. And that's really the process. Calculate the ceiling, calculate the floor, calculate market, calculate lower of cost or market. That's really the only way to do this. Calculate the ceiling, calculate the floor, calculate market, calculate lower of cost or market. Let's do product B. Historical cost is $6 a unit. Replacement cost is $5.25. Selling price $8.50. Disposal cost $3.50. And there's a normal gross profit on sale of 80 cents a unit. All right, let's go through the process. Step 1, calculate the ceiling. The ceiling would be that selling price, $8.50 a unit, minus a normal disposal cost per unit, the normal cost to complete and sell, $3.50 a unit. The ceiling, net realizable value, would be $5 a unit. The floor would be that ceiling, $5, minus a normal gross profit on sale, 80 cents. The floor would be $4.20. All right, now what's your step 3? Step 3, you look at three numbers. Look at the floor, $4.20 a unit. The ceiling, $5. Replacement cost, $5.25. The number in the middle is $5. The middle number is always market, so you might want to circle that. Put a little M there. M stands for middle, M stands for market. The middle number is always market of those three. So now my last step is to say it is the lower of cost, which is $6 a unit, or market, which I now know is 5. I would use 5. It's lower. It's lower of cost or market. Because market is lower than cost, I would use $5. What's the journal entry here? Well, aren't I writing my inventory down $1? In other words, if I have 100,000 units in my ending inventory, I'm going to take 100,000 units times $1. I'm writing my inventory down from $6 a unit down to $5 a unit. So I would take the 100,000 units in my ending inventory times $1, and I would take an inventory loss to my income. I would debit a loss. I would take an inventory loss to my income statement of 100,000, and I would credit inventory, 100,000. I'm writing my inventory down to market. Let's do product C. Historical cost is $10 a unit. Replacement cost is $9 a unit. The selling price is $15. Normal disposal costs $2, and a normal gross profit is $3.50 a unit. So let's go through our steps. Step 1, calculate the ceiling. The ceiling would be the selling price, $15, minus normal disposal cost of $1. The ceiling would be $13 a unit. The floor would be that ceiling, net realizable value, $13 a unit, minus a normal gross profit on sale, $3.50 a unit. The floor would be $9.50 a unit. All right, step 3, look at three numbers, right? Step 1, calculate the ceiling. Step 2, calculate the floor. Step 3, look at three numbers. I look at the floor, $9.50 a unit. The ceiling, $13 a unit. Replacement cost, $9 a unit. I know whatever number's in the middle, and that's $9.50 here. The number in the middle is always your market. Middle number is market, so you might want to circle that floor. Circle the $9.50, put an M next to it. That's your market. Now, what's your last step? Step 4. Your last step is to say it is the lower of cost, which is $10 a unit, or market, which I now know is $9.50. I'll write down to $9.50. It's lower. I use market. It's lower. $9.50. Let's do product D. Historical cost, $150 a unit. Replacement cost, $175 a unit. Normal selling price, $200. Disposal costs are $10. And normally the gross profit is $80 a unit. So let's go through the steps. Step 1, calculate the ceiling. The ceiling is defined as that selling price, $200, minus normal disposal costs, $10. I think we agree that the ceiling net realizable value would be $190 a unit. The floor, step 2, we calculate the floor. That would be that ceiling, net realizable value, $190, minus a normal gross profit on sale, 80. The floor would be 110. All right, so step 1, we calculate the ceiling, 190 per unit. Step 2, we calculate the floor. It's 110. What's step 3? Look at 3 numbers. I look at the floor, $110 a unit, the ceiling, 190, replacement cost, 175, circle the 175. Whatever number's in the middle. Look at the ceiling, look at the floor, look at replacement cost, look at those 3 numbers. Whatever number's in the middle, that's your market. Circle it. Put an M there. There's your market. What's step 4? Your 4th step is to say it's the lower of cost, which is $150 a unit, or market, which we now know is 175. What would I do? I'd stay at cost. Cost is lower. Cost is lower than market, so I would make no adjusting entry at all. I would just stay at cost, 150. Now you might say, well, but Bob, isn't there an easier way to do this? There really isn't. This is the only way you can break it down. Steps. Step 1, calculate the ceiling. Step 2, calculate the floor. Step 3, look at those 3 numbers. Get your market. And then step 4, it's the lower of cost or market. Let's try a multiple choice on this. I'd like you to shut the class down, do the first 2 questions in your viewer's guide. 2 questions 1 and 2, and then come back. We'll go through them. Welcome back. Let's do these questions together. In number 1, they say the following information pertains to an inventory item. The cost is $12 a unit. The selling price is $13.60 a unit. Normal disposal costs are 20 cents a unit. Normal gross profit margin is $2.20 a unit. And replacement cost is $10.90 a unit. And they say, under the lower of cost to market rule, this inventory item would be valued at what? Well, you've got to go through the steps. Step 1, you calculate the ceiling. The ceiling is called net realizable value, and it's defined as that selling price, $13.60 a unit, minus normal disposal costs, in this case 20 cents a unit. So let's agree that the ceiling, net realizable value, would be $13.40 a unit. Step 2, calculate the floor. The floor is defined as that ceiling, net realizable value, $13.40 a unit, minus a normal gross profit on sale, $2.20 a unit. So the floor would be $11.20 a unit. What's step 3? You look at 3 numbers. You look at the floor, $11.20 a unit, the ceiling, $13.40 a unit, and replacement cost, $10.90 a unit. And you know, whatever number's in the middle number is always market. That's your market. What's the number in the middle? $11.20. In this case, the floor is the market. Middle number is always market. And then what's your last step? 4. It's the lower of cost, which is $12 a unit, or market, which I now know is $11.20. I use $11.20 because it's lower. And the answer is C. Calculate the ceiling. Calculate the floor. Calculate market. Calculate lower of cost or market. Let's go to number 2. Number 2 says the original cost of an inventory item is below net realizable value, but above net realizable value less normal profit margin. The inventory item's replacement cost is below net realizable value less normal profit margin. Under the lower of cost to market rule, inventory would be valued at what? So you're in the exam, you have this question. Now there are no numbers. It's just theoretical now. And I think you can see what they're trying to do here. What they're hoping you do with a question like this is stare at it. That's what they want. They want you to sit in the exam for 10 minutes going, all right, it's above this, it's below this, it's between this, and waste all kinds of time. And you may have already thought of this. What is the best way to simplify a question like this? Make up numbers. They didn't give us numbers, but we can make them up. You got scrap paper in the exam, use it. I would make up numbers. Now, the only tricky thing is you have to make up numbers that fit the facts. I'll show you the numbers I made up. You make the numbers as easy to work with as you can. They said the original cost of an inventory item, I'm going to assume that's $10. Let's say the original cost of the inventory is $10 a unit, is below NRV. Let's say NRV is 15. That fits. So the original cost, 10, is below NRV, 15, but it's above net realizable value less normal profit margin. So it's above the floor. So cost is above the floor. I'll make the floor 5 because the cost 10 is above the floor, okay? And then they said the replacement cost is below the floor. Well, then I'll make replacement cost something below 5. I'll make it 2. All right, now, how long would it take to make up numbers to fit the facts. Just a few seconds. And once you have numbers to fit the facts, now you solve it like a number problem. I look at three numbers, right? I look at replacement cost, 2, the floor, 5, the ceiling, 15. The number in the middle is always market. The middle number here is the floor, 5. There's my market. Then I say it's the lower of cost, which is $10 a unit, or market, which I now know is 5. I'd use 5, it's lower, I'd use the floor, and the answer is D. I hope you see the real lesson you learn in a question like this. The last thing you want to do is sit in that exam, it's above this, it's below this, and waste 10 minutes on it. No. Make up some numbers, make the numbers fit the facts, and then solve it like a number problem. And you really greatly simplify it. All right, so that's topic number 1, costing. We know that the primary basis of accounting for inventory is historical cost, and make sure when you go in the exam, you know what we capitalize to the inventory account as part of the cost of merchandise, all the costs we incur to bring that merchandise into a condition and location for sale. But ultimately, though, inventory will be carried on the balance sheet at its original cost or its market value, whatever's lower. So when you go in the exam, make sure you know how to apply the concept of lower of cost of market to your inventory. Let's go to topic number 2, which is measurement. Now, when you talk about measuring inventory, there are basically 2 pure approaches. It's either going to be a periodic approach or a perpetual approach. I want to make sure you see the difference. In a periodic inventory system, what that basically means is that the company does use a purchases account. It's really what it means. In a periodic inventory system, the company does use a purchases account. So, as they go through an accounting period, every time they purchase merchandise, they debit purchases. They credit accounts payable. They debit purchases. Credit accounts payable. They debit purchases. Credit accounts payable. Then, when they get to the end of the accounting period, they're going to know their total purchases for the period because they kept track of them, right? And when they add their total purchases to the beginning inventory, that gives them the goods that were available for sale. Then, periodically, which is where the name comes from, you go in your warehouse, you take a physical count, and you find out 2 things. You find out what's there, ending inventory, and when you subtract the ending inventory from what was available, that gives you the cost of the goods that you sold. So you see why they call it a periodic inventory system. They call it a periodic inventory system because you're finding out 2 critical pieces of information, ending inventory and cost of goods sold, periodically. When you go in your warehouse and take a physical count, you're finding out those 2 essential pieces of information, ending inventory and cost of goods sold, periodically. All right, now, what does a perpetual system mean? Well, I know you're ahead of me. In a perpetual system, the company does not use a purchases account. That's really what it means. When a company uses a perpetual inventory system, there is no purchases account. So, as they go through an accounting period, every time they purchase merchandise, they debit inventory, credit accounts payable. There is no purchases account. Every time they purchase merchandise, debit inventory, credit accounts payable, debit inventory, credit accounts payable. Then, when they make a sale, they make 2 entries. Not only do they debit accounts receivable, credit sales, the entry any company would make, but they make a second entry where they debit cost of goods sold for the cost of the merchandise shipped and credit inventory. So you see the result of this. If every time I purchase merchandise, I debit inventory, and every time I make a sale, I credit inventory, don't I end up with a perpetual running total of my inventory balance? I also end up with a perpetual running total of my cost of goods sold. That's why they call it a perpetual system, because you end up with a perpetual running total of your inventory balance, and you also end up with a perpetual running total of cost of goods sold. In a perpetual system, would you ever need to take a physical count? Yes. In inventory accounting, it's very hard to get away from a physical count because that's really the bottom line. That's how you verify the records. Now, even in a perpetual system, eventually you'd have to take a physical count to verify the records. Why? Because of breakage, theft, spoilage, shoplifting, shortages. In accounting, we call it shrinkage. Because of shrinkage, even in a perpetual system, at some point, certainly on an annual basis, you'd have to take a physical count to verify the records. Again, because to verify the records, because of breakage, theft, spoilage, shrinkage, shoplifting, shortages. Again, in accounting, we just lump it all together and we call it shrinkage. All right, so if you're with me down to there, we're done with measurement. Now we're going to get to the biggest of the three topics, the most heavily tested of the three topics: costing, measuring, valuing inventory, and that is valuation. And as I said earlier, anytime I say valuation in this class, I'm talking about the proper valuation of the ending inventory. So let's get into that. Now, you know that one way you can place a value on ending inventory is specific identification, where you go through your warehouse item by item, and you specifically identify the cost of each piece of merchandise that's on hand. That's called specific identification, where again, you go through your warehouse painstakingly, item by item, and you specifically identify the cost of each piece of merchandise that's on hand. That's one way you can place a value on ending inventory, specific identification. Now, having said that, there are some problems with specific identification. Specific identification is very time-consuming. It's very expensive. It may not be practical. You know, a company of any real size, it's not practical, and it might even be impossible. Just think for a minute. How could specific identification be impossible? Well, what if the ending inventory was destroyed in a fire, a flood? Well, now specific identification would be impossible. Let me get to my point. My point is, we have to have other methods of estimating the value of ending inventory without using specific identification, because again, specific identification is time-consuming, it's expensive, it may not be practical, and it might even be impossible. So there has to be other ways of estimating the value of ending inventory without using specific identification, and that's what we're going to get into next. We're going to look at these different approaches, different methods of estimating the value of ending inventory without using specific identification. And the first method I want to look at is the gross profit method. Companies can use the gross profit method to estimate the value of ending inventory primarily in interim financial statements. That's where you'll see it. Companies can use the gross profit method to estimate the value of their ending inventory in interim statements, quarterly statements. Also, you can use the gross profit method to estimate the value of ending inventory when ending inventory has been destroyed, in a fire or a flood, something like that. That's where it's used. Now, before we do a problem on this method, I want to just take a second and make sure that you're very clear on the difference between a gross profit margin and a markup on cost percentage. I have to make sure that you're comfortable with this difference, because if you're not comfortable with this difference, it can get you messed up. So let me just take a minute and make sure that you are completely comfortable with the difference between a gross profit margin and a markup on cost percentage. I'll just give you a very simple example. Let's say that I'm a business and I only sell one thing. I just sell video cameras. That's all I sell. And let's say that video cameras cost me $1,000 each. All right? So that's all I sell are video cameras. And video cameras cost me $1,000 each. And let's say this year I sold one. Well, if I sold one, we know my cost of goods sold would be $1,000. Now let's say also that I use a 25% markup on cost. What does that mean? If I use a 25% markup on cost, all it means is that I sell merchandise at 125% of what it cost me. That's all it means, that I sell merchandise at 125% of what it cost me. So what would my sales be? 125% of 1,000 or 1,250. That's really all that means. But notice this. If my sales are 1,250, my cost of goods sold is 1,000, notice my gross profit is $250. So it turns out I made a $250 gross profit on a $1,250 sale, take 250 over 1,250, my gross profit percentage, my gross margin, is 20% of sales. And of course, you know what gross margin means. If you see a gross profit percentage, a gross margin, 20%, that means 20% of my sales is gross profit. If I take 20% of 1,250, it gets me back to 250. And another thing I know, if my gross profit percentage is 20% of sales, my cost of goods sold is 80% of sales, because that's always a function of 100. If I take 80% of 1,250, it gets me back to 1,000. Because if gross margin is 20% of sales, cost of goods sold has to be 80% of sales. I'm leading to a point. I want to make sure that if you had to, in the exam, you could convert from a markup on cost percentage to gross profit and cost of goods sold. Trust me, it's a handy thing to be able to do. So I just want to take a minute and make sure that you're in the exam, you're able to quickly convert. If the exam gives you a markup on cost percentage, you can go to gross profit, cost of goods sold. So you might want to jot this down. Make sure it's in your notes. When you're going to use this shortcut, you're going to use this shortcut if the exam gives you a markup on cost percentage, but you want to know gross profit. You want to use, and you want to know cost of goods sold. Here's the shortcut. Just take the markup and divide by 100 plus the markup. That's all you have to do. Take the markup and divide by 100 plus the markup. So you see how it would work in this problem. This company's markup on cost was 25%. So what I would do in the exam is take 25 over 125. 25, remember, it's the markup over 100 plus the markup. So I would take 25 over 125, which is 1/5. I know that 1/5 of sales would be gross profit. 4/5 of sales would be cost of goods sold. You just can't do it faster than that, right? 25 over 125 is 1/5, or 20%. 20% of sales would be gross profit. 80% of sales would be cost of goods sold. Let's do another one. What if you're in the exam and they say a company uses a 50% markup on cost? What can you quickly do? If they use a 50% markup on cost, take 50 over 150. Remember, it's the markup over 100 plus the markup. So you would take 50 over 150, which is 1/3. You know that 1/3 of sales would be gross profit. 2/3 of sales would be cost of goods sold. You just can't do it faster than that. Let's do another one. You're in the exam. They say a company uses a 20% markup on cost. Well, if they tell you that a company uses a 20% markup on cost, you're going to take 20 over 120. 20 over 120 is 1/6. I just always use fractions. 20 over 120 is 1/6. I know 1/6 of sales would be gross profit. 5/6 of sales would be cost of goods sold. Just a very handy thing to be able to do quickly. So with that in mind, let's go to a problem. If you look in the viewer's guide, we have a little problem on the gross profit method. We're told that this company's beginning inventory, $200,000. Purchases during the year, $450,000. Sales during the year, $500,000. And this company does use a 25% markup on cost. Notice the ending inventory was destroyed in a fire. So the question in the exam would be, what's the fire loss? If your ending inventory was destroyed in a fire, what's your fire loss? Or what was the value of ending inventory before the fire? Well, I'll tell you what I like with this. If you get a problem like this in the exam, I'm a big believer in use what you know. Right away, if I had a problem like this, I would go to my scrap paper and put down the skeleton of cost of goods sold. As I say, I'm a big believer in, use what you know. So, you're in the exam, you know the format of cost of goods sold, why not use it? So let's say you go to your scrap paper, just put the skeleton down for cost of goods sold. We know that's beginning inventory plus purchases equals goods available for sale, less ending inventory equals cost of goods sold. So we get that down. Now let's fill it in as far as we can. In this problem, do we know beginning inventory? It's given, 200,000. Do we know the purchases? It's given, 450,000. So we know goods available for sale would be 650,000. Do I know the ending inventory? No. It was destroyed in a fire. I don't know that. It was destroyed. How about cost of goods sold? I can figure it out, can't I? See, I don't know cost of goods sold, but I can figure it out. Let me ask you a question. If this company uses a 25% markup on cost, wouldn't cost of goods sold be 75% of sales? Let me ask you that again. Because this company uses a 25% markup on cost, wouldn't their cost of goods sold be 75% of sales? No. That's the mistake a lot of students make. See, the problem with that is you're treating that markup on cost like a gross margin. It's not a gross margin. It's a markup on cost percentage. So how do we convert from a markup on cost percentage back to gross profit, back to cost of goods sold? Let's do it. We're going to take the markup, 25 over 100 plus the markup. 25 over 125 is 1/5. I know that 1/5 of sales, or 20%, would be gross profit. 4/5 of sales, or 80%, would be cost of goods sold. If I take 80% of 500,000, I know cost of goods sold would be 400,000. Let me just do that again. I took the markup, 25 over 125. 25 over 125 is 1/5. 1/5 of sales, or 20%, would be gross profit. 4/5, or 80% of sales, would be cost of goods sold. So I take 80% of 500,000, I know cost of goods sold would be 400,000. Now I can solve it. If goods available for sale totaled 650,000 and cost of goods sold is 400,000, ending inventory had to have a value of 250,000. There's your fire loss. That's the value of ending inventory before the fire. In other words, how much from 650 would give me 400,000? Or just subtract the 400,000 from the 650. But you can plug the ending inventory, and it must have had a value of 250,000. That must have been the value of ending inventory before the fire. That must be your fire loss. It's just a way of estimating the value of ending inventory without using specific identification. I'd like you to try a couple more questions. I'd like you to shut the class down, do questions 3 and 4, and then come back. Welcome back. Let's do 3 and 4 together. In number 3, we have a flood. It's destroyed the inventory, and they want to know what amount of inventory was lost in the flood. And this is a classic case of where we would use the gross profit method. And you know I like the skeleton of cost of goods sold. So you're in the exam, go to your scrap paper, put down the skeleton of cost of goods sold, and let's fill it in as far as we can. We know beginning inventory, it's given, 35,000. We know the purchases during the year, 200,000. So we know goods available for sale, 235,000. Now we don't know ending inventory because it was destroyed in a fire. But we can figure out cost of goods sold. Notice the gross profit margin is 40% of sales. Well, if gross margin is 40% of sales, cost of goods sold is 60% of sales. That's a function of 100. It does make it a little easier when the exam does not give you a markup on cost percentage. They just give you a gross margin. Hey, gross margin is 40% of sales. Cost of goods sold is 60% of sales. So I'm going to take 60% of 250, the sales. Cost of goods sold must be 150,000. Now I can solve it. If goods available for sale totaled 235,000 and cost of goods sold was 150,000, ending inventory must have had a value of 85,000. But it's not answer B. Be careful. They said what amount of inventory was lost in the flood. Now it's true that the value of ending inventory before the flood was 85,000. They said that 30,000 of inventory was not damaged by the flood. So 55,000 of inventory must have been lost in the flood. And the answer is A. In number 4, they want to know what would be purchases. Well, here again, this is another case. Something's missing from cost of goods sold. Use what you know. Go right to your scrap paper, put down the skeleton of cost of goods sold. We know beginning inventory, it's given, 30,000. We don't know purchases. That's what's missing. We don't know goods available for sale. We do know ending inventory was 18,000. Do we know cost of goods sold? Sure, we can figure it out because if the gross margin is 20% of sales, cost of goods sold must be 80% of sales. That's a function of 100 every time. So take 80% of 275,000. Cost of goods sold must have been 220,000 because if gross margin is 20% of sales, cost of goods sold must be 80% of sales. So I took 80% of 275,000. Cost of goods sold must have been 220,000. So now we just basically work backwards. If cost of goods sold is 220,000, ending inventory was 18,000, available must have been 238,000. Now, if beginning inventory was 30,000 and available was 238, purchases must have been 208. Answer B. Anytime something's missing from cost of goods sold, get the skeleton down of cost of goods sold and start to work with it. Start to fill it in. Continuing with our discussion on different methods of estimating the value of ending inventory without using specific identification. Of course, another way to estimate the value of ending inventory without using specific identification is to make an assumption about the way inventory costs are flowing. And there are basically three. It's either going to be first in, first out, or FIFO, last in, first out, or LIFO, or weighted average. Let's start with FIFO. I'm sure you know that if a company chooses a first in, first out cost flow assumption, they are assuming the first merchandise purchased is the first to be sold. First in, first out. But what's very important is to make sure you're comfortable with the impact on the financial statements from choosing FIFO. Just think about it for a minute. If I'm going to make an assumption that the first merchandise purchased is the first to be sold, first in, first out, then my older merchandise prices are going to be in cost of goods sold on the income statement. My most recent merchandise prices will be in inventory on the balance sheet. That's the impact on your statements. If you're assuming that the first merchandise purchased is the first to be sold, first in, first out, that effect would be that older merchandise prices would be in cost of goods sold on the income statement. My most recent merchandise prices would be in inventory on the balance sheet. So let's think about this. How do we feel about the balance sheet? Pretty strong, because the argument would be, because your most recent merchandise prices are in inventory on the balance sheet, your balance sheet does reflect the type of current financial resources that the company has invested in merchandise. The balance sheet is very well served by FIFO, and I know you're with me. If you want to attack FIFO, you go to the income statement. The problem with FIFO is that cost of goods sold on the income statement is made up of older merchandise prices, and they may not be relevant anymore. You have to argue that the company could be in a period of dramatically changing merchandise prices, whether it's inflation, deflation. That's the problem, that there could be dramatically changing merchandise prices. And now, cost of goods sold on the income statement is made up of older merchandise prices. And as I say, they may not be relevant anymore. And you know where I'm leading with this. The matching concept. Our objective on an income statement is to have a proper matching between this year's sales and this year's expenses, right? That's our objective on an income statement. That's the matching concept. Having a proper matching between this year's sales and this year's expenses. Well, with FIFO, you're not doing that. With FIFO, on your income statement, you end up matching this year's sales with older merchandise prices that may not be relevant anymore. I want you to remember that FIFO does cause a distortion in the matching concept. And that all makes a lot of sense when you remember the bottom line. The bottom line is that FIFO is a balance sheet method. FIFO, bottom line, is a balance sheet method. Why? Because the recent merchandise prices are on the balance sheet. The balance sheet does reflect the type of current financial resources that the company has invested in merchandise. Let's go to LIFO. Now, when a company chooses a last in, first out cost flow, now they're assuming that the last merchandise purchased is the first to be sold. Last in, first out, LIFO. And really, in every respect, LIFO is the exact opposite of FIFO. So think about the impact on the financial statements. If I'm going to assume that the last merchandise purchased is the first to be sold, well, now my most recent merchandise prices are in cost of goods sold on the income statement. Older merchandise prices are in inventory on the balance sheet. So how do we feel about the income statement? Very strong. Because now my income statement is matching current sales, this year's sales, with this year's merchandise prices. Cost of goods sold is made up of my most recent merchandise prices. So LIFO is very consistent with the matching concept, because now in our income statement we are matching this year's sales with this year's merchandise prices. And of course, if you want to attack LIFO, you go to the balance sheet. The problem with LIFO is inventory on the balance sheet is made up of older merchandise prices. They may not be relevant anymore. As I say, a company could be in a period of hyperinflation, deflation. And the problem with LIFO is, on the balance sheet, your inventory basically gets older and older and older and more out of date. It can get to the point where your balance sheet does not reflect in any way the type of current financial resources that the company has invested in merchandise. And it all makes perfect sense when you remember the bottom line. LIFO is an income statement approach. Remember that basic difference. FIFO is a balance sheet method. Why? Because the recent prices are on the balance sheet. LIFO is an income statement method. Why? Because the recent prices are in cost of goods sold on the income statement. That is the essential difference. FIFO is a balance sheet approach. LIFO is an income statement approach. I'd like you to try a couple of questions. Try 5 and 6 and come back. Welcome back. Number 5 says a company decides to change their inventory valuation method from FIFO to LIFO, notice, in a period of rising prices. If you go from FIFO to LIFO in a period of inflation, what's the effect on ending inventory? What's the effect on net income? Well, just think about this. FIFO, let's think about ending inventory. Don't we know that FIFO is a balance sheet approach? So with FIFO, the recent prices are on the balance sheet in inventory, and the recent prices are higher because it's a period of rising prices. So if you go from FIFO to LIFO, in terms of the balance sheet, aren't you going from recent prices under FIFO, which are higher, to older prices under LIFO, which are lower? Inventory is going down. So you want decrease under that column. How about net income? Well, with FIFO, older prices are in cost of goods sold. So you're going from older prices in cost of goods sold to newer prices under LIFO in cost of goods sold. So the newer prices are higher, cost of goods sold is higher, net income is lower. And the answer is C, decrease under both. Number 6, generally, which inventory costing method approximates most closely the current cost for what? Cost of goods sold, ending inventory. What's going to approximate current cost for cost of goods sold? We know it's going to be LIFO, because LIFO is an income statement approach. The recent prices are in cost of goods sold. For ending inventory, you want FIFO, because FIFO is a balance sheet approach. Recent prices are on the balance sheet in ending inventory. So the answer is A. Let's talk about weighted average. Let me give you the formula for a weighted average cost per unit. If you want to figure out a weighted average cost per unit, you simply take cost of goods available for sale and divide by the number of units available for sale. That's the formula for a weighted average cost per unit. It's simply cost of goods available for sale divided by the number of units available for sale. So if I just make up some numbers, if my cost of goods available for sale was $120,000 and I had 10,000 units available for sale, then my weighted average cost per unit would be $12. So if at year end I have 1,000 units in my ending inventory times $12, my weighted average cost per unit, my ending inventory would be valued at $12,000. That would be the proper valuation of the ending inventory, $12,000, under weighted average. Now, one thing I worry about, don't confuse a weighted average with a moving average. Let me show you a moving average. Let's say we start January 1. I've got 1,000 units in my beginning inventory valued at $2 each, so my beginning inventory is valued at $2,000. Then let's say on February 3rd, we purchase 500 units for $5 each. Well, if I purchase 500 units for $5 each, that's a $2,500 purchase. Add that to my beginning inventory, $2,000. Now I have $4,500 invested in inventory. Divide by the 1,500 units on hand on that date. My weighted average cost per unit as of February 3rd is $3. See, that's the key to a moving average. In a moving average, every time you purchase units, you strike a new weighted average cost per unit on that day. So if on February 23rd you sell 200 units, they get costed out at that unit price. So if on February 23rd we sell 200 units, they get costed out at $3 a unit. So my inventory would drop $600 from $4,500 down to $3,900. Let's say on March 4th, we purchase another 300 units for $11 each. Well, if we purchase another 300 units for $11 each, that's a $3,300 purchase. Add that to my inventory balance at that point, $3,900. Now I have $7,200 invested in inventory. How many units do I have? Well, I had 1,500 units. I sold 2. That brought me down to 1,300. Then I'd purchase 300. I have 1,600 units divided into $7,200 invested. My weighted average cost per unit as of March 4th would be $4.50 per unit. As I say, the key to a moving average is every time you purchase units, you strike a new weighted average cost per unit on that day. And of course, you would use a moving average with a perpetual inventory system. You would use a simple weighted average with a periodic system. Remember that. You're going to use a moving average with a perpetual inventory system. You would use a simple weighted average with a periodic system. I'd like you to try 7 and 8 and then come back. Welcome back. Let's do these questions together. In 7 and 8, we're talking about a perpetual inventory system. And in number 7, they say under a moving average, what would be inventory January 31? Well, notice they started January 1 with 1,000 units in their beginning inventory, valued at $1 each. So beginning inventory would be valued at $1,000. Then on January 7th, they purchased another 600 units for $3 each. That's an $1,800 purchase. So now they have what? $2,800 invested in inventory. Divide by the 1,600 units on hand at that date. The weighted average cost per unit as of January 7th is $1.75. As I said, that's the key to a moving average. Every time you purchase units, you strike a new weighted average cost per unit on that day, and now that's $1.75. So on January 20th, when they sell 900 units, they get costed out at that unit price, $1.75. So inventory would drop $1,575. Now you have $1,225 invested in inventory after that drop. Then on January 25th, you purchase another 400 units for $5 each. That's a $2,000 purchase. Add that to the $1,225 you had invested in inventory on that date. The value of inventory as of January 31 would be answer B, $3,225. That's a moving average. Now, number 8 says it's still a perpetual inventory system, but now they use LIFO, last in, first out, with a perpetual inventory system. So let's work it through. Again, they start January 1 with 1,000 units valued at $1 each. Beginning inventory is valued at $1,000. Then on January 7th, they purchase another 600 units for $3 each. That's an $1,800 purchase. But remember, I'm not going to strike a weighted average cost per unit on this day because it's not weighted average. It's LIFO in conjunction with a perpetual inventory system. So if on January 20th they sell 900 units, how do we handle that? Last in, first out. So the 600 units that we purchased back on January 7th, they would go out the door first, last in, first out, and 300 units from our beginning inventory would go out the door. So now what I have on hand after that sale is still 700 units from my beginning inventory, valued at $1 each, 700. So when I purchase the units on January 25th for $2,000, now, again, it's answer B. I have $2,700 invested in inventory as of January 31. What I want to get into next is the retail method. We're continuing our discussion on different ways of estimating the value of ending inventory without using specific identification. And the retail method is used by retailers, obviously. And if you imagine a company like Walmart, Walmart probably has tens of thousands of products all on the shelves, bought at different prices. So specific identification is just not practical, especially for interim financial reporting. So this is the type of company that would use the retail method. Now, before we look at a problem, I'll just tell you that anytime you see a problem on the retail method, there are 2 essential pieces that you have to figure out to solve it. So you might want to just jot these down. Anytime you see the retail method, there are 2 critical pieces to this puzzle. Number 1, you're going to have to calculate the cost to retail ratio. That's number 1. You're going to have to figure out the cost to retail percentage, or the cost to retail ratio. And number 2, you're going to have to figure out ending inventory at retail. Those are the 2 essential pieces of this puzzle. The cost to retail ratio and ending inventory at retail. Let's go to question number 9. Dean Company uses the retail method to estimate their ending inventory for interim financial reporting purposes. Now you see the kind of information that we're given. We know the beginning inventory, February 1, at cost and at retail. We know the purchases at cost and at retail. We know the markups, we know the markdowns, we know the sales, we know the shoplifting losses. Then they say at the bottom, now this is a mouthful, they say, under the approximate lower of average cost or market retail method. As I say, that's a mouthful. Under the approximate lower of average cost or market retail method is another name for this. This is also called in the exam conventional retail. All right, so that's another way to think of this. When you see lower of average cost or market retail, it's conventional retail. So under conventional retail, what is Dean's estimated inventory July 31? Well, as I said, anytime you see a retail question, there are 2 essential pieces you have to figure out. Number 1, you have to figure out the cost to retail percentage or the cost to retail ratio. Let me give you the formula. If you're going to work out the cost to retail ratio, in the numerator, you want goods available for sale at cost. In the numerator, you want goods available for sale at cost. And in the divisor, you want goods available for sale at retail. That's how you figure out the cost to retail ratio. It's goods available for sale at cost divided by goods available for sale at retail. So let's figure it out. If you go to the cost column, we know beginning inventory at cost is $180,000. Purchases at cost, $1,020,000. Just draw a line there. So goods available at cost adds up to $1,200,000. We've got that. Now let's figure out goods available at retail. Now you might want to put a little check mark next to each number I say. I'm going to pick up beginning inventory at retail, $250,000, plus purchases at retail, $1,575,000, plus the markups, $175,000. I'm going to ignore the markdowns. I'll say why in a moment. You add that up, goods available at retail comes out to $2 million. So I think you see my point. If I take goods available at cost, $1,200,000, divide by goods available at retail, $2 million, my cost to retail ratio, my cost to retail percentage is 60%. You need that percentage. So my cost to retail ratio is 60%. Now, just a quick point. Why did I ignore the markdowns? Because anytime the exam says the phrase lower of cost or market in a retail question, when you see that phrase, lower of cost or market in any retail question, it always means the same thing. Put the markups, not the markdowns in the ratio. That's always what it means. When you see the phrase lower of cost or market in any retail question, it always means the same thing. Put the markups, not the markdowns in the ratio. And if you play with it, you'd see why it works out that way. If I put the markups, not the markdowns, in the divisor, remember the markdowns would be a minus. It makes the ratio a little lower. It suppresses it a little bit. What it tries to do by putting the markups, not the markdowns, in the divisor, in the ratio, it tries to suppress the ratio, make it a little lower. It tries to approximate lower of cost of market. But you just have to know that little quirky point, that if they say that phrase, lower of cost of market, in a retail question, they're always telling you to do the same thing. Put the markups, not the markdowns in the ratio, which we did. All right, so we know the cost to retail ratio is 60%. What's the second piece of the puzzle I have to have? Ending inventory at retail, which is a fairly easy number for Walmart to figure out. We know goods available at retail, that's in our divisor, 2 million. Now how do I figure out ending inventory at retail? Take out what they sold, 1,705,000. Take out markdowns. I'm going to take out the markdowns now. I don't ignore the markdowns, they're just not in the ratio. When you see lower of cost of market, markdowns are not in the ratio, but I have to consider them. So back out the markdowns of 125,000. Take out breakage, theft, spoilage, shoplifting, any kind of shrinkage. Back out the 20,000. And we know that ending inventory at retail comes out to $150,000. As I say, that's a fairly easy number for Walmart to figure out. Now, my last step is to say, if my ending inventory at retail is $150,000 and my cost to retail ratio is 60%, then ending inventory at cost must be 60% of $150,000. Answer A, $90,000. That's how it works. If my ending inventory at retail is $150,000 and my cost to retail ratio is 60%, well then ending inventory at cost must be about $90,000. Answer A. It's a way of estimating the cost of what's on the shelves without using specific identification. Now, the last method I want to show you in terms of valuing ending inventory without using specific identification is dollar value LIFO. When a company uses dollar value LIFO, they don't count physical units. They don't care how many physical units they have in inventory. What they count is dollars. In other words, when a company uses dollar value LIFO, 1 unit of inventory to them is $1 invested in inventory. That's how they look at it. $1 invested in inventory is 1 unit of inventory to them. That's really how simple this is. That's dollar value LIFO. I don't count physical units, I count dollars. So when I use dollar value LIFO, $1 invested in inventory is 1 unit of inventory for me. And it really is that simple, but what complicates this is inflation, because the dollar changes as well. So let's go to a problem. In your viewer's guide, you'll see the acute company. It says, the acute company manufactures a single product. On December 31, year 10, acute adopted the dollar value LIFO inventory method. The inventory on that date, using dollar value LIFO, was determined to be $300,000. I think you ought to circle that $300,000 and label it. That's called the LIFO base. So when you converted to dollar value LIFO, you had $300,000 invested in inventory. In other words, you had 300,000 units in inventory, because $1 invested in inventory is 1 unit of inventory to me. That's your LIFO base. I think you also should write down that the base year index is always 1.00. Make sure you write that down. Base year index is always 1.00. You see, in this method, our job is to keep track of inflation since the base year, and you always start with a clean slate. So your base year index is always 1.00, because, again, your job in this approach is to keep track of inflation since the base year, and you always start with a clean slate. Now, if you look at the chart they gave us, inventory data for succeeding years are as follows. A year goes by the end of year 11, we have 363,000 invested in inventory, but notice the price index is now 1.1. That tells you there's been 10% inflation since the base year. At the end of year 12, we have 420,000 invested in inventory, but notice the index is 1.2. That tells you there's been 20% inflation since the base year. And then by the end of year 13, we have 430,000 invested, but now the index is 1.25. That tells me there's been 25% inflation since the base year. They say compute the inventory amounts at December 31, years 11, 12, and 13 under the dollar value LIFO method. Now, this really is a matter of steps, and I think you'll see once we do a couple of years, you just get used to the basic approach, the basic steps. So let's do year 11. A year goes by, right? We get to the end of year 11, we now have 363,000 current dollars invested in inventory. Those are all current dollars. That's what we keep track of. But the problem is, there's been 10% inflation since the base year. Now the index is 1.1. Step one, every time, step one in a problem like this is you divide by the price index to get back to base year dollars. So I'm going to take that 363,000, divide by 1.1. In terms of base year dollars, that comes out to 330,000. So try to remember that. That's always step one. Divide by the price index, and that'll get you back to base year dollars. So if you take that 363,000, divide by 1.1, in terms of base year dollars, that comes out to 330,000. Now listen carefully. How many base year dollars were invested last year? The base, 300,000. So in real terms, when I pull out the inflation, we have more invested in inventory this year than we did last year. What we added this year was a $30,000 layer. You have to be able to find that layer. That's a big part of it. All right, now, if you're with me on how I found the layer, now the most important thing. What do I take to my balance sheet for inventory at the end of year 11? What I'll take to my balance sheet for inventory at the end of year 11, I've got my base, 300,000. I haven't touched that. But now I've added a 2011 layer of 30,000 times 1.1. You have to remember that in dollar value LIFO, every layer is valued at its own index. Again, in dollar value LIFO, every layer is valued at its own index. Why? Because if we did add to inventory, we added this year's dollars. We can't add old dollars. It's not possible. See, what we did this year is we added 33,000 current dollars to what we already had invested. What I'll take to the balance sheet at the end of year 11 is 333,000. That is the proper valuation of the ending inventory under dollar value LIFO. Let's do another year, see if it gets more comfortable for you. Another year goes by. We get to the end of year 12. We now have 420,000 current dollars invested in inventory. That's what they keep track of in this approach. What's the current dollars we have invested? 420,000. But the problem is, there's been 20% inflation since the base year. Notice the index is 1.2. What's my first step every time? I always divide by the price index to get me back to base year dollars. So I'm going to take that 420,000, divide by 1.2. In terms of base year dollars, that comes out to 350,000. Now be careful. How many base year dollars were invested last year? 330, not 300. Don't go back to the base. A lot of students do that. No, the question is, how many base year dollars were invested last year? 330,000. So in real terms, we added another $20,000 layer. You've got to be able to find that layer. Now, if you're with me on that, now the most important thing. What do we take to the balance sheet for our inventory at the end of year 12? Well, we've got the base, 300,000. We haven't touched that. We've got the year 11 layer of 33,000. That hasn't been touched. But now I've added a year 12 layer of 20,000 times 1.2. That comes out to 24,000. Every layer gets valued at its own index. Because again, if we did add to inventory, we added this year's dollars. We can't add old dollars. It's not possible. What we did this year is add 24,000 current dollars to what we already had invested. What we'll take to the balance sheet at the end of year 12 is 357,000. That is the proper valuation of the ending inventory under dollar value LIFO. Let's do another year. Another year goes by. We get to the end of year 13. We now have 430,000 current dollars. Those are all current dollars invested in inventory. But the problem is, there's been 25% inflation since the base year. You know step one, we always divide by the price index to get us back to base year dollars. So I'm going to take that 430,000. I'm going to divide by 1.25. In terms of base year dollars, that comes out to 344,000. How many base year dollars were invested last year? 350. So in real terms, inventory's gone down. I hope you see what just happened there. When I divide that 430,000 by 1.25, in terms of base year dollars, that comes out to 344,000. Last year I had 350,000 base year dollars invested. So in real terms, when I pull the inflation out, we have less invested in inventory this year than we did last year. There's been a $6,000 decline. I hope you see how to find that decline. All right, so now that we have the decline, what you're about to see is why they call this dollar value LIFO. Remember, this is not just called the dollar value method. It's called dollar value LIFO. You know why it's called LIFO? Because if inventory ever goes down, as it did here, the last layer you added is the first one you begin to cost out. Last layer added is the first one you begin to cost out. Last in, first out. So now you're seeing the LIFO aspect to it. Because if inventory ever goes down, last layer that was added is the first one you begin to cost out. So with that in mind, what do I take to my balance sheet for inventory at the end of year 13? Well, I've got my base, 300,000. That hasn't been touched. I've got my year 12 layer of 33,000. Hasn't been touched. But that year 12 layer, the year 12 layer that was 20,000 base dollars times 1.2, dropped 6,000 base dollars to 14,000 base dollars times 1.2. That layer is now valued at 16,800. You see what happened there? When inventory drops, the last layer that you added is the first one you begin to cost out. So that 2012 layer that was 20,000 base dollars times 1.2 drops 6,000 base dollars to 14,000 base dollars times 1.2. Every layer gets valued at its own index. So that layer is now valued at 16,800. So what do I take to my balance sheet for inventory at the end of year 13? My base, 300,000, the 2011 layer of 33,000, and now the year 12 layer is down to 16.8, 349,800. That will be the proper valuation of the ending inventory under dollar value LIFO. It's, I think, one of those approaches that once you do a few years, you start to get used to it. Now, one little wrinkle I have to mention. If you look at how they set this problem up, we know that the base year index is always 1.00 because our job in this approach is to keep track of inflation since the base year. So when they told me the index at the end of year 11 was 1.1, that told me there was 10% inflation since the base year. When I got to the end of year 12, the index was 1.2. That told me there was 20% inflation since the base year. And when I got to the end of year 13, index is 1.25. That told me there was 25% inflation since the base year. Now listen carefully. When they give you in your index the inflation since the base year, there's a name for that. That's called the double extension approach. So that's called the double extension approach to dollar value LIFO, when they give you the inflation since the base year. And I'll tell you that normally the exam will give you the double extension approach. That's what they seem to like, the double extension approach, where they give you in the price index the inflation since the base year. But I have to warn you on this. They could give you each year's inflation. Let me show you what you'd have to do. What if, I'll use the same numbers. We get to the end of year, first of all, we know. And by the way, the name for this is called the linked chain approach. When they give you each year's inflation, that's called the linked chain approach to dollar value LIFO. And the exam might throw a curve at you, and that's what I'm worried about. Again, normally the exam likes the double extension approach to dollar value LIFO, where they just give you the inflation since the base year. But if they start giving you each year's inflation, that's called the linked chain approach to dollar value LIFO. And I'll use the same numbers. Now, as always, we know the base year index is always 1.00. That never changes. Because again, our job in this approach is to keep track of inflation since the base year. Now, we get to at the end of year 11. Now, there's been 10% inflation since the base year. Now the index is 1.1. Well, that first year wouldn't be any different. That's the index I'd use. I would use 1.1. Now, where it gets different is at the end of year 12. Now they're saying there's been 20% inflation in the last year. That's what the exam would have to tell you, that there's been 20% inflation just for year 2. So how do I figure out the inflation since the base year? I'd have to multiply 1.1 times 1.2. I'd have to multiply 1.1 times 1.2. So my index for year 12 would be 1.32. I multiply 1.1 times 1.2. That's what you have to do. Take last year's index, 1.1, times 1.2. So that would give me the index of 1.32. There's been 32% inflation since the base year. That's the index. All the other steps would be the same, but that's the index I would use, 1.32. What if they told me that there was 25% inflation in the next year, year 13? Well, if there was 25% inflation in year 13, they're just giving me that year's inflation. Well, how do I figure out the inflation since the base year? Multiply that 1.25 times 1.32. And that would tell me the index would be 1.65. There's been 65% inflation since the base year. It's just one more step you have to work in. If it's linked chain, they're just giving you each year's inflation, so you have to do that extra step to figure out the index that you need. I don't know whether the exam would throw that at you or not. Normally what the exam likes is the double extension approach. I'd like you to please do 10 and 11 and then come back. Welcome back. Let's do these questions together. And number 10, they say Walt adopted the dollar value LIFO inventory method as of January 1 of the current year when the inventory was valued at $500,000. You know what that is. That's your LIFO base. And you also know that the base year index is always 1.00. You always start with a clean slate in this method, and you keep track of inflation since the base year. Walt's entire inventory constitutes a single pool using the relevant price index of 1.1. So a year's gone by, there's been 10% inflation since the base year. Now the index is 1.1. Walt determined that at December 31, inventory was valued at $577,500 at current year cost. That's what they keep track of. The current dollars they have invested in inventory. And now they have $577,500 invested in inventory, and you know the basic process. Step 1, every time, is to divide by the price index, get back to base year dollars. So I'm going to take that 577.5, divide by 1.1. In terms of base year dollars, that comes out to 525,000. And notice they did that for you. They did that division for you, really. But the point is, in real terms, we've added more to inventory because last year we had 500,000 base year dollars invested. Now we have 525. So in real terms, when I pull the inflation out, we have more invested in inventory this year than we did last year. What we added this year was a $25,000 layer. But now the important question, what do we take to the balance sheet as our inventory at December 31 of the current year? Well, we've got our base, 500,000, hasn't been touched. But we've added a $25,000 layer times 1.1. Because remember, in dollar value LIFO, every layer is valued at its own index. Because if I did add to inventory, I added this year's dollars. I can't add old dollars. It's not possible. So what I added this year was 27,500 current dollars to what I already had, my base, 500,000. What I'll take to the balance sheet at the end of the year for inventory will be answer B, 527.5. That is the proper valuation of the ending inventory under dollar value LIFO. Look at number 11. January 1st, year 1, PO adopted the dollar value LIFO method. Inventory data for years 1 and 2 follow. Notice the day they adopted dollar value LIFO, they had $150,000 invested in inventory. They don't count units, they count dollars, and that's the LIFO base. And notice the base year index is given, and it's always 1.00, because that's our job, to keep track of inflation since the base year. And we always start with a clean slate. Now a year goes by, at December 31, year 1, we now have 220,000 invested in inventory. But there's been 10% inflation since the base year. So we always divide by the price index to get back to base year dollars. And if you divide that 220,000 by 1.1 in terms of base year dollars, that comes out to 200,000. They did that for you. But notice, last year we had, or a year ago, we had 150,000 base year dollars invested. So in real terms, we've added a $50,000 layer. Same thing with year 2. We get to the end of year 2, we have 276,000 invested in inventory. But there's been 20% inflation since the base year. So I take that 276,000, divide by 1.2 in terms of base year dollars, that comes out to 230,000, which they did for you. How many base year dollars were invested last year? Last year, 200,000. So in real terms, in year 2, we added another $30,000 layer, but now the important question. What would be the inventory taken to the balance sheet December 31, year 2? Well, we've got our base, 150,000, not touched. We've got our year 1 layer of 50,000 times 1.1. We added 55,000 year 1 dollars to what we already had. And then we have our year 2 layer of 30,000 times 1.2. We added 36,000 year 2 dollars to what we had. Every layer is always valued at its own index. Add it all up. Add up the base, 150,000. The year 1 layer, 55,000. The year 2 layer, 36,000. What we take to the balance sheet is answer C, 241,000, the proper valuation of the ending inventory under dollar value LIFO. Let's move on to something else. What I want to get into next is fixed assets. Now, you know, when we say fixed assets, we're talking about land and buildings and machinery and equipment and furniture and fixtures. But to be more precise, always remember that when we're talking about fixed assets, we're talking about capital expenditures, meaning these are expenditures that benefit more than one accounting period, as opposed to what? Revenue expenditures. You know, revenue expenditures only benefit the current period. I pay my telephone bill. That's a revenue expenditure. Only benefits the current period. But fixed assets represent capital expenditures in that they are expenditures that benefit more than one accounting period. And by the way, that's where the word capitalize comes from. Now, in terms of fixed assets, there are a lot of things the exam can get into. Fixed assets are a fairly heavily tested area. There's a lot of picky areas they can get into with fixed assets. Here's the first thing they like to get into. What costs do we capitalize to fixed asset accounts? In other words, over and above the cash price you pay for an asset, what costs do you capitalize for fixed asset accounts? Well, what you're dealing with here is a rule. Let me just give you the rule. The rule is that for fixed assets, we must capitalize all the costs we incur to bring that fixed asset into a condition and location for use. That's known as the condition and location for use rule, because for fixed assets, over and above the cash price you pay for an asset, we must capitalize all the costs we incur to bring that fixed asset into a condition and location for use. So let me give you some examples. Machinery and equipment. Over and above the cash price you pay for machinery and equipment, you have to capitalize freight charges, insurance during transit, installation charges, and don't forget if there's a testing period. If there's a testing period before you put machinery and equipment into production, all the costs that you incur during that testing period would all be capitalized to the machinery and equipment account. How about land? What costs are you going to capitalize to a land account? You know, over and above the cash price you pay for the land, which is obvious. But for land, you're going to capitalize attorney's fees. Now be careful, they could call it title search. Costs for grading the land, clearing the land, draining the land, surveying the land. These are all costs that you capitalize to a land account, because these are costs you incur to get the land in a condition for use. So attorney's fees, title search, grading, clearing, draining, surveying the land, all these costs get capitalized to the land account. How about a building? Well, for buildings, over and above the cash price you pay for the building, you're going to capitalize architect's fees, engineering fees, and building permits, things like that. All get capitalized to the building account. And while we're talking about buildings, there's one more thing you should be aware of, and that is capitalized interest. Let's talk about capitalized interest. Here's the point. If a company borrows money to construct a building or any asset, I want to emphasize that capitalized interest does not just relate to buildings. It applies to any asset the company is constructing for its own use. But back to my point. If a company borrows money to construct a building or any asset, they must capitalize interest during the period of construction. That's the requirement, that we must capitalize interest during the period of construction. This is another cost that gets capitalized to fixed asset accounts. You must capitalize interest during the period of construction. Let's go to a problem. Number 12. Says her has a fiscal year ending April 30th. On May 1 of the previous year, her borrowed $10 million at 15% interest to finance the construction of a building. Repayments of the loan are to be commenced in the month following completion of the building. During the current year, ended April 30, expenditures for the partially completed structure totaled $6 million. So notice, $6 million of the $10 million that they borrowed has been spent on construction costs in the first year. And you might want to underline, it's an important point, the expenditures were incurred evenly. That's an important point. They were incurred evenly throughout the year. They say interest earned on the unexpended portion amounted to $400,000, and they want to know what you'd capitalize for interest. Now, I want you to see that there's a couple of ways students might be tempted to go here. They might go, well, what's capitalized interest? Take the interest rate, 15%, times the borrowing, $10 million, and say, well, it's $1.5 million. No, that's not how it's done. Or some students might go, well, it's the interest rate, 15%, times the borrowing, $10 million. That's $1.5 million minus the $400,000 of interest income they earn on the unexpended funds. That's $1.1 million. That gives you answer D. That's not it either. You might think, well, maybe it's the interest rate, 15%, times the construction cost, $6 million. That's $900,000. That's not it either. Because as you would probably guess, there's a trick to this. You knew there would be. The trick is this, that what the company must do is capitalize interest on average expenditures. That's what they must do. Capitalize interest on average expenditures. So here's how you do capitalized interest. When you're going to do capitalized interest, you don't look at the borrowing. you do look at the construction costs of $6 million. That's what you look at. Why? Because the argument is that they now have $6 million of borrowed money in this project. That's the basic argument, that they now have $6 million of borrowed money in the project. And because they said that we must capitalize interest on average expenditures, there's one more adjustment we need to make. Now listen carefully. As long as those construction costs are incurred evenly, and notice they said they were, and I think realistically in the exam they would be. If they tell you that the construction costs were incurred evenly through the year, you just take that $6 million, divide by 2. If you divide by 2, that gives you an estimate of your average expenditures. So the average expenditures would be $3 million times the interest rate 15%, and the answer is C. Your capitalized interest would be $450,000. Notice we don't worry about that interest income earned on the unexpended funds. That's just interest income. That doesn't play into it because it doesn't alter the fact that we have $6 million of borrowed money in this project. And as I say, as long as the construction costs are incurred evenly through the year, you just divide by 2. And that'll give you an estimate of your average expenditures, $3 million times the interest rate 15%, and that gives you the capitalized interest, which is answer C. Now, I think the exam would probably do that. I think more than likely they'd have the construction costs incurred evenly, but what if they didn't? Let's go to the second year. What if we now get into the second year? Let me show you what happens. When we go to the same problem, if we got into the second year, do you see what happens? The $6 million of borrowed money that we have in the project from year 1 would still be invested for all 12 months of year 2, right? The $6 million of borrowed money that we have in the project from year 1 would still be in the project for year 2 and be invested for all 12 months of year 2. Now let's say, in addition to that $6 million, they incur another $1,200,000 of construction costs on March 1. Well, if they incur another $1,200,000 of construction costs on March 1, that borrowed money is going to be in the project for 10 months. I'm assuming a calendar year here. So if they incur another $1,200,000 of construction costs on March 1, assuming a calendar year, well, that borrowed money would be in the project for 9 months. March, April, May, June, July, all the way through December. So that borrowed money would be in the project for 10 months, from March 1 to the end of December. You'd give it a weight of 10/12. That would be $1 million of average expenditures. Let's say they incur another $1,200,000 of construction costs on October 1. Well, that borrowed money would be in the project for October, November, December, 3 months. So I'd give it a weight of 3/12, a quarter. That's another $300,000 of average expenditures. So what would be your average expenditures for the second year? The $6 million of borrowed money from year 1 that would carry over to year 2, plus $1 million, plus $300,000. My total average expenditures for the second year would be $7,300,000 times the interest rate, 15%. That's how you would do it the following year. So I'm just pointing out that if they don't say that the construction costs are incurred evenly, then you have to weight the borrowed money by how many months it's been in the project. So, if at the halfway point of the year they put some borrowed money in the project, you give it a weight of a half times the interest rate. If they put so much borrowed money into the project after 9 months, well, that borrowed money would be in the project for 3 months. Give it a weight of 3/12. So if they don't say that the construction costs are incurred evenly, then you have to weight the borrowed money by how many months it's been in the project. I'm not sure the exam would do that, but you never know. I think more than likely they'll just say those construction costs are incurred evenly. If they're incurred evenly, you just divide by 2. That gives you an estimate of your average expenditures, in this case $3 million times 15%. So capitalized interest would be answer C, $450,000. Let's look at number 13. 13 says a company is constructing an asset for its own use. Construction began the previous year. The asset is being financed entirely with a specific new borrowing. Construction expenditures were made last year and this year at the end of each quarter. The total amount of interest cost that would be capitalized in the current year would be determined by applying the interest rate on the borrowing times what? Well, it's not A, total expenditures. It's not D, total expenditures. It's always the interest rate times average expenditures. But here's what you had to think about. Is this C? Would it be the average expenditures for the asset just for the current year? Or B, the average expenditures for the asset for both years? It would be B. it would be B. You see why? Because, as in my example, the $6 million of borrowed money that was in the project in the first year would carry over and still be invested for the second year. That's why you have to consider both years. Because in the example I gave you, that $6 million of borrowed money from the first year of the project would still be invested for the entire year of the second year of the project. That's why you have to consider the borrowed money for both years. That's why the answer is B, not C. It's a tricky point. What I want to get into next is how you handle improvements to fixed assets. How do we handle improvements? And I think you know what the issue is. If we make an improvement to a fixed asset, we paint something, we replace a gear. The exam gets very picky on this. You make an improvement to a fixed asset, I think you know. The basic issue is, should we capitalize that improvement or should we expense that improvement? That's the question, isn't it? We make an improvement to a fixed asset. Is that improvement capitalized or is it expensed? Well, I want to start with some categories because you'll see when you do questions on this that sometimes in the exam it comes down to terms. So let's go over some terms. The first term you might see is betterments. An example of a betterment would be putting a new roof on a building. Just remember, betterments are always capitalized. What I'm saying is, if the CPA exam calls something a betterment, don't argue with it. Betterments are always capitalized. Again, for example, you put a roof on a building, a new roof on a building. That's a betterment. And betterments are always capitalized. And again, my point is, if the CPA exam calls something a betterment, you don't argue with it. It's got to be capitalized. Another category, watch out for additions, extensions, enlargements. An example would be putting a new wing on a building. Just remember that additions, extensions, enlargements are always capitalized. My point being that if the CPA exam calls something an addition, if they call something an extension, if they call something an enlargement, you don't argue with it. It's got to be capitalized. Has to be. And then the last category would be extraordinary repairs. Example would be putting a new motor in your machine, putting new motors in all your machines. These are extraordinary repairs. Just remember, extraordinary repairs are always capitalized. My point again is that if the CPA exam calls something an extraordinary repair, you don't argue with it. It's got to be capitalized automatically. So watch out for these terms. Sometimes in the exam, it really comes down to terms, how the exam refers to something. That'll tell you that it has to be capitalized, but as I've already said, the exam gets very picky on this. And I'm going to give you a rule that should answer whatever they dream up. Here's a rule you can always lean on. Just remember, you must capitalize an improvement if it does any one of four things. Again, you must capitalize an improvement if it does any one of four things. Number one, if it extends the useful life of the asset. If it extends the useful life of the asset, capitalize. Or if the improvement increases the number of units produced by the asset, capitalize. All right, so if the improvement extends the useful life of the asset, capitalize. Or if the improvement increases the number of units produced by the asset, capitalize. Or if an improvement increases the quality of the units produced by the asset, capitalize. If the improvement increases the quality of the units produced by the asset, capitalize. One more. If the improvement increases the efficiency of the asset, capitalize. So remember, any one of those four conditions met. If it extends the life, increases the number of units produced, increases the quality of units produced, or increases efficiency, you have to capitalize. And a quick way to remember it, just remember QUEEN, Q-E-E-N. Quality increased, extends life, efficiency increased, number of units increased. Just remember QUEEN. Any one of those four conditions are met, you automatically capitalize. And of course, if none of those conditions are met, expensive. That should answer whatever they dream up. I also want to talk about how we handle impairments to long-lived assets and also intangibles. How do we handle an impairment to a long-lived asset or an intangible? Well, when you're talking about impairments to long-lived assets or intangibles, there's really three broad categories. First, there are long-lived assets or intangibles that are held for use. That's the first category. If you have long-lived assets or intangibles that are held for use, how do you know they're impaired? Well, you know that a long-lived asset or an intangible you're holding for use, you know it's impaired if the carrying value on the books is greater than any expected future cash flows from that asset. That's how you know it's impaired. If the carrying value on the books is greater than any expected future cash flows from that asset, you know, what you could sell it for, you know it's impaired. If it's impaired, what do? You're going to debit a loss, take a loss to the income statement, and credit the asset. You're going to write the asset down to fair value. That's what you're supposed to do. If the carrying value on the books is greater than any expected future cash flows from that asset, what you could ever sell it for, then that asset is impaired. So you debit a loss, take that loss to the income statement, credit the asset, write it down to fair value. What you're doing is writing the asset down to fair value, and that fair value becomes the new basis of the asset. And that new basis will be depreciated over the asset's remaining life. Don't touch prior periods. No, that new basis would simply be depreciated over the asset's remaining life. And what if it recovers? What if it recovers in value? Recoveries are not recorded. So if it recovers in value, it's not recorded. Now, the second category would be long-lived assets or intangibles held for sale. That's the second category. Long-lived assets or intangibles held for sale. What does held for sale mean? Sale is probable within 12 months. So when I say we have long-lived assets or intangibles held for sale always means sale is probable within 12 months. Now, how do we know if a long-lived asset or intangible that's held for sale, how do we know it's impaired? It's impaired if the carrying value on the books is greater than the selling price minus any cost to sell. If the carrying value on the books is greater than the selling price minus any cost to sell. In other words, if the carrying value on the books is greater than what you're going to net out of that sale, it's impaired. So what do? Same entry. Debit a loss. Take a loss to the income statement, credit the asset, write it down to fair value, and depreciation would stop. Now depreciation would stop. Now there's a third category. The third category would be long-lived assets or intangibles held for disposal other than by sale. Now when I say other than by sale, we're saying it could be an asset that you might abandon. You could intend to exchange it for another asset, distribute it to owners. You do have that third category. Long-lived assets or intangibles that are held for disposal other than by sale. And by other than by sale, it could mean that you intend to abandon the asset, exchange the asset, distribute it to owners. And there's really a simple rule here. If you have long-lived assets or intangibles held for disposal other than by sale, the basic rule is you treat that asset as held for use. Just treat that asset as held for use until you dispose of it. So you just go right back to what we just said about held for use, because you're just going to treat these assets as held for use until you dispose of the assets. I'd like you to try a couple of more questions. Please try 14 and 15 and then come back. Welcome back. Let's do these questions together. In number 14, they want to know what you would capitalize for the cost of the land. Well, you know you're going to pick up the $135,000 cash paid for the land. You're also going to pick up the title search, the attorney's fees of $625, and the assessment for the sewer lines. That's a cost you incur to get the land in a condition for use. Pick that up. I don't think those first three would bother you. Now the $21,000 excavation for construction of the basement, that's going to be capitalized to the building account. But how about the last one? How about removal of the old building? This land had an old unwanted building. It cost us $21,000 to get rid of the old building, minus the $5,000 we get for scrap. What do we do with that $16,000? Does that get capitalized to the land account or the new building? And it is land. It is land. The answer is C. Why? Because the cost of destroying that old building is a cost we incurred to get the land in a condition for use. It's really a straight application of the rule that cost of destroying the old building really is a cost that we incurred to get the land in a condition for use. It does go to the land account, not the new building. In number 15, July 1, one of Rudd's delivery vans was destroyed in an accident. On that date, the van's carrying amount was $2,500. Then on July 15th, 2 weeks after the accident, Rudd received and recorded a $700 invoice for a new engine that was installed back in May. You know what that is. That's an extraordinary repair. That would be capitalized to the fixed asset account, the van account. They get another $500 invoice for various repairs. Ordinary repairs and maintenance would be expensed. Then they get $3,500 from the insurance company. They want to know the gain. Well, what's the entry? When they get that $3,500 cash from the insurance company, you know they're going to debit cash, $3,500. They're going to credit the van for its carrying value. And the carrying value would be the $2,500 plus the $700 new engine. That's an extraordinary repair, would be capitalized to the van account. So the carrying value of the van would not be $2,500, $3,200, and there is a gain from that transaction of $300, and the answer is B. And I want to point out that would be a gain from an involuntary conversion because you didn't mean to do it. It was destroyed in an accident, as opposed to what? I go out and I sell the van at a gain. That's voluntary. But always remember, GAAP doesn't care. GAAP doesn't care whether gains or losses are voluntary, involuntary. They have to be on the income statement either way. So the answer is B. What I want to get into next is how we handle exchanges of assets. I'm sure you've seen these type of problems before. A company, two companies exchange a delivery truck for a computer, an automobile for a piece of machinery. How do we handle exchanges of assets? Well, how we handle exchanges of assets all comes down to one thing now. Does that exchange have commercial substance? That's the issue. Because how we handle an exchange of assets is all determined by that question. Does the exchange have commercial substance? Now, what do we mean by commercial substance? Well, we mean, as a result of the exchange, will the cash flows of the companies involved change significantly in terms of risk or timing or amount? That's commercial substance. As a result of the exchange, will the cash flows of the companies involved change significantly in terms of risk or timing or amount? That's commercial substance. But honestly, I think the exam will make it very clear that there is commercial substance. And the basic point is this. When an exchange does have commercial substance, we have to use the fair value approach. What's the fair value approach? It means that the company must record the new asset at its fair value. Let me give you an example. Let's say in an exchange that does have commercial substance, and as I say, I think the exam will make it quite clear. In an exchange that does have commercial substance, A and B exchange assets. A and B exchanges assets, and let's say A gives up an old asset with a book value of $6,000 and a fair value of $20,000. A also has to pay $4,000 cash in exchange for new asset. So A gives up an old asset with a book value of $6,000, fair value of $20,000, and A also has to pay $4,000 cash in exchange for new asset. Now, what did we just say? When an exchange does have commercial substance, you have to use the fair value approach, which means if you're A, you have to record the new asset at its fair value. How do you get the fair value of the new asset? Well, you have to look at the fair value of what you're receiving or the fair value of what you're sacrificing, whichever is more clearly evident. Notice in this problem, I don't know the fair value of the new asset. So I look at the fair value of what A gave up to acquire the asset. And through that, we infer the fair value of the new asset. In other words, because A gave up an old asset that's worth $20,000 and also kicked in $4,000 cash, since A gave up $24,000 in value to acquire the new asset, we infer that the new asset must be worth $24,000. So A is going to debit the new asset for its fair value, $24,000. A is going to credit the old asset, for its book value, $6,000. By the way, that never changes. You always credit the old asset for its book value, its carrying value. In this case, $6,000. A credits cash, $4,000, because A paid cash. And notice A credits gain on exchange, $14,000. Why? Because when an exchange does have commercial substance, you record the new asset at its fair value and recognize gains or losses. Gains or losses, whatever is indicated by the exchange. Let me give you another example. In an exchange that does have commercial substance, A gives up an old asset with a book value of $6,000 and a fair value of $20,000 in exchange for $8,000 cash and a new asset. So now A is receiving cash. So A gives up an old asset with a book value of $6,000, a fair value of $20,000 in exchange for $8,000 cash and a new asset. Well, what do we know? We know that when an exchange does have commercial substance, we have to use the fair value approach, which means that A has to record the new asset at its fair value. How do we get the fair value of the new asset? Well, we use the fair value of what we're receiving or the fair value of what we're sacrificing, whichever is more clearly evident. What's more clearly evident in this problem is the fair value of what A gave up. Since A is giving up an old asset that's worth $20,000, we have to infer that A must be receiving $20,000 in value. So here's the entry. A is going to debit cash $8,000. Notice A is receiving cash. A is going to debit cash $8,000 and debit the new asset $12,000, because we have to infer that A must be receiving $20,000 in value. So A is going to debit cash $8,000 and debit the new asset must be worth about $12,000. A is going to credit the old asset for its book value, always, $6,000, and credit gain on exchange, $14,000. Why? Because when an exchange does have commercial substance, we recognize gains or losses. Gains or losses, whatever is indicated by the exchange. I'll give you another example. In an exchange that does have commercial substance, A gives up an old asset with a book value of $6,000 and a fair value of $1,000 in exchange for a new asset. A gives up an old asset with a book value of $6,000 but a fair value of $1,000 in exchange for a new asset. What do we know? We know that when an exchange does have commercial substance, we have to use the fair value approach. And that means that A must record the new asset at its fair value. How do I get the fair value of the new asset? I use the fair value of what I'm receiving or the fair value of what I'm sacrificing, whichever is more clearly evident. What's more clearly evident in this problem is the fair value of what A is giving up. Since A is giving up an old asset worth $1,000, we have to infer that A must be receiving $1,000 in value. So A is going to debit the new asset for $1,000, credit the old asset for its book value, $6,000, and debit loss on the exchange, $5,000, because we know when an exchange does have commercial substance, we recognize gains or losses, whatever is indicated by the exchange. Now let's talk about how we handle an exchange that does not have commercial substance. What if an exchange is lacking in commercial substance? Well, if an exchange is lacking in commercial substance, does not have commercial substance, we don't use the fair value approach, we use the book value approach. Again, if an exchange does not have commercial substance, if it's lacking in commercial substance, we don't use the fair value approach, we use the book value approach. And what's the book value approach? We record the new at the book value of the old plus any cash paid. You simply record the new at the book value of the old plus any cash paid. And if there's a gain indicated, generally speaking, it's ignored. Let me give you an example. Let's say A and B exchange assets. And let's say this exchange does not have commercial substance. It is lacking in commercial substance. A gives up an old asset with a book value of $10,000 and a fair value of $25,000 in exchange, and also A has to pay $2,000 cash. So A gives up an old asset with a book value of $10,000, a fair value of $25,000. A has to pay $2,000 cash in exchange for a new asset. And this exchange does not have commercial substance. Well, as you know, when an exchange does not have commercial substance, we use the book value approach. So A is going to record the new, debit new for $12,000. Credit the old for its book value. That never changes. Credit the old for its book value, $10,000, and credit cash, $2,000. Notice, A would simply record the new at the book value of the old, 10, plus any cash paid, 2. A would record the new at $12,000. And if there's a gain indicated, and there is here, there's a huge gain indicated because the old asset has a fair value of $25,000. There's a big gain indicated, but when there's a gain indicated, generally speaking, it's ignored. Now, I should quickly say that I say that generally speaking, gains are ignored. The exception would be when an exchange is lacking commercial substance and there's cash received. You have to be careful of that because cash received is a partial realization of the gain. So even when an exchange does not have commercial substance, again, normally you just record the new at the book value of the old plus any cash paid. If there's a gain indicated, generally you just ignore it, but the exception to that would be when there's cash received. Cash received is considered to be a partial realization of the gain, even though there's no commercial substance. So, in other words, if 5% of the consideration I'm receiving is in the form of cash, I do have to recognize 5% of the gain indicated. If 12% of my consideration that I'm receiving is in the form of cash, even though there's no commercial substance, I do have to recognize 12% of the gain because cash received is a partial realization of the gain. So that's the exception. But generally, you just record the new at the book value of the old plus any cash paid, and if there's a gain indicated, generally speaking, it's ignored. Let me give you another example. In an exchange that does not have commercial substance, A gives up an old asset with a book value of $10,000 and a fair value of $2,000 in exchange for a new asset. So A is giving up an old asset with a book value of $10,000 and a fair value of $2,000 in exchange for a new asset. What are you going to do? Well, normally I'd record the new at the book value of the old plus any cash paid, but not here. Notice in this case, even though there's no commercial substance, I would record the new at its fair value, $2,000. That's the fair value of what I gave up. I use the fair value of what I'm receiving or the fair value of what I'm sacrificing, whichever is more clearly evident. Notice I'm giving up an old asset that's only worth $2,000. So the new asset must be worth about $2,000. Notice in this particular case, I'm going to debit the new asset for fair value, $2,000. Why? Because there's a loss indicated. Losses are never ignored. Losses must always be recorded. So in this case, I would debit the new for its fair value, $2,000, credit the old for its book value, $10,000, that never changes, and I would debit a loss of $8,000. Because again, even though there's no commercial substance, losses are never ignored. Losses must always be recorded. So just in case they throw that curve at you, you can't ignore losses. But generally, when there's no commercial substance, just record the new at the book value of the old plus any cash paid, and if there's a gain, just ignore it unless there's cash received. That's the exception. If 18% of the consideration is cash, you would have to pick up 18% of the gain, even though there's no commercial substance. I'd like you to do 16 and 17 and then come back. Welcome back. Let's take a look at these questions together. In number 16, Balt is exchanging a truck in exchange for shares of Ace. And they said the exchange does have commercial substance. And as I've been saying, I think the exam will make that quite clear. And the point is, when an exchange does have commercial substance, we have to use the fair value approach, which means that if you're Balt, you should record the investment in Ace at its fair value. How do we get the fair value of investment in Ace? We use the fair value of what we're receiving or the fair value of what we're sacrificing, whichever is more clearly evident. What's more clearly evident here is the fair value of what Balt is giving up. Balt is giving up a truck that's worth $3,000. So we have to infer that Balt must be receiving $3,000 in value. So Balt is going to debit investment in Ace for its fair value, $3,000. Credit the truck for its book value, $2,500, and credit gain on exchange, $500, because we know when an exchange does have commercial substance, we recognize gains or losses, whatever is indicated by the exchange. So when they ask at the bottom, what amount would Balt report as investment in Ace, it would be answer A, $3,000. And notice the book value of Ace's shares, that's not the same thing as fair value. So we wouldn't go by the book value of those shares. No, our best estimate of the fair value of that stock is looking at the fair value of the truck they gave up. Book value of the shares wouldn't be adequate in this sort of analysis. In number 17, in an exchange that does have commercial substance, they traded equipment with an original cost of $100,000, accumulated depreciation of $40,000 for similar equipment. By the way, it doesn't matter whether it's similar or dissimilar. That's not the determining factor. What's the determining factor? Commercial substance. And they said this exchange does have commercial substance. And notice the new equipment does have a fair value of $120,000. And they want to know the carrying value of the equipment received. Well, we know very quickly that if the exchange does have commercial substance, then they should use the fair value approach, which means that they should record the new equipment at its fair value. How do I get the fair value of the new equipment? Use the fair value of what I'm receiving or the fair value of what I'm sacrificing, whichever is more clearly evident. What is clearly evident here is the fair value of what they is receiving. This is much easier. They said the fair value of the new equipment is $120,000. We know the fair value of what they is receiving. So they would debit the new equipment for its fair value, $120,000, and the answer is D. When an exchange has commercial substance, use the fair value approach. Record the new asset at its fair value and recognize gains or losses, whatever is indicated by the exchange. Now, you know that when you talk about fixed assets, inevitably, what you have to talk about is depreciation. And I want to go through all the depreciation methods that you have to know for the exam, and I'm even going to cover the basic ones because I worry a little bit about salvage value. I've just noticed that when students mess up on the basic methods, it tends to be on salvage. So let's pay particular attention to what methods back out salvage, what methods ignore salvage. So I'll just give you a very simple example. Let's say a company goes out, buys a machine for $20,000. They estimate there is some salvage of $5,000. They estimate the useful life of the machine is 5 years. And they also estimate the machine will produce 15,000 units over its life. I'm trying to make the numbers very simple. Now, the most basic method, of course, is straight line. I know you're not going to mess up on straight line, but just to say it, straight line would back out salvage. In straight line, you would take the original cost of the machine, $20,000. Yes, you would take out the salvage of 5, so that's $15,000 over 5 straight line years. You know, in straight line, you would take $3,000 depreciation every year for 5 years. Now, productive output depreciation. Sometimes they call it the units of production method. In the productive output method of depreciation, we're going to take the original cost of the machine, $20,000. Yes, we do back out the salvage. Some students aren't sure. So we would back out the salvage of $5,000. So that would be $15,000. And we would divide by the 15,000 units we estimate the machine will produce over its life. And what we do in this method is take $1 of depreciation for every unit produced. That's productive output depreciation. And again, just make sure it's clear, yes, we do take out salvage in productive output depreciation. Now I want to get into accelerated methods of depreciation. Now you know, with accelerated methods, we're going to take more depreciation in the early years of a fixed asset life and less depreciation in the later years of a fixed asset life. I'm sure you know that essentially what depreciation is a method of allocation. It's a method of allocating the cost of a fixed asset to all the accounting periods that will benefit from that fixed asset. That's what depreciation is. It's a method of allocation. It's a method of allocating the cost of a fixed asset to all the accounting periods that will benefit from that fixed asset. And as I say, with accelerated methods, we're going to take more depreciation in the early years of a fixed asset life and less depreciation in the later years of a fixed asset life. Let's start with sum of the year's digits. We'll use the same machine that I've been using. What if we depreciate this machine under sum of the year's digits? Well, remember, in sum of the year's digits, what we do is add up the digits of the useful life. In my example, the machine has an estimated life of 5 years. So we would add up 1 plus 2 plus 3 plus 4 plus 5. But remember, there's a shortcut to that. I bet you haven't seen it in a long time. The shortcut to adding up digits is n times n plus 1 over 2. N times n plus 1 over 2. So if it's a 5-year life, 5 times 5 plus 1. 5 times 6 is 30, over 2 is 15. If it's a 10-year life, 10 times 11 is 110, over 2 is 55. If it's a 7-year life, 7 times 8 is 56, over 2 is 28. It's really quick. So we add up the digits, 1 through 5, they add up to 15. And in sum of the year's digits, the first year, we're going to take 5/15, and then the second year, we're going to take 4/15, and then the third year, we're going to take 3/15, then 2/15, then 1/15 of what? 20,000 or 15,000, and it is 15,000. In sum of the year's digits, we do take out the salvage. A lot of students mess that up, but we do take out salvage. So in the first year, we'll take 5/15 of 15,000 or $5,000 of depreciation. Second year, we'll take 4/15 of 15,000 or 4,000 of depreciation, and so forth and so on. Another method we're going to look at is double declining balance. Now, with double declining balance, the name of the method really says literally what has to be done. It means literally what it says. It is literally double the straight line rate times an ever declining balance. It is double the straight line rate times an ever declining balance. So using the same machine, if it's a 5-year life, what's the straight line rate? 1/5 every year, or 20%. We're going to double that to 40% times 20,000. This is the method where you wouldn't back out the salvage. So in year 1, we're going to take $8,000 depreciation. How about year 2? In year 2, it would still be 40%, but the balance has declined. Now you take the original cost of the machine, $20,000, minus the accumulated depreciation, $8,000. Now the carrying value of the machine is $12,000 times 40%. So in year 2, we would take $4,800 of depreciation. Now, be careful. This method, you don't back out salvage, but when you get to salvage, you stop. Be careful there. This is the method where you don't back out the salvage, but you only depreciate down to salvage. When you get to salvage, you stop. Remember that. Another method the exam likes, same machine, 150% declining balance. Now, with 150% declining balance, it's 1.5 times the straight line rate times the declining balance. So, using the same machine, what's the straight line rate? Well, the estimated life is 5 years, so the straight line rate is 1/5 every year, or 20%. 1.5 times that is 30% times 20,000. Notice in these declining balance methods, we don't back out the salvage. So in year 1, we would take $6,000 depreciation. In year 2, it would still be 30%, but the balance has declined because the original cost of the machine is $20,000 minus the accumulated depreciation of $6,000. Now the carrying value of the machine is $14,000 times 30%. So in year 2, we would take $4,200 of depreciation. And here again, we ignore salvage, but when we get to salvage, we stop. Salvage isn't backed out in the calculation, but we only depreciate down to salvage. We know under GAAP, you can't knowingly depreciate below salvage. So we don't take salvage out in the calculation, but when we get to salvage, we do stop. I'd like you to try 18 and 19 and then come back. Welcome back. Let's do these questions together. In number 18, we're talking about Spiro Corporation. They use the sum of the year's digits method of depreciation for a piece of equipment. They bought January of the current year for $20,000. There is a salvage value for this equipment of $2,000. The estimated life is 4 years, and they want to know the carrying value of this equipment at the end of the 3rd year. So you got to work it out. So let's work it out. You know, with some of the year's digits, we have to add up the digits of the useful life. Here it's a 4-year life. So we would add up 1 plus 2 plus 3 plus 4 adds up to 10. Or the shortcut, 4 times 5 is 20 over 2 is 10. So in the first year, we would take 4/10 of what? 20,000 or 18,000? 18,000. Because some of the year's digits does take out salvage. So in the first year, we would take $7,200 of depreciation. In the second year, we would take 3/10 of 18,000, or 5,400 of depreciation. In the third year, we would take 2/10 of 18,000, or 3,600 of depreciation. So if you add it up, what is accumulated depreciation by the end of the third year? Well, it's 7,200 plus 5,400 plus 3,600, 16,200. If you take the original cost of that equipment, 20,000, minus the accumulated depreciation, 16,200, the carrying value of that equipment by the end of the third year, under some of the year's digits, would be answer C, 3,800. In number 19, we're told that Rye purchased a machine with a 4-year life. That's the estimated life. They estimate there's a 10% salvage value, and they bought the machine for $80,000 in the current year, January 1 of the current year. In the income statement for the third year, what would be depreciation expense under double declining balance? Well, here again, we know that when you see double declining balance, the name of the method tells you really what you have to do. It means literally what it says, double the straight line rate times never declining balance. Well, we know the straight line rate. If it's a 4-year life, the straight line rate would be 1/4 every year. Double declining balance, we double that to 2/4, or 50%. So a straight line rate would be 1/4 every year, or 25%, we're going to double it to 50%. So in year one, we would take 50% times 80,000. You don't take out salvage. As you know, in these declining balance approaches, you don't back out salvage. So you would just take 50% of 80,000. In year one, you would take 40,000 of depreciation. How about year two? In year two, it's still 50%, but the balance has declined. Take the original cost of the machine, 80,000, minus the accumulated depreciation, 40,000. Now the carrying value of the machine is 40,000 times 50%. So in the second year, we would take 20,000 of depreciation. But they're asking about the third year. What happens in the third year? It's still 50%. But what's the balance declined to? What's the carrying value of the machine? Well, the original cost was 80,000 minus 40,000 of depreciation for the first year, 20,000 of depreciation for the second year. There's 60,000 of accumulated depreciation. So now the carrying value of the machine is 20,000 times 50%. We would take answer B, 10,000 of depreciation for the third year, which is what they wanted. Now, I have to assume that straight line, productive output depreciation, sum of the year's digits, double declining balance, 150% declining balance depreciation, I have to assume that you no doubt have seen all those methods before, but the last depreciation method we're going to look at might be new to you, could be. What I want to get into next is group and composite depreciation. Let me give you some definitions. First of all, understand that some companies, in order to save bookkeeping costs, that's why they do this, to save bookkeeping costs, they don't depreciate individual assets, they depreciate groups of assets. Now, group depreciation is a grouping of similar assets. So you would group delivery trucks into a group, depreciate the group. That is group depreciation. It is a grouping of similar assets. You group delivery trucks into a group and depreciate the group. Composite depreciation is a grouping of dissimilar assets. So with composite depreciation, you would group delivery trucks, automobiles, and computers into a group and depreciate the group. That's composite depreciation. Now, make no mistake about this, all the numbers are the same. All the calculations are the same with group and composite depreciation, but you just have to know that the only difference between group and composite depreciation is that group depreciation is a grouping of similar assets, composite depreciation is a grouping of dissimilar assets. All the calculations are the same. To show you the sort of calculations that you have to make in group and composite depreciation, let's go to a question. Let's go to number 20. Number 20 says, a schedule of machinery owned by lessor is presented below. Notice machine A costs $550,000 with an estimated salvage of $50,000 and an estimated life of 20 years. Machine B costs $200,000 with $20,000 of salvage and a useful life of 15 years. Machine C costs $40,000, no salvage, with a useful life of 5 years. It says lessor computes depreciation on the straight line method. Based on the information presented, what is composite life? What they're asking you for here is the group life or the composite life. All right, now listen to me carefully. With group and composite depreciation, I don't care what they ask you for. You always start the same way. You always start by calculating the straight line depreciation for each asset in the group. Again, always start by calculating the straight line depreciation for each asset in the group. So let's do that. I take machine A, cost $550,000, back out the $50,000 salvage. That's what? That's $500,000 over 20 straight line years. Let's agree that in straight line, we would take $25,000 depreciation every year. Machine B cost $200,000 with $20,000 salvage. That's $180,000 over 15 straight line years. Let's agree that in straight line, we would take $12,000 depreciation every year. And then finally, machine C costs $40,000, no salvage, over 5 straight line years. In straight line, we would take $8,000 depreciation every year. Now you add it up. If I add up 25,000 plus 12,000 plus 8,000. Notice the total straight line depreciation for all the assets in the group, 45,000. See, you need that number. I don't care what they ask you for. You have to have that number. And the fact is that the total straight line depreciation for all the assets in the group, 45,000. Now let's answer the question. They want to know the group life or the composite life. Here's how you do it. If you go back to the schedule, add up the cost of all the assets. I'm going to add up 550 plus 200 plus 40. Draw a line under that 40,000. Notice the total cost of all the assets in the group, 790,000. Now draw a line under salvage. Notice the total salvage value, add up 50 plus 20. The total salvage value for all the assets in the group adds up to 70,000. Here's how you work out the group life or the composite life. Take the total cost of all the assets in the group, 790,000, minus the total salvage value for all the assets in the group, 70,000. What is that? That's 720,000, and divide by 45,000. Divide by the total straight line depreciation for all the assets in the group, and your group life or your composite life is answer B, 16 years. That's the group life or the composite life. They could ask you for that. Now, one more thing. Same problem. What if they wanted the group rate or the composite rate? I'm just trying to show you everything they could ask for here. What if they had the same problem and they wanted the group rate or the composite rate? Listen carefully. If they want the group rate or the composite rate, you start the same way. You need that 45,000. You're going to have to figure out the total straight line depreciation for all the assets in the group, 45,000. So you would take that 45,000 and divide by the total cost of all the assets, 790,000. Not 720. Don't back out salvage here. Why? Because salvage is already reflected in the 45,000. You don't want to double count it. So you still need, though, the total straight line depreciation for all the assets in the group, 45,000, divide by the total cost of all the assets in the group, 790, and the group rate comes out to 0.0569. They could ask you for that. That's the group rate or the composite rate. Remember I said that companies use these methods to save bookkeeping costs. And you see why it saves bookkeeping. How does this company get their depreciation expense for the year? Well, they just go to the computer, look at the cost of all the assets in the group, multiply by 0.0569. That's the depreciation expense for the year. It does save bookkeeping, right? You just go to the computer, just look at the total cost of all the assets in the group, multiply by 0.0569, the group rate, and that is the depreciation expense for the year. And of course, periodically you adjust the rate if there's been any material changes. Now, one more thing. What happens in group or composite depreciation if you sell an asset out of the group? Let me give you an example. Let's say a company uses group or composite depreciation and they take an asset out of the group that costs $10,000 and they sell it for $3,000. So we have a company uses group or composite depreciation and they take an asset out of the group that costs $10,000, they sell it for $3,000. What are you going to do? Well, you know they're going to debit cash $3,000. That's what they collected. And we know they're going to credit the asset for $10,000. Now the entry doesn't balance. I need a $7,000 debit to balance the entry out. What do? I just debit accumulated depreciation, $7,000. And now I want you to listen to me. It's an important point. Because in these methods, we're not depreciating individual assets, we won't have a carrying value for an individual asset. Again, because in these methods, we're not depreciating individual assets, we don't have a carrying value for an individual asset. So in these methods, there's never any gain or loss from the sale of an asset. I'll say it again. Because in these methods, we're not depreciating individual assets, we're not going to have a carrying value for an individual asset. So in these methods, there's never any gain or loss from the sale of an asset. And does that save bookkeeping? Look at question number 21. See if it makes sense. 21 says, when equipment is retired, look at the entry that we just went through. Debit cash, $3,000. Credit the asset, $10,000. Debit accumulated depreciation, $7,000. That would be a retirement. When equipment is retired, accumulated depreciation is debited, in my example, for $7,000. That would be for the original cost, $10,000, less any residual residual recovery. 3, that's true under either approach, group or composite. Yes, under both. Answer D would be double yes. I hope that question makes sense to you. Now, we're done with depreciation. We're done with fixed assets. And now I want to move on to something else. What I want to get into next is research and development costs. Let me give you the bottom line. The bottom line is this. Any item that is defined as a research and development cost, and I'll give you some definitions in a moment, but the bottom line is that any item that is defined as a research and development cost must be expensed as it's incurred. Any item that is defined as a research and development cost must be expensed as it's incurred. In other words, companies are not allowed to defer research and development costs. Companies are not allowed to capitalize research and development costs. That's the bottom line. Companies are not allowed to capitalize R&D costs. Companies are not allowed to defer R&D costs. No, R&D costs must be expensed as they're incurred. Let me give you some definitions. Now, I'm going to mention some definitions because once in a while, the exam gets picky. Every now and then in a question, you really have to know what research is, what development is. So let's talk about it. Research is a critical investigation. It is a critical investigation aimed at the discovery of a new product or a new process or even the improvement of an old product or an old process. Now, I'll say that again, but I want you to notice how broad it is. Research, it's a critical investigation aimed at the discovery of a new product or even a new process or even the improvement of an old product or an old process. It's very broad. What's development? Development is taking that research, taking new knowledge, and translating it into a plan or a design or a prototype. That's the development phase. That's development. Taking new knowledge, taking research, and then translating it into a plan or a design or a prototype. Now, you can already see that this isn't a tough area. We know that any item that is defined as a research and development cost, we know the definitions, has to be expensed as it's incurred. Companies are not allowed to capitalize R&D costs. Companies are not allowed to defer R&D costs. They must be expensed as they're incurred. Now, one little tricky thing you have to be careful about. You'll see that one way the exam has always tested this is in a multiple choice, they love to give you a list of costs and have you pick out the research and development costs. They do that a lot. You'll see a multiple choice, there'll be a list of costs, and they want you to pick out the research and development costs. And what they could put into a list of costs would be this. Bothers people. You might see in a list of costs, setup costs, preparing for actual production. What if you saw that in a list? Setup costs, preparing for actual production. Is that R&D? No, it's not. And I want to give you a little tip here. Just remember this point. Once a company is doing anything related to the actual production of the product, I'll say it again. Once a company is doing anything related to the actual production of the product, even setting up, preparing for the actual production of the product, by definition, they are no longer in research and development for that product. See, that's the cutoff point. And I just think it's good to know that for an exam. That's where it cuts off. See, once a company is doing anything related to the actual production of the product, even setting up, preparing for the actual production of the product, by definition, they are no longer in research and development for that product. That's exactly where it cuts off. And as I say, I just think in an exam, it's just good to know where does it cut off. Now, one more little tricky thing. Be careful of any R&D cost that has, quote, alternative future uses. You have to be careful of any R&D cost that has alternative future uses. I'll give you an example. Here's the classic case. Let's say a company buys a laboratory building for research and development. We have a company they buy a laboratory building for research and development. I think you can agree with me that something like a laboratory building will probably not be consumed in the current R&D project. Something like a laboratory building probably has alternative future uses. So here's the point. Even though the lab was built for R&D, the lab would be capitalized, and only the depreciation expense on the lab would be part of R&D costs for the year. I hope that makes sense to you. Something like a laboratory building is probably not going to be consumed within the current R&D project. Something like a lab probably has alternative future uses. So even though the lab, was built for R&D, the lab does get capitalized, and only the depreciation expense on the lab would be part of your R&D cost for that year. And remember, same thing with machinery, same thing with equipment. Normally things like laboratory buildings, machinery, equipment, normally these items have alternative future uses. And when they have alternative future uses, they do get capitalized. And only the depreciation expense on those items would be part of your R&D expense for that year. So just watch out for that. That can be a little tricky. Try a couple of questions, please. Please do 22 and 23, and then come back. Welcome back. In number 22, we have a classic sort of multiple choice that they would ask on research and development, where they say at the bottom, in the year-end income statement, what would Cody report as R&D expense? What is your research and development expense? We have a list to go through. How about the design of tools, jigs, molds, and dies involving new technology? Yeah, that's development. That's what development is. Development is taking new knowledge, new technology, and then translating it into a plan, a design, a prototype. In this case, tools, jigs, molds, dies. It's exactly what development is. How about modification, formulation of a new process? Yeah, research. Research is broad enough to encompass the creation of a new process, the improvement of an old process. Research is broad enough to pick that up. How about troubleshooting in connection with breakdowns during commercial production? No. If you're in commercial production, by definition, you're no longer in R&D for that product. How about adaptation of existing capability to a particular customer's needs as part of continuing commercial activity? No. If it's part of continuing commercial activity, it's not R&D. So your research and development expense for the year would be the $125,000 plus the $160,000, answer D. Number 23. Again, they want to know which of the following would be research and development costs. Well, it's not D, market research. How about C? How about research and development performed under contract for others? Well, that's their R&D. If you're doing research and development for others on contract, well, that's their research and development. It's revenue for you. It's not your research and development cost. Offshore oil exploration is to find oil. That's the cost of developing more oil wells. That's not to develop a new product or a new process. The improvement of an old product or old process. That's not research and development. Answer A, development or improvement of techniques and processes. Research is broad enough to pick that up, and the answer is A. Let's talk about intangible assets. And I think when we say intangible assets, we're talking about copyrights, patents, trademarks. Goodwill is an intangible. A franchise is an intangible. A leasehold improvement would be an intangible. Secret formulas would be an intangible. These are your basic intangible assets. Copyrights, patents, trademarks, goodwill, a franchise, leasehold improvements, secret formulas. As I say, these are your basic intangible assets. Now, with intangibles, there are a couple of areas the exam likes to get into. First, they could ask you, what costs do you capitalize for a copyright, for a patent, for a trademark? I'm trying to make my points broad because the exam is very broad on this. That is the broad question. What costs do we capitalize for an intangible? Well, if they ask you that, watch out for three things. What costs do we capitalize for an intangible? Number one, we capitalize purchase price. In other words, if I purchase your copyright for $8 million, I capitalize the $8 million. If I purchase your trademark for $100 million, I capitalize the $100 million. I do capitalize purchase price. Also, number two, we capitalize legal and other fees. Legal and other fees to register a copyright, a patent, a trademark. Again, I'm trying to make my notes broad here. We're going to capitalize, number two, legal and other fees to register a copyright, a patent, a trademark, whatever it is. And then don't forget number three, because the exam likes it. Number three, we also capitalize legal fees in successful defense. We capitalize, number three, legal fees in successful defense of a copyright, a patent, a trademark, whatever it is. What if the defense is unsuccessful? Well, I think you know. If the defense is unsuccessful, we expense the legal fees, right? If the defense is unsuccessful, we expense the legal fees, and we also write off the patent because we no longer have legal rights to it. And the exam has asked that. Hey, if the defense is unsuccessful, not only would you expense the legal fees, but you'd also write off the patent because you no longer have legal rights to it. But we do capitalize legal fees in successful defense of a copyright, a patent, a trademark, whatever it might be. Now, another point. Please remember, on the other hand, there's only one thing we capitalize for goodwill. Only one thing gets capitalized as goodwill. Goodwill is what a company is willing to pay over fair market value to acquire another company's net assets. That's what goodwill is. Only one thing gets capitalized to a goodwill account. Goodwill, by definition, is what a company is willing to pay over fair market value to acquire another company's net assets. That's what goodwill represents. It's what a company is willing to pay over fair market value, not over book value, over fair market value to acquire another company's net assets. That's the only thing that goes to a goodwill account. Now be careful. The exam will throw junk at you on this. They'll say a company incurs costs to develop goodwill, restore their goodwill in the community, maintain their goodwill in the community, enhance their goodwill in the community. The exam loves to give you all this junk where they'll say a company incurs costs to develop goodwill in the community, restore their goodwill in the community, enhance their goodwill in the community. What do you do with costs like that? They're expensed as they're incurred. So if a company incurs costs to develop goodwill, maintain goodwill, enhance goodwill, restore goodwill, costs like that are expensed as they're incurred. I say again, the only thing you capitalize to goodwill is what a company is willing to pay over fair market value to acquire another company's net assets. Now, inevitably, when you talk about intangibles, we have to talk about amortization. How do we amortize intangibles? Well, you have to remember that intangibles fall into two broad categories. Don't forget this. Two broad categories of intangibles. First category, there are intangibles with finite useful lives. That's category number one. There are intangibles with finite useful lives. A copyright, a leasehold improvement, a patent. I mean, there are intangibles with finite useful lives, and here's the point. If a company has an intangible with a finite useful life, they must amortize that intangible over their best estimate of that useful life. If a company has an intangible with a finite useful life, they must amortize that intangible over their best estimate of the useful life. And to come up with that best estimate of useful life, you have to consider legal requirements, regulatory requirements, business needs. But that's the bottom line. If you have an intangible with a finite useful life, a copyright, a leasehold improvement, you must amortize that intangible over your best estimate of the useful life. And to come up with that best estimate of useful life, consider legal requirements, regulatory requirements, business needs. If your best estimate of useful life is 114 years, use 114 years. Now, the second category, there are intangibles with an indefinite useful life. Category number 2, there are intangibles with an indefinite useful life. Goodwill is the classic case. Goodwill is an intangible with an indefinite useful life. A trademark usually has an indefinite useful life. And here's the point. If a company has an intangible with an indefinite useful life, it's not amortized. It's not amortized. It's tested for impairment, at least annually. So one more time. If a company has an intangible with an indefinite useful life, goodwill is the big one, a trademark, it's not amortized. It's not amortized. It's tested for impairment, at least annually, and the basic test for impairment is basically this. If the carrying value on the books for the goodwill, for the trademark, if the carrying value on the books is greater than its fair value, if the carrying value on the books is greater than the fair value, it's impaired. So you debit a loss. Take a loss to the income statement and credit goodwill. Write goodwill down to fair value. That's the entry that you make. You test it for impairment at least annually. I'd like you to try number 24 and come back. Welcome back. In number 24, we're talking about a patent. And they say at the bottom, what amount would J report as the patent net of any accumulated amortization? Well, the first question is, would there be amortization on this patent? Yes, because it's an intangible with a finite useful life. So this intangible would be amortized, because after all, a patent is an intangible with a finite useful life. Now, a couple things you have to think about here. What would you capitalize for the patent? Well, you know you're going to pick up the $34,000 of legal and other costs to register the patent, pick up that $34,000. That would be capitalized to the patent account. How about the $136,000 of research and development costs that led directly to this patent? Isn't that what they said? They incurred $136,000 of research and development costs that led directly to this patent. You can trace those research and development costs directly to this patent. Would you capitalize that or expense it? Expense it. Don't let them talk you into something. R&D costs are expensed as they're incurred. So don't let them talk, even though they said, yeah, but these R&D costs led directly to this patent. It doesn't change the fact that R&D costs are expensed as they're incurred. So let's agree. All we're going to capitalize to the patent account is the $34,000 of costs to register the patent. Now, how many years are we going to amortize this over? Are we going to amortize over the 20 years? That's the legal life. Or 10 years, the economic life. That's right, 10 years. The period of economic benefit. It doesn't matter that it has a legal life of 20 years. All we care about is the period of economic benefit. We amortize an intangible with a finite useful life over our best estimate of its useful life. And our best estimate of its useful life, in this case, would be the period that the company is going to get economic benefit, which would be 10 years. So I'm going to take that $34,000, divide by 10 straight line years. What is that? That's $3,400 of amortization for a full year on the patent. Do I want a full year? No, because the patent was granted on July 1. We're at December 31. Only 6 months have gone by. Take a half a year's amortization, which is $1,700. So when they ask me at the bottom, what would they report as the patent net of accumulated amortization? It would be the cost capitalized for the patent, $34,000, minus the accumulated amortization, which would just be $1,700, a half a year's amortization. The answer is A. Carrying value of that patent is now $32,300. In number 25, Jambon bought a piece of equipment for research and development. And the basic facts are that the equipment has a useful life of 10 years, but the R&D project's going to go for 5 years. And they're asking at the bottom, what would you expense for this equipment? Let's cut right to the chase. You know it's going to come down to B versus C. If you think we should depreciate that equipment over the life of the project, which is 5 years, you'd pick answer B. You'd expense 1/5 every year. But if you think you should expense that equipment over the life of the equipment, it's answer C. Expense 1/10 every year. What do you think? B or C? I hope you're with me. It's neither. It's neither. Why? Because they said something else. I hope you noticed it. They said towards the bottom, the equipment can be used only for this project. Notice that line. The equipment can be used only for this project. When they say that the equipment can only be used for this project, that's their way of telling you there's no what? There are no alternative future uses. If the equipment can only be used for this project, there are no alternative future uses. And the point is, if there are no alternative future uses, you expense 100% year one like any other R&D cost, and the answer is A. Remember, the only exception is alternative future uses. When a cost does have alternative future uses, we can capitalize it and depreciate it. But if there are no alternative future uses, that you would expense 100% year one, like any other R&D cost, it doesn't fall into that exception. And the answer is A. I've got to ask you this. What if they said the equipment does have alternative future uses? What if they threw that in? What if they said the equipment does have alternative future uses? Now would it be B or C? It would be answer C. We would depreciate over the life of the equipment 1/10 every year, because we're going to use the equipment way beyond the 5-year project, right? Over its whole 10-year life of the equipment. So it would be answer C if it did have alternative future uses. But because the equipment can only be used for this project, there are no alternative future uses, we expense 100% year one like any other R&D cost. And that's why it is answer A. Please do 26 and 27 and then come back. Welcome back. In number 26, they say on June 30th, Union purchased goodwill of $125,000 when they acquired the net assets of Apex. Remember, that's what goodwill. It's what you're willing to pay over fair market value to acquire another company's net assets. So when acquiring Apex, in acquiring the net assets of Apex, they've purchased goodwill of $125,000. Then they say during the year, Union incurred additional costs to develop goodwill by training employees. That's expensed as it's incurred. You know, hiring additional employees, expensed as it's incurred. Union's December 31 balance sheet would report goodwill of answer D, $125,000. That's the only thing you bring to a goodwill account. What a company is willing to pay over fair market value for another company's net assets. All those other costs would be expensed as incurred. In number 27, we're dealing with a leasehold improvement. On December 1 of the current year, Clark leased office space for 5 years. The monthly rental is $60,000. They paid the following. They want to know what the current year expense relating to the office space would be. Well, the current year's expense would only be for December, 1 month. Notice they paid the first month's rent, $60,000. We picked that up. That was the rent for December. How about the last month's rent? No, that's prepaid rent. That won't be expensed till the last month. That's on the balance sheet as prepaid rent. That's not rent expense. The security deposit, notice it's refundable at the end of the lease. That's a receivable. That's not rent expense. And then the installation of new walls and offices, that's a leasehold improvement. It's an intangible asset. We capitalize it and amortize it over the 60 months of the lease. It's a 5-year lease, 60 months. That's a leasehold improvement. Take that $360,000, divide by the 60 months in the lease. We're going to take $6,000 of amortization on the leasehold improvement. Add that to the $60,000 for December's rent. The rent for December would be $66,000. Answer B. In 28, 29, and 30, what we're dealing with is software that you're developing to be sold as a product. Now, this isn't software you're using as an application, you know, for payroll, something like that. No, this is software you're going to market as a product. And I want to do these questions with you because there's a couple of quirky things about software that you're marketing as a product. If you go to 28 and 29, 28 says, during the year, Pitt incurred costs to develop and produce a low-risk computer software product as follows. Notice they had costs to complete a detailed program design, $13,000. Costs incurred for coding and testing to establish technical feasibility. You might want to bracket the $13,000 and the $10,000 together. That's all research and development costs. That's how software costs that you're developing as a product get handled. All the costs you incur until you actually establish technical feasibility is research and development. It's expensed as it's incurred. I'll say it again. All the costs you incurred until you establish technical feasibility, until you know you actually have something that's feasible. All those costs are just purely speculative. They're just research and development costs expensed as incurred. So as I say, you might want to bracket the $13,000 and the $10,000, just right next to it, R&D. Now, once you've established technical feasibility, then you're in a different phase. They say they have other coding after. You might want to circle the word after establishing technical feasibility. Other testing after you've established technical feasibility. The cost of producing product masters and training manuals. That $24,000, that $20,000, and the $15,000, bracket those three numbers together, that's your capitalized software costs. So I'll say it again. All the costs you incur until you establish technical feasibility, until you know you have something that's feasible. All that's research and development, gets expensed as it's incurred. But then once you've established technical feasibility, you're in a different phase. Other coding after you've established technical feasibility, other testing after you've established technical feasibility, producing product masters, training manuals. That phase, the $24,000, the $20,000, and the $15,000, that $59,000, that's what you'd capitalize on your balance sheet as capitalized software. So in number 28, they want to know what would be capitalized software. The answer is C, $59,000. Now the last two items, duplication costs and packaging, the $25,000 and the $9,000, that goes to inventory. So duplication costs, packaging costs, that goes to inventory. So that answers number 29. What goes to inventory? The 25 and the 9, 34,000. So you just have those three distinct phases. Until you establish technical feasibility, it's all research and development. It's all purely speculative. Once you've established technical feasibility, then you have other coding, other testing. That's your capitalized software. And then duplication costs, packaging, that goes to inventory. And then finally, number 30. They say on December 31, BIT had capitalized software. So it's given that they have capitalized software for a new computer software product with an economic life of 5 years. Sales for year 2 were 30% of the expected total sales. And they want to know at the bottom what percentage of the original capitalized software would be reported at the net amount on the December 31 year 2 balance sheet. Well, notice if I use straight line, I've got my capitalized software. That's a given. I've got my capitalized software on the balance sheet. They said the economic life was 5 years. So if I use the straight line approach, I would amortize 1/5 every year, or 20%. So in year 2, I would amortize 20%. So what would be left on the balance sheet is answer C, 80%. I hope you see that. If I use the straight line approach here, they said the economic life was 5 years. So in straight line, I would amortize 1/5 every year, or 20%. So what would be left on the balance sheet for capitalized software would be 100% minus 20%, or 80%. Answer C. Now, the other approach is to use the percentage of sales approach. Since they generated 30% of the sales they expect to get from that product in year 2, in the percentage of sales approach, I would amortize 30% of the software costs. So if I amortize 30% of the software costs, what's left on the balance sheet is 100% minus 30%, or answer A, 70%. And here's the rule of thumb. You look at the straight line percentage, look at the percentage of sales approach, take the larger of the two. That's what they let you do with capitalized software in terms of amortization. You look at the straight line percentage, look at the percentage of sales approach. Whatever percent is larger, that's what you would take. And they do that because trying to estimate the life of software is very tough. Sometimes that's very speculative. As you know, things get old and out of date very quickly. So if in year one you've generated 30% of the sales you expect to ever receive from that product, they'll let you amortize 30% of the costs, so what's left on the balance sheet is 70%. Just remember to take the larger of the two. So the answer is A. That's what's on the balance sheet now, 70%. And then they threw in the net realizable value is 90%. The only reason that would be relevant is if it was very low. If they said net realizable value was 50%, you'd have to write down to 50%. Because if all you're ever going to net out of the product is 50%, you can't have it on your balance sheet at 70%. You'd be overstating it. So that's how that would work in. So that's what they're just trying to throw you off there. But if they said all you're ever going to net from the product is 50%, that's its net realizable value, well then you can't have it on the balance sheet at 80% or 70%. You'd be overstating it. You'd have to write it down to 50%. I don't think the exam would do that. I think they're much more interested in you knowing that basic rule of thumb, that when you're amortizing capitalized software costs, look at the straight line percentage, look at the percentage of sales approach, take the larger of the two. And that's why, again, in this question, the answer is A. And that's the last question we're going to do in this class. I just want to finish by wishing you the best of luck on the exam from all of us at the Bisk Review. Do a good job on the exam. Best of luck on the test.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam that let you customize your own review program to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured, professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you're going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as diagnostic exams, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of the computer-based exam, including multiple choice and simulation questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you'll have the confidence and knowledge to pass it, guaranteed.
Hello, and welcome to the Bisk CPA Review course and our coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette. I'll be your instructor for this class, and in this class, we're going to be covering two major topics: the accounting for leases and also the accounting for pensions. Before we begin, I want to mention that the best way to use this class is to treat it like any other class. Try to avoid just sitting back passively watching the class. Be an active participant. Take good notes. Later in the class, when we do problems, the best thing to do is shut the class down. Work on the problems, get your answers before you come back and we discuss the problem together. I think you'll find that if you do those simple things, you get much more out of this class, and it's what we both want. So with that said, let's get started. Let's begin with the accounting for leases. And I think you know that the basic issue with any lease is simply this. If I'm a lessee and I sign a lease, the issue is, am I using that lease to just rent the property? Am I just renting, or am I using that lease in substance to purchase the asset? That's the issue. Let's get some terminology down. If I'm a lessee and I sign a lease and I'm using that lease to just rent the property, if I'm just renting, we call that an operating lease. But if I'm using that lease in substance to purchase the asset, we call that a capital lease. Now, it's the same idea on the lessor side. And remember, in the CPA exam, with leases, they could have questions on the lessee side or the lessor side. And it's the same idea on the lessor side. If I'm a lessor and I sign a lease, if I'm using that lease to just rent out my property, if I'm just renting out my property, we call that an operating lease. But if I'm a lessor and I sign a lease and I'm using that lease in substance to sell the property, if in substance the lease is a way to sell the property, well, then there are two possibilities for the lessor. It could be a sales type lease, or it could be a direct financing type lease. Those are your different possibilities. Let's start with the easiest part of this, and that is operating leases. As I said, if I'm a lessee and I sign a lease and I'm using that lease to just rent the property, we know we call that an operating lease. And if I'm just renting the property, what it simply means is that all the lease payments that I make will be debited to rent expense. It really is that simple. I'm a lessee, I sign an operating lease, I'm just renting the property. So all the lease payments I make will be debited to rent expense. Now, how could they complicate this? Well, just give you something to look out for. Watch out for uneven rental payments. Be careful of uneven rental payments. I'll give you an example. Let's say I'm a lessee. I sign an operating lease, and the lease payments are going to be $10,000 every year for 10 years. $10,000 every year for 10 years. But to get me to sign the lease, the lessor says, Bob, the first 2 years rent are free. Well, think about it. If the first 2 years rent are free, what do I end up paying? I end up paying $10,000 every year for 8 years. I pay $80,000 for 10 years rent. Take $80,000, divide by 10. My rent expense for year one is $8,000, not zero. Don't forget that uneven rental payments are still incurred evenly. It doesn't matter how you pay it. You incur it evenly. You know what I'm saying? Fundamentally, if you get a question on an operating lease, it's all about accrual accounting. Same idea on the lessor side. If I'm a lessor and I sign an operating lease, you know I'm just using that lease to rent out my property. So all the lease payments I collect, I'll credit to rental income. It really is that simple. I'm a lessor, I have an operating lease, I'm just renting out my property. So all the lease payments I collect will be credited to rental income. And they can do the same thing here. Watch out for uneven receipts. I'll use the same numbers. I'm a lessor. I sign an operating lease. The lease payments are going to be $10,000 every year for 10 years. But to get the lessee to sign the lease, I say, well, the first 2 years rent are free. Well, if the first 2 years rent are free, what do I end up collecting? I end up collecting $10,000 every year for 8 years. I collect $80,000 for 10 years rent. Take $80,000, divide by 10. What I earned in year one is $8,000, not zero. Don't forget that uneven receipts are still earned evenly. It doesn't matter how you collect it. You earn it evenly. All right, let's go back to the lessee side. Let's think about some basic things they could throw into a problem on an operating lease for a lessee. Now, as we know, we're going to have to watch out for dates. We know that uneven rental payments are incurred evenly. What else could they throw in? Well, what if the lessee pays prepaid rent? Well, if the lessee pays prepaid rent, remember prepaid rent is an asset. It's not expense till the proper period. Another one, what if the lessee pays a non-returnable deposit? Well, if the lessee pays a non-returnable deposit, you set up an asset and you amortize it to rent expense over the term of the lease. It's non-returnable. So if the lessee pays a non-returnable deposit, then the lessee should set up an asset and amortize that to rent expense over the term of the lease. What if the lessee pays a returnable deposit? Well, if it's returnable, the lessee would set up an asset, a receivable. Don't amortize it. It's returnable. They're going to get it back. So just set up an asset, a receivable, and don't amortize it. What if the lessee pays an initial direct cost, like a finder's fee? If the lessee pays an initial direct cost, like a finder's fee, they should set up an asset and amortize it to expense over the term of the lease. One more thing. What if the lessee makes a leasehold improvement? Be careful. If you see a leasehold improvement, remember, a leasehold improvement is capitalized and amortized over the useful life to me, the lessee. Again, a leasehold improvement gets capitalized and amortized over the useful life to me, the lessee. I'll give you a quick example. Let's say that I have an operating lease on my office building, and I'm a lessee, and I put in brand new hardwood floors. Now, the hardwood floors have a useful life of 100 years. My lease runs out in 4 years, and I'm going to leave the building. So what am I going to do with those hardwood floors? Well, we know it's a leasehold improvement. I'd capitalize it, and I would amortize those hardwood floors over how many years? 100 years or 4? 4, the useful life to me. That's the remaining period of my lease. and I intend to leave the building. So it's over the useful life to me, not the useful life of the floors. Let's go to the lessor side. What are some things they could throw into an operating lease question on the lessor side? Well, again, always watch out for dates. As we've already said, watch out for uneven receipts. If you're the lessor, uneven receipts are still earned evenly. What if the lessor collects rent in advance? If the lessor collects rent in advance, that's a liability. If you're a lessor and you collect rent in advance, that's a liability. It's not revenue, rental revenue, till the proper period. What if you're a lessor and you collect a non-returnable deposit? Well, if you collect a non-returnable deposit, you set up a liability and you amortize it to rental income over the term of the lease. What if you're the lessor and you collect a returnable deposit? Well, if it's returnable, set up a liability, a payable, don't amortize it, because you're going to have to pay it back. What if the lessor has an initial direct cost, like a finder's fee? What if the lessor pays some sort of initial direct cost, like a finder's fee? Well, then they should set up an asset and amortize it to expense over the term of the lease. As I say, fundamentally, you're in that exam, you get a problem on an operating lease, it's all about accrual accounting. I'd like you to try some operating lease questions. In your viewer's guide, I'd like you to do questions 1, 2, and 3, and as I suggested earlier, shut the class down, work on those 3 questions, get your answers, and then come back. Welcome back. Let's do these questions together. In number 1, we know it's an operating lease because they say it. So that settles that. And notice we're on the lessee side. So what do we know? We know if you're a lessee, you sign an operating lease, all the lease payments that you make will get debited to rent expense. And that's what they want to know in this question. What's the rent expense for the year? Well, you know we're going to pick up the annual rent of $96,000. How about that $24,000 bonus that Park had to pay? That's an initial direct cost, isn't it? That bonus would be an example of an initial direct cost. So what Park would do is set up an asset and amortize that over the 10-year term of the lease. So I'm going to take that $24,000, divide by 10, we'll pick up $2,400 of that. And then don't forget, there's that extra 5% penalty. We agreed in the lease that if our sales ever exceeded $500,000, we'd have to pay a 5% premium. And notice that the sales were $600,000, we're $100,000 over that threshold times 5%. That $5,000 is also part of this year's rent. So just add it up, $96,000 plus $2,400 plus $5,000. The rent expense for this year would be answer C, $103,400. In number 2, notice once again, we know it's an operating lease because they state that it is. And notice we're on the lessor side. So what do we know? We know if you're a lessor, you sign an operating lease, you're just renting out your property, so all the lease payments that you collect will be credited to rental income. And that's what they want to know. They want to know the rental income for the year. Well, notice that the rental income for the first year is $8,000. But to get the person to sign the lease, we said, well, the first 6 months are free. So if the first 6 months are free, what they're going to collect in the first year of the lease is not $8,000, it's $4,000. And then in years 2, 3, 4, and 5, they're going to collect $12,500 each year, another $50,000. So if you're the lessor, you're going to collect in total $54,000 for 5 years' rent. So take $54,000, divide by 5. What you earned in the first year is answer C, $10,800, because we know uneven receipts are still earned evenly. It doesn't matter how you collect it. You earn it evenly. In the third question, again, we're told it's an operating lease, and we're on the lessor side. Rent is the lessor. And again, we start by knowing that if you're a lessor, you sign an operating lease, you're just renting out your property, so all the lease payments you collect will be credited to rental income, and that's what they want to know. What's the rental income for the year? Well, The lease payment we're going to collect every year is $50,000, but they're asking for the net rental income for the year. We're going to have to back out our expenses. What are our expenses? Well, obviously, you're going to back out the $12,000 depreciation. You're going to back out the $9,000 for property taxes, insurance. And how about that finder's fee of $15,000? You know what that is. That's an initial direct cost. And if the lessor has an initial direct cost, like a finder's fee of $15,000, they set up an asset and amortize it over the term of the lease. It's a 10-year lease. So divide by 10, we'll amortize $1,500 to this year. So add up all the expenses. They add up $9,000 plus $12,000 is $21,000 plus $1,500 is $22,500. Take your $50,000 rental revenue minus your expenses, $22,500. The net rental income for the year, answer A, $27,500. Now, if you're with me on those questions, you can see that operating leases, again, are fundamentally about accrual accounting. But now we're going to get into something a little bit more complicated, and that is a capital lease. I'm going to start on the lessee side. I'll get to the lessor side later. But we know if you're a lessee and you sign a lease and you're using that lease in substance to purchase the asset, if in substance the lease is a way to purchase the asset, we call that a capital lease. Now, here's the first thing that comes up in the exam. When you're in the exam, how do you know that you have a capital lease? How do you know that in substance the lease is a way to purchase the asset? Well, there's some criteria, and you're going to have to know it. Let's go over the criteria. The lessee has a capital lease if any one of four criteria are met. Any one. Number one, if there's a transfer of ownership. Always look for that. Either during the lease or at the end of the lease, does the ownership of the asset transfer from the lessor to the lessee? Always watch for that. Is there a transfer of ownership? Or, number two, is there a bargain purchase option? In other words, either during the lease or at the end of the lease, does the lessee have the option to purchase the asset at a bargain price? Is there a bargain purchase option? Or number three, is the term of the lease equal to or greater than 75% of the remaining life of the asset? Is the term of the lease equal to or greater than 75% of the remaining life of the asset? Or one more, or is the present value of the lease payments, equal to or greater than 90% of the fair value of the asset? If any one of those four criteria are met, the lessee has a capital lease. In substance, the lease is a way to purchase the asset. Now, let me just state the obvious. There's no way you can win the exam and not know that criteria cold. As you're going to see in this class, you have to know that criteria to break down multiple choice, to work out any problem on leases. You have to have that criteria in your mind. So I'm going to give you a memory tool. Just remember, 2 BOP 7590. 2 BOP 7590. It's a fast way to remember the criteria. Let's go over what it stands for. The TO, hey, is there a transfer of ownership? Either during the lease or at the end of the lease. Does the ownership of the asset transfer from the lessor to the lessee? Or number two, is there a BOP? Is there a BOP? Is there a bargain purchase option? Or what's 75? Is the term of the lease equal to or greater than, notice, equal to or greater than 75% of the remaining life of the asset, or 90? You know what 90 means? Is the present value of the lease payments, equal to or greater than, notice, equal to or greater than 90% of the fair value of the asset? Any one of those four criteria are met, you know it is a capital lease. Now, once you get that criteria down, now we're ready to approach a problem. Let's go in your viewer's guide to illustrate a problem number one. In illustrative problem number 1, they say that a lessee signs a lease contract which transfers ownership January 1, year 1. I would circle transfers ownership and right above it, TO. What do we already know? We already know it's a capital lease. That's how you take the exam. When you're in the exam, you're always thinking 2 BOP 7590, 2 BOP 7590. We know if any one of those 4 criteria are met, it is a capital lease. There's a transfer of ownership, that settles it. It is a capital lease. Then they go on to say that the minimum lease payments, the MLP, the minimum lease payments are going to be $10,000 every year for 5 years. And notice the first payment is due December 31. Let's pause here. Let's talk about something for a moment. You always have to remember that a lease contract represents an annuity. You know what an annuity is? It's a series of equal periodic payments over a specified number of periods. We know that a lease contract always represents an annuity in that it is a series of equal periodic payments over a specified number of periods. And I bring this up because when you see an annuity, as we have here, you have to remember that there are 2 types of annuities. Let's go over it. The first type of annuity is called an ordinary annuity, or a deferred annuity, or an annuity in arrears. Just remember that with an ordinary annuity, the equal payments are made at the end of every period. In other words, the end of every month, the end of every quarter, the end of every year. That's what makes an ordinary annuity, when the equal payments are made at the end of every period. The other type of annuity is called an annuity due. Sometimes they call it an annuity in advance. Just remember that with an annuity due or annuity in advance, the equal payments are made at the beginning of every period, the beginning of every month, the beginning of every quarter, the beginning of every year. That's what makes an annuity due. And I bring this up because in these lease problems, it's going to be critical that you nail down very quickly what sort of annuity you're dealing with. It's always going to be an important issue. In a lease problem, you've got to nail down what sort of annuity you're dealing with. How about this problem? What sort of annuity are we dealing with? Well, the lessee signed the lease contract January 1. Notice the first payment is due at the end of the first year, December 31. This is an ordinary annuity. You have to know that. Let's read on. They go on to say that the asset has a useful life of 8 years with no salvage. The lessee's incremental borrowing rate is 10%. Now let's get into the factors. We don't want present value of a dollar. We want present value of an ordinary annuity, 5 periods at 10%. The factor's 3.79. Let's do some entries. On January 1, when the lessee signs this lease, because we know it is a capital lease, because we know in substance the lessee is using the lease to purchase the asset, the lessee is going to take that factor, 3.79, times the equal payments in the lease, 10,000, and they're going to debit leased property, 37.9. Notice the lessee is actually debiting a fixed asset. In substance, they purchased this equipment, whatever it is, this machine, this piece of equipment. They own it. In substance, it's a purchase. So the lessee is going to take that factor, 3.79, times the equal payments, 10,000, debit lease property, 37,900, and credit lease liability, 37.9. So notice the lessee records a fixed asset at the discounted present value of the payments, and the lessee records a liability at the discounted present value of the payments. Let's go ahead a year. Let's say it's now December 31, year 1. Here's your thinking. Because the lessee had a balance outstanding in their liability all through year 1 of 37,900 times the interest rate 10%, the lessee is going to debit interest expense, 3,790. What's the credit to cash? 10,000. That's what the lease contract says. The lease contract says that the lessee has to make a $10,000 payment every December 31. So the lessee is going to credit cash 10,000. Notice the entry doesn't balance. They need a debit of 6,210 to balance the entry out. Debit lease liability, 6,210. That's the pay down of principal for the first year. And let me mention, if we did a balance sheet a year ago, that 6,210 would have been the current portion of the lease liability. because it's going to be paid off within a year. The rest of the lease liability would be non-current. And I want you to know that about lease liabilities. They do get divided up into their current and non-current portions. Are we done with year one? No. Don't forget that in substance, the lessee purchased this asset. They own this equipment. They own this piece of machinery, whatever it is. Notice I'm looking at that debit to lease property, $37,900. They have a fixed asset on the books at $37,900. Don't forget, they have to depreciate that fixed asset. Let's say they use straight line depreciation. I don't know if you see the little trouble spot yet or not. Do you see the little trouble spot? If I'm going to depreciate that machine, that leased property, how many years would I use? Would I depreciate that fixed asset over the 5-year term of the lease or the 8-year life of the property? I hope you see that wrinkle. A lot of students freeze right there. You know I have to depreciate the fixed asset, but over how many years? Would I use the 5-year term of the lease or the 8-year life of the asset? There's a rule. There's a rule, and you have to know it. Let's go over it. The rule is this. If the two of the BOP are met, if there's a transfer of ownership or a bargain purchase option, if the two of the BOP are met, depreciate over the life of the asset. If the 75 or 90 criteria is met, depreciate over the term of the lease. Make sure you know that rule. If the two of the BOP are met, depreciate over the life of the asset. If the 75 or 90 criteria is met, depreciate over the term of the lease. Now, obviously, in this problem, the criteria that was met is a transfer of ownership. So we're going to depreciate over the life of the asset. So if I'm the lessee here, I'm going to take that leased property, $37,900. No salvage. They said there was no salvage. If there was salvage, I'd back it out. No salvage. Over 8 straight line years, the life of the asset, because there's a transfer of ownership. And I'm going to debit depreciation expense, $4,737.50, and I'm going to credit accumulated depreciation, $4,737.50. Don't forget to depreciate that fixed asset. A lot of students do. Let's go ahead another year. Same problem. Let's say it's now December 31, year 2. Well, the first thing we have to do is work out the balance in the liability. We know that we had a balance in our lease liability when we started of $37,900, but at the end of the first year, we paid off $6,210 of principal. So that means that the balance that was outstanding in our liability all through year 2, $31,690. $31,690 times the interest rate 10%, we're going to debit interest expense, $3,169. Debit interest expense, $3,169. What do I credit to cash? $10,000, because that's what the lease contract says. The lease contract requires that we make a $10,000 payment every December 31. So we're going to credit cash $10,000. The entry doesn't balance. I need a debit of $6,831 to balance the entry out. You know what that is. Debit lease liability, $6,831. That's the pay down of principal for the second year. It's a plug. You really get that by getting that entry down, the difference between the interest expense and the payment. That's the pay down of principal. And obviously, if we'd done a balance sheet, a year ago, that $6,831 would have been the current portion of that lease liability. The rest would be non-current. But always remember that lease liabilities do get divided up into their current and non-current portions. Are we done at the end of year 2? No. Don't forget to depreciate the fixed asset. This is a capital lease. In substance, we purchased this equipment. So we're going to take that leased property, $37,900. No salvage. Over 8 straight line years, the life of the asset, because this is a transfer of ownership. And we're going to debit depreciation expense, $4,737.50, and credit accumulated depreciation, $4,737.50. That adjustment has to be made. Why? Because we own this equipment. We own it now. It's a capital lease. In substance, we use the lease to purchase the asset. All right, now, in a sense, that problem was really just to kind of warm you up, get you in the mood. Now let's do another problem, maybe a little bit more complicated. Look at illustrative problem number 2. The lessee signs the lease January 1, year 1. It's a 10-year lease. The MLP, the minimum lease payments, are going to be $15,000 every year. And the first payment is due, notice, on the first day, the day we sign the lease, January 1. This is an annuity in advance. This is an annuity due, because the equal payments are made at the beginning of every period. The first payment was made the first day of the lease, January 1. It's an annuity in advance or an annuity due. As I've said, in lease problems, you've got to be able to nail down what sort of annuity you're dealing with. They say that the asset has a useful life of 15 years, no salvage. Then they say that at the end of the lease, the property has a fair market value of $25,000. But notice the lessee has the option to purchase the asset at a bargain price, $10,000. You know what that is? It's a BOP. Hey, that's a BOP. It's a bargain purchase option. They have the option to purchase the asset at the end of the lease at a bargain price. That's a BOP. What do we know? What do we know already? It's a capital lease. Because that's how you take the exam. 2 BOP 7590, 2 BOP 7590, 2 BOP 7590. That's what's in your head. Any one of those criteria are met. It is a capital lease. So we know that. Now, they go on to play a little game with interest rates. And the exam does like this. They say that the lessee's incremental borrowing rate is 12%, but the lessor's rate, implicit in the lease, is 10%. And that's known to the lessee. So you're in the exam, how would you know what interest rate to use? The lessee's rate, which is 12%, or the lessor's rate, which is 10%. Well, there's another rule, and you have to know it. Let's go over the rule. I know you love these rules, but it's a rule, and you have to know it. The rule is, we use the lessor's rate. Use the rate implicit in the lease. Use the lessor's rate. If it's both lower than the lessee's rate and known to the lessee. It's got to be both lower than the lessee's rate and known to the lessee. That's the rule. Use the lessor's rate, the rate implicit in the lease, when it's both lower than the lessee's rate and known to the lessee. It has to be both lower and known. Lower and known. And notice in this case, the lessor's rate, 10%, is both lower than the lessee's rate, 12, and they do know about it. So we are going to use 10%. That's the interest rate. Let's get our factor. We don't want present value of an ordinary annuity. We want present value of an annuity in advance. 10 periods, 10%. The factor is 6.76. We're going to take that factor, 6.76, times the equal payments in the lease, $15,000. That multiplies out to $101,400. That is the discounted present value of those minimum lease payments. $101,400. But I'm not done. What's different in this problem is that there's a BOP. Notice at the end of the lease, the property has a fair value of $25,000, but the lessee has the option to purchase the asset at a bargain price, $10,000. When you're in the exam, you have to assume that that's such a bargain, that's such a good deal, that the lessee no doubt will take advantage of it. So theoretically, that's another $10,000 cash that flows out at the end of the lease. You have to discount that as well. So your job here is to discount all the cash outflows for the lessee, even the BOP. And as I say, the thinking is that that's such a good deal. No doubt the lessee would take advantage of it. So theoretically, that's another $10,000 cash that flows out at the end of the lease. Let's get our factor. Now we want present value of a single dollar, 10 periods of 10%. The factor is 0.386. This is not a stream of payments. It's not an annuity. It's one lump sum, theoretically, that flows out at the end of the lease. So I want present value of a single dollar, 10 periods of 10%. The factor is 0.386. I'm going to take that factor, 0.386, times the BOP, 10,000. That discounts to 3,860. If you add it up, the 1,014 and the 3,860, the discounted present value of all the cash flows, all the cash outflows, adds up to 105,260. So on January 1, year 1, if I'm the lessee, I'm going to debit lease property. In substance, I own this asset. I'm going to debit a fixed asset account, lease property, for the discounted present value of all the cash outflows, $105,260. And I'm going to credit lease liability for the discounted present value of all the cash outflows, $105,260. What I'm asking you to remember is this. BOPs get capitalized. Don't forget, BOPs get capitalized. That's what we're learning here. You see a BOP, you know it gets capitalized. Now, when does the lessee make the first $15,000 payment? That's right, today. This is an annuity in advance. This is an annuity due. So the lessee makes the first $15,000 payment right away. So we're going to debit lease liability $15,000 and credit cash $15,000. I think we can agree that if the first payment is made the first day, it would all be principal. There'd be no interest. It would all be principal. No time has passed. There'd be no interest factor. So we'll just simply debit lease liability $15,000 and credit cash $15,000. Now let's go to the end of the year. Now it is December 31, year one. Let's work out the balance in our liability. We know that the lease liability started with a balance of $105,260, but this is an annuity in advance, so they made a $15,000 payment the first day. It was all principal, so right away that knocked the liability down to $90,260. Let's agree that they had a balance outstanding in their liability all through the first year of $90,260 times the interest rate 10%. They're going to debit interest expense $9,026. What would I credit to cash? What do you think I would credit to cash? Nothing. My lease contract says I make a $15,000 payment every January 1. I'm at December 31 making my accruals, so I would credit interest payable $9,026. Be careful. There's no payment till January 1. We're at December 31 making our accruals. Am I done? No. Don't forget to depreciate the fixed asset. Remember, this is a capital lease. In substance, the lease was used to purchase this equipment, whatever it is. It has to be depreciated. Now let's assume they use straight line. Am I going to depreciate this fixed asset over the 10-year term of the lease or the 15-year life of the asset? 15. Why? Because there's a BOP. We know if the two of the BOP are met, depreciate over the life of the asset. If the 75 and 90 criteria is met, depreciate over the term of the lease. What if more than one criteria is met? What if there's a BOP and also the term of the lease is 75% or more of the life of the asset? Then you depreciate over the life of the asset. Anytime two or BOP are met, use the life of the asset for depreciation, even if some other criteria are met. You see two or the BOP are met, you have to depreciate over the life of the asset. So because there's a BOP here, we're going to depreciate over the life of the asset. So we're going to take that leased property, $105,260, that fixed asset, no salvage. They said there was no salvage. If there was salvage, I'd back it out. Divide by 15 straight line years, the useful life of the asset. We're going to debit depreciation expense, $7,017, and credit accumulated depreciation, $7,017. Don't forget to depreciate that fixed asset. I know you won't. Now, the next time there'd be an entry, of course, would be January 1, year 2. I'd have to make a lease payment because that's what my lease contract says. Our lease contract says that we have to make a $15,000 payment every January 1. So on January 1, year 2, we're going to credit cash $15,000. Now we debit that interest payable, $9,026, and debit lease liability, $5,974. That's the pay down of principal for the first year. And it's a plug, the difference between the interest and the payment. That's our pay down of principal. And obviously, if we'd done a balance sheet a year ago, that $5,974 would have been the current portion of our lease liability. The rest would be non-current, because we always remember that lease liabilities do get divided up into their current and non-current portions. All right, now let's go to the end of year 2. It's now December 31, year 2. You know the first thing we have to do, work out the balance in our liability. And I hope you understand this is like a little side calculation that you'd have to do in the exam in your scrap paper. You've got to be good at manipulating this liability. So let's work out the balance in our liability. Our liability started January 1, year 1 at $105,260, but we made a $15,000 payment right away. It was all principal, so that brought the liability down to $90,260, and then we paid off $5,974 principal at the end of year one. So that means the balance that was outstanding our liability all through year two, $84,286. I'm going to take that liability, $84,286, times the interest rate, 10%. We're going to debit interest expense, $8,429. It's actually $8,428.60, but I'll just round it. Debit interest expense, $8,429, and credit interest payable, $8,429. Not cash, because you know there's no payment till January 1, because that's what the lease contract says. The lease contract says that I make a $15,000 payment every January 1. We're at December 31, making our accruals. Am I done with year two? Of course not. Don't depreciate the fixed asset, and I know you won't. We, in substance, have purchased this asset. We own this asset. It has to be depreciated. So I'm going to take that lease property, $105,260, no salvage, over 15 straight line years, the life of the property, because there's a BOP. I'm going to debit depreciation expense, $7,017, and credit accumulated depreciation, $7,017. You never forget to depreciate that fixed asset. When's the next time there'd be an entry? That's right, January 1, year 3, because that's what my lease contract requires, that I make a $15,000 payment every January 1. So on January 1, year 3, I'll credit cash $15,000. Now I'll debit that interest payable, $8,429. The entry doesn't balance. I need a debit of $6,571 to balance the entry out. That would be a debit to lease liability, $6,571, because that is the pay down of principal for the second year. I hope you're getting more comfortable with the flow. Now, I want to go back to the first entry that we made in this problem. We know that way back on January 1, year 1, we had to get the discounted present value of all the cash outflows on the lease, even the BOP, and it added up to $105,260. So what we did originally was debit lease property, $105,260, and credit lease liability, $105,260. That's the first entry that we made in this problem, back on January 1, year 1. Just want to show you a couple of other wrinkles they could put into these problems. What if in the same problem they had said that the lessee had to pay $3,000 in initial direct costs, say for a finder's fee? Well, if the lessee in this problem had to pay $3,000 in initial direct costs, like a finder's fee, instead of debiting lease property $105,260, you would debit lease property $108,260. You'd still credit the liability, lease liability, $105,260, and you would credit cash $3,000. I want to show you that entry just to make the point that an initial direct cost, like a finder's fee, would be capitalized. It would be capitalized. Same problem. What if the problem said that the lessee has to pay $2,000 in annual executory costs? Well, if you see annual executory costs, I would always think of it as annual maintenance. Same idea. And the point is that annual executory costs, annual maintenance, is not capitalized. It's expensed every year. So when you made, in this problem, when you made your first payment of $15,000, you would debit the lease liability $15,000, debit the executory costs and expense $2,000, and credit cash $17,000. I just want to make those points that an initial direct cost, like a finder's fee, would be capitalized. But any sort of annual executory costs, annual maintenance would not be capitalized. It's expensed every year. One more point. What if in the same problem they said that the asset, the machine, the piece of equipment, whatever it is, has a cash price, a fair market value, a cash price of $95,000? If the exam told you that the lease property, the asset, the machine, the equipment, whatever it is, has a cash price of $95,000, then you could not debit lease property $105,260. You cannot knowingly write an asset above its fair value, above its cash price. So if they told you that the asset had a cash price of $95,000, I would debit lease property, not $105,260. I would debit lease property $95,000 and credit lease liability $95,000. And the rest, the thinking would be, would have to be interest. In other words, in substance, the argument would be that in substance, you're paying much more than 10% interest. The rest would have to really be interest, because you can't write an asset above its cash price. Now, I'm not saying the examiner would do that a lot, but just another little trick they could throw in. They tell you that the lease property has a cash price of $95,000, then you can't debit lease property $105,260 and credit lease liability $105,260 because you can't write an asset above its cash price. No, you're really, in that case, paying much more than 10% interest. Debit lease property $95,000, credit lease liability $95,000, its cash price, and the rest would be written off to interest. And as I say, that's not something the exam does a lot, but it is a possible trick they could throw in, so be careful. Now, we've covered a lot of ground. I think it's time to see how you're doing on this. I'd like you to try multiple choice number 4. Just shut the class down, do number 4, and then come back. Welcome back. In number 4, if you go to the bottom, they say, at inception of the lease, Clay would record a lease liability of what? So they want to know the balance in the lease liability. And I have a question for you. You're in the exam. What is the only way that you know you have a capital lease? That's right. 2 BOP 7590. 2 BOP 7590. It's the only way you know. So let's go through the criteria. In this problem, is there a transfer of ownership? No. Did you notice they said that at the end of the lease, possession of the machine reverts back to Sachs, the lessor? No, there's no transfer of ownership. Is there a BOP? Is there a bargain purchase option? No, they don't say anything about Clay having the option to purchase the asset at a bargain price. What's 75 mean? Hope you're getting used to it. 75 means what? Is the term of the lease equal to or greater than 75% of the remaining life of the asset? Well, in this problem, what's the term of the lease? 10 years. What's the remaining life of the asset? 15. 10 over 15 is 66 2/3%. No, the term of the lease is not equal to or greater than 75% of the remaining life of the asset. It's not. What's 90 mean? Is the what? What do I look at? Is the present value of the lease payments. We have to work it out. Let me ask you this. Is this an ordinary annuity or annuity due? It's an annuity due. I think I'd circle the word beginning. They say payments are made at the beginning of each lease year. So we know it's an annuity due, annuity in advance. Let's get the factor. I want present value of an annuity in advance, 10 periods, 10%. The factor is 6.76. We're going to take that factor, 6.76, times the equal payments in the lease, 50,000. Notice that the present value of the lease payments in the lease comes out to 338,000. Is that equal to or greater than 90% of the fair value of the asset? What's the fair value of the asset? 400,000. If you take 338,000, present value of the lease payments, over 400,000, the fair value of the asset, it comes out to 84.5%. No, the present value of the lease payments are not equal to or greater than 90% of the fair value of the asset. Here's my question. If none of the criteria are met, what sort of lease is this? That's right, it's an operating lease. They're just renting the property. There is no lease liability, and the answer is D. Be careful. The only way you know you have a capital lease is 2 BOP 7590. And as I say, if none of the criteria are met, it's an operating lease. You're using that lease to just rent the property. It's not a capital lease. There is no lease liability, and the answer is D. And one of the lessons you learn in that question is that when you're doing lease questions, anytime you see a 0 for an answer, that always gets your attention, because if none of the criteria are met, it is 0. So be careful. Try a couple more. Please try 5 and 6, and then come back. Welcome back. Let's do these questions together. In number 5, if you go to the bottom, once again, they want to know the balance in the lease liability. And as I said before, you're in that exam. The only way you know you have a capital lease is 2 BOP 7590. So let's go through it. In this problem, Is there a transfer of ownership? No. At the bottom they said possession of the machine reverts back to Greg, the lessor. No, there's no transfer of ownership. Is there a BOP? No, they don't say anything in the problem about Haber, the lessee, having the option to purchase the asset at a bargain price. There's no BOP. What's 75 mean? Is the term of the lease equal to or greater than 75% of the remaining life of the asset? Well, in this problem, the term of the lease is 10 years. Remaining life of the asset is 12. 10 over 12 is 83%. You can stop right there. It is equal to or greater than 75% of the remaining life of the assets, 83%. It is a capital lease. Let me ask you this. Is this an ordinary annuity or annuity due? Ordinary annuity. I'd circle the word end. Payments made at the end of each lease year. So let's get our factor. I want present value of an annuity in arrears. 10 periods, 10%. Factor 6.15. I'm going to take that factor, 6.15, times the equal payments in the lease, 100,000. And if I'm Haber, the lessee, I'm going to debit lease property, a fixed asset, 615,000. I'm going to credit lease liability, which is what they wanted, for 615,000. Answer B, the discounted present value of all the lease payments. Because in substance, this lease was a way to purchase that asset. They own the asset. And I know it's a capital asset because the 75 criteria was met. Number 6. In number 6, we know it's a capital lease because they say it. And I want to say this to you. If the exam says this is a capital lease, that ends, you don't have to worry about the criteria, that ends the issue. It is a capital lease. I don't want you to think that the exam will say it's a capital lease, but you have to figure out it's not really a capital lease. The exam's not going to do that. If the exam says it's a capital lease, that ends the issue. You know it's a capital lease. Now, we know that the lessee's incremental borrowing rate is 9%. We know present value of an ordinary annuity for 9 periods at 9%. It's 5.6. We got the factor. Now, what are the lease payments? The only tricky thing in this problem was that they said that the lease payments are $52,000 every year, but that includes $2,000 of real estate taxes annually. Well, that's not a payment on the lease. Real estate taxes shouldn't be capitalized. The payments on the lease are $52,000. Back out those real estate taxes, $2,000. The payments on the lease are $50,000. Times that factor, 5.6. We're going to debit lease property, $280,000. Credit lease liability, $280,000. They wanted the balance in the liability. And the answer is A. And then for the real estate taxes every year you're going to debit real estate tax expense, $2,000, and credit cash, $2,000. That's like annual executory costs. These annual costs, annual maintenance, annual executory costs. In this case, annual real estate taxes. The point is, they're not payments on the lease. They're not capitalized. They're annual expenses every year, and they should be expensed every year. I'd like you to try 7 and 8, and then come back. Welcome back. In number 7, they want to know, again, the balance in the lease liability. And, of course, the first question is, in number 7, how do we know it is a capital lease? Well, they say it. They do say it's a capital lease. That ends the issue. Not only that, we know there's a BOP, so we know it is a capital lease. Let me ask you this. In this problem, is it an ordinary annuity or an annuity due? It's an annuity due because they said payments begin immediately. They begin immediately. It is an annuity in advance, an annuity due. Here's another issue in this problem. When it comes to the interest rate, should I use Robin's, the lessee, should I use Robin's incremental borrowing rate of 14% or the lessor's rate, 12? 12, because I use the lessor's rate, the rate implicit in the lease, when it's both lower and known. And the lessor's rate, 12%, is lower than the lessee's rate, 14, and they must know about it because the lease specifies the rate. So we're going to use 12%. Let's get our factor. We want present value of an annuity due, 12%, 10 periods, factors 6.328. I'm going to take that factor, 6.328, times the equal payments in the lease, 10,000. That discounts to 63,280. But we can't stop there because there's a BOP. BOPs get capitalized. They said at the end of the lease, the asset's going to have a fair market value of $20,000. But Robbins has the option to purchase the asset at a bargain price, $10,000. As we said earlier in this class, in the exam, you have to assume that's such a bargain. That's such a good deal that theoretically, that's another $10,000 cash that flows out at the end of the lease. That's another cash outflow. But now we want present value of a single dollar, 10 periods of 12%, 0.322. I'm going to take that factor, 0.322, times the $10,000 BOP. That discounts to $3,220. Add it all up. The discounted present value of all the cash outflows will be $66,500. So if you're Robbins, the lessee, you're going to debit lease property, $66,500, and credit what they wanted, the lease liability, $66,500. And the answer is C. Just remember, BOPs get capitalized. And let me mention this too. If they said in a lease that the lessee was guaranteeing a residual value, if you ever see that in a problem, that the lessee is guaranteeing a residual value, you treat that like a BOP. A guaranteed residual value is something the lessee is guaranteeing the asset will have a certain value at the end of the lease. That guaranteed residual value, you'd capitalize that like a BOP. It's treated just like a BOP. Number 8. Once again, they're asking whether or not this is a capital lease. We don't know. We don't know it is a capital lease. All we know is at the bottom, they want to know what East would record as a capitalized asset. Well, there's no zero for an answer, so it must be a capital lease. But how do you know for sure it's a capital lease? Because the term of the lease, 10 years, over the remaining life of the asset, 12 years, is about 83%. Notice the term of the lease is equal to or greater than 75% of the remaining life of the asset. It's actually 83%. So we know it is a capital lease. In number 8, are we dealing with an ordinary annuity or annuity in advance? Well, if you circle the word beginning, you know it's an annuity in advance. Payments made at the beginning of each lease year. So we'll get our factor. Present value of an annuity in advance, 10 periods at 14%. The factor is 5.95. You're going to take that factor, 5.95 times the equal payments in the lease, 40,000. That discounts to 238,000. Is there a BOP? Well, they say that East has the option to purchase the asset, the machine, on May 1, year 16, by paying $50,000, which approximates its expected fair value on that date. That's not a BOP. A BOP is you have the option to purchase the asset at a bargain price. No, this option is that at the end of the lease, you have the option to purchase the asset at its fair value. Oh, that's a terrific deal. The point is, you can't assume they'll take advantage of that option. They may or may not take advantage of that option. Maybe at that point, they'd rather have a new asset. My point is this: only capitalize a purchase option if it's a bargain purchase option. It has to be a bargain price. When it's a bargain price, we assume that the lessee would take advantage of it, but not just any option to buy. Yeah, they have the option to purchase the asset at its fair value. You can't assume they'll take advantage of that. So the answer is B. They're going to debit a capitalized asset for $238,000, credit lease liability $238,000. Answer B. They wanted the value of the capitalized asset. But as I say, you don't just capitalize any purchase option. It has to be a bargain price. A bargain purchase option. A BOP. Please do 9 and 10 and then come back. Welcome back. In number 9, they want to know what the depreciation expense would be for the year. And I'm sure you noticed there's a 0 for an answer right on top. You know if none of the criteria are met, it's not a capital lease, it would be an operating lease, and in an operating lease, there wouldn't be any depreciation expense, and the answer would be 0. So here's my question. How do you know this is a capital lease? I hope you noticed it. They said title passes. Notice they said title passes to the lessee. There is a transfer of ownership. It is a capital lease. It is. Now, what they capitalized for the asset was $108,000. That must have been the discounted present value of all the cash outflows, $108,000. But here's my question. If I'm going to do depreciation, would I depreciate that asset over the 8-year term of the lease or the 12-year life of the asset? 12, because the two of the BOP met. If the two of the BOP met, depreciate over the life of the asset. If the 75 and 90 criteria is met, depreciate over the term of the lease. Here what's met is a transfer of ownership. The TO is met. We would depreciate over the life of the asset, which is 12 years. So if I take what they capitalized for the asset, $108,000, divide by 12 straight line years, the answer is B, $9,000 of depreciation expense. In number 10, once again, they want to know the depreciation expense for the year. Now here we know it's a capital asset because they say it is. There's no zero for an answer anyway. But we know it's a capital asset. We know it's a capital lease. And there's a BOP also. So there's no question. It's a capital lease. Now what they capitalized for the asset was $240,000. And if you read it carefully, that $240,000 included the BOP, as it should. BOPs get capitalized. If you take that $240,000, should I depreciate that over the 8-year life of the asset or the 5-year term of the lease? 8-year life of the asset. The two of the BOP are met, depreciate over the life of the asset, and there's a BOP. If you take that $240,000 cost of the asset, divide by 8 straight line years, you get answer C, and answer C is wrong. But it's tempting. If you pick C, I hope you see what you missed. Salvage value. They said Nori estimates that the equipment's fair value will be $20,000 at the end of its 8-year life. Well, that's salvage value. And straight line does back out salvage. So we're going to take what they capitalized for the asset, $240,000, back out the salvage, $20,000, that's $220,000 over 8 straight line years, and the answer is D. So be careful. Straight line backs out salvage. And that's really the first time it's come up. Please do 11, 12, and 13, and then come back. Welcome back. Let's do these questions together. In number 11, if you go to the bottom, they want to know the balance in the lease liability at December 31, year 2. And I know that you noticed that answer D is a 0. So you had to think, are we sure it's a capital lease? Because it all comes back to 2 BOP 7590, and if none of the criteria are met, it's an operating lease. There is no lease liability. The answer would be D. So that's my question to you. How do you know it's a capital lease? Because in the first sentence, they said the term of the lease is for the entire 9-year life of the asset. Well, obviously, if the term of the lease is for the entire life of the asset, that's equal to or greater than 75%, so we know it is a capital lease. We know that. So it's not answer D. Now, another thing you had to think about, always with a capital lease, is this an ordinary annuity or annuity in advance? Well, notice in the first sentence they said the $50,000 lease payments are made at the start of the lease term. They made it immediately, right at the start of the lease. December 31, year 1, when they signed the lease, they made a $50,000 payment. So obviously, if the payments are made at the beginning of every yearly period, right at the start, it is an annuity in advance. It's an annuity due. Another thing I want to ask you. If we have to work out the balance in the lease liability December 31, year 2, what was your starting point? What was the balance in the liability when you began? December 31, year 1. Was it $316,500 or $298,500? Got two choices there. Be $316,500, wouldn't it? Because we use the lessor's rate, the rate implicit in the lease, if it's both lower and known. And notice that the lessor's rate, 12%, the lessor's rate, 10%, is both lower than the lessee's rate, and Oak's rate is 12. The lessor's rate implicit in the lease is 10. It is lower, and they say Oak knows about it. They do know about it. It's both lower and known. We're going to use the lessor's rate, 10%. So that means that the liability started December 31, year one, at $316,500. And because it's an annuity in advance, didn't they make their first $50,000 payment immediately on that same day? And if they made it on that same day, it would all be principal. There'd be no interest. No time has passed. So right away, that knocked the liability down to $266,500. But they want the balance in the liability a year later, December 31, year two. What happens on December 31, year two? They make another $50,000 lease payment, but some of that would be interest. The balance that was outstanding in the liability all through year two, $266,500 times the interest rate 10%, $26,650. $26,650 of that payment would be interest. The rest of the $50,000 payment, $23,350, would be a pay down of principal. So we would pay down the liability from $266,500 down $23,350 to answer B, $243,150. Make sure you're good and comfortable with manipulating that liability. You know, I basically think of leases as a liability area, even though there are obviously other accounts involved, assets and depreciation, other things are involved as well. But fundamentally, I think of capital leases as a liability area because it's so essential that you're comfortable with manipulating that liability. In number 12, they say on January 1, year one, Frost entered into a 2-year lease with A company to lease 10 new computers. The term of the lease is 2 years. The annual lease payments are $8,000. Present value of the lease payments, $13,000. Which of the following circumstances would require Frost to classify this as a capital lease? Well, again, it's 2 Bob 7590. That's what you're looking for. How about answer A? What if the economic life of the computers is 3 years? Well, the term of the lease, 2 years, over 3, the life of the computers, that's just 2/3, 66 2/3%. It's not, the term of the lease is not equal to or greater than 75% of the remaining life of the asset, just 2/3, 66 2/3%. So that wouldn't do it. How about B? What if the fair value of the computers on the day you signed the lease was $14,000? What's 90% of $14,000? $12,600. Notice the present value of the lease payments, $13,000. They gave you that. Is greater. It's equal to or greater. Here it's greater than 90% of the fair value of the asset. That would make it automatically a capital lease. If the present value of the lease payments, $13,000, is equal to or greater than 90% of the fair value of the asset, 90% of $14,000 is $12,600. Yeah, the present value of the lease payments, $13,000, is equal to or greater than 90% of the fair value of the asset. Answer B would automatically make it a capital lease. So the answer is B. C said there's no bargain purchase option, no BOP. That wouldn't do it, of course. D, ownership does not transfer. That wouldn't do it. Answer B would do it. And the answer, of course, is B. In number 13, it says on December 31, year 6, Roe leased a machine from Colt for a 5-year period. Equal payments under the lease are $105,000, but that included $5,000 in annual executory costs, annual maintenance. The payments are due December 31 of each year. And notice the first payment was due right away, December 31, year 6. It's an annuity in advance, an annuity due. They said that the present value of all the lease payments on the day they signed the lease, $417,000. Let's do a couple of entries. We know the day they signed the lease, December 31, year 6. They would have debited lease property for the discounted present value of the lease payments, $417,000, and credited lease liability for the discounted present value of the lease payments, $417,000. Now, because this is an annuity in advance, they made the first payment right away. So on that same day, December 31, year 6, they would have credited cash $105,000. They would have debited executory costs and expense $5,000 and debit lease liability $100,000. So they paid down $100,000 of principal on the first day. Right away, that brought the lease liability down to $317,000 right away because it's an annuity in advance. And notice again, those executory costs, those annual executory costs, those really aren't payments on the lease. annual maintenance, annual real estate taxes, things like that are not expensed. Excuse me, things like that are not capitalized. They're not payments on the lease. They're expensed every year. So that's why I credited cash $105,000, debit executory costs and expense for $5,000, and debit the liability for just $100,000. But my point is, now the liability going forward is down to $317,000. We go ahead a year. It's now December 31, year 7, which is what they're asking about. Didn't they have a balance outstanding in their liability all through year 7 of $317,000 times the interest rate 10%? They're going to debit interest expense $31,700. Credit cash $100,000. That's the payment on the lease. And debit lease liability $68,300. That's the pay down of principal for that year. And then they would debit executory cost $5,000, credit cash $5,000. That would be expensed every year. Those are all the entries. They ask us at the bottom, December 31, year 7, what's the liability now? Well, it was $317,000. We just paid off $68,300 of principal, so the liability is down to answer D, $248,700. Now, you may have noticed that up until this point, all we've discussed are leases from the lessee side. Now let's go to the lessor side, because as I mentioned at the beginning of class, sometimes the exam asks questions on the lessor side. Now let's go back to the beginning of class. Remember we said at the beginning of class, if I'm a lessor and I sign a lease, if I'm using that lease to just rent out my property, if I'm just renting out my property, we call that an operating lease. But if I'm a lessor and I sign a lease and I'm using that lease in substance to sell my property, if in substance the lease is a sale, well then there are two possibilities for the lessor. It could be a sales type lease, or it could be a direct financing type lease. Those are the possibilities for the lessor. Either a sales type lease or a direct financing type lease. Here's the first thing that you could see in the exam. You're in the exam. How do you know if the lessor has a sale? Here we go. The lessor has a sale if it meets all this criteria. First, the 2 BOP 7590 criteria has to be met from the lessor's perspective. So that's number one. The 2 BOP 7590 criteria, which you know so well, must be met from the lessor's perspective. And collectability of the lease payments. Collectability of the MLP, minimum lease payments, must be reasonably assured. So the 2 BOP 7590 criteria must be met from the lessor's perspective. And collectability of the MLP, the minimum lease payments, must be reasonably assured. And one more, and there are no material uncertainties regarding any future costs. That's the final piece. There can't be any material uncertainties regarding any future costs. If the lessor meets all of that criteria, in substance, the lessor has a sale. In substance, the lease was a way for the lessor to sell the property. And then, as I said, if in substance it's a sale, then there are two possibilities for the lessor. Could be a sales type lease, could be a direct financing type lease. Let's start with a sales type lease. And I want to go back to the problem we did earlier, because we sort of know the numbers. We're going to go back to that illustrative problem number 1. And you remember the basic facts. The lease was signed January 1, year 1. It is a 5-year lease. The lease payments are $10,000 every year. It was an ordinary annuity. Payments made at the end of every year. Now, just to refresh your memory, remember what the lessee did. This we've already covered. The lessee said, well, present value of an ordinary annuity, 5 periods of 10%. The factor is 3.79. What the lessee did was take that factor, 3.79, times the $10,000 of equal payments in the lease. And what the lessee did was debit lease property, $37,900, and credit lease liability, $37,009. That's what the lessee did. Debit lease property, $37,900. Credit lease liability, $37,900 for the discounted present value of all the lease payments. Well, now let's take the same problem, since we sort of know the numbers, but let's go to the other side. Now let's say we're on the lessor side, and let's say it is a sales-type lease. So now we're on the lessor side. It is a sales-type lease, and also let's assume that the asset has a cost to the lessor of $30,000. Those are my assumptions. Same problem. Now we're the lessor side. It is a sales-type lease. And let's assume that the asset has a cost to the lessor of $30,000. Let me show you the entries that the lessor would make in the same problem. If I'm the lessor in this problem, I know that I'm going to collect 5 payments of $10,000 each. So I'm going to debit gross lease receivable $50,000. Again, if I'm the lessor, I know that I'm going to collect 5 payments of $10,000 each. So I'm going to debit gross lease receivable $50,000. And notice this. In a sales-type lease, I credit sales. I'm going to credit sales, in this case, for $37,900, the discounted present value of the payments, or sometimes in the exam, they'll just give you the sales price. So I'm going to say it again. If you're in a sales-type lease, you're going to credit sales for the discounted present value of the payments, or sometimes the exam will just give you the sales price, the cash selling price. We don't know the cash selling price here, so I'm going to credit sales for the discounted present value of the payments, $37,900. But the big point is, it's a sales-type lease, so I credit sales. If I'm the lessor, I'm going to treat this as if I went out and made a sale of $37,900, and I'm going to credit discount $12,100. Now, we're going to make another entry. We said that the asset has a cost to the lessor of $30,000. So now they make a second entry where they debit cost of goods sold, $30,000, and credit the asset, $30,000. That's the second entry. Debit cost of goods sold, $30,000, credit the asset, $30,000. Those are the entries that you would make in a sales-type lease. So with those entries in mind, what could the exam ask you? Well, a couple of questions. They could ask you, in a sales-type lease, what is the profit on sale? What's the profit on sale for the lessor? Well, if you look at the entries, it's pretty obvious. They want the profit on sale. Just take the sales, $37,900, minus the cost of goods sold, $30,000. Profit on sale would be $7,900. That's a question they could ask you. In a sales-type lease, what is the profit on sale? Just look at the entries. It's obvious. Take the sales, $37,900, minus the cost of goods sold, $30,000. Profit on sale would be $7,900. Now, there's only one thing left that they could get into. Let's go to that $12,100 discount. All that's left is that the lessor will take that discount and amortize it to interest income over the term of the lease. See, that's the nature of a sales-type lease. There's a profit on sale, and then the lessor makes a little money on financing as they amortize the discount to interest revenue over the term of the lease. All right, let's say a year goes by. Let's say it's now December 31, year 1. How do you work out the interest revenue? Well, the important thing is to work with the net receivable. I'm going to take the gross receivable, which was $50,000, minus the discount, $12,100. Notice the net receivable is $37,900 times the interest rate, 10%. We're going to debit discount, $3,790, and credit interest income, $3,790. What we've now gone through, that is the nature of a sales-type lease. That's what happens to the lessor. There's a profit on sale, and then they make some money on financing as they amortize the discount to interest income over the term of the lease. There's a profit on sale, they make some money on financing. There's a profit on sale, they make some money on financing. And as I say, when you're working out the amortization of the discount, the important thing is to work with the net receivable. Taking the gross receivable, $50,000, minus that discount, $12,100, the net receivable would be $37,900 times the interest rate, 10%, debit discount, $3,790, credit interest revenue, $3,790. I'd like you to try a problem. Please do number 14 and then come back. Welcome back. In number 14, they say Peg leased equipment from Howe, July 1, year 7, for an 8-year period expiring June 30th, year 15. Equal payments under the lease, $600,000. Every payment is due July 1. And notice that The first payment is due July 1, year 7, the day you sign the lease. So obviously, this is an annuity due, always important. The rate of interest contemplated by Peg and Howe, 10%. The cash selling price of the equipment, $3,520,000. The cost of the equipment on Howe's books, $2,008,000. They say the lease is appropriately recorded as a sales type lease. And when you're on the lessor side, generally the exam will tell you whether it's a sales type lease or it's a direct financing type lease. That's one good thing about being on the lessor side. When the exam has questions on the lessor side, they'll tell you whether it's a sales type lease or it's a direct financing type lease. For the lessor, here it is a sales type lease. What is the amount of profit on sale, and what's the interest revenue that Howe, the lessor, would record for the year ended December 31, year 7? Well, let's think about a couple of entries. Not that you had to do entries, but I'm hoping that the entries make this clearer. On July 1, year 7, when Peg and Howe enter into this lease, what entry would Howe make? Howe is the lessor. Well, if you're Howe, you're going to look at this as if over the term of the lease, you're going to collect 8 payments of $600,000 each. So you're going to debit gross lease receivable for $4,008,000. And in a sales type lease, if you're Howe, you're going to credit sales. In this case, for $3,520,000, the cash selling price. As I said before, in a sales type lease, you credit sales for either the discounted present value of the payments, or sometimes the exam will give you the cash selling price. Here they gave you the cash selling price, $3,520,000. But the important thing is that in a sales type lease, you credit sales. In this case, for the cash selling price, $3,520,000, and you would credit discount $1,280,000. And then Howe would make a second entry where they debit cost of goods sold for the cost of the asset shipped. They said the cost of the asset on Howe's books, $2,008,000. So they would debit cost of goods sold, $2,008,000, and credit the asset, $2,008,000. Those are the entries that you make in a sales type lease. Now let's answer some questions. In the first column, they want to know what's the profit on sale. Well, if you look at the entries, it's pretty obvious. Take the sales, $3,520,000, minus the cost of goods sold, $2,008,000. Let's agree that profit on sale would be $720,000. So it has to be A or B. Has to be. But they also want the interest income, the interest revenue, because that's all that's left for the lessor. The lessor takes that discount of $1,280,000 and amortizes it to interest revenue over the term of the lease. Let's work it out together. What would happen on December 31, year 7? Well, remember I said the key to working out the interest revenue is to work with the net receivable. But what's a little tricky in this problem is that it is an annuity due, an annuity in advance. So what is the net receivable? Well, the gross receivable, when we started, $4,008,000. But the lessee would have made a $600,000 payment immediately on the first day. It would all be principal. There'd be no interest. So right away, that brought the gross receivable down from $4,008,000 to $4,002,000, minus the discount, $1,280,000. The net receivable, which is what I have to work with, is $2,920,000. That's the net receivable. Now, what's the interest rate? It's 10%, but that's for a full year. This is just a half a year. Notice that they signed the lease July 1, and they want to know interest revenue December 31, just a half a year. So don't use 10%, use 5% times $2,920,000, the net receivable. You're going to debit discount, $146,000, credit interest revenue, $146,000, and that's answer B. As I say, that is the essence of a sales type lease. There's a profit on sale, and the lessor makes a little money on financing as they amortize the discount to interest revenue over the term of the lease. There's a profit on sale, they make some money on financing. There's a profit on sale, they make some money on financing by amortizing that discount to interest revenue over the term of the lease. Now, the second possibility for the lessor, when in substance the lease is a sale, is a direct financing type lease. Let's go back to illustrative problem number 1 once again. Since we sort of know those numbers, We're comfortable with those numbers. Let's use those again. Let's assume we're back to illustrative problem number 1. We're on the lessor side. And now I'm going to assume for the lessor, it is a direct financing type lease. Now listen carefully. There's one big thing to remember about a direct financing type lease. And that is that with a direct financing type lease, there's never, the word is never, any gain or loss from the sale of the asset. There's never, with a direct financing type lease, a gain or loss from the sale of the asset. I promise you, if illustrative problem number 1 had been a direct financing type lease, the asset would have had a cost to the lessor of $37,900. Let me show you the entries for a direct financing type lease. If I'm the lessor in a direct financing type lease, I know I'm going to collect 5 lease payments of $10,000 each, so I'm going to debit gross lease receivable $50,000 once again, because I know that I'm going to collect 5 lease payments of $10,000 each. I'm going to debit gross lease receivable $50,000. But notice this, I don't credit sales. It's not a sales type lease. I just credit the asset for its cost, $37,900. As I say, if this had been a direct financing type lease, trust me, the asset would have had a cost to the lessor of $37,900, so that when I take the selling price, the discounted present value of the payments, $37,900, minus the cost of the asset, $37,900, there is no gain or loss on sale. But notice, getting back to the entry, that I don't credit sales. I just take the asset off the books at its cost, $37,900, and I credit discount, $12,100. So you see my point. When you look at the selling price, the discounted present value of the payments, $37,900, minus the cost of the asset, $37,900, there is no gain or loss on sale. My point is this. A company like this makes all their money by amortizing that discount to interest revenue over the term of the lease. They're a financing agent. They make all their money by amortizing that discount to interest revenue over the term of the lease. And you know how to do that. Let's go ahead a year. It's now December 31, year 1. Remember, you have to work with the net receivable. So I'll take the gross receivable, $50,000, minus the discount, $12,100. Then the net receivable is $37,900. That's the net receivable times the interest rate, 10%. We'll debit discount, $3,790. Credit interest revenue, $3,790. They're a financing agent. There's never any gain or loss from the sale of the asset. They make all their money by amortizing that discount to interest revenue over the term of the lease. As I say, they're a financing agent. That's the whole point of a direct financing type lease. I'd like you to try 15, 16, and 17, and then come back. Welcome back. In number 15, they tell us that Kern is the lessor, and this is a direct financing type lease. As I said earlier, that's one good thing about the exam. When they have problems on the lessor side, generally, they'll tell you if it's a sales type lease or a direct financing type lease for the lessor. So let's think about the entry that Kern would make. Kern knows that they're going to collect 6 payments of $10,000 each. So Kern is going to debit gross lease receivable for $60,000. And that's all they wanted here. The answer is A. They wanted the balance in the gross lease receivable, $60,000. But let's finish the entry. In a direct financing type lease, you don't credit sales. You just credit the asset for its cost, whatever it is. In this case, $48,000. And credit discount, $12,000. The whole point of a direct financing type lease is to make the money on the financing. A company like this is going to make all their money by amortizing that discount to interest revenue over the term of the lease. They're a financing agent. There's never any gain or loss from the sale of the asset. It's not what they're interested in. But as I say, all they wanted here was the balance in the gross lease receivable, and that was answer A, $60,000. And notice, I don't need those present value factors. We don't use those at all in this case. Those are just there to slow you down. So you'd stare at them and go, what do I do with those? We don't need them at all. In number 16, once again, we're told that Glade is a lessor, signs a direct financing type lease. And what we're told is that Glade wants to make 8% from the lease payments, because that's how they make their money. They're a financing agent. They want to make a return from the lease. They don't care about any gain or loss on the sale of the asset. They want to make 8% on the lease payments. Now we're told that the present value of an annuity at 8% for 5 periods is 4.312. But I don't know what the annual lease payments are going to be. But I know I want the discounted present value of the lease payments to equal the cost of the asset, 320.34. Because if the discounted present value of the lease payments equals 320.34, that's the selling price. It'll equal the cost of the asset, and there'll be no gain or loss on sale. It's not what I'm interested in. So I can set up my equation. I can take that factor, 4.312, times X, the lease payments, whatever they're going to be. They have to equal the cost of the asset, 320.34. Now you know whatever we do to one side of an equation, we do to the other, so I'm going to divide both sides by 4.312. That tells me that the minimum lease payments on the lease have to be $75,000 if I want to earn 8%. So now I can do the entry for Glade. If I'm Glade, I know that I'm going to collect 5 payments of $75,000 each. So I'm going to debit gross lease receivable for $375,000. I'm going to credit the asset for its cost, $320.34. I just take the asset off the books at its cost, $320.34. I don't credit sales. It's not a sales type lease. So credit the asset for $323,400 and credit discount, $51,600. And that's the interest revenue I will earn, $51,600, over the term of the lease. The answer is A, because that's what they're asking. What's the total amount of interest revenue that Glade will earn over the lease? $51,600, the discount, because that's what they'll do. Amortize that discount to interest revenue over the term of the lease. That's the total interest revenue they'll earn. Answer A. And number 17, it starts off sounding like a problem for the lessor. On January 1 of the current year, TEL leased equipment from S under a 9-year sales type lease. It is a sales type. The equipment had a cost of $400,000 to the lessor and an estimated useful life of 15 years. Semi-annual lease payments of $44,000 due every January 1 and every July 1. The present value of all the lease payments at 12%, $505,000, which equals the sales price. Under the straight line method, what amount would TEL? TEL is the lessee. What's the depreciation expense for TEL? What would they recognize for depreciation expense? Well, think about what TEL would do here. If it's a capital lease for TEL, and it must be because they want to know depreciation expense, and there's no zero for an answer, when TEL signed that lease, wouldn't TEL debit lease property for the discounted present value of all the lease payments at 12%, $505,000, and credit lease liability, $505,000. That's the entry TEL would make. Now, they want to know the depreciation expense for TEL. Then the question is, that lease property that's valued at $505,000, would I depreciate that over the 9-year term of the lease or the 15-year life of the asset? And you may have noticed that if I take that cost of the asset, lease property, $505,000, and I divide by 9 straight line years, the term of the lease, there's no salvage mentioned. If I take that $505,000, divide by 9 straight line years, the term of the lease, I get answer D. But if I take that $505,000, divide by the life of the asset, which is 15 years, I get answer B. It's really going to come down to B versus D. So that's what I'm asking you. Should we depreciate over the term of the lease or the life of the asset? Well, what's the rule? Well, if the two of the BOP are met, depreciate over the life of the asset. They don't say anything about a transfer of ownership. They don't say anything about a bargain purchase option. The two of the BOP aren't met here, not that we're told. How about the 75 criteria? Is the term of the lease equal to or greater than 75% of the remaining life of the asset? Well, the term of the lease is 9 years. Remaining life of the asset is 15 years. That's 60%. No, the term of the lease is not equal to or greater than 75% of the remaining life of the asset. It's about 60%. It's exactly 60%. How about the 90 criteria? Is the present value of the lease payments, that's $505,000, equal to or greater than 90% of the fair value of the asset? It is, because they said that the present value of the lease payments equals the selling price. So the present value of the lease payment equals 100% of the fair value of the asset. If that's the selling price, It equals 100% of the fair value of the asset. So the 2 of the BOP are not met, the 90 criteria is met. So I'm going to depreciate over the 9-year term of the lease, and the answer is D. What I want to get into next is sale lease back. But let me say before I do that the exam has a lot more questions on the lessee side for leases. They don't ask the lessor side as often. You can't ignore it. I want to mention that to you. You can't ignore the lessor side. They do test it. But I will say that the exam tends to hit the lessee side heavier, which is why we've spent more of our class time on the lessee side. But as I started to say, we do have to cover one more thing about leases before we leave the area of leases, and that is sale leaseback. In a sale leaseback, a company sells an asset to somebody and then leases the same asset right back from the person they just sold it to. There's a sale, then there's a lease back. That's what's going on. A company sells an asset to somebody, and then the company leases the same asset right back from the person they just sold it to. Let me give you an example. Let's say a company takes an asset that has a carrying value, a cost of $80,000, and they sell it to another company for $100,000. So a company's taking an asset that has a cost to the company of $80,000. They sell it to another company for $100,000, and then they lease the same asset right back from the person they just sold it to. Let's start with a sale. I always tell my students that in your mind, when you see sale leaseback, always remember that there's 2 distinct transactions. There's a sale, then there's a lease. There's a sale, then there's a lease. There's 2 separate transactions here. There's a sale, then there's a lease. There's a sale, then there's a lease. Let's deal with the sale. We know when they made the sale, they would debit cash for the selling price, $100,000, credit the asset for its carrying value, $80,000, and obviously we need a $20,000 credit to balance the entry out. That would be the gain on sale. And here's the point. If by leasing the same asset right back from the person you just sold it to, if by leasing that same asset right back, the seller has retained a substantial economic interest in that property, if by leasing the asset back, the seller has retained a substantial economic interest in that property, we're going to have to credit deferred gain. We can't put that gain on our income statement. If by leasing the asset back, the seller has retained a substantial economic interest in that property, we can't put that gain on our income statement. We're going to have to credit deferred gain. And I hope you see what's going on here. Do you see why they did this? Because they think it's all a big sham. Just think about it. I sell you this table at a big gain, put the gain on my income statement, and then I lease the same table right back from you. It never leaves the room. They just think it's a big sham, right? I lease the table to you. I sell the table to you, put a big gain on my income statement, then I lease the same table right back from you. It never leaves the room. They just think it's a big sham. So if by leasing the asset back, the seller has retained a substantial economic interest in that property, they can't put that gain on their income statement. They're going to have to credit deferred gain. I hope that makes sense to you. Now here's the question. How do you know if the seller has retained a substantial economic interest in the property? Well, there's some criteria. First, if the term of the lease is a large percent of the remaining life of the asset. If the term of the lease is a large percent of the remaining life of the asset, the seller has retained a substantial economic interest in that property. Does the term of the lease have to be equal to or greater than 75% of the remaining life of the asset? No, that's capital lease criteria. No, all we're saying is the term of the lease has to be a large percent of the remaining life of the asset. It's not equal to or greater than 75%. That's capital lease criteria. In other words, arguably, 60% is enough. You're supposed to use judgment. But if the term of the lease is a large percent of the remaining life of the asset, the seller has retained a substantial economic interest in that property. Or our old friend, if the present value of the lease payments are equal to or greater than 90%, if the present value of the lease payments are equal to or greater than 90% of the fair value of the asset, the seller has retained a substantial economic interest in that property. And as I said, if the seller has retained a substantial economic interest in that property, they can't put that gain on their income statement. They're going to have to credit deferred gain. Now, what happens to that deferred gain? It gets amortized. See, now there's two possibilities. They lease the asset back. You're going to amortize that gain against rent expense if they now set up an operating lease, right? There's two possibilities. They lease the asset back. You're going to amortize that deferred gain against rent expense if they set up an operating lease. In other words, every year, you're going to debit deferred gain, credit rent expense. Debit deferred gain, credit rent expense. Debit deferred gain, credit rent expense. Or you'll amortize that deferred gain against depreciation expense if they set up a capital lease, right? If they set up a capital lease, then you'll amortize that deferred gain against depreciation expense. Every year you'll debit deferred gain, credit depreciation expense. Debit deferred gain, credit depreciation expense. So that's what happens. You amortize that deferred gain against rent expense if they set up an operating lease. You'll amortize that deferred gain against depreciation expense if they set up a capital lease. Please do 18 and 19 and then come back. Welcome back. In number 18, they say in a sale-leaseback transaction, the seller who becomes a lessee retains the right to substantially all of the remaining use of the equipment sold. Notice they have retained a substantial economic interest in this asset that they've sold. So they say the profit on the sale should be deferred, which is true, and subsequently amortized by the lessee when the lease is classified as a capital lease. Yes. You want yes in that column because you'll amortize the deferred gain against depreciation expense. And yes, under operating lease also because you'll amortize the deferred gain to rent expense. Yes, under both. Answer D. 19. In a sale-leaseback transaction, a gain resulting from the sale should be deferred at the time of the sale-leaseback and amortized when what? Statement number 1 says the seller who becomes a lessee has transferred substantially all of the risks of ownership. No, you would not defer the gain in that case. If the seller, who now leases the asset back, has transferred substantially all of the risks of ownership, it's a sale. The gain should go right to your income statement. So that's not a true statement, but the second statement is true. If the seller who becomes a lessee retains the right to substantially all of the remaining use of the property sold, the gain should be deferred, as you know, and the answer is B. I'd like you to try number 20 and come back. Welcome back. In number 20, we're dealing with the sale-leaseback of equipment. And as I mentioned earlier, anytime you see sale-leaseback in the exam, it's important to remember that there's a sale and then there's a lease. Split that in your mind. There's a sale and then there's a lease. Let's deal with the sale. We know when Mega makes the sale, Mega's going to debit cash for the selling price, $400,000. Mega will credit the equipment for its carrying value, $300,000. And obviously, we need a $100,000 credit to balance the entry out, and that would represent the gain on sale. Now, you know the issue here. Anytime you see sale leaseback in that exam, the issue will be, should we defer that gain? We should, if by leasing the asset back, Mega has retained a substantial economic interest in this property. So that's my question to you. How do we know if Mega has retained a substantial economic interest in this property? Well, if the term of the lease is a large percent of the remaining life of the asset, they've retained a substantial economic interest in this property. In this problem, what's the term of the lease? 1 year. What's the remaining life of the property? 25 years. So no, the term of the lease is not a large percent of the remaining life of the asset, 1 over 25 years. No. What's the other criteria? is the present value of the lease payments. They gave you that, $36,900. Is that equal to or greater than 90% of the fair value of the asset? Well, the fair value of the asset is the selling price, $400,000. Notice the discounted present value of the payments, the lease payments, would be less than 10% of the fair value of the asset. So no, the present value of the lease payments are not equal to or greater than 90% of the fair value of the asset. They represent less than 10%. So I hope we can agree. Mega did not retain a substantial economic interest in this property. So what's the answer? When they ask at the bottom, what is the deferred gain? It is zero. It is A. That entire gain can go to Mega's income statement. No part of that gain would be deferred because they did not retain a substantial economic interest in that property. Try number 21 and come back. Welcome back. In number 21, we're dealing with the sale leaseback of an airplane. Let's deal with the sale. When Park goes out and makes the sale, Park would debit cash for the selling price, $600,000. Park is going to credit the airplane for its carrying value, $100,000. And obviously we need a $500,000 credit to balance the entry out. That would be the gain on sale. But we know the issue. Because Parker now leases the asset back, has Parker retained a substantial economic interest in this airplane? Well, first of all, is the term of the lease a large percent of the remaining life of the asset? Well, in this problem, the term of the lease is 3 years. The remaining life of the asset is 10 years. No, the term of the lease is not a large percent of the remaining life of the asset. It's not. Would the present value of the lease payments be equal to or greater than 90% of the fair value of the asset? Well, in this problem, the present value of the lease payments, they gave us $195.81 over $600,000, the fair value of the airplane. It's about 32%. No, the present value of lease payments are not equal to or greater than 90% of the fair value of the assets, about 32%. So I hope we can agree. Park has not retained a substantial economic interest in this airplane. But we're in a weird area here. What we would call this, we agree that Park has not retained a substantial economic interest. That's true. But what we would call this problem is that Park has retained more than a minor interest, but less than a major interest. Now, you're in this area. Anytime you're more than 10%, less than 90, that's it's a gray area. When you're more than 10%, less than 90, now Park has retained what we would call more than a minor interest, but less than a major interest. And here's the point. If the seller, who becomes a lessee, retains more than a minor interest, but less than a major interest, they have to defer the gain up to the present value of the lease payments. They just have to defer the gain up to the present value of the lease payments. So let's do the entry again. When Parker makes the sale, Parker's going to debit cash, $600,000, the selling price. Parker's going to credit the airplane for its carrying value, $100,000. And notice I am going to credit deferred gain, $195.81. Notice I do defer the gain up to the present value of the lease payments. So I'm going to credit deferred gain, $195.81. That's why the answer is B. They wanted the deferred gain, and it would be $195.81. And then notice I just credit a regular gain for $309,419. The rest of that $500,000 gain, $309,419, can just go right to my income statement. I only have to defer the gain up to the present value of the lease payments if I retain more than a minor interest, less than a major interest. That's not a heavily tested point, but with this far into leases, and I thought we should at least look at a problem like that. As I say, not heavily tested, but you should be aware that when you're in that more than 10, less than 90% range on the present value of the lease payments, you are talking about more than a minor interest, less than a major interest being retained. So you should defer the gain, but just up to the present value of the lease payments. And as I say in this problem, the rest of the gain, $309,419 of the gain can go right to your income statement. We are done with accounting for leases. And now we're going to move on to accounting for pensions. When we're talking about the proper accounting for pensions, it's important to remember that there are two types of pension plans. There are defined contribution plans and there are defined benefit plans. That's what it boils down to. There are defined contribution plans and there are defined benefit plans. We're going to begin with defined contribution plans, what you will come to think of as the easy one. Let's get into it. In a defined contribution plan, all that is defined is what the corporation, the employer, is obligated to contribute to the plan each year. That's what we mean by a defined contribution plan, where all that is defined is what the company, the employer, is obligated to contribute to the plan each year. Let me give you an example. Let's say a corporation has a defined contribution plan, and let's say this year the company is obligated to make an $850,000 contribution to the plan. Well, if this year the company is obligated to make an $850,000 contribution to the plan, then we're going to debit pension expense $850,000. It really is that simple. In a defined contribution plan, your pension expense for any year will be what the company is obligated to contribute to the plan that year. So we know they're going to debit pension expense $850,000. Now, assuming they did turn $850,000 cash over to the trustee that administers the fund, well, then we would simply credit cash $850,000, and we would call that fully funded. Now, same example. Company has a defined contribution plan. This year, the company is obligated to make an $850,000 contribution to the plan. So we know they're going to debit pension expense $850,000. I'm not going to change that on you. In a defined contribution plan, your pension expense in any year is whatever the company is obligated to contribute to the plan that year. But now let's assume they turn not only $200,000 cash over to the trustee that administers the fund. So now they credit cash $200,000. Well, of course, now they would be underfunded. It's not really a big deal. You would just credit an underfunded pension liability. Credit underfunded pension liability for $650,000. Same example. Company has a defined contribution plan. This year, the company is obligated to make an $850,000 contribution to the plan. So we know they're going to debit pension expense for $850,000. That's not going to change. In a defined contribution plan, your pension expense in any year is whatever the company is obligated to contribute to the plan that year. But now let's assume instead they turn $950,000 cash over to the trustee that administers the fund. So now we credit cash $950,000. Well, of course, in this case, they would be overfunded. It's not a big deal. You would just debit for $100,000 a prepaid pension or an overfunded pension asset for $100,000. That's the entry that you would make. Now, I want you to look at those three entries. This is very important. This is pension accounting in a nutshell. I don't care what kind of plan a company has. What pension accounting always comes down to is this. First, figure out the expense. Get that first. And in a defined contribution plan, that's easy. It's whatever the company is obligated to contribute this year. But once you have the expense, you're always back to these three possibilities. Are they fully funded? Are they underfunded? Or are they overfunded? I just want you to know that you never get away from those three possibilities. So again, that's pension accounting in a nutshell. Figure out the expense. But once you have that expense, you're always back to those three possibilities. Are they fully funded? Are they underfunded? Or are they overfunded? That is pension accounting. And you know, when you look at a defined contribution plan, it's a 401k. This is how a corporation accounts for a 401k. And it's what most of us have. And even though it is what most of us have as a pension plan, if we have one, the exam does not test defined contribution plans very heavily. In fact, very lightly. So let's get right down to it. If the exam is going to test you on pensions, what they'll probably hit you on is a defined benefit plan. In a defined benefit plan, what is defined are the pension benefits that will be paid out at retirement. That is a defined benefit plan, where what is defined are the pension benefits the company will pay you at retirement. That is a defined benefit plan. Now, in a defined benefit plan, there are 6 elements that make up your pension expense for the year. Don't you miss a defined contribution plan already, because in a defined benefit plan, there are 6 elements that make up your pension expense for the year. Let's go over the 6 elements. The first element is service cost. Service cost is the discounted present value of all the pension benefits earned by your employees this period. That's service cost. The discounted present value of all the pension benefits earned by your employees this period. Not too bad. Now, number 2, the second element, is the hardest one to understand. You're going to find that of the 6, number 2 is a little difficult. It's a little difficult when you first start studying pensions to really get your mind around. But I think you'll find that we keep working with it in this class. You'll just start to feel comfortable with it. You just start, I don't know what it is, you work with it enough, it makes sense. Number 2 is interest on projected benefit obligation. Number 2 is interest on projected benefit obligation. Here's what's going on. What a company does is they do a projection. Notice this is called projected benefit obligation. What a company does is they do a projection. They project out their total obligation for pension benefits into the future. And it's a difficult calculation because you have to project out retirement ages, years of service, future salary levels. It's a very complicated calculation because you're projecting out your total obligation for pension benefits into the future. And as I say, it's complicated because you have to project out future salary levels, retirement ages, project out years of service. It's complex. What the company has done is they have discounted that obligation back to January 1. But now it's December 31, and that obligation has grown just a little bit because a year has gone by. Interest on projected benefit obligation, interest on PBO. Now you're going to find, as we go through these, some of these are always a plus, always an addition to your pension expense. Some are a minus, and of course that's a big part of the exam. So you want to remember that service cost, the present value of all the pension benefits earned by your employees this period, always a plus. Always an addition to your pension expense for the year. Interest on PBO, always a plus. Always an addition to your pension expense for the year. Number 3, third element, is the actual return on plan assets. You know what's going to happen. Every year, the company is going to turn cash over to the trustee that administers the fund. They make investments. And the point is, the better those investments do, that's good for us. That lowers our pension expense for the year. So that's a minus. So again, every year you turn cash over to a trustee that administers the fund. They make investments. The better those investments do, that lowers your pension expense for the year. That's a minus. The actual return on plan assets. Number 4 is amortization of prior service cost. Now just think for a minute. What is prior service cost? Well, let the words help. You should be able to figure it out. Prior service cost is the discounted present value of all the pension benefits earned by your employees in years before we had a plan. Notice prior service cost. Hey, that's the present value of all the pension benefits earned by our employees in years before we had a plan. Prior service cost. And what we're going to do is amortize some of that prior service cost as one of our 6 elements. It's a plus. It's an addition to your pension expense for the year. Number 5 is actuarial gain or loss. You bring in actuaries. You can have a gain or loss because of actuarial changes. You know, people are living longer. People are retiring later. You can have a gain or loss just because of actuarial changes. Now, you know that you don't have to be an actuary to take the CPA exam. The exam will have to give you this. But what you have to remember is that if you've had an actuarial gain, that's good for you. Lowers your pension expense for the year. If you've had an actuarial loss, that's bad for you. Increases your pension expense for the year. And then finally, number 6, transition asset, transition obligation. The year you begin a defined benefit plan, the year you start a defined benefit plan, if you're overfunded, if you're initially overfunded, we would call that a transition asset. If you're initially underfunded when you start the plan, we call that a transition obligation. That's bad for you. So if you have a transition obligation, that's bad for you. That's going to be a plus, in addition to your pension expense for the year. If you have a transition asset, that's good for you. It lowers your expense for the year. That's a minus. And those are the 6 elements that make up your pension expense in a defined benefit plan. Now, just to say the obvious, you have to know those elements cold. You're not going to be able to do a multiple choice or any kind of problem on a defined benefit plan if you don't know those 6 elements. So I'm going to give you a memory tool. To remember the 6 elements, just remember SIRPAT. S-I-R-P-A-T. If you remember SIRPAT, you've got the 6 elements. Let's go over it. The S, you know what that is. It's service cost. And you know what that is. Hey, that's the present value of all the pension benefits earned by my employees this period. Service cost. Always a plus. Always an addition to your pension expense for the year. I is the hard one. Interest on PBO. Interest on projected benefit obligation. Let's go through it again. The company does a projection. They project out their total obligation for pension benefits into the future. What they did is discount that obligation back to January 1. But now it's December 31. A year has passed. So that obligation would grow just a little bit because a year has gone by. See, that obligation gets bigger and bigger and bigger and bigger as people get closer and closer and closer to retirement. Interest on PBO, always a plus, always an addition to your pension expense for the year. The R is return on plan assets every year. You turn cash over to the trustee that administers the fund. They make investments. The better those investments do, that return on plan assets, that's a minus. Lowers your expense for the year. The P, prior service cost amortization. You know what prior service cost is. Hey, that's the present value of all the pension benefits earned by your employees in years before you had a plan. Prior service cost. We're going to give employees credit for those years. We're going to amortize some of that prior service cost as one of our 6 elements. It's a plus. It's an addition to your pension expense for the year. A, actuarial gain or loss. You bring in actuaries. If you've had an actuarial gain, that's good for you. Lowers your expense for the year. Actuarial loss is bad for you. Increases your pension expense for the year. And then finally, the T, transition asset, transition obligation. When you start a defined benefit plan, if you're overfunded, if you're initially overfunded, we would call that a transition asset. A transition asset's good for you. Lowers your expense for the year. If you're initially underfunded, you have a transition obligation. That's bad for you. Increases your expense for the year. If you know SIRPAT, you've got the 6 elements. And as you're going to see, that's a huge part of the battle. Once you get those 6 elements down, this isn't really that bad at all. I think we're ready to try a problem. Let's go in your viewer's guide and look at the illustrated problem on a defined benefit plan. In the illustrative pension problem, we can see that they started the plan January 1st, year 1. And then they funded $1 million cash over to the trustee December 31, year 1. They also tell us that the unrecognized or the unamortized prior service cost as of January 1st, year 1 was $480,000. Now you know what that prior service cost represents. Hey, that's the present value of all the pension benefits earned by our employees in years before we had a plan. Prior service cost. And we have a note here on where that $480,000 came from. We're assuming that the average remaining service period for those employees, 12 years. And the way we got the $480,000, you'll notice we're expecting that we're going to have to pay those people $2 million worth of benefits. And we took present value of $1 at 12 years. Why 12 years? Because that's the average remaining service period for these employees at a 10% discount rate or settlement rate. The factor was 0.24. So I took that factor times 0.24 times the total benefits we're eventually going to have to pay these people in the future, $2 million, and that's where we got the $480,000. And let me show you the entry for that. The entry for the prior service cost would have been a debit to OCI, $480,000, and a credit to underfunded pension liability, $480,000. That's the first entry we would have made. Debit OCI, $480,000, credit underfunded pension liability, $480,000. We're also told that the year one service cost, $400,000. That's the present value pension benefits earned by our employees this period, $400,000. Now our job in this problem is to work out the pension expense for the year ended December 31, year one. So dates are always important. That's where we are now. It's December 31, year one. How do we work out the pension expense for the year? Well, you know the way I feel about it. Anytime you have to work out the pension expense in a defined benefit plan, you're thinking SIRPAT, SIRPAT. Let's go through the elements. The S, of course, is service cost. Present value of all the pension benefits earned by our employees this period, we know that's $400,000. Next, the I, it's the hard one. Interest on PBO, interest on projected benefit obligation. Now, I want you to listen to me carefully. Don't get confused here. The day you start a pension plan, just think about this for a minute. The day you start a plan, January 1st, year one, what is your only obligation for benefits? Prior service cost. I want you to see that the day you start a plan, your only obligation for benefits is prior service cost. Nobody's earned anything else. So I'd like us to agree that the day you start a plan, prior service cost and projected benefit obligation are one and the same. I hope that makes sense to you, because the day we start the plan, our only obligation for benefits is prior service cost. Nobody's earned anything else. So the day you start a plan, prior service cost and projected benefit obligation are one and the same. All right, so think what happened here. We did a projection, right? We projected out our total obligation for benefits into the future. And we're expecting in the future to pay these people $2 million worth of benefits. What we did is discount that obligation back to January 1, year one. Came out to $480,000, right? But now it's December 31, year one. A year has passed. And at a 10% discount rate, multiply that $480,000 by 10%, our obligation has increased $48,000 just because of the passage of time, just because a year has gone by. Interest on PBO, always a plus, always an addition to your pension expense for the year. Now the next element, R, return on plan assets. Didn't we give the trustee $1 million cash? But that was not until December 31, year one, at the end of the year. So there's been no return on plan assets. They haven't earned anything yet, so that's nothing. How about prior service cost amortization? Well, our prior service cost is $480,000. We know that the average remaining service period for those employees is 12 years. So I'm going to take that $480,000 over 12 straight line years. It's just a straight line calculation based on the average remaining service period for these employees. And notice I put another $40,000. It's a plus, an addition to my pension expense for the year. Amortization of prior service cost. A, actuarial gain or loss. I'm going to assume there's none. And I will say that that's something you have to get used to in the exam. You have to deal with the elements they give you. Not all 6 elements have to be there. Apparently there is no actuarial gain or loss. Transition asset, transition obligation. I'm assuming there's none. If you add it all up, it all adds up to $488,000. We're going to debit pension expense, $488,000. See, that's what SIRPAT does for you. It gets you the pension expense in a defined benefit plan. So we're going to debit pension expense, $488,000. We're going to credit cash $1 million. That's the funding. We turned $1 million cash over to the trustee December 31, year 1. So we're going to credit cash for the funding $1 million. Notice we're overfunded. So what do? Well, when we recorded our prior service cost, didn't we debit OCI $480,000, credit underfunded pension liability $480,000? Right now we had, before this entry, an underfunded pension liability of $480,000. Well, now we funded it. So now I debit that underfunded pension liability, $480,000. So now it's been funded. And now I need to debit to balance the entry out. That is my overfunded pension asset, $32,000. That's the entry that we would make to record the pension expense for year 1. Notice, once again, that what SURPAT does for you is get you the expense. But then you're always back to the 3 possibilities we talked about earlier. Are they fully funded? Are they overfunded? Are they underfunded? Here they were overfunded. So we got rid of that underfunded pension liability and set up an overfunded pension asset, basically a prepaid pension of $32,000. Let's go ahead another year. Let's go to the end of year 2. It's now December 31, year 2. Notice we funded another $475,800 to the trustee, December 31, year 2. The year 2 service cost, $425,000. And we're going to assume that pension assets are earning 10%. We're just going to make an assumption that all my pension assets are earning 10%. So where are we? It is now December 31, year 2. We have to work out the pension expense for the year. And you know the way I feel about this. Anytime my students have to work out the pension expense in a defined benefit plan, they're always thinking SURPAT, S-I-R-P-A-T. So we list it down, and let's put a date over that. What's the date on this? It's December 31, year 2. That's where we are. We've got to work out the pension expense at December 31, year 2. Now, before we do SURPAT, there's another calculation we have to do first. You'll notice that we have a little schedule there to work out the balance in PBO. Let's work out the balance in our projected benefit obligation. What was the balance in the projected benefit obligation January 1, year 1? $480,000, because as we said, the day you start a plan, projected benefit obligation and prior service cost are one and the same. So here's what you had to think about. During year 1, what increased that obligation? Well, don't forget interest on PBO. Don't forget that that obligation would have grown by $48,000 just because a year goes by. Also, your service cost for year 1. All the pension benefits earned by your employees in year 1, $400,000. Didn't that increase your obligation? All the pension benefits earned by your employees in year 1, that would have increased your obligation. So add that. And then if they pay out any benefits, notice that would be a minus. If they pay out any benefits, there were none here. There were none. But if they pay out any benefits, that would be a minus. Why? Because they've met that obligation. They no longer have that obligation. If you add it up, the balance in projected benefit obligation, January 1st, year 2, is $928,000. That's the balance in PBO. January 1st, year 2, $928,000. Now let's do SURPAT. I know you're getting used to it. The S, you know what that is. That's service cost. Hey, that's the present value of all the pension benefits earned by my employees this period. They gave us that, $425,000. Always a plus, always an addition to your pension expense for the year. Let me ask you a question. Could the exam ask you to calculate service cost? Or realistically, do they have to give it to you? It's got to be given. It's got to be given. It takes experts to come up with that number. That's a complex number. It takes actuaries, takes experts to come up with that number. There's no way they could ask you to calculate it. It has to be given. And we know it's always a plus, always an addition to your pension expense for the year. I is the hard one. Interest on projected benefit obligation. Interest on PBO, always a plus, always an addition to your pension expense for the year. How do we work it out? Well, think what happened here. They did a projection, didn't they? They projected out their total obligation for pension benefits into the future. And what they did is discount that obligation back to January 1st, year 2. Came out to $928,000. We just worked it out. But now it's December 31, year 2. A year has grown. A year has gone by. So hasn't that obligation grown by 10%? $92,800. Just because a year goes by. Interest on PBO. Interest on projected benefit obligation. Always a plus, always an addition to your pension expense for the year. How about the R? Return on plan assets. Didn't we give the trustee $1 million cash at the end of year 2? The end of year 1? We gave the trustee $1 million cash at the end of year 1. Wasn't that invested all through year 2? And we're assuming that pension assets are earning 10%. So that's a minus $100,000. Remember, the better those investments do, that's good for you. That lowers your pension expense for the year. That's a minus $100,000. Why didn't I worry about the $475,800 cash I gave to the trustee at the end of year 2? Because that hasn't earned anything yet. That went to the trustee at December 31, year 2. It hasn't earned anything yet. But the $1 million cash we gave the trustee at the end of year 1 was invested all through year 2, earned 10%, a minus $100,000. Now, I should mention that it's a minus because we're assuming it's a return, an actual return on plan assets. You know, if the stock market plummets, if you have a loss on plan assets, which of course could happen, if you have, the stock market takes a huge tumble and you have a loss on plan assets, this would be a plus. So, assuming you're making a positive return, an actual return on your plan assets, it's good for you, lowers your expense for the year. But as I say, if you took a bath on your plan assets, which can happen, that all of a sudden becomes a plus. That's bad for you. But here it is a 10% return minus $100,000. How about the P in SURPAT? Prior service cost amortization. Well, that's just a straight line calculation. We're going to take the $480,000 prior service cost, divide by 12 straight line years, the average remaining service period for those employees, it's another $40,000. It's a plus. It's an addition to your pension expense for the year. A, actuarial gain or loss, we're assuming there's none. T, transition asset, transition obligation, we're assuming there's none. If you add it up, it adds up to $457,800. We're going to debit pension expense, $457,800. As I said, that's what SURPAT does for you. It gives you the pension expense for the year in a defined benefit plan. What's the credit to cash? Well, the funding was a credit to cash of $475,800. That was the funding. Notice we are overfunded. So what do? We debit an overfunded pension asset, $18,000. Notice the basic process here. SURPAT, do an entry. SURPAT, do an entry. SURPAT, do an entry. That's how you handle a defined benefit plan. It's SURPAT, then do an entry. Let's do year 3. Notice we funded another $300,000 cash to the trustee at December 31, year 3. The year 3 service cost, $430,000. And we're still assuming that pension assets are earning 10%. Let's work out the pension expense for the year of year 3. Anytime you have to work out the pension expense in a defined benefit plan, you're thinking SIRPAT. We know the date on it. Dates are important. It's December 31, year 3. Now, before we work out SURPAT, there's another calculation we have to do first. Let's work out the balance in PBO. What was the balance in projected benefit obligation January 1st, year 2? $928,000. We had to work that out. Now, just stop and think. During year 2, what increased your obligation? Well, didn't that obligation increase by $92,800 just because a year goes by. Don't forget interest on PBO. What else increased your obligation? How about all the pension benefits earned by your employees in year 2? $425,000. That increased your obligation. And as I mentioned, if you pay out benefits, you've met that obligation. You no longer have that obligation. That would be a minus, but I'm assuming there's none. If you add it up, the balance in projected benefit obligation, January 1st, year 3, $1,445,800. That's the balance in PBO, January 1st, year 3. $1,445,800. And I want to make a point. Anytime you're doing year-to-year information on pensions, you have to work out the balance in PBO, as we're doing here. That's why I'm showing you this schedule. I'm showing you this schedule on how you work out the balance in PBO, because that's when it comes into play. Anytime you're doing year-to-year information, you have to work out the balance in PBO each year. They probably won't give it to you. But the good news is that's all they can test with PBO. That's pretty much it. But you've got to know that little schedule that we're going over, how to work out the balance in PBO year to year. Because they give you any kind of problem where you're doing year-to-year information, it would be up to you to work out the balance in PBO each year. So that's why we're showing you that schedule. All right, now let's do SIRPAT. S-I-R-P-A-T, and I know you're getting used to it. The S, service cost. Hey, that's the present value of all the pension benefits earned by my employees this period. For year 3, it's $430,000. Always a plus, always an addition to your pension expense for the year. I's the hard one. Interest on PBO. Let's think about it. They did a projection, right? They projected out their total obligation for pension benefits into the future. And what they did is discount that obligation back to January 1st, year 3. Came out to $1,445,800. But now it's December 31, year 3. A year has passed. So that obligation would have grown by $144,580 just because a year goes by. Interest on PBO. Always a plus, always an addition to your pension expense for the year. As we said earlier, that obligation gets bigger and bigger and bigger and bigger as people get closer and closer and closer to their retirement. How about the R? Return on plan assets. Well, didn't we give the trustee $1 million cash at the end of year 1? Wasn't that invested all through year 2 and earned 10%? So didn't that grow to $1.1 million? And then didn't we give the trustee at the end of year 2 $475,800? So what we had invested all through year 3 is $1,575,800. It earned 10%, so that's a minus $157,580. Let me do that again. We gave the trustee $1 million cash at the end of year 1. It was invested all through year 2 and earned 10%. So that grew to $1.1 million. And then we gave the trustee another $457,800 at the end of year 2. So what we had invested all through year 3 is $1,575,800. We're assuming the return is 10%. That's a minus $157,580. The P, prior service cost amortization. You know that's just straight line. Take the $480,000 prior service cost, divide by 12 straight line years, the average remaining service period for those employees, add another $40,000. It's a plus, an addition to your pension expense for the year. Now, I know that you listen to me carefully, at least I like to think you do, and I hope that you think that I try to choose my words carefully. And you may have noticed that when I get to prior service cost amortization, I have not said it's always a plus, always an addition to your pension expense for the year. I can't say it's always. It could be a minus if there was some agreed upon reduction of benefits with the pension. It is possible that it could be a minus. Again, some sort of a negotiated reduction in benefits, that could be a minus. I don't think the exam is likely to get into that. It's usually prior service cost amortization, a plus, an addition to your pension expense for the year. A, actuarial gain or loss, there was none. T, transition asset, transition obligation, none. Add it all up. It all adds up to $457,000. So you know we're going to debit pension expense, $457,000. As I say time and again, that's what SURPAT will do for you. It'll give you your pension expense in a defined benefit plan. What do I credit to cash? $300,000. That's the funding. That's the funding. You know what I'm going to ask. Am I overfunded or underfunded? Under. So what do? Be careful. Don't I have an overfunded pension asset on the balance sheet? Back in year one, we were overfunded, so I set up an overfunded pension asset of $32,000. Then in year two, I was overfunded. I added another $18,000 to my overfunded pension asset. So don't I have an overfunded pension asset on my balance sheet of $50,000? Now that I'm underfunded, I have to get rid of that. I'm no longer overfunded. I have to get rid of that overfunded pension asset. So I'm going to credit overfunded pension asset, $50,000, and credit an underfunded pension liability for $107,000. Notice, Sir Pat, do an entry. 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 Works every time. That's how you handle a defined benefit plan. Let's try a problem. I'd like you to shut the class down, do question number 22, and then come back. Welcome back. Let's do number 22 together. And number 22 is a classic sort of multiple choice question they would have on a defined benefit plan. They say the following information pertains to RAL Corporation's defined benefit plan. And at the bottom they say, all right, what is the pension expense for the year? Well, you know what I'm hoping? I'm always hoping that my students, anytime they get a question like this, are thinking one way and one way only. S-I-R-P-A-T, SURPAT. If you have to work out the pension expense in a defined benefit plan, that's always your thought process. SURPAT. So you put it down, you fill it in. The S is service cost. In this problem, $300,000. Always a plus, always in addition to your pension expense for the year. Interest on PBO, $164,000. Always a plus. Always in addition to your pension expense for the year. The return on plan assets, $80,000. That's a minus. Prior service cost amortization, the P. Apparently they don't have any. Apparently they're not going to give people credit for years before they had a plan. There is no prior service cost. I mentioned earlier that students really have to get used to that you have to deal with the elements they give you. Not all 6 elements will necessarily have to be in a problem. They don't have any prior service cost amortization. A, actuarial gain or loss, that's $30,000, and because it's a loss, it's bad for you, it's a plus. In addition to your pension expense for the year. And then transition asset, transition obligation. The amortization of the obligation is $70,000, and because it's a transition obligation, that's bad for you. A transition asset is good for you, be a minus, but this is a transition obligation. It's bad for you. Increases your expense for the year. It's a plus. Add it all up. The pension expense for the year is answer B, $484,000. You put down Sir Pat. That'll always give you the pension expense in a defined benefit plan. Let's go to number 23. They say the following information pertains to SATA Company's pension plan. We know their estimate of projected benefit obligation, January 1. We know they use a discount rate of 10%. We know the service cost for year 1, $18,000, and we also know the benefits paid, $15,000. And they say, okay, what is PBO December 31, year 1? Well, let's go through the calculation. We know that projected benefit obligation back on January 1, a year ago, was $72,000. And you really just have to stop and think. During year 1, what increased that obligation? Well, first of all, don't forget interest on PBO. That obligation would have grown by $7,200 just because a year goes by. Interest on PBO. What else increased your obligation? All the pension benefits earned by your employees in year 1. $18,000. That increased your obligation. And as I mentioned earlier, if you pay out any benefits, which they did here, $15,000. That's a minus. Why? Because you've met that obligation. You no longer have that obligation. So back that out. The balance in PBO, December 31, year one, is answer D, $82,200. Now, I want you to look at that calculation and remember what I mentioned before. Anytime you're doing year-to-year information, you have to work out the balance in PBO, just as we did in that multiple choice. This is why I make you do this schedule with me a couple of times. And the good news is, if you're desperate for some good news, the good news is that's all they can do with PBO. That's all they can do with it. They can't ask you for the $18,000. That takes experts. They can't ask you for the $72,000. The beginning balance takes experts to come up with that. Has to be given. But the one thing they could do with projected benefit obligation is have you work out the balance from year to year. In this case, from the beginning of the year to the end of the year. You know, if we give you the service cost for the year, we tell you the benefits that were paid. What's the balance in PBO at the end of the year? And as I say, where this becomes critical is anytime you're doing year-to-year information. So, as I say, make sure you know that little schedule and how you work out the balance in PBO. But the good news is that's really all they can test with PBO. That's pretty much all they can do with it. Now, let's think about SURPAT for a minute. The S, service cost, the present value of all the pension benefits earned by my employees this period, has to be given. There's no way the exam could ask you to calculate that. That takes experts. I, interest on PBO, you have now seen everything they can really do with PBO. Let's go to the R, the return on plan assets. You might remember that in the illustrated problem that we just did together in the viewer's guide, when we did those 3 years of information, I was assuming that plan assets were earning 10%. I just assumed every year plan assets were earning 10%. That's how I figured out the return on plan assets. Well, that's very easy, isn't it? Well, I mention this because once in a while in the exam, they'll ask you to really work out the actual return on plan assets. How do you work it out if you have to work it out? Let me show you a problem. Number 24. 24 says the following information pertains to galley companies' defined benefit plan. We know the fair value plan assets January 1, the fair value plan assets December 31, the employer contributions, and the benefits paid. They say in computing the pension expense for the year, what amount would galley use as the actual return on plan assets? In a multiple choice like this, they're making you work it out. I want to show you how it's done. And it's actually a fairly simple calculation. I think it'll make sense when you see it. If I want to work out the actual return on plan assets, here's how I start. I look at the fair value plan assets at the end of the year. In this case, $525,000 minus the fair value plan assets at the beginning of the year, $350,000. So the first thing I notice is that in the last year, plan assets have increased by $175,000. That's your starting point. I know in the last year, plan assets have increased by $175,000. And notice that's answer C. But we can't stop there. Why? Well, think about it for a minute. Did I make all that increase in the stock market? No. Look at the employer contributions. The employer put $110,000 in. Again, you can't say that that entire increase of $175,000 occurred in the stock market because the employer put in $110,000. So back out the employer contribution of $110,000. That brings you down to $65,000. That's answer A. That's not it either. Because I also paid out benefits of $85,000. Add back the benefits, and that gives you answer B. That's the actual return on plan assets. Every now and then, they'll make you work it out. And that's basically how you do it in practice. You know, in practice, you're not going, oh, plan assets are earning 15%. No. You look at the fair value plan assets at the end of the year minus the fair value plan assets at the beginning of the year. Oh, they increased by this much. Back out what the employer put in, add back any benefits, and that'll give you the actual return. All right, now let's get back to SURPAT. So service cost has to be given. We've seen everything they can hit with interest on PBO. Now you know how to calculate the return on plan assets if you have to calculate it. The P, prior service cost amortization, you've really seen what that is. It's a straight line calculation. All that really is taking the prior service cost, which the exam has to give you, divide by the average remaining service period for the employee, straight line. So there's really nothing complicated there. Let's go to the A, actuarial gain or loss. Let's say that a company has a huge actuarial loss. Let's say a company has a $4 million actuarial loss. Do they just put $4 million in as their fifth element? They say, well, their fifth element is a $4 million plus. No, but there's a minimum amount that they have to take. So they don't have to take the whole actuarial loss, but there's a minimum they have to take. Let's go to a problem, number 25. We're talking about, in number 25, Mercury Company. They have a defined benefit plan, and here's what we know. We know the accumulated benefit obligation is $500,000. I'd like you to put a line through that. We'll talk about that in a bit. We also know the projected benefit obligation, $600,000. Circle that. We know the fair value plan assets. We also know the market-related value plan assets. Circle that, $650. The market-related value plan assets. Now, the actuarial loss is $80,000. And the average remaining service period for the employees is 10 years. And they ask at the bottom, the amount of actuarial loss that they would include in their calculation of pension expense for the year would be what? Well, of course, a lot of students would sit in the exam and go, oh, I see it. I take the actuarial loss of $80,000, divide by 10 straight line years, the average remaining service period for the employees, and they say, hey, hello, D. I'm looking at you, answer D. It's not D. Here's how you work this out. You have to look at the two numbers that I had you circled. You have to look at the projected benefit obligation, $600,000, and the the market-related value of plan assets, $650,000. You look at those two numbers. Now, you might be wondering, well, Bob, what's the difference between the fair value plan assets and the market-related value plan assets? Well, the difference is that the fair value plan assets is as of December 31. The market-related value is a weighted average for the year. That's the difference. Fair value plan assets is as of December 31. The market-related value plan assets is a weighted average for the year. And in this calculation, we have to use the market-related value plan assets. And what might make you feel a little better is the only time you worry about that distinction, the only time you worry about the difference between the fair value plan assets and the market-related value plan assets is this calculation right here. It's really the only time you worry about it. All right, so I look at those two numbers. Projected benefit obligation, $600,000. Market-related value plan assets, $650,000. Take 10% of the larger number. Take 10% of whatever number is larger. Why 10%? It's just a threshold. It's just a rule. So because the market-related value plan assets is larger, I'll take 10% of $650,000. That comes out to $65,000. Notice that the actuarial loss, $80,000, is $15,000 higher than that threshold. What they're going to do is take that $15,000 difference, divide by 10 straight line years, the average remaining service period for the employees. And the answer is A. That's the minimum amount of actuarial loss they have to amortize as one of their 6 elements. And I mention that because it's pretty much all they can do with actuarial gain, actuarial loss. Make sure you know that little calculation. And as I say, it's the only time we worry about the market-related value plan assets. All right, now the only element that's left is transition asset, transition obligation. Let's go to number 26. If you go to number 26, we'll go right to the numbers. Notice the year we started the plan, our projected benefit obligation, $780,000. The fair value plan assets, $600,000. So the year we started the plan, our plan was underfunded. PBO was underfunded by $180,000. We started with a transition obligation of $180,000. Let's read on. It says at December 31, year 7, all amounts accrued as net periodic pension cost have been contributed to the plan. Then they say the average remaining service period for the employees is 10 years. Then they go on to say some participants are going to work 20 years. Some participants are going to work 25. I hope you understand we don't care about that. In these calculations, what we're always looking at is the average remaining service period for the employees. And again, they'll say, oh, some people are going to work 15 years. Some people are going to work 35 years. We don't care. What we always need in these calculations is the average remaining service period. They go on to say, to minimize the accrual for net periodic pension cost, what amount of transition obligation would they amortize? Well, of course, people sit in the exam and go, oh, I see it. Take the transition obligation, $180,000, divide by 10 straight line years, the average remaining service period for the employees, hello D. No, because there's a little rule here. Here's the rule. When you're amortizing transition asset, transition obligation, if the average remaining service period for these employees, if the average remaining service period is less than 15 years, they'll let you go up to 15. If the average remaining service period is less than 15 years, here it's 10, they'll let you go up to 15. So I'm going to take the $180,000, divide by 15 straight line years. What they would amortize is answer C, $12,000. Just remember, if the average remaining service period for the employees is less than 15, they'll let you go up to 15. What if the average remaining service period was 22 years? What would you use? 22 or 15? 22, right? If the average remaining service period is 44 years, use 44. But if the average remaining service period is less than 15, they'll let you go up to 15. That way you minimize the accrual on the income statement. You minimize the hit on the income statement, and that's what they said they wanted to do, minimize the accrual. So they'll let you do that. All right, now if you're with me on, and that's pretty much what they could hit with transition asset, transition obligation, that's pretty much all there is to it. Let's go back to more typical type of questions they have on defined benefit plans. I'd like you to try 27 and 28 and then come back. Welcome back. In number 27, we're told that Locke has a defined benefit plan. And we know that anytime you see a defined benefit plan, you're thinking SIRPAT, S-I-R-P-A-T. SIRPAT, do an entry. So let's work out SIRPAT. We know that S is service cost, I is interest on PBO, and you'll notice that in this problem, they combined service cost and interest on PBO together adds up to a total of $620,000, a plus, an increase to your pension expense for the year. How about the R, the return on plan assets? Well, we gave the trustee $1 million cash. It has earned 10%. That was the actual return. That's a minus $100,000. Prior service cost amortization, they don't have any. Actuarial gain or loss, they don't have any. Transition asset, transition obligation, they don't have any. As I keep saying, you've got to deal with the elements they give you. Add it all up. It adds up to $520,000. So we know that Locke is going to debit pension expense, $520,000, because that's what SIRPAT does for you. It gets you the pension expense for the year in any defined benefit plan. We know they're going to credit cash $1 million. That was the funding. So we know they're overfunded. They're going to debit an overfunded pension asset, $480,000. The answer is C, because that's what they wanted. They wanted the balance in the overfunded pension asset, and it is $480,000. Notice, SIRPAT, do an entry. SIRPAT, do an entry. Works every time. Let's try number 28. Once again, we're dealing with a defined benefit plan. So let's work out SIRPAT. We know the service cost is $19,000. That's a plus. Interest on PBO, $38,000 is a plus. Return on plan assets, 22, is a minus. Prior service cost amortization, $52,000 is a plus. Apparently they don't have any actuarial gain or loss or transition asset, transition obligation. You add it up. It adds up to $87,000. So we know they're going to debit pension expense, $87,000, because that's always what SERPAT does for you. Get you the expense in a defined benefit plan. Now, the employer contribution was $40,000, so we know they're going to credit cash $40,000. Aren't they underfunded? So what should I do? Well, they have an overfunded pension asset on the balance sheet. Now that they're underfunded, you have to get rid of that. So I'm going to credit overfunded pension asset, $2,000, and credit an underfunded pension liability for $45,000. And the answer is A. They wanted the balance in the underfunded pension liability. Just remember, SERPAT, do an entry, and you've got it. When a corporation has a defined benefit plan, they have to report the funded status of that plan. Companies are required to report the funded status of any defined benefit plan. Let me show you how it's done. Let's say a corporation has a defined benefit plan, and when they get to December 31, their projected benefit obligation is $1,200,000. But let's say the fair value plan assets at year end, $1 million. So at year end, December 31, the projected benefit obligation, $1,200,000. But the fair value plan assets at December 31, $1 million. So notice at year end, their PBO is underfunded by $200,000. Listen carefully. Because their PBO is underfunded by $200,000, they're going to have to report a liability for pensions on their balance sheet of $200,000, because they are required to report the funded status of any defined benefit plan. Their PBO is underfunded by $200,000 at year end. So they're going to have a liability for pensions on their balance sheet of $200,000. So what entry did they make? They would debit OCI, $200,000, and credit underfunded pension liability, $200,000, because you are required to report the funded status of any defined benefit plan. Same example. What if at December 31, the balance in PBO, $1,200,000. Fair value plan assets, $1 million. So once again, year end, their PBO is underfunded by $200,000. But the exam mentions that they already have a pension liability on the balance sheet of $45,000. What would be your analysis? Well, we know that we are required to report the funded status of any defined benefit plan. Since their PBO is underfunded by $200,000, we know they need a liability on the balance sheet for pensions of $200,000. Since they already have $45,000 on the balance sheet, we have to bring that up to $200,000. So we're going to debit OCI $155,000, credit underfunded pension liability $155,000 to bring the liability on the balance sheet from $45,000 up to $200,000. We have to report the funded status. And I mention that because the exam could ask you what additional liability must be recorded. In this case, $155,000. You have to read the problems carefully. They might ask what additional liability must be recorded. $155,000 to bring the liability on the balance sheet from $45,000 up to $200,000, because corporations are required to report the funded status of any defined benefit plan. Let me ask you this. What if at December 31, let's reverse the numbers. What if the balance in PBO was $1 million and the fair value plan assets $1 million too? Let's just reverse the numbers. December 31, the balance in PBO, $1 million. The fair value plan assets, $1,200,000. Notice at year end, PBO is overfunded by $200,000. If PBO is overfunded by $200,000 at year end, would I debit overfunded pension asset $200,000 and credit OCI $200,000? Yes. Yes. Because you are required to report the funded status, overfunded or underfunded, of any defined benefit plan. So just remember that anytime a corporation has a defined benefit plan, they have to, at year end, report the funded status, either overfunded or underfunded, of any defined benefit plan. I'd like you to shut the class down, do 29 and 30, and then come back. Welcome back. In number 29, at the bottom they're saying, what is the amount of pension liability that would have to be on the December 31, year 7 balance sheet? Well, I think you know the analysis. At December 31, year 7, their projected benefit obligation, $5,700,000. But the fair value plan assets on December 31, $3,450,000. Notice their PBO is underfunded by $2,250,000. They're going to have to debit OCI, $2,250,000, and credit an underfunded pension liability of $2,250,000. And the answer is B, because a corporation is required to report the funded status of any defined benefit plan. And I want you to notice that line, accumulated benefit obligation, ABO. Just put a line through that. And you want to put in your notes, that's not used for any calculation. And you'll find when you do your homework that very often in pension questions, they'll mention the ABO, the accumulated benefit obligation. And I know students sit in the exam and go, what do I do with that? It's not used in any calculation. It's just there to get you down the wrong path. So we're not going to use the ABO, the accumulated benefit obligation, for anything. So don't get caught up in that. It's just simply not used in any calculation. In number 30, at the bottom they say, what amount would Payne record as their additional pension liability December 31, year 3? Well, think what happened here. For year 3, their net periodic pension cost, $90,000. So we know they debited pension expense, $90,000. And of course, Sir Pat is how they got that $90,000. It's made up of the 6 elements, but here they gave it to you. So we know they debited pension expense, $90,000. The employer contribution was $70,000. So we know they credited cash, $70,000 for the funding. They were underfunded, so they must have credited underfunded pension liability, $20,000, when they booked their pension expense for the year. They ended up crediting underfunded pension liability for $20,000. Now, is that the liability for the balance sheet? No. No, it's not, because at year end, the PBO is $103,000. The fair value plan assets at year end, $78,000. So notice their PBO is underfunded by $25,000. If their PBO is underfunded by $25,000 at year end, they have to have a liability for pensions on the balance sheet of $25,000, because corporations are required to report the funded status of any defined benefit plan. So since they already have a $20,000 underfunded pension liability on the balance sheet from when they booked their pension expense for the year, our job would be to bring that up to $25,000. So we're going to debit OCI, $5,000, and credit underfunded pension liability, $5,000. That brings our underfunded pension liability from $20,000, which they recorded when they recorded their pension expense for the year, up to $25,000, because at year end, their PBO is underfunded by $25,000. So when they ask us what additional liability must be recorded, the answer is B, $5,000, to bring that underfunded pension liability from $20,000 up to $25,000, because at year end, their PBO was underfunded by $25,000. They had to have a liability on the balance sheet for pensions of $25,000. So the additional liability that had to be recorded there, answer B, $5,000. Now I could be wrong, but I'm going to assume that you're in the mood to talk about post-retirement benefits. Let's talk about post-retirement benefits. Now, when you see that phrase in the exam, post-retirement benefits, what they're referring to is a defined benefit plan for fringe benefits. That's what we mean by post-retirement benefits. It's a defined benefit plan for fringe benefits. In other words, we owe our retired employees health care, dental care. It's almost always health care. But we owe our retired employees fringe benefits, health care. That's what we mean by post-retirement benefits. Now, you'll be happy to know that there are 6 elements that make up your post-retirement benefit expense for the year. And what'll help is it's still SURPAT. That's why I have to show this to you. If you know SURPAT, you've got the 6 elements of pension expense for a defined benefit pension plan, but you've also got the elements for your post-retirement benefits expense. Let's go over SURPAT. It's basically the same idea. The S is still service cost. You know what that is. That would be the discounted present value of all the post-retirement benefits earned by your employees this period. Always a plus. Always in addition to your expense for the year. The I is a little different, but it's the same idea. Now I is interest on APRBO, interest on accumulated post-retirement benefit obligation. Just think of it as interest on the obligation. It's interest on APRBO, interest on accumulated post-retirement benefit obligation. But it's always a plus, always in addition to your expense for the year. The R is return on plan assets. Same idea. Every year, you turn cash over to the trustee. They make investments. The better those investments do, that's good for you. That would be a minus. That lowers your expense. The P, you know what that is, prior service cost, amortization. And you know what prior service cost is. Hey, that's the present value of all the post-retirement benefits earned by your employees before you had a plan. We're going to give credit for those years and amortize some of that prior service cost as one of our 6 elements. It's a plus, an addition to your expense for the year. A is actuarial gain or loss. If you've had an actuarial gain, that's good for you. Lowers your expense. Actuarial loss is bad for you. Increases your expense. And then T, transition asset, transition obligation. When you started the post-retirement benefit plan, if you were overfunded, you had a transition asset. That's good for you. Lowers your expense. If you were underfunded when you started the plan, you have a transition obligation. That's bad for you. Increases your expense. So I want to show you that if you know SURPAT, you've got the 6 elements. Now, I know you know this, but I want to say it. Remember, SURPAT just gives you the expense for the year. And then you're always back to, are they fully funded? Are they overfunded? Are they underfunded? You might want to put in your notes, entries are the same. I'm not going to make us do them, but the entries would be the same. SURPAT would get me the expense, and then wait, are they overfunded, underfunded, fully funded? It's still SURPAT, do an entry. SURPAT, do an entry. Will still work. Another point. It's a little picky point, but you have to know it. Remember when we did a defined benefit plan for pensions, and we got to transition asset, transition obligation. Remember we said that if the average remaining service period for the employees was less than 15 years, to minimize the hit on the income statement, they'll let you go up to 15 years. I know you remember that, right? For transition asset, transition obligation, for a defined benefit pension plan. If the average remaining service period for the employees is less than 15 years, to minimize the hit on the income statement, they'll let you go up to 15. Well, for post-retirement benefits, they'll let you go up to 20. It's a picky point, but you got to be careful. They could ask that. So for transition asset, transition obligation, with a post-retirement benefit plan, to minimize the hit on the income statement, you can go up to 20 years. If the average remaining service period for the employees is less than 20 years, to minimize the hit on the income statement, you can go up to 20 years. Another point. A corporation is required to report the funded status of any post-retirement benefit plan. You also have to report the funded status of any post-retirement benefit plan. Let me give you an example. Let's say we get to December 31. The balance in APRBO, the accumulated post-retirement benefit obligation, is $4 million at year end. But let's say the fair value plan assets at year end, $2.6 million. Well, that would mean that their APRBO, their accumulated post-retirement benefit obligation, is underfunded by $1.4 million. Well, they would have to have a liability on the balance sheet for post-retirement benefits of $1.4 million. So they'd have to debit OCI $1.4 million and credit underfunded post-retirement benefit obligation $1.4 million, because corporations are required to report the funded status, either overfunded or underfunded, of any defined benefit plan, even a post-retirement benefit plan. Same concept. That concludes our discussion on leases and pensions, And from all of us at Bisk Review, we want to wish you the best of luck on the exam. Study hard.
Welcome to Bisk CPA Review, comprehensive review materials for the CPA exam that let you customize your own review program to meet your individual learning style and ensure your success. Worried about finding the time to study? Our customizable learning system allows you to study anytime, anywhere, 24/7 to fit your busy lifestyle and ensure your success on the exam. Looking for a particular way to prepare? From structured, professor-led online reviews to independent self-study programs on CD-ROM, video, audio, and text, our interrelated products are designed to meet your individual learning style. Wondering how you're going to master the exam content? Our unique learning management system ensures that you will master the material. And features such as diagnostic exams, streaming video lectures, and a computerized personal trainer actually reduce your study time. Concerned about the computer-based exam format? The online, classic, and software versions of Bisk CPA Review accurately mirror the real-life experience of the computer-based exam, including multiple choice and simulation questions. It's all about passing. Each of our products has been specifically designed to ensure your success on the CPA exam. With Bisk CPA Review, you'll have the confidence and knowledge to pass it, guaranteed.
Hello, and welcome to the Bisk Review for the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette, and I'll be your instructor in this class. And in this class, we're going to be covering several important topics. We're going to look at the type of questions that come up in the exam for stockholders' equity, ratio analysis, partnership accounting, and also foreign operations. Now, before we dive into the material, I just want to take a moment to give you some advice about the way to get the most out of this class. The important thing is to avoid just sitting back passively and watching this class. The important thing is to be an active participant. Take good notes. Treat this like any other class. Later in the class, when we do problems, the important thing will be to shut the class down. Do the problems yourself. Come up with your answers before you come back and we go through the problems together. And I think if you do these simple things, you'll get much more out of this class, and obviously, that's what we both want. Let's do our first topic. Let's get into stockholders' equity. Now, you certainly know that in a formal, classified, published balance sheet, corporations report their capital structure under the heading stockholders' equity. And I want to begin by going over the different components that make up stockholders' equity. Starting with common stock. Notice in my example on the screen, there are 60,000 common shares issued and outstanding at $10 par value per share. So the total par value for all the common shares issued and outstanding is $600,000. And by the way, that is a requirement. Corporations are required to publish in their balance sheet the total par value or the total stated value of all the common shares issued and outstanding. And let me just quickly say that in the CPA exam, you can treat par and stated value as being exactly the same thing. But corporations are required to report the total par or stated value for all the common shares issued and outstanding. And since corporations are required to report this, what is it? What is par value? I think we should talk about it for a minute. If you're in the exam and they ask you anything about the concept of par value, you remember one key phrase. The phrase is legal capital. Remember that. The par value of a corporation is that corporation's legal capital. Theoretically, it is there to provide creditors of the corporation with some minimum basic protection. So that's what it represents. It is the legal capital of the corporation. And as I say, theoretically, it is there to provide the creditors of a corporation with some minimum basic protection. What do I mean by protection for creditors? Well, in most states, now this does depend on the laws of the state of incorporation, but in most states, corporations are not allowed to pay any dividends out of par value. Why? Because they're the legal capital of the corporation, and theoretically, that par value, that legal capital, is there to provide some minimum basic protection for creditors. As I say, in most states, corporations are not allowed to pay a dividend out of par value. Next, we have additional paid-in capital, or APIC. And I think you know, for the most part, what that $1 million represents is what shareholders were willing to pay over par or stated value, over legal capital to acquire shares. That is additional paid-in capital, what shareholders were willing to pay over legal capital to acquire shares. Then we have retained earnings, and you know what that is. Retained earnings is the cumulative net income of the corporation from the date of incorporation, after you've deducted dividends, essentially. Retained earnings is the cumulative net income of the corporation from the date of incorporation after you've deducted dividends. But always remember, there is still one more element in stockholders' equity. Notice accumulated other comprehensive income items. And I think you know what that $500,000 represents. There are gains and losses that are simply not on the income statement. There are gains and losses that are not on the income statement. These gains and losses flow directly to stockholders' equity as items of other comprehensive income, items of OCI. So now down in stockholders' equity, we have accumulated OCI. Notice these gains and losses accumulate. I think you know exactly what that represents. That's like having a retained earnings account down in stockholders' equity for all these gains and losses that are not on the income statement. They accumulate, accumulated other comprehensive income items. Now, with those elements in mind, let's get into what the exam tests on stockholders' equity, and let me just say that the primary thing that the CPA exam tests with stockholders' equity is dividends. Now, just to get us into this, let's start with a simple cash dividend. Let's say that this corporation that we just looked at on the screen, let's say this corporation declares a $200,000 cash dividend. Well, I think you know, if this corporation declares a simple $200,000 cash dividend, they're going to debit retained earnings, $200,000. Always remember that dividends come directly out of retained earnings. They're not on the income statement in any way. Dividends come directly out of retained earnings, so there would be a debit to retained earnings, $200,000, and a credit to dividends payable, $200,000. That is the entry for a simple cash dividend. All right, now let's try to complicate it. Let's say that that $200,000 dividend never happened. Forget that. That's a simple cash dividend. It's too simple. Let's say instead this same corporation declares a dividend of $1,750,000. I think you see the complication. If this same corporation declared a dividend of $1,750,000, you know they're going to credit dividends payable $1,750,000. But notice they're going to debit retained earnings for just $1,500,000. You see what's happened in this problem. They've declared a dividend greater than their accumulated earnings. And here's the point. If a corporation declares a dividend greater than their accumulated earnings, well, then the argument would be that at that point, they are no longer distributing earnings. They are distributing capital. So the other $250,000 would be a debit to additional paid-in capital. That's the basic argument. If a corporation declares a dividend greater than their accumulated earnings, well then at that point, they are no longer distributing earnings. They are distributing capital. So the other $250,000 would be a debit to additional paid-in capital, and I want you to know that that debit to additional paid-in capital for $250,000, that's what the CPA exam would mean by a liquidating dividend. You have to know how the exam talks. And that $250,000 that we debit to additional paid-in capital, that's what the exam would mean by a liquidating dividend. I'd like you to try a couple of questions. And as I said earlier, when we get to questions like this, the best thing to do is shut the class down. Do the questions, get your answers, and come back. You'll learn a lot more that way. So I'd like you to do questions 1 and 2, and then come back. Welcome back. Let's do these questions together. Number 1 says, Old Corporation declared and paid a liquidating dividend of $100,000. This distribution resulted in a decrease of Old Corporation's what? Well, we know that liquidating dividends by definition are a distribution of capital. So there would be a decrease to additional paid-in capital. So you want yes under paid-in capital because, again, liquidating dividends by definition are a distribution of capital. APIC would have to decrease. How about retained earnings? No. No. Liquidating dividends are a distribution of capital. APIC would go down. Retained earnings, as far as we know, wouldn't be touched. And the answer is D. And you might be thinking, but Bob, wouldn't I have to go to retained earnings first? Well, how do you know this corporation ever had earnings? You don't know that. You be careful. You can't make assumptions. All I know in this question is that there's been a liquidating dividend. That's all I know. And I know that liquidating dividends are a distribution of capital. I know APIC would go down, but I can't assume that this corporation ever had earnings. You can't make assumptions. Be very careful. And just to drive this point home, look at number 2. Number 2 says, a corporation declared a dividend, a portion of which was liquidating. How would this declaration affect each of the following? Well, the portion that's liquidating would decrease additional paid-in capital. The portion that's non-liquidating would lower retained earnings. Now you want decrease under both. Now the answer is B. So I hope you see the difference in those questions, because if a portion of the dividend is liquidating, that's a little different. The portion that's liquidating, of course, would lower additional paid-in capital, and the portion that's non-liquidating would lower retained earnings. So now you'd want decrease under both. Now, we're going to stay on dividends, and what I want to get into next is how you would allocate dividends to common and preferred stockholders. It's a basic type of problem, but I have to be sure that you're comfortable with this kind of problem. So if you look in your viewer's guide, you'll see the same stockholders' equity section that we started with, but now we've added some preferred stock. Notice in this stockholders' equity section now there are 4,000 shares of preferred stock outstanding at $100 par per share. So the total par value for all the preferred shares outstanding, $400,000. And we're also given some information about the preferred. The preferred is 9%. It is cumulative. It is fully participating preferred stock. Dividends are 8 years in arrears, not including the current year. And if you look at what we're told here, the board of directors have declared a $380,000 dividend. So the question is, how much of that $380,000 would go to preferred stockholders? How much would go to common stockholders? So we'll set up a column for preferred, a column for common, and let's work it through. Now, I'm sure you know that the minute you see the word cumulative, you know that before common stockholders can get a dime of dividends, the dividends in arrears have to be settled first. Those are the demands of the cumulative feature. Remember, the whole idea behind preferred stock is that you as a shareholder, you give up your voting rights. That's what they want. You give up your voice in management. You give up your voting rights. And in return, you get privileges, preferential treatment that other shareholders don't receive. And the most basic preferential treatment you receive is, of course, in terms of dividends. Preferred stockholders are preferred as to dividends, and when preferred stock is cumulative, which it most often is, when preferred stock is cumulative, it means before common stockholders can get a dime of dividends, dividends in arrears have to be settled first. So let's start with the dividends in arrears. I'm sure you remember that with preferred stock, the annual dividend is a fixed rate on par value. So we're going to take the fixed dividend rate for preferred, which is 9%, times the par, $400,000. Let's agree that the annual preferred dividend here is $36,000 because with preferred stock, the annual dividend is a fixed rate on par value. So take that fixed dividend rate, 9%, times the par, $400,000. I know we agree that the annual preferred dividend is $36,000, and since it's 8 years in arrears, take $36,000 times 8, let's agree that the first $288,000 of the $380,000 dividend has to go to preferred stockholders, and we have no choice. Those are the demands of the cumulative feature. Now, what comes next? That's right, don't forget the current year. The problem said that the dividends were 8 years in arrears, not including the current year. And don't forget, in the current year, preferred stockholders are going to step forward and demand to be paid first. That is the most basic privilege. You give up your voting rights, you get privileges that other shareholders don't receive. And as I say, the most basic privilege you as a preferred shareholder receive by giving up your voting rights is your preferred as to dividends. And in the current year, that wouldn't go away. So they're going to demand their current year's dividend before common can get anything. So add another $36,000 for the current year. So if you add it up, let's agree that the first $324,000 of the $380,000 dividend has to go to preferred stockholders, and you have no choice. Now, I want to ask you a question. I'd like you to think about this. If I told you that the preferred stock was non-participating, now I know it is, we'll get to that, but I'd like you to think of this first. If I were to tell you the preferred stock was non-participating, would I work down to the $324,000 exactly the same way and just give the rest to common? Is that what that means? If I tell you that preferred stock is non-participating, would we work down to the $324,000 exactly the same way we just did and then just give the rest to common? Yes. Yes, it's a much easier problem. If they tell us that preferred stock is non-participating, we're basically done. We give the first $324,000 to preferred stockholders, give the rest to common, and you're out. I'd like you to see this the way I do. When preferred stock is participating, what that does, it puts a limit, it puts a ceiling on what I can give common stockholders at this point. See, that's what participation does to you. When you see participation, it means there's a limit, a ceiling, to what common stockholders can receive at this point. All common stockholders can receive at this point is a dividend at the same rate. at the same rate as preferred stockholders. So now common can get up to 9% of their par, 9% of 600,000, or the next 54,000. So you see what participation does to you. It puts a limit, a ceiling, on what common stockholders can get at this point. All common stockholders can receive at this point is a dividend at the same rate as preferred stockholders. So now common can get up to 9% of their par, or the next 54,000. Now let me summarize. Didn't we give the first 324,000 to preferred stockholders, then the next 54,000 to common stockholders? Add up 324 plus 54. Haven't we allocated 378,000 of dividends? But the problem is the dividend this year is 380,000. That still leaves an additional 2,000 of dividend to be distributed this year. That is your participation amount. So I hope you see how we got that participation amount. We gave the first 324,000 to preferred, the next 54,000 to common. We've allocated 378,000 of the dividend, but the dividend is 380,000. There's still another 2,000 of dividend to be paid out this year. That is your participation amount. So we're down to one final question. How do you work out that participation? How do you allocate that final $2,000 of participation? And from my experience, this is what a lot of students forget. You know, a lot of students remember it pretty well down to here. But from my experience, a lot of students forget how to work out the final 2,000. So it's good that we go over it. Remember, the way you work out participation is always based on relative par values. Again, the way you work out participation is based on relative par values. So let's work it out. We know in this problem the total par value for common stockholders is 600,000. The total par value for preferred stockholders, 400,000. Add it up. Add up 600,000 plus 400,000. Notice the total par value in the corporation is $1 million. Now you strike a ratio. You say since preferred stockholders make up 400,000 over $1 million, 40% of the total par in the corporation, preferred stockholders would get 40% of that remaining $2,000, or $800 of participation. I'll do that again. Since preferred stockholders make up 400,000 over $1 million, 40% of the total par in the corporation, preferred, would get 40% of that remaining $2,000, or $800 of participation. Since common makes up 600,000 over $1 million, 60% of the total par value in the corporation, common would get 60% of that remaining 2,000, or 1,200 of participation, and that gives us our final distribution. The final distribution of that dividend would be 324,800 to preferred stockholders, 55,200 to common stockholders. There's no way you can win that exam and not know how to allocate dividends between common and preferred stockholders. As I said, it's a basic type of problem, but you want to make sure you're comfortable with it. Let's try multiple choice on this. I'd like you to do multiple choice number 3 and then come back. Welcome back. Let's do number 3 together. In this question, we have a $44,000 dividend to distribute, and of course the question is, how much of that $44,000 would go to preferred stockholders, how much would go to common stockholders? So we'll set up a column for preferred, we'll set up a column for common, and we'll work it through. And you certainly know that the minute you see that word cumulative, before common stockholders can get a dime of dividends, the dividends in arrears have to be settled first. Those are the demands of the cumulative feature. So they said that dividends were in arrears on the preferred and amount to $12,000. So the first $12,000 of that $44,000 has to go to preferred stockholders. We have no choice. As I say, those are the demands of the cumulative feature. What comes next? You don't forget the current year. In the current year, preferred stockholders are going to demand to be paid first. That's their most basic preference. So let's deal with the current year's dividend. We know with preferred stock, the annual dividend is a fixed rate on par value, so I'm going to take the fixed dividend rate, 6%, times the par 100. The annual preferred dividend is $6 a share, times 4,000 preferred shares outstanding. I think we can agree that the current year's preferred dividend is $24,000. If you add up the $12,000 and the $24,000, I know we agree that the first $36,000 of the dividend has to go to preferred stockholders because they are, after all, preferred as to dividends. And because there's no participation to worry about, just give the rest to common. And the answer is B. And let me just quickly say, you would never assume participation. I hope that's clear. If preferred stock is participating, it has to be stated. You would never assume participation. So notice, since they said nothing, I assume there is no participation. I just give the rest of the $44,000 dividend to common, the other $8,000, and that's why the answer is B. So you'd never assume participation. Would you assume cumulative? That's a more difficult question. I don't think the exam would put you in that position. Preferred stock is almost always cumulative. To me, the exam would have to say, they'd have to state non-cumulative, and I think they'd be pretty good about that. I don't think they'd be silent. I mean, I'm just giving you my opinion, because that's a more difficult question. If they were silent, would I assume cumulative? Most of the time, preferred stock is cumulative. It usually is. But again, I'm not trying to give you something to worry about that you don't have to worry about. I don't think the exam would ever be silent. If preferred stock was non-cumulative, they would state it. And as I say, participation has to be stated. All right, now we're going to move on to something else. And what I want to get into next is stock dividends and stock splits. Let me start with a couple of definitions. A stock dividend is simply a dividend that's declared in the form of shares. In other words, a corporation declares a dividend, but rather than send you cash as a dividend, the corporation sends you additional shares of stock in the corporation as a dividend. That is a stock dividend. It's a dividend that's declared in the form of shares. Now, a stock split is really just a very large stock dividend. So a stock split is just a very large stock dividend. Now, the first thing that could come up in the exam is this. How large is large? How large would a stock dividend have to be before you would consider it a split? I'm going to give you a little guideline that you can always trust. Just remember, if a corporation increases their shares outstanding by 25% or more, 25% or more, you treat it as a split. Under 25%, treat it as a dividend. You're safe with that guideline. If a corporation increases their shares outstanding by 25% or more, 25% or more, treat it as a split. Under 25%, treat it as a dividend. You should be safe with that guideline. And every now and then, in the exam, they'll try to slip that by you. So just be aware of that guideline. Now, let's get to the most important part of this. The most important part of this is when you go in the exam, make sure you know how to record a stock dividend. You know how to record a stock split. That's the most important thing. If you look in your viewer's guide, you'll see the same stockholders' equity section that we started with in this class. This corporation has 60,000 common shares outstanding at $10 par per share. Total par for all the common shares outstanding, $600,000. Additional paid-in capital, $1 million. Retained earnings, $1.5 million. Accumulated other comprehensive income items, $500,000. So as we start, the total value of stockholders' equity, the total book value of the corporation, is $3,600,000. Now, let's start with a stock dividend. Let's assume that this corporation declared a 10% stock dividend. Notice, when the fair market value of the stock is $50. So that's what's happened. This corporation has declared a 10% stock dividend when the fair market value of the stock is $50 a share. And I want to say something about this. That $50, listen carefully, that's what the stock is trading for on the day of declaration. I've got to warn you on this. In the exam, they love to give you different market prices. They'll tell you what the stock is trading for on the day of stockholders of record. They'll tell you what the stock is trading for on the day they send out the shares. All you care about is what the stock is trading for on the day of declaration. In any dividend problem, that's the important date, the date of declaration. All right, so what is the entry to book a stock dividend? Well, I always like to start with basics. How many shares are going out? Well, I know you know this. If you declare a 10% stock dividend, you are literally increasing your shares outstanding by 10%. You're sending out another 10%. You're sending out another 6,000 shares, 10% of 60,000. That's how you read that problem. If you declare a 10% stock dividend, you are literally increasing your shares outstanding by 10%. you're sending out another 10%. You're sending out another 6,000 shares. Now, with a stock dividend, you're going to take those 6,000 additional shares times $50, the fair market value of the stock on the date of declaration. And we're going to debit retained earnings, $300,000. We're going to credit common stock for legal capital. We're going to credit common stock for 6,000 shares at par 10, $60,000. And we're going to credit additional paid-in capital for the rest, $240,000. That is the entry to book a stock dividend, and you have to know it. Now, before I leave that entry, I want to bring up a couple of points, and I know they're basics, but you've got to be aware of this. Notice something. Notice that the total value of stockholders' equity, the total book value of the corporation before the stock dividend, $3,006,000. Now think about this. What's the total value of stockholders' equity? What's the total book value of the corporation after the stock dividend? $3,006,000. If you look at that entry, notice we're not doing anything in that entry that affects total stockholders' equity. All we're doing is taking money out of retained earnings and putting it into other capital accounts. And there's a term you should know. What you've done in this entry is you have capitalized a portion of your retained earnings. You should know that term. So what you've done in this entry is you have capitalized a portion of your retained earnings, and please remember that stock dividends or splits, we'll get to splits in a moment, but stock dividends or splits never affect total stockholders' equity. They never affect the total book value of the corporation. All right, now let's say that that 10% stock dividend never happened, okay? Wipe it from your memory banks. Let's say instead, let's say the same corporation, see this way we can use the same stockholders' equity section. Let's say the same corporation declares a 100% stock dividend, or what they could call a 2-for-1 split. So the same corporation now declares a 100% stock dividend, or a 2-for-1 split. Now again, let's start with basics. How many shares are going out? Well, you know. If you declare a 100% stock dividend, you are literally increasing your shares outstanding by 100%. You're sending out another 60,000 shares. Now you have to be careful because there are two acceptable ways of handling a split. One way of handling a split, you just make a memorandum entry. Notice there's no journal entry. We're not going to book anything. We just make a memorandum entry to the effect that the number of shares outstanding have doubled from 60,000 to 120,000, and the par is cut in half. The par goes from $10 a share to $5 a share, so take $5 times 120,000 shares outstanding. Notice we still have 600,000 of legal capital. That is a perfectly acceptable way of handling that split. You just make a memorandum entry. There's no journal entry. You don't book anything. Just a memo that says, hey, the shares outstanding have doubled from 60,000 to 120,000, and the par is cut in half from 10 to 5. Now, notice something. Before I get into the second approach, before we get into the second way you can handle a split, notice that if we handle a split with a memorandum entry, par per share has to go down. I want you to know that. Anytime you handle a split with a memorandum entry, par per share has to go down. Like in my example, shares outstanding have doubled, par is cut in half from 10 to 5. And the problem is that in practice, you may not be able to do that. In practice, you could run into a legal restriction. It could be that the laws of the state you're incorporated in won't allow that. That $10 per share par value is sacred. Or it could be your bylaws, your articles of incorporation. Say, well, you can't do that. That $10 per share par value is sacred. All right, so here's the second way you can handle a split. In a split, if the corporation wants to maintain that $10 per share par value, and as I say, it's probably, in practice, a legal requirement. That's what you run into, a legal barrier. And with a split, if a corporation wants to maintain that $10 per share par value, now they will book an entry. They'll capitalize retained earnings for the par value of the shares they send out, not the fair value. So we know they sent out another 60,000 shares times par 10. We're going to debit retained earnings, 600,000. We're going to credit common stock, 600,000. That's the second way you can handle a split. If the corporation wants to maintain that $10 per share par value with a split, and as I say, it's probably a legal requirement, well, now they will book an entry. They will capitalize retained earnings for the par value of the shares they send out, not the fair value. So I took the 60,000 shares that they're sending out as a dividend times the par 10, and I debit retained earnings 600,000. I credit common stock 600,000. So now what does my balance sheet look like? I've got 120,000 shares outstanding times par 10. I kept the par 10. I now have 1,200,000 of legal capital. So those are the two ways you can handle a split. Either make a memorandum entry, hey, shares outstanding have doubled, par is cut in half, or if the corporation in a split wants to maintain that $10 per share par value, they will book an entry where they capitalize retained earnings for the par value of the shares they send out. I'd like you to try some questions. I'd like you to do questions 4 through 7 and then come back. Welcome back. Let's do this group of questions together. And number 4, they say on May 18th of the current year, Sol's board of directors declared a 10% stock dividend. The market price of Sol's 3,000 outstanding shares of $2 par stock was $9 a share on that date. And you know that's the only date we care about, date of declaration. They go on to say the stock was trading for $10 a share on July 21st, the day they actually send out the shares. But as I say, all we care about with a dividend is the date of declaration. Let's think about the entry that would be made here. We know that if you declare a 10% stock dividend, you are literally increasing your shares outstanding by 10%. You're sending out another 10%, you're sending out another 300 shares, 10% of 3,000. We're going to take those 300 additional shares times $9, what the stock is trading for on the day of declaration, and we're going to debit retained earnings, $2,700. We're going to credit common stock for legal capital, 300 shares times par 2, or 600, and you would credit additional paid-in capital for the rest, 2,100. That's the entry to book a stock dividend. So when they ask at the bottom, what amount would Sol credit to APIC because of the stock dividend? You know it's answer A, 2,100. Now 5 and 6 are a set. 5 says, how would a 100% stock dividend affect additional paid-in capital and retained earnings? And I have a question for you. In a split, and we know 100% stock dividend, that's big enough to be a split. In a split, would it be possible to have no change to APIC, no change to retained earnings? Would it be possible to have no change under both columns? Yes. How? If we did a memorandum entry. Remember, if we do a memorandum entry, there is no journal entry. We don't book anything. It's just a memorandum entry. So with a memorandum entry, there'd be no change to additional paid-in capital, no change to retained earnings. But did you notice that's not an answer choice? If that's not an answer choice, we had to infer they must have done the second approach, where they would capitalize retained earnings for the par value of the shares they sent out. Now, how many shares are they sending out? Well, notice as we start here, the stock has a par of $1. There must be 90,000 shares outstanding because common stock has a balance of 90,000. And if we declare a 100% stock dividend, we're sending out another 90,000 shares. And if we want to maintain the par per share, we'll take those 90,000 shares they're sending out times par $1. We'll debit retained earnings 90,000, credit common stock 90,000. So the answer is D. Retained earnings would go down, in this example, 90,000. APIC would not be touched. They must have capitalized retained earnings for the par value of the shares they sent out. It's a split. So retained earnings would go down, but APIC wouldn't be touched. And the answer is D. In number 6, they say, how would a 5% stock dividend affect APIC and retained earnings? So now it's a small one, right? Now it's a 5% dividend. Well, if it's a 5% dividend, instead, we're going to debit retained earnings for the fair value of the shares, whatever that is. We were not told the fair value of the shares. But in a stock dividend, not a split, we would debit retained earnings for the fair value of the shares, credit common stock for par $1, and credit APIC for the rest. And we know there would be APIC because they did say at all times the stock was selling for more than par. They did say that. At all times the stock was selling for more than par. So there would be APIC. So in a small stock dividend, in this case 5%, we would debit retained earnings for the fair value of the shares. So retained earnings would go down. We'd credit common stock for legal capital, and APIC would go up. And the answer is A. Number 7. The following stock dividends were declared and distributed by Sol, and they want to know the aggregate debit to retained earnings. Well, remember I said, basic guideline you can always lean on is 25% or more split, under 25% dividend. Just good to know that. It's a good guideline. You can lean on it. 25% or more, split. Under 25% dividend. And if you remember that, you know that the 10% distribution is a stock dividend. So you would debit retained earnings for the fair value of the shares. Fair value. So I would circle that 15,000. Now the 28% distribution is a split. So you would debit retained earnings for the par value of the shares. So I would circle the 30,800. So when they ask us at the bottom, what is the aggregate debit to retained earnings? It's 15,000 plus 30,800. Answer B, 45,800. Now, one thing I worry about with my students, don't be one of those students who confuses a stock dividend with a property dividend. They're really very different. Let me make sure you see the difference. You know that if I own 1,000 shares of Microsoft stock and Microsoft sends me 25 shares of Microsoft stock as a dividend, we know that's a stock dividend. We know that. But how about this? What if I own 1,000 shares of Microsoft stock and Microsoft sends me 32 shares of AOL stock as a dividend? That's a property dividend. They're very different. So if I own 1,000 shares of Microsoft and Microsoft sends me 15 shares of AOL stock as a dividend, that is a property dividend. Now, before we look at a problem, the big thing to remember about property dividends is that property dividends are always recorded at their fair market value. Always use the fair market value of the property on the day of declaration. Always with dividends. That's the date we care about, date of declaration. And with property dividends, it's always the fair market value of the property on the date of declaration. Let's go to a problem. Look at number 8. 8 says, on December 1, Nilo declared a property dividend. So notice the exam makes it very clear. This is a property dividend. Nilo declared a property dividend of marketable securities to be distributed on December 31 to shareholders of record December 15th. So you notice very often in the exam they give you all these dates, but as you know, the only date we care about is date of declaration. They go on to say, on December 1, the date of declaration, the marketable securities had a carrying amount of 60,000 and a fair value of 78,000. What is the effect of this property dividend on retained earnings? Well, let me show you the entry that you make for a property dividend. When Nilo declares this property dividend, they're going to debit retained earnings for the fair value of that property on the date of declaration, in this case, 78,000. As I said, the key to property dividends is to use the fair market value of the property on the date of declaration. So Nilo, in this problem, will debit retained earnings for 78,000. They'll credit, investment in AOL and investment in Tandy Company, whatever it is, credit the investment for its original cost, 60,000. And the important thing is, they'll credit gain, 18,000. Nilo will have to report any gain or loss on the property. And here it is a gain of 18,000. Now there's a nasty little point here. They said, what is the effect of this property dividend on retained earnings? Now you'd think it's answer D, but be careful because they said after all the nominal accounts have been closed. Now I don't know if you've seen that term before. What are nominal accounts? Nominal accounts are income statement accounts. Revenues, expenses, temporary accounts. These are nominal accounts. And if you look at our entry, where I debit retained earnings for the fair value of the property, 78,000, credit the investment for its original cost, 60,000, credit gain on investments, 18,000. What is the nominal account in that entry? The gain. The gain is an income statement account. It's a nominal account. And if that's been closed, that gain was closed to retained earnings, where all gains and losses ultimately end up. So think what's happened here. Retained earnings went down by 78,000 because of the declaration, but if all the nominal accounts have been closed, that gain would have gone to retained earnings, and retained earnings would have gone up 18,000. So the net effect on retained earnings is 78 minus 18, 60,000. Answer C. It's nasty. After the nominal accounts have been closed, after that gain has been closed to retained earnings, the net effect on retained earnings would only be 60,000. Answer C. Make sure you remember that entry to record a property dividend, because you might see that. Now, what I want to get into next is stock options. More precisely, stock options that are meant to be salaries and wages. Stock options that are meant to be compensation. Let me say this right away. If you're in the exam and you see stock options that are meant to be salaries and wages, they're meant to be compensation, right away you know there are two big issues. Issue number one, when do we measure the compensation? That's issue number one. When do we measure the compensation? And issue number two, how do we measure the compensation? Those really are the issues. When do we measure the compensation? How do we measure the compensation? When do we measure the compensation? How do we measure the compensation? Well, the answer to when you measure the compensation is on the day of the grant. Remember that. We measure the compensation when? On the day of the grant. Now, how do we measure the compensation? Well, in terms of how we measure the compensation, all corporations now have to use what they call the fair value-based method. The fair value-based method to value the stock options as compensation. And the point is that the real way to measure the compensation is to ask yourself, what are those options worth on the day of the grant? What would somebody be willing to pay you for those options? What's the fair value of those options on the day of the grant? That's the best way to measure the compensation. So here's what it comes down to. How do we estimate what options are worth? How do we estimate the fair value of options? Well, they recommended the Black-Scholes binomial pricing model. In terms of how you measure what the options are worth, the fair value of the options on the day of the grant, they've recommended what they call the Black-Scholes binomial pricing model. Now listen carefully. In the Black-Scholes model, we have to look at 6 factors on the day of the grant. We look at 6 factors to try to estimate what the options are worth. And I think going in the exam, you've got to know the 6 factors. And just a fast way to remember the 6 factors, remember the word devils. D-E-V-I-L-S. If you just remember the word devils, you've got all 6 factors. Let's go through them. The D stands for dividends. You know, what are the expected dividends from the stock? Are they high, low, non-existent? I is exercise price. What's the exercise price? What's the option price on the stock? We look at that. It's important, isn't it? The V is volatility. How volatile is the stock? Is this a boring old utility or an internet startup? It matters, doesn't it? How volatile the stock is. Look at volatility. I is interest rates. On the day of the grant, are interest rates high, low? It matters in terms of how you discount, doesn't it? High, low, interest rates. So I is interest rates. L is the life of the option. Why do we look at that? Well, because you know, if I have an option to buy 1 million shares of Microsoft stock, and I have to exercise those options within 24 hours, they're not nearly as valuable, are they, as if I had 10 years to exercise the options, right? The life of the options matters a lot. If I have to exercise the options within the next 15 minutes, they're not worth very much. But if Microsoft gives me 15 years to exercise the options, they're worth a great deal. So you look at the life of the option, and then S, what's the underlying stock price? What's the underlying stock price? If you can remember devils, it gives you all 6 factors. Let's do a little problem. If you look at your viewer's guide, you'll see a problem. On January 1st, 2011, a company grants an option to A. We're going to assume that A is the president of the corporation. So company grants an option to A, and the president, A, can use this option to purchase up to 10,000 shares of stock. The stock has a par of 10, and the option price is $25 a share. That's the option price. That's the exercise price. In other words, the president can buy up to 10,000 shares at that fixed price. It's called the exercise price or the option price, $25 a share. Now, one more thing. These options are meant to compensate the president for 4 years of service. All right, so these options are meant to compensate the president for 4 years of service. All right, so you're in the exam, you see this problem, you know that there's 2 big issues right off the bat. When do we measure the compensation? How do we measure the compensation? Well, as you know, the answer to when you measure the compensation is on January 1st, 2011, the date of the grant. So you're going to measure the compensation on January 1st, 2011. That's the date of the grant. Now, how do you measure the compensation? Well, all corporations have to use the fair value-based method, so they've recommended the Black-Scholes binomial pricing model. So let's say we use the Black-Scholes model, and we look at the expected dividends from the stock, the exercise price in the option, how volatile the stock is, interest rates, the life of the option, the underlying stock price. We evaluate all those 6 factors, and based on those 6 factors, we estimate the options are worth, on the day of the grant, $160,000. All right, so by analyzing those 6 factors, we've estimated that on the day of the grant, those options are worth $160,000. By the way, I really believe the exam would have to give you that number. In my opinion, there's no way the exam could give you the 6 factors, have you evaluate the 6 factors, and come up with a number. So don't get nervous about that. That's beyond the scope of the exam. That takes experts. So don't get nervous about that. I believe the exam would have to give you a number. Because as I say, to have you evaluate the 6 factors and come up with a number, that's just beyond the scope of the exam. It takes experts to come up with that. All right, so we've analyzed the 6 factors, and based on those 6 factors, we estimate those options are worth $160,000. You know me. Let's do some entries. What's the entry that they would make on the day of the grant? Listen carefully. On January 1st, 2011, on the day of the grant, we're going to debit deferred compensation, $160,000, and we're going to credit stock options outstanding, $160,000. That would be the entry that would be made on the day of the grant. We would debit deferred compensation, $160,000, and we would credit stock options outstanding, $160,000. I'd like you to think about a couple of things. What kind of account is stock options outstanding? Is it an asset, a liability? No, it is a stockholders' equity account. That's why we're covering this with stockholders' equity, because that account, stock options outstanding, that is a stockholders' equity account, and in fact, that account is going to stay down in stockholders' equity until when? Till the options come in, until they're exercised. That is a stockholders' equity account. What kind of account is deferred compensation? Contra equity. That's a contra equity account. So that's a debit in stockholders' equity. That is a reduction of stockholders' equity. It is a contra equity item. So right now in the balance sheet, this all washes out. But that would be the entry on the day of the grant. Now listen carefully. Don't forget that your job in that exam is to allocate the compensation over the periods of service. A lot of students forget that that's really your job in the exam, to allocate the compensation over the periods of service. Weren't we told that these options were meant to compensate the president for 4 years of service? So let's say a year goes by. It's now December 31. It's now December 31, 2011. What's my thinking? Well, since one of the 4 years have passed, right, these options were meant to compensate the president for 4 years of service. So at December 31, 2011, we're going to think, well, since one of the 4 years have passed, presumably what? 1/4 of the services have been performed, so we're going to debit compensation expense for 1/4 of $160,000, $40,000. And we're going to credit deferred compensation, $40,000. Notice my entry. Debit compensation expense, salaries and wages. This goes to my income statement as an expense. We allocate the compensation over the periods of service. So we're going to debit compensation expense, $40,000. We're going to credit deferred compensation, $40,000. And you know there'd be an entry just like that on December 31st, 2012, December 31st, 2013, December 31st, 2014. We allocate the compensation over the periods of service. Now, one more thing. What happens when the options are exercised? Let's say the President, A, decides to exercise all the options. Well, let's go through the entry. If the President, A, decides to exercise all the options, how many shares can the President buy? 10,000. Does the President have to pay any cash? Yes, $25 a share. Remember, the stock's not free. The President can buy up to 10,000 shares at a fixed price, called the option price or the exercise price, $25 a share. So if the President exercises all the options, buys 10,000 shares at $25 a share, won't the corporation debit cash $250,000? Because the President, after all, just bought 10,000 shares at $25 a share. So the corporation is going to debit cash $250,000. And now, because the options have come in, they're going to debit stock options outstanding $160,000. That account comes out of stockholders' equity. We're going to credit common stock. We issue 10,000 shares at par 10. So we're going to credit common stock for legal capital, always $100,000, and we're going to credit additional paid-in capital for $310,000. That's the entry that's made when the options are exercised. And I want to make sure you understand that entry could be made 12 years from now, right? They could say the president has up to 12 years to exercise the options. Well, that's very generous, but it doesn't alter the fact that we allocate the compensation over the periods of service. Watch out for those time periods. Again, they could say in a problem, the president, A, has up to 25 years to exercise the options. That's incredibly generous. But it doesn't alter the fact that we allocate the compensation over the 4 years of service. Watch out for those time periods. I'd like you to try a couple of questions. Please do 9 and 10, and then come back. Welcome back. Let's look at these questions together. Number 9 says, January 2nd of the current year, K Company granted Morgan, the president, compensatory stock options to buy up to 1,000 shares of K stock. The stock is a par of 10, and there's a call price of $20 a share. So that's the exercise price. That's the option price. The president can buy up to 1,000 shares at that fixed price, $20 a share. And then it says the options are valued at $35,000 on the date of the grant. Now, we know that when we see compensatory stock options, we know there's two issues. First, when do we measure the compensation? On the day of the grant. How do we measure the compensation? Fair value. What's the fair value of the options on the day of the grant? Notice they gave it to you, $35,000. They must have evaluated the 6 factors in the Black-Scholes model, the dividends, the exercise price, how volatile the stock is, interest rates, the life of the option, the underlying stock price. They looked at devils, and analyzing those 6 factors, they thought the options were worth $35,000 on the day of the grant. And as I said before, I think realistically, the exam has to give you that number. They can't make you come up with a number. I don't believe so. Just beyond the scope of the exam. All right, so what entry did this company make on the day of the grant? On the day of the grant, January 2nd, they would have debited deferred compensation, $35,000, and they would have credited stock options outstanding, $35,000. That's the entry on the day of the grant. And then they say on December 31, Morgan exercised all the options. So let's go through that entry. If Morgan exercises all the options, December 31, we know that Morgan can buy 1,000 shares at that fixed price, $20 a share, so the company's going to debit cash, $20,000. And now that the options have come in, they'll debit stock options outstanding, $35,000. They'll credit common stock for legal capital, 1,000 shares at par 10, $10,000, and credit APIC for the rest, $45,000. That's the entry that would be made. So when they ask at the bottom, by what net amount would stockholders' equity increase as a result of the grant and exercise of the options? Well, look at our entries. Didn't we credit common stock $10,000? Didn't we credit APIC $45,000? Haven't we credited capital accounts for a combined $55,000? But deferred compensation is contra equity. So total stockholders' equity went up $55,000 minus $35,000 because deferred compensation is contra equity. Total stockholders' equity went up, answer A, $20,000. Number 10 says, in a compensatory stock option plan for which the grant, measurement, and exercise date are all different, the stock options outstanding account would be reduced on what day? When do we debit stock options outstanding? When the options are exercised. And the answer is D. You know when the options are exercised. We debit cash, whatever is paid, debit stock options outstanding. It is reduced on the exercise date, answer D. And then we credit common stock for legal capital and APIC for the rest. Let's talk about treasury stock. I think you know that when a corporation acquires shares of its own stock. That's what we're going to look at here. When a corporation acquires shares of its own stock, these shares immediately go in the treasury. And it's what we mean by the phrase treasury stock. Now, right off the bat, I think there are three main points that you always want to remember about treasury stock. Let's go over them. Point number one, remember that when shares are in the treasury, they're still considered authorized. They're still considered issued, but they're no longer considered outstanding shares. Always keep that in mind. When shares are in the treasury, they're still considered authorized. They're still considered issued, but they are no longer considered outstanding shares. In fact, what does outstanding mean? Well, remember, outstanding means in the hands of shareholders. For shares to be outstanding, those shares have to be in the hands of shareholders. And of course, these shares are not in the hands of shareholders. They're in the treasury. So when shares are in the treasury, yeah, they're still authorized, they're still issued, but they are no longer considered outstanding shares. Point number two, remember that treasury stock gets reported in the balance sheet as a contra equity item. Treasury stock is a debit in stockholders' equity. It is a reduction of stockholders' equity. It always gets reported as a contra equity item. And point number three, the cost of the shares in the treasury also place a restriction upon retained earnings itself. So you should also remember that when shares are in the treasury, the cost of the shares in the treasury place a restriction upon retained earnings itself. In other words, when you have shares in the treasury, you have to have a footnote for creditors, shareholders, other interested parties that theoretically the corporation could distribute all of their retained earnings as a dividend except the cost of the shares in the treasury. See, the cost of the shares in the treasury place a restriction upon retained earnings itself. So when you have shares in the treasury, you basically have to have a footnote that says theoretically the company could distribute all their retained earnings as a dividend except the cost of treasury shares. So keep that in mind as well. Now, the most important thing about treasury stock, the most heavily tested part of treasury stock, is how to account for treasury stock. And as you may know, there are two acceptable methods of accounting for treasury stock. There is the cost method and there is the par value method. So that's what you're up against. There are two acceptable methods of accounting for treasury stock. There's the cost method and there is the par value method. Now, we're going to start with the cost method, and let me just say that I think the best way to study this, if you know the journal entries for each approach, you should be able to break down any problem the exam comes up with. So let's start with the cost method. Here's a problem. If you look in your viewer's guide, let's say originally a corporation issued 1,000 shares of $10 par stock at $15 a share. That's what originally happened. Originally, corporation issued 1,000 shares of $10 par stock at $15 a share. So we know what entry the corporation originally made. The corporation would have debited cash for what they collected, 1,000 shares at 15,000. They would credit common stock for legal capital. They would credit common stock for 1,000 shares at par 10 or 10,000, and they would credit APIC for the rest, 5,000. That's what originally happened. Now we're going to assume that some time goes by and the company has bought back 200 shares of their own stock and paid $18 a share. So they've bought back 200 shares of their own stock, paid $18 a share, and notice they've decided to account for that treasury stock under the cost method. Let's go through the entries under the cost method. First of all, remember, under the cost method, we always debit the treasury stock account for the cost of the treasury shares. That's why they call it the cost method. So we're going to start by debiting treasury stock for 200 shares at 18, $3,600, and credit cash, $3,600, because under the cost method, we always debit the treasury stock account for the cost of the treasury shares. All right, now let's assume some time goes by, and now the company sells 100 shares out of the treasury for $20 a share. What are you going to do? Well, if they sell 100 shares out of the treasury for $20 a share, you know they're going to debit cash for what they collected, 100 shares at $20 or $2,000. What do they credit to treasury stock? Well, they're going to credit treasury stock for its cost, for its carrying value, and that would be 100 shares at 18, $1,800, and you'll notice what we have here, a gain on sale of treasury stock. Notice we need a $200 credit to balance the entry out. What we have here is a gain on sale of treasury stock. Now, you know what I'm going to ask you. Should I credit gain on sale of treasury stock, 200? Never. Listen carefully. Treasury stock transactions never affect income statement accounts. Remember that. Treasury stock transactions only affect balance sheet accounts, and I'll give you another absolute. Anytime there's a gain indicated in any type of treasury stock situation, anytime there's a gain indicated in any type of treasury stock situation, what do you always credit? APIC. Now you notice I'm going to be a little bit picky here. I'm going to credit additional paid-in capital from treasury stock. I'm going to credit APIC from treasury stock. But again, anytime there's a gain indicated in any type of treasury stock situation, you would always credit additional paid-in capital, or in this case, APIC from treasury stock. And I don't want you to misunderstand. That account, APIC from treasury stock, that account's not published. In a published balance sheet, you only publish one APIC account. But in your subsidiary accounts, you keep track of APIC by source. But that's not why I'm using that account name. I'm using that account name, APIC from treasury stock, because you'll see that in the exam sometimes. Sometimes the exam draws that distinction. But in your balance sheet, it's just all going to show up as APIC. All right, now let's assume some more time goes by. And now they sell the other 100 shares out of the treasury for $12 a share. What are we going to do? Well, if they sell the other 100 shares out of the treasury for $12 a share, we know they're going to debit cash for what they collect. 100 shares at 12 or 1,200. We know they're going to credit treasury stock for its cost, its carrying value. That's 100 shares at 18, 1,800. And notice now we have a loss from the sale of treasury stock. Notice now I need a debit of $600 to balance the entry out. Should I debit loss on sale of treasury stock, 600? No, we've already talked about that. Treasury stock transactions never affect income statement accounts. Here's what I really want to ask you. Should I debit APIC, 600? You can't. You can't. Why? Because there's a rule. There's a rule you have to know here. And it is just a rule. You know what the rule is? When you sell treasury shares at a loss, if there's a loss on treasury stock, you can only debit APIC to the extent there have been gains on prior treasury stock transactions. I'll say that again. When there's a loss on sale of treasury stock, you can only debit APIC. You can only debit APIC to the extent there have been gains on prior treasury stock transactions. In other words, you can only debit APIC from treasury stock. So I'm going to debit APIC from treasury stock for 200. The other 400 would be a debit to retained earnings. Notice, only balance sheet accounts. Only balance sheet accounts, never income statement accounts. All right, so if you're with me down to there, that's what you want to study. Under the cost method, you want to know how to buy the shares, sell them at a gain, sell them at a loss. Let's now do the par value method. Let's start the same way. Let's say originally the company issued 1,000 shares of $10 par stock at $15 a share. So we know the original entry they made. If they issued 1,000 shares of $10 par stock at 15, we know they would have debited cash for what they collected. 1,000 shares at 15 or 15,000. We know they would credit common stock for 1,000 shares at par 10 or 10,000, and we know they'd credit APIC for 5,000. That's the original entry they would have made. And we're going to assume again that some time goes by, and now they've bought back 200 shares of their own stock and paid $18 a share. So you'll notice this is exactly the same problem we did a moment ago, but now we're going to assume they've decided to account for the treasury stock under the par value method. Here we go. Under the par value method, we always debit the treasury stock account for the par value of the treasury shares. So I'm going to debit treasury stock for 200 shares at par 10, 2,000. I'm still going to credit cash for what I paid. 200 shares at 18, 3,600. But that's why they call it the par value method, because under the par value method, we always debit the treasury stock account for the par value of the treasury shares. So debit treasury stock for 200 shares times par 10 or 2,000, credit cash for what you paid, 200 shares times 18 or 3,600. Now, I want you to know that the CPA exam always calls this the par value method, always. And that does help because we know in the par value method, we always debit the treasury stock account for the par value of the treasury shares. Makes perfect sense. But I want you to know when I was a student, I never thought of this as the par value method. I always thought of this as the retirement method. And if you look at old textbooks used to call this the retirement method. The CPA exam never does. CPA exam calls it the par value method. But I'll tell you why I liked it. The reason why some textbooks call this the retirement method is that the key to this method is to remember, in the opening entry, we have to constructively retire the shares. In the opening entry, we have to constructively retire the shares. What does that mean? It means we have to debit APIC as if we've retired the shares. We have to debit APIC for the original APIC on every share. Now, what is the original APIC on every share? $5, right? Because originally, didn't they issue 1,000 shares of $10 par stock at 15? So don't we know there's $5 of original APIC on every share times 200 shares. We're going to debit that original APIC for 1,000, and we're going to debit retained earnings for 600. Only balance sheet accounts, of course. But that's why old textbooks used to call this the retirement method, because that's the key to the method. To remember, in the opening entry, you have to constructively retire the shares. You've got to debit APIC as if you've retired the shares. You've got to debit APIC for the original APIC on every share, and isn't that $5? Because originally, they issued 1,000 shares of $10 par stock at 15. So I know there's $5 of original APIC on every share times 200 shares. We're going to debit that original APIC for 1,000 and debit retained earnings for the rest. 600, as I say, only balance sheet accounts. Now, I want you to see, once you get that entry down, that entry's a little tricky, but once you get that entry down, it's not bad. For example, let's say some time goes by and they sell the 200 shares out of the Treasury for $14 a share. What are you going to do? Well, if they sell the 200 shares out of the Treasury for $14 a share, you know they're going to debit cash for 200 shares at 14 or 2,800. That's what they collected. They're going to credit Treasury stock for par. Remember, what's in that Treasury stock account is par value, not cost. So we're going to credit Treasury stock for 200 shares times par 10, 2,000. And we know anytime there's a gain indicated in any type of Treasury stock situation, we credit APIC or APIC from Treasury stock, in this case, 800. And if you look at that entry, isn't it like a normal issuance of stock? Look at that entry. It's just like a normal issuance of stock. We debit cash, what we collected, credit Treasury stock for par, and the rest is APIC. I don't think that entry bothers people. But the first entry, you've got to get used to it. That in that opening entry, we constructively retire the shares. I'd like you to try some questions. I'd like you to do 11, 12, and 13, and then come back. Welcome back. Let's do this group of questions together. In number 11, they give us a lot of information and they just say, what is total stockholders' equity at December 31? So in the area of stockholders' equity, you may get a question like this, where they just ask for total stockholders' equity. So basically, what you have to do in a question like this is organize it. You know you're going to pick up the common stock of $600,000. You know you're going to pick up the additional paid-in capital of $800,000. Now the retained earnings, they told you that there was retained earnings appropriated of $150,000 and retained earnings unappropriated of $200,000. It really makes no difference. Total retained earnings here would be $350,000. When you appropriate retained earnings like that, $150,000, you're just telling shareholders, look, this part of retained earnings won't be available for dividends. You know, they're setting it aside for some project, maybe like plant expansion, something like that. But it's really just informational to tell shareholders that, hey, this part of retained earnings is appropriated. It won't be available for dividends. But it doesn't alter the fact that your total retained earnings would be $150 plus $200,000, $350,000. And then they also had an unrealized loss on available for sale securities of $20,000. Now, we have to assume this must be their first year of operation. This must be the only one they have. So if that's true, accumulated OCI down in stockholders' equity would be a $20,000 deficit. And then Treasury stock, we know that that $50,000, the cost of the shares in the Treasury, would be reported on the balance sheet as a contra equity item. It's a debit in stockholders' equity. It's a reduction of stockholders' equity, so back that out. Add it all up. Total stockholders' equity is answer A, $1,680,000. Now, in number 12, we're talking about SEDA Corporation. SEDA Corporation goes out and buys 6,000 shares of their own stock at $36 a share. SEDA does use the cost method. So we know in the cost method, we always debit the Treasury stock account for the cost of the Treasury shares. So SEDA is going to debit Treasury stock for 6,000 shares at 36, or $216,000. Credit cash, $216,000. That's the first entry that would be made. And then some time goes by, and now SETA sells off 3,000 shares out of the Treasury. She sells 3,000 shares out of the Treasury for $50 a share. So what will you do? Well, if SETA sells 3,000 shares out of the Treasury for $50 a share, you know that SETA is going to debit cash for what's collected. 3,000 shares at 50, 150,000. SETA is going to credit Treasury stock for its cost, its carrying value. That would be 3,000 shares at 36 or 108,000. And we know anytime there's a gain indicated in any type of Treasury stock situation, we're going to credit APIC or APIC from Treasury stock, in this case 42,000. So when they ask us at the bottom, what accounts and amounts would SETA credit to record the issuance of the 3,000 shares? We know the answer is C. SETA would credit Treasury stock 108,000. SETA would credit APIC 42,000. SETA wouldn't touch retained earnings. SETA wouldn't touch common stock. So the answer is C. And then ASP Company. On January 5th, ASP goes out and buys, well, let's start January 5th. January 5th, ASP issues 20,000 shares of their own stock at $15 a share. So we know the original entry that was made, right? ASP issues 20,000 shares at 15 originally, so ASP would have debited cash for what was collected, 20,000 shares at 15 or 300,000, credit common stock for legal capital, 20,000 shares at par 10, 200,000, and credit APIC for the rest, 100,000. That's the original entry that was made. And now some time goes by. Then on July 14th, ASP buys back 5,000 shares of their own stock at $17 a share. Now ASP uses the par value method to account for Treasury stock. So let's go through it. We know in the par value method, we always debit the Treasury stock account for the par value of the Treasury shares. So on July 14th, this company is going to debit Treasury stock for 5,000 shares at par 10 or 50,000. In the par value method, we always debit the Treasury stock account for the par value of the Treasury shares. We know the company is going to credit cash for what was paid, 5,000 shares at 17 or 85,000. And remember, another way to think of this method is to think of it as the retirement method, because in the opening entry, you have to constructively retire the shares. You have to debit APIC as if you're retiring the shares. You've got to debit APIC for the original APIC on every share. And wouldn't that be, again, $5? Because originally, back on January 5th, they issued 20,000 shares of $10 par stock at 15. So we know there's $5 of original APIC on every share times 5,000 shares. We're going to debit that original APIC, 25,000, and debit retained earnings for the rest, 10,000. Only balance sheet accounts. Then on December 27th, the company now sells the 5,000 shares out of the Treasury for $20 a share. So what are you going to do? Well, you're going to debit cash for what you collect, 5,000 shares at 20 or 100,000. You're going to credit Treasury stock for par. That's what's in that account, 5,000 shares at par 10 or 50,000. And anytime there's a gain indicated in any type of Treasury stock situation, you're going to credit APIC or APIC from Treasury stock, in this case 50,000. Those are the entries that would be made here. So when they ask at the bottom, in the December 31 balance sheet, what amount would the company report for additional paid-in capital? Well, think about it. Back on January 5th, APIC was 100,000. Then on July 14th, APIC went down 25,000. But then on December 27th, APIC went up 50,000. So it was 100,000, down 25, then up 50. Now the balance in APIC is answer B, 125,000. Now that concludes our discussion on stockholders' equity. And now I'd like to move on to another topic. What we're going to get into next is how to account for partnerships. Now, in the area of partnership accounting, there are several things the exam can get into. First, they could ask you, how do you allocate profits and losses between partners? That's a question that could come up in the exam. How do you allocate profits and losses between partners? Well, the answer really is that you would allocate profits and losses to partners however they agree to allocate the profits and losses in the partnership agreement. That's really the answer. You're going to allocate profits and losses to partners however they agree to allocate profits and losses in their partnership agreement. What if the exam is silent? Well, if the exam is silent, you would have no choice but to assume that profits and losses are allocated equally to all the partners, right? If the exam is silent, you'd have no choice but to assume profits and losses are allocated equally to the partners. I want you to understand my thinking here. Do you think the exam is going to be silent? No, because that lets everybody off the hook. If they're silent, we assume it's equal. They're not going to be silent. Then it's too easy. If they're silent, it's equal. That's much too easy. You trust me on this. If the exam is going to give you a problem on how you allocate profits and losses to partners, you trust me. The method of allocation will be in that problem. You have to read it carefully because, as I say, if they're silent, it's just equal. That's too easy. So if they ask you a problem on how to allocate profits and losses between partners, the method of allocation will be in the problem. You just have to read it carefully. Some of the ones they like, they may give you in a problem a profit and loss sharing ratio. In other words, 60% to you, 40% to me. So they may give you a profit and loss sharing ratio. Another one they like, they could have partners allocate profits and losses based on their average capital balances. And their favorite example, they may have the partners take, like a monthly salary, some sort of bonus, and then any remaining profits and losses would be allocated in some profit and loss sharing ratio. I'd like you to try one of these. I'd like you to try number 14 and then come back. Welcome back. Let's look at this question. Number 14. They're asking at the bottom what amount of these earnings would be credited to each partner's capital account. So we'll set up a column for red, a column for white, and you'll notice that they each take a salary. Red takes a $55,000 salary, white takes a $45,000 salary, to live. They have to live. And the problem is that the partnership profit for the year was $80,000. So when you back out the salaries they took, $45,000 plus $55,000, $100,000, that throws the partnership into a $20,000 loss position. And red would get 60% of that loss, or $12,000. White would get 40% of that loss, or $8,000, and that'll give you the final distribution. The final distribution to red would be the $55,000 that red took as a salary minus their share of the loss, $12,000. The distribution to red will be $43,000. White got the $45,000 salary minus their loss distribution of $8,000. What will be credited to white's account would be $37,000, and the answer is B. So it's not too bad. As I say, anytime the exam is going to ask you how to allocate profits and losses to partners, the method of allocation has to really be laid out in the problem one way or another, because if they're silent, it's equal, and I just don't think they would do that. The problem with partnership accounting is, I think you know, that there are other things they can get into. For example, they could ask you questions about the formation of a partnership formation. They could ask you questions about how you admit a new partner to a partnership. They could ask you questions on how you handle the retirement or the withdrawal of an old partner from a partnership. And, of course, everybody's favorite, they could ask you how to liquidate a partnership. Let's start with formation. And I want to go right to a problem. Let's go right to number 15. 15 says, Abel and Carr formed. I would circle the word formed. This is a question on formation. Abel and Carr formed a partnership and agreed to divide initial capital equally. I want you to underline, divide initial capital equally. That's important. Even though A contributes $100,000 and C contributes $84,000 in identifiable assets. Under the bonus approach, I want you to circle bonus approach. Under the bonus approach, to adjust the capital accounts, what is Carr's unidentifiable asset? And I'd like you to write underneath unidentifiable asset the word goodwill. I don't know if you recall this from school, but Remember, goodwill, technically, is an unidentifiable intangible. The point is, it's not an identifiable asset that you can buy and sell. I can't sell you goodwill I paid for. You can't sell me goodwill you paid for. Goodwill is what they call, technically, an unidentifiable intangible. I could sell you my copyright. I could sell you my patent. Those are identifiable intangibles, but goodwill is an unidentifiable intangible. So when they ask for CAR's unidentifiable asset, they mean what would be the goodwill. Let me show you the entry. They said they used the bonus approach. Here's the entry that the partnership would make under the bonus approach. They said that A contributes $100,000 in assets, C contributes $84,000 in assets. So the partnership will debit assets, $184,000. So the partnership will bring the assets on the books, debit assets, $184,000, and because they said they agreed to divide initial capital equally, not only will we credit A capital, $92,000, we'll credit C capital, $92,000. The way to look at this, in the bonus approach, really A is giving C an $8,000 bonus. Because they said they agreed to divide initial capital equally, not only would I credit A capital, $92,000, I would also credit C capital, $92,000. And as I say, the way we really look at this, A is really giving C an $8,000 bonus. All right, that's the entry that you would make in the bonus method. What's the answer? What is CAR's unidentifiable asset? What's the goodwill? It's answer D. There is no goodwill. There's no goodwill in the bonus approach. There's only goodwill in the goodwill approach. So I hope you see why the answer is D. There is no goodwill in the bonus method. There's only goodwill in the goodwill method. Let me show you the goodwill method. Same problem. If I did this problem under the goodwill method, again they said A contributes $100,000 in assets, C contributes $84,000 in assets. So the partnership will debit assets, $184,000. But because they said they would divide initial capital equally, not only would I credit A capital, $100,000, I'd also credit C capital, $100,000. And I would recognize that C must be bringing in $16,000 of goodwill, and I would debit goodwill, $16,000, and now the answer is B. If I were you, for my studying, I would write next to answer B, goodwill method. If this had been the goodwill method, the answer would be B. But because it's the bonus method, it's answer D, because there's no goodwill in the bonus method. There's only goodwill in the goodwill method. So I hope you're with me on that. That's really everything the exam could ask on the formation of a partnership. Just make sure you study those two entries. Make sure you know the bonus method, and make sure you know the goodwill method. All right, now let's get into how you admit a new partner to a partnership. How do we handle the admission of a new partner to a partnership? Let's go to question number 16. 16 says, Blau and Ruby are partners who share profits and losses in the ratio of 60-40 respectively. On May 1 of the current year, their respective capital accounts were as follows. So notice as we start, Blau capital is $60,000, Ruby capital is $50,000. I want you to bracket those two numbers together, and I want you to show they add up to $110,000. Because as we start, Blau capital is $60,000, Ruby capital is $50,000. So you bracket those two numbers together and just show, for your own information, that as we start, total contributed capital is $110,000. Then they say, on that date, Lind was admitted as a partner with a 1/3 interest in capital and profits for an investment. I'd like you to underline the word investment. We'll talk about it in a bit. For an investment of $40,000. All right, now listen carefully. This is really subtle. I mean, this is really subtle. Then they say the new partnership began with total capital of $150,000. Now just think for a minute. What was total capital before Lind came in? 60 plus 50, $110,000. How much is Lind bringing in? 40. Doesn't that add up to $150,000, right? And because they said the new partnership began with total capital of just that $150,000, that tells me they're not going to record any goodwill. This is going to be the bonus method. I'll grant you that's very subtle. Again, total capital invested before I started, $110,000. Lind brings in 40. And because they said the new partnership began with total capital of $150,000, that tells me they're not going to record any goodwill. This is the bonus method. Now let me show you the bonus method. Here's the entry that the partnership would make under the bonus method of admitting Lind. Lind brings in $40,000 into the partnership. So the partnership is going to debit cash $40,000. Now, didn't they say that Lind is going to get a 1/3 interest in capital and profits? Well, total capital now is $150,000. So I'm going to credit Lind capital for 1/3 of $150,000, or $50,000. They said Lind was going to get a 1/3 interest in capital and profits. So since total capital is now $150,000, I'm going to credit Lind capital for 1/3 of 150, or $50,000. See, the way we look at this in the bonus method, the old partners are giving Lind a $10,000 bonus because all Lind contributed was $40,000, and yet Lind's going to get a capital account of 1/3 of 150, $50,000. So the way you look at this in the bonus method is that the old partners are giving Lind a $10,000 bonus, and we're going to take that bonus out of the old partners' accounts in their profit and loss sharing ratios. So I'm going to debit I'm going to debit Blau capital for 60% of the bonus, or $6,000. I'm going to debit Ruby capital for 40% of the bonus, or $4,000. That's the entry that you'd make in the bonus method. So when they ask me at the bottom, immediately after Lind's admission, what is Blau capital? Well, Blau capital before I started was $60,000. Now look at your entry. Hasn't Blau capital gone down 60% of the bonus, or $6,000? Now Blau capital is $54,000. Answer B. Blau capital before I started, $60,000. When you bring Lind in, Blau capital went down $6,000 to $54,000. All right, now I think you know the answer there is B, but I can't leave it there because there's also the goodwill method. That's the bonus method. Now let's do the same problem, but I'm going to change a couple of things here. Now let's assume that Lind invests $40,000 for a 20% interest in capital and profits. I'm just going to change it a little bit. Same basic problem, but now let's assume that Lind invests $40,000 for a 20% interest in capital and profits, but now it's the goodwill method. Now listen carefully. Anytime you see goodwill method, think formula. You really get used to it. Oh, it's goodwill method? I have to set up a formula. Here's the formula. Don't we know that 20% of X, the implied value of the whole business, the implied value of the whole partnership, must be worth $40,000. 20% of X, X meaning the implied value of the whole partnership, must be worth $40,000. Now we know that whatever we do to one side of an equation, we do to the other side of the equation. We're going to divide both sides by 20%. What I end up with is that the implied value of the whole business, the implied value of the whole partnership, would be that $40,000 divided by 20%. If you take $40,000 divided by 20%, the implied value of the whole partnership, the implied value of the whole business, is $200,000. I hope you see how we got the implied value of the whole business, $200,000. All right, now what's been invested? What's been invested? What was invested before Lind came in? 60 plus 50, $110,000. How much did Lind bring in? $40,000. What's been invested is $150,000. So the implied goodwill in the partnership is $50,000. Again, if I know the implied value of the whole business is $200,000, but all that's been invested is 60 plus 50 plus 40, 150, the implied goodwill here is $40,000. Now I record that goodwill. The implied goodwill is $50,000. Again, if the implied value of the whole business is $200,000 and all that's been invested is 60 plus 50 plus 40, 150, the implied goodwill here is $50,000. Now I'm going to record that goodwill. I'm going to debit goodwill, $50,000. I'm going to credit Blau capital for 60% of the goodwill, or $30,000. I'm going to credit Ruby capital for 40% of the goodwill, or $20,000. Remember, the old partners built up the goodwill. Lind had nothing to do with that goodwill. The old partners built up the goodwill in the business. So 60% goes to Blau, or $30,000, 40% goes to Ruby, or $20,000. And now you just bring Lind in. Debit cash, $40,000, and credit Lind capital, $40,000. That's the goodwill method. Now I have a question for you. Now don't hate me for this, but I have to ask you this. In this problem, did Lind's $40,000 come into the partnership, or did it go to the individual partners outside the partnership? You understand what I'm asking here? Did Lind's $40,000 come into the partnership, or did Lind's $40,000 go to the individual partners outside the partnership? No, it came into the partnership. How do I know that? Because they said it was invested. That's why I had to underline that word. That told me, when I see that word invested, it tells me the $40,000 came into the partnership. I'm going to change it now. What if they said this? What if they said that Lind pays the individual partners outside the partnership $40,000 for a 20% interest in capital and profits. You see the difference? What if Lind paid the individual partners outside the partnership $40,000 for a 20% interest in capital and profits? Now the money's going to the individual partners outside the partnership. Well, let me show you the bonus method. The bonus method's really not bad. In the bonus method, you would simply debit Blau Capital for 20% of their capital balance, 20% of $60,000 or $12,000. I would debit Ruby Capital for 20% of their capital, 20% of $50,000 or $10,000, and credit Lind Capital $22,000. Just bring Lind in. So the bonus method's not bad there. That's if the $40,000 goes to the individual partners outside the partnership. I'll just debit Blau Capital for 20% of their capital or $12,000. I'll debit Ruby Capital for 20% of their capital or $10,000, and credit Lind Capital $22,000. Now you know I can't leave it there. What if it's the goodwill method? Well, when you see goodwill method, formula. Let's set up the formula. Don't we know that 20% of X, 20% of X, the implied value of the whole partnership, must be worth $40,000. So I divide both sides by 20%. What I end up with is that the implied value of the whole business, the implied value of the whole partnership must be that $40,000 divided by 20%, or $200,000. Now I know the implied value of the whole business is that $40,000 divided by 20%, or $200,000. Now be careful. What's been invested? What's been invested? 150 or 110? 110, because the $40,000 went to the individual partners outside the partnership. See the difference? What's been invested is still the original 110 in the partnership, because Lind's $40,000 went to the individual partners outside the partnership. So now the implied goodwill is $90,000. You see the difference? Because all that's been invested in the partnership is still the original 60 plus 50, 110. Lind's $40,000 went to the individual partners outside the partnership. So now the implied goodwill would be 200 minus 110, or 90,000. We're going to record that goodwill. We're going to debit goodwill, 90,000. I'm going to credit Blau Capital for 60%, or 54,000. I'm going to credit Ruby Capital for 40%, or 36,000. Remember, the old partners built up the goodwill. Lind had nothing to do with that goodwill. The old partners built up the goodwill in the business. So I credit Blau Capital for 60% of the goodwill, or 54,000. Credit Ruby Capital for 40% of the goodwill, or 36,000. All right, now stay with me. After I record the goodwill, what's the balance in Blau Capital? Well, Blau Capital, when I started, was 60,000. Hasn't Blau Capital gone up 54,000 to 114,000? Now I debit Blau Capital for 20% of 114,000, or 22,800. What's the balance in Ruby Capital? Well, before I started, Ruby Capital was 50,000. Ruby Capital's gone up 36,000 because of the goodwill. Now Ruby Capital is 86,000. I'm going to debit Ruby Capital for 20% of 86,000, or 17,200, and I'll credit Lind Capital 40,000. That's if the 40,000 goes to the individual partners outside the partnership, and it's the goodwill method. See, that's the problem with partnerships. There's so many variations. And I know when you first start to study this, you have to sort of get it straight in your mind, but I'll tell you what you'll end up with on this. What you sort of end up with, you're in the exam, you'll go, okay, wait a minute, is the money coming into the partnership or outside the partnership? Oh, inside. Is it bonus method, goodwill method? Goodwill method, formula. That's sort of where you are on it. I'll do that again. That's sort of your mindset when you see partnership questions. You'll go, wait a minute, is the money coming into the partnership or outside the partnership? Oh, outside. Is it bonus method or goodwill method? Oh, it's bonus. So I don't worry, I don't have to do a formula. I just bring the partner in. Oh, it's goodwill method, formula. Work with it a little bit. You get used to it. I'd like you to try one. We're going to go to a set, which is 17 and 18. All I'd like you to do is number 17. We're going to do 18 together. So, shut the class down. Just do number 17. Come back, we'll do it together, and then we'll do 18 together. Welcome back. Let's look at numbers 17 and 18. In 17, they say, on June 30th of the current year, the condensed balance sheet of the partnership of Eddie, Fox, and Grimm, together with their respective profit and loss sharing percentages, are as follows. And in 17, they say, Ham is admitted as a new partner with a 25% interest in the capital of a new partnership. So notice, in this case, the money's going to come into a new partnership. So in this case, The money's not going to the individual partners outside the partnership. No, Ham's money is going to come into a new partnership. Ham is going to make a cash payment of $140,000 into a new partnership. So the money is coming into the partnership. Total goodwill. I'd circle that goodwill. It is the goodwill method. Total goodwill implicit in the transaction is to be recorded immediately after the admission of Ham. What is Eddie's capital account? Well, I think you know. Anytime you see goodwill method, you think formula. Let's cut right to the chase. Don't we know that the implied value of the whole business must be that $140,000 divided by 25%? If you take $140,000 divided by 25%, let's agree that the implied value of the whole partnership, the whole business, must be $560,000. Now, once we know that, we can figure out the goodwill. If the implied value of the whole business is $560,000, 140 divided by 25%, what's been invested? Well, what was invested before Ham came in was Eddie's 160, Fox's 96, Grimm's 64. What was invested before Ham came in was $320,000. Ham brings in 140. So what's been invested is $460,000. So if the implied value of the whole business is $560,000, what's been invested is $460,000. That tells us the implied goodwill is $100,000. Now we record that goodwill. We're going to debit goodwill $100,000. We're going to credit Eddie Capital for 50% of the goodwill, or $50,000. Credit Fox Capital for 30% of the goodwill, or $30,000. Credit Grimm Capital for 20% of the goodwill, or $20,000. Remember, the old partners built up the goodwill. Ham had nothing to do with that goodwill. And now, after you've recorded the goodwill, you just bring Ham in, debit cash $140,000, credit Ham Capital $140,000. So when they ask us at the bottom, immediately after admission of Ham, what is Eddie's capital account? Well, Eddie's capital account before I started was $160,000. Eddie Capital has gone up $50,000 because of Eddie's share of goodwill. Now Eddie Capital is $210,000, which is answer B. I hope you got that. Now, there's also number 18. 18 says, assume instead that Ham is not admitted as a new partner, but Eddie decides to retire from the partnership. So now we're getting into how you handle the withdrawal or the retirement of an old partner from a partnership. And by mutual agreement is to be paid $180,000 out of partnership funds for his interest. Total goodwill, I'd circle that word, it is the goodwill method. Total goodwill implicit in the agreement is to be recorded after Eddie's retirement. What are the capital balances for the other partners? Well, I want to show you the bonus method first. We'll get to the goodwill method in a moment. Let me show you the bonus method. If Eddie retires under the bonus method, well, you know you're going to debit Eddie Capital for the balance. Eddie Capital right now has a balance of $160,000. Eddie's gone. So we're going to debit Eddie Capital $160,000, right? Eddie's gone. We're going to credit cash $180,000 because by mutual agreement, they agreed to give Eddie $180,000 cash out of partnership funds. So you'd credit cash $180,000. The way you look at it in the bonus method, the old partners, Fox and Grimm, are giving Eddie a $20,000 bonus. Now this is what's a little tricky. You're going to take that $20,000 bonus out of the surviving partners' accounts in their surviving ratios. Again, you're going to take that $20,000 bonus out of the surviving partners' accounts in their surviving ratios. What do I mean by their surviving ratios? Well, Fox gets 30% of profits and losses. Grimm gets 20%. 30 plus 20 is 50. So Fox would get 30 over 50, 3/5 of the bonus, or $12,000. Grimm would get 20 over 50, 2/5 of the bonus, or $8,000. So debit Fox Capital for 30 over 50, 3/5 of the bonus, or $12,000. Debit Grimm Capital for 20 over 50, 2/5 of the bonus, or $8,000. That would be the entry. Now notice something. They said, after Eddie's retirement, what are the capital balances for the other partners? Look at answer A. Look at our entry. Hasn't Fox gone from $96,000 down 12 to $84,000? Hasn't Grimm gone from $64,000 down 8 to $56,000? I think if I were you, just for my own studying, I would write next to answer A, bonus method. If this had been the bonus method, which they could ask you, the answer would be A. Now, we're not doing the bonus method in this problem. They want the goodwill method. Anytime you see goodwill method, what do you think? Formula. We're going to have to set up a formula. Here's how you set up the formula. Don't we know that the balance in Eddie Capital when I start is $160,000? How much cash did they agree to give Eddie? $180,000. When you do the goodwill method, you have to assume that that extra $20,000 cash that they're giving Eddie must be Eddie's share of goodwill. Again, in the goodwill method, you have to assume that that extra $20,000 cash they're giving Eddie must be Eddie's share of goodwill. And because Eddie gets 50% of profits and losses, now we can set up our formula. 50% of X. 50% of X, the total goodwill in the partnership, must be worth $20,000. I'm going to divide both sides by 50%. What I end up with is that the total goodwill in the partnership must be worth that $20,000 divided by 50%, or $40,000. Now I'm going to record that goodwill. I'm going to debit goodwill, $40,000. I'm going to credit Eddie Capital for 50% of it, or $20,000. Credit Fox Capital for 30% of the goodwill, or $12,000. I'm going to credit Grimm Capital for 20% of the goodwill, or $8,000. The old partners built up the goodwill, so we give the goodwill to the partners' capital accounts. Now, after I make that entry to record the goodwill, what's the balance in Eddie Capital now? $180,000. And now I just let Eddie retire. Debit Eddie Capital $180,000, credit cash $180,000. Now we just let Eddie retire. And when they say at the bottom, after Eddie's retirement, what are the capital balances for the other partners? Look at answer C. Hasn't Fox gone from 96 up 12 to 108? Hasn't Grimm gone from 64 up 8 to 72,000? The answer now is C. So there's the bonus method of handling the retirement of a partner or the withdrawal of a partner, and there's also the goodwill method. Now, the last thing we're going to look at in partnerships is how to liquidate a partnership. You have to know how to do this. Number 19 says, on January 1 of the current year, the partners of Cobb, Davis, and Eddy, who share profits and losses in the ratio of 50, 30, 20, respectively, decide to liquidate the partnership. Now, what they give us is the partnership balance sheet. The partnership balance sheet is showing cash of $50,000, other assets with a book value of $250, liabilities of $60,000. The balance in C capital is $80,000, D capital is $90,000, E capital is $70,000. Then they say on January 15th of the current year, the first cash sale of other assets with a carrying amount of $150,000 realized only $120,000. Safe installment payments to the partners were made on the same date. How much cash should be distributed to each partner? All right, now to really understand this, we're going to set up a little spreadsheet here. And I'm just going to pull this information right out of this balance sheet. We know as we start, the balance sheet is showing cash of $50,000, other assets with a book value of $250,000, liabilities of $60,000, and the balance in C capital is $80,000, D capital $90,000, E capital $70,000, and we also know the profit and loss sharing ratios. C gets 50% of profits and losses, D gets 30%, and E gets 20%. So we set up our little spreadsheet, and now let's work it through step by step. They said on January 15th of the current year, the first cash sale of other assets with a carrying amount of $150,000 realized just $120,000. So let's put that in. Don't we know that the cash would go up by $120,000 up to $170,000? Other assets would drop by their book value $150,000. And of course, the point is, there was a $30,000 loss on sale. Again, cash would go up by $120,000 up to $170,000. Other assets would drop by a book value of $150,000. And of course, there was a $30,000 loss on sale. So we have to allocate that loss. C would get 50% of that loss, or $15,000. D would get 30% of that loss, or $9,000. E would get 20% of that loss, or $6,000. All right, so we now have, after that cash sale of assets, we now have $170,000 of cash. What do I have to do first with that cash? I'll bet you know, pay off the liabilities. You can't distribute any cash to partners yet. You've got to pay off the liabilities. So I'm going to take $60,000 of that cash, pay off the liabilities. So that's going to drop the cash from $170,000 down 60 to $110,000, and liabilities would drop to 0. Pay off the liabilities. So after I pay off the liabilities, I still have $110,000 cash to distribute. You know where a lot of students make a mistake? Listen very carefully. A lot of students in the exam get it down to this point and go, oh, I see it. There's $110,000 cash to distribute. C would get 50%, or $55,000. D would get 30% or 33,000. E would get 20% or 22,000. And they go, hello, C. A lot of students do that. Hey, there's 110,000 cash remaining. Why can't I give 50% to C, 30% to D, 20% to E? I'm looking at you, answer C. Wrong. Why doesn't that work? Very tempting. Why doesn't that work? Because we're not allocating profits and losses. You can't use the profit and loss sharing ratios because we're not allocating profits and losses. We're allocating capital, and you always allocate capital based on what's left in the capital accounts. Hope that makes sense to you. We're not allocating profits and losses, so we can't use the profit and loss sharing ratios. We're allocating capital, and you always allocate capital based on what's left in the capital accounts. Now, do we know what's left in the capital accounts? Not yet. There's still another little problem here. Look at the other assets. When we started, other assets had a book value of $250,000. We sold other assets that had a book value of $150,000. Doesn't the partnership still have other assets with a book value of $100,000 still on the books? What's the worst that could happen? This is the thinking. What's the worst that could happen? It's conservatism. Well, the worst that could happen is there a total loss. What if we get zero for all the remaining assets? What if that $100,000 of remaining assets sells for zero? It's a total loss. They call this maximum possible loss, MPL, maximum possible loss. If the $100,000 of other assets are now a total loss, C would get 50% of that loss, or $50,000. D would get 30% of that loss, or $30,000. E would get 20% of that loss, or $20,000. So what's left in the partner's capital accounts after maximum possible loss would be $15,000 left in C capital, $51,000 left in D capital, $44,000 left in E capital, and the answer is A. That's how we would allocate the remaining capital. We're not allocating profits and losses. We're allocating capital. And you always allocate capital based on what's left in the partner's capital accounts after maximum possible loss. So be careful. Now, there's a couple of things you might see that are not in this particular problem, but they could put them in. What if one of the partners went into deficit? Now, that wasn't in this problem, but I just want to make sure you're on top of it. For example, what if in this problem C went into deficit? Well, if C went into deficit, you cannot allocate any capital till you allocate that deficit to the surviving partners in their surviving ratios. Let me say that again. If one of the partners goes into deficit, like C, you can't allocate any cash till you allocate that deficit to the surviving partners in their surviving ratios. And I think you know what I mean by surviving ratios. D gets 30% of profits and losses. E gets 20% of profits and losses. 30 plus 20 is 50. So D would get 30 over 50, 3/5 of C's deficit. E would get 20 over 50, 2/5 of C's deficit. Then you could allocate the cash. So be careful. Any partner goes into deficit, you can't allocate any cash till you allocate the deficit to the surviving partners in their surviving ratios. So be careful. Another point. What if I were doing a partnership liquidation and I looked on the balance sheet and I saw loans receivable from partners or loans payable to partners? That'll mess people up. Let me just quickly illustrate. What if I looked on this balance sheet and I saw a $5,000 loan payable to D? You know what I would do? Before I started, I would debit that payable 5, wipe it out, credit D capital 5,000. In other words, I'd make D capital 95,000 before I start. What if I looked on the balance sheet and I saw a $2,000 loan payable to E? What would I do? Well, before I start, I would debit that payable 2,000, wipe it out, and credit E capital 2,000. I'd make E capital 72,000 before I started. What if I looked on the balance sheet and I saw a $5,000 loan receivable from C? What if there's a $5,000 loan receivable from C? Well, before I start, I would credit that receivable 5,000, wipe it out, debit C capital 5,000. In other words, I would make C capital 75,000 before I begin. Then I would just proceed as I just did, proceed as normal. So if there's any loans receivable from partners or loans payable to partners, you wipe those out first, combine those loans with the partner's capital accounts before you start, just in case that was thrown into the balance sheet. Well, that concludes our discussion of partnership accounting, and what we're going to get into next is foreign operations. In the area of foreign operations, there's a couple of things the exam likes to get into. First, they might ask you how to convert a foreign subsidiary's financial statements back to US dollars. That's one of the topics they'll get into. How do you convert a foreign subsidiary's financial statements back to US dollars? Well, there are two approaches. There are two methods. There is the remeasurement method and there is the translation method. So that's what you're up against. It's either going to be the remeasurement method or the translation method. Now listen carefully. Which method you use depends on what currency the sub functions in. Now listen carefully. If the sub really functions in US dollars, most of their transactions are in US dollars. They get all their financing from US banks. A lot of transactions with the US parent. If the sub really functions in US dollars, again, most of their transactions are in US dollars. They get their financing from US banks. A lot of transactions with the US parent. If the sub really functions in US dollars, you have to use the remeasurement method. But if the sub functions in their local currency, and you know what that means, most of their transactions are in their local currency. They get their financing from local banks. Very few transactions with the US parent. If the sub functions in their local currency, well, then you have to use the translation method. And you really have to have an idea of what these methods are all about. Let's start with the remeasurement method. Now, when you look at the remeasurement method, you have to remember that the way a balance sheet breaks down, there are basically monetary items and there are non-monetary items. Now remember, monetary items are items whose amounts are fixed in terms of a currency, by contract or otherwise. Again, monetary items are items whose amounts are fixed in terms of a currency, by contract or otherwise. So obviously we're talking about cash, accounts receivable, notes receivable, accounts payable, notes payable, don't forget bonds payable, held to maturity securities. These are monetary items, items whose amounts are fixed in terms of a currency, by contract or otherwise. Now, under the remeasurement method, and remember, when you use the remeasurement method, the sub really functions in US dollars. Under the remeasurement method, all monetary items are converted at the current exchange rate. The rate of exchange on the balance sheet date, December 31. All monetary items get converted at the current exchange rate. The rate of exchange on the balance sheet date, usually December 31. Now, there are also non-monetary items. Non-monetary items are items whose amounts are not fixed in terms of a currency, but their values change with changing prices. Again, non-monetary items are items whose amounts are not fixed in terms of a currency, but their values change with changing prices. So we're talking about land, property, plant, and equipment, intangibles. Don't forget trading securities, available for sale securities. These are non-monetary items. These items are not fixed in terms of a currency. Their values change with changing prices. All, under the remeasurement method, all non-monetary items are converted at the historical rate. The rate of exchange when you bought the land, the rate of exchange when you bought the equipment. All non-monetary items are converted at the historical rate. So you got to remember that. All monetary items, you know what those are, you hopefully know what those are, get converted at the current exchange rate. All non-monetary items get converted at the historical rate, the rate of exchange on the day you bought the equipment. Now, how about the income statement? Well, the revenues and expenses on the income statement get converted at the weighted average exchange rate for the period. Again, on the income statement, the revenues and expenses get converted at the weighted average exchange rate for the period, but there are exceptions. Not depreciation. Depreciation expense would be based on the historical rate, the rate of exchange the day you bought the equipment. Not cost of goods sold. That would be the historical rate. That would be the rate of exchange the day you bought the inventory. Right? That's non-monetary. That's a non-monetary item. So as I say, the revenues and expenses get converted at the weighted average exchange rate for the period, but not depreciation. That would be the historical rate. Rate of exchange on the day you bought the machine. Not cost of goods sold. That would be the historical rate. The rate of exchange on the day you bought the inventory. How about retained earnings? Well, remember, there's no exchange rate for retained earnings. You just convert the revenues and expenses the way we've said, and retained earnings builds over time. You back into it. So there's no exchange rate for retained earnings. You just convert the revenues and expenses the way we've stated, and retained earnings builds over time. You back into it. How about common stock? Additional paid-in capital, historical rate. The rate of exchange on the day that you issued the shares. Dividends. Dividends always. The rate of exchange, I know you know it, on the date of declaration. All right, now, we do all these conversions, right? We do all these conversions, and what we end up with is a remeasurement gain or loss. And you've got to remember that a remeasurement gain or loss belongs on the income statement. It's included in earnings. So a remeasurement gain or loss, as I say, after you've done all these conversions, you end up with a remeasurement gain or loss, and a remeasurement gain or loss does belong on the income statement. It's included in earnings. All right, now how about the translation method? Now remember, we're going to use the translation method when the sub really functions in their local currency. Now what do we mean by the translation method? It's actually easier. Under the translation method, all assets, all liabilities get converted at the current exchange rate. You know, the rate of exchange on December 31, balance sheet date. All assets, all liabilities get converted at the current exchange rate. On the income statement, all revenues, all expenses get converted at the weighted average exchange rate for the period. No exceptions. So on the income statement, all revenues, all expenses get converted at the weighted average exchange rate for the period. How about retained earnings? Well, here again, there's no exchange rate for retained earnings. You just convert all the revenues and expenses the way we've stated, and then retained earnings builds over time. You back into it. Common stock, additional paid-in capital, historical rate. Rate of exchange on the day you issue the shares. Dividends always. Rate of exchange on the day of declaration. But here's the point. We do all these conversions, and what we end up with is a translation gain or loss. And remember, a translation gain or loss does not go to the income statement. A translation gain or loss goes directly to stockholders' equity as an item of other comprehensive income, an item of OCI. So remember, a remeasurement gain or loss belongs on the income statement, not a remeasurement gain or loss. A remeasurement gain or loss does not go to the income statement, goes directly to stockholders' equity as an item of OCI, an item of other comprehensive income. I'd like you to do 20, 21, and 22, and then come back. Welcome back. Let's do these questions together. Number 20 says, a foreign subsidiary's functional currency is its local currency. Now, you know, the minute you see that, if the sub is really functioning in their local currency, you have to use the translation method, not the remeasurement method. They go on to say that the local currency has not experienced significant inflation. The reason they mention that is because when there's hyperinflation, if the local currency has experienced hyperinflation, and that is inflation, you know, greater than 100% in the 3 previous years, when you get into hyperinflation like that, you have to use the remeasurement method. So if the local currency is experiencing hyperinflation, 100% or more inflation for the 3 previous years, then you have to use the remeasurement method. But there hasn't been significant inflation, so it would be the translation method. The weighted average exchange rate for the current year would be the appropriate exchange rate for what? Sales to customers? Yes. Wage expense? Yes. Answer B. Because under the translation method, all revenues, all expenses get converted at the weighted average exchange rate for the period. No exceptions. So the answer is B. Number 21, gains resulting from the process of translating. So we're talking about the translation method. Translating a foreign entity's financial statements from the functional currency. They've not experienced significant inflation, so it would be the translation method. Where would these gains end up? Well, if it's the translation method, the gain wouldn't go to the income statement. It would go directly to stockholders' equity as an item of other comprehensive income. Answer A. 22. They say the sub's functional currency is the currency of the country in which it is located. If they're functioning in their local currency, you have to use the translation method. So remember, under the translation method, all assets, all liabilities get converted at the current exchange rate. So just go to the current column, add it up, 475,000. The answer is C. Because in the translation method, all assets, all liabilities on the balance sheet get converted at the current exchange rate. So you just had to go to the current exchange rate column, take the total, and the answer is C. Now, just take a look at this for a second. Stay on number 22. What would be the answer in the remeasurement method? Just to make you think about it. Well, if this were the remeasurement method, the monetary items, the note receivable and the prepaid rent, would be converted at the current exchange rate, 240 plus 85. But the non-monetary item, the patent, would be converted at the historical rate, 170. Now the answer would be D. You might want to, just for your own studying, right next to answer D, remeasurement method. Answer would be D in the remeasurement method because this is the translation method. The answer is C. Now there's one more thing the exam likes to get into with foreign operations, and that is how do we handle transactions that are denominated in a foreign currency? Let's go to a problem. Number 23. 23 says on September 22nd, year 4, Yumi Corporation purchased merchandise from an unaffiliated foreign company for 10,000 units of the foreign company's local currency. On that date, the spot rate was 55 cents. Let's say they're euros, just to have a name for it. All right, so let's do some entries. What entry would the company have made on September 22nd, year 4? Well, if you go out and you purchase merchandise from a foreign company, and you've got to buy the merchandise for 10,000 euros, and on that date, the euros are trading for 55 cents each, you're going to debit purchases for 10,000 euros times 55 cents, $5,500, and you're going to credit accounts payable, $5,500. Then it says, Yumi paid the bill in full March 20th, year 5, when the spot rate was 65 cents per euro. The spot rate was 70 cents per euro on December 31, year 4. What amount would Yumi report as a foreign currency transaction loss on their income statement for year 4? Well, let's go to December 31, year 4. You see what happens? When you get to December 31, year 4, what are euros trading for? 70 cents each. When you get to December 31, year 4, aren't euros 15 cents more expensive? So I have to adjust my payable. I have to take that 15-cent increase in euros times 10,000 euros. I'm going to credit accounts payable, 1,500, and I'm going to debit a transaction loss of 1,500. And the answer is D. That loss would go to my income statement. So I would debit a transaction loss of 1,500 and credit accounts payable, 1,500. That brings my payable from 5,500 up to 7,000. I had to adjust my payable. All right, now let's carry it through. I pay the bill on March 20th, year 5. All right, so on March 20th, year 5, when I pay the bill, I'm going to debit what? Accounts payable. What's the balance in my accounts payable? Well, it was originally 5,500, but at year end, I adjusted it by 1,500. Now the balance in accounts payable is 7,000. So at December 31, I would debit accounts payable, 7,000. What would I credit to cash? Well, now euros are just 65 cents each. So I would credit cash for 10,000 euros times 65 cents, 6,500. And notice in year 5, I have a transaction gain of 500. And that gain would go to my income statement in year 5. But it's not answer B, because that gain goes to my income statement in year 5. They wanted the transaction loss on the income statement in year 4, and that is answer D, 1,500. And you know what I worry about a little bit as your teacher? I worry about this. Notice something. Transaction gains and losses belong on the income statement, not translation gains and losses. Watch out for that distinction. Again, transaction gains and losses do belong on the income statement, but not translation gains and losses. Translation gains and losses go directly to stockholders' equity as an item of other comprehensive income. So just be careful with that terminology. So that's pretty much what the exam hits with foreign operations. And now I want to move on to another topic. Let's get into ratio analysis. In terms of ratio analysis, there are, of course, a lot of ratios that have been in the exam, and if you look at our book, in our book we cover every ratio that's ever been in that exam, and I think it's critically important that you go to our book and expose yourself to all the ratios that have been in the exam. But I think you know that with ratio questions, you really have to know a formula. Now, I don't think you have to memorize all the formulas that are in the book, because there's a lot of them. But as I say, I think you do have to expose yourself to all the ratios. But I think there are 7 ratios that you absolutely have to know cold, because these 7 are what I think of as the big 7, the 7 that are tested most often. So you can't go in the exam and not know these 7 ratios absolutely cold. You want to memorize these formulas. So let's go over the big 7, and you'll see that some of them are easy, some of them are a little bit more difficult, but you got to know these big 7. Let's go over the big 7. The first one, it's an easy one, is the current ratio. If you're going to calculate the current ratio, in the numerator, you want total current assets. And in the divisor, you want total current liabilities. It's an easy one, but it's asked a lot in the exam. The second one you have to know cold is the acid test ratio. Sometimes they call it the quick ratio. Now, when you do the acid test ratio or the quick ratio, in the numerator, you want your most liquid assets. Cash plus marketable securities plus receivables. That's what goes in the numerator, your most liquid assets. Cash plus marketable securities plus receivables, and you divide by current liabilities. Number 3, the exam loves, and that is the accounts receivable turnover. Now, if you're going to calculate the accounts receivable turnover, in the numerator, you want net credit sales. That's what goes in the numerator, net credit sales. And you divide by average receivables. Now, be careful of the divisor. What do I mean by average receivables? It's beginning receivables plus ending receivables divided by 2. Sometimes people will mess up that divisor. Remember, you're dividing by average receivables, which again would be beginning receivables plus ending receivables divided by 2. Number 4 is inventory turnover. It's in the exam a lot. If you're going to calculate the inventory turnover, in the numerator, you want cost of goods sold. And in the divisor, you want average inventory. And I know you're ahead of me. Average inventory would be beginning inventory plus ending inventory divided by 2. Number 5 is the price-earnings ratio. You've got to know it. When you calculate the price-earnings ratio, in the numerator, you want the market price of the stock. And you divide by earnings per share. So obviously, what can make this one a little bit more difficult is that you may have to calculate earnings per share first, because that's how you get the price-earnings ratio. It's the market price of the stock divided by EPS, divided by earnings per share. Number 6. Number 6 is book value per share. Now listen carefully. If the exam wants book value per share, in the numerator, you want total stockholders' equity. And if you think about it, total stockholders' equity does represent the book value of a corporation, because after all, the book value of a corporation is assets minus liabilities, or the total value of stockholders' equity. So in the numerator, you put total stockholders' equity, and you divide by the number of shares outstanding. Always be careful. With book value per share calculations, don't divide by authorized shares, don't divide by issued shares. You always divide by the number of shares outstanding. Now, the 7th ratio is the most heavily tested of all the ratios and the most complex of all the ratios. The 7th ratio is earnings per share. And we'll get to that in a little bit. Let's do a problem on book value per share. Let's go to number 24. '24 says, Hoyt Corporation's current balance sheet reports the following stockholders' equity section. And if you look at it, notice there are common shares outstanding and there are preferred shares outstanding. And I want you to know that when you see a book value per share problem and there's common and preferred stock outstanding, you have to be able to calculate a book value per common share and a book value per preferred share. That's what you have to be ready for. Calculate a book value per common share, calculate a book value per preferred share. Now, what do they want here? If you go to the bottom, they want book value per common share. That's what they're asking for here, book value per common share. All right, so you're in the exam. Hopefully you've memorized the formula and you know that when you do book value per share, in the numerator, you want total stockholders' equity, and they gave you that. Total stockholders' equity adds up to $1,025,000. And of course, that is the book value of the corporation. Now, I'm going to divide by the number of shares outstanding, but I want you to listen carefully. When there's common and preferred stock outstanding, I don't care whether they ask you for book value per common share, book value per preferred share. The fastest way to do a problem like this is to do a quick calculation on what legal claims preferred stockholders have on that $1,025,000. That's really the way to do this. You want to do a quick calculation on what legal claims preferred stockholders have on that $1,025,000. Because once I know that, once I know what legal claims preferred stockholders have on that $1,025,000, common gets the rest. See, you can always plug the common equity, and that saves time. So let's work out preferred stockholders' legal claims. When you work out preferred stockholders' legal claims, you watch out for three things. Number one, preferred stockholders are entitled to their par value. So let's put down the par, $250,000. See, what you're doing is looking at theoretically what this corporation would do if it ever were to liquidate. And the point we're making is, if this corporation were to ever liquidate, preferred stockholders would go to a bankruptcy court, demand that $250,000, and they'd get it. That's a legal claim they have in liquidation, their par value. You know, old textbooks used to call this liquidation value per share. Now, the CPA exam never does. They always call it book value per share, but it's not wrong to call it liquidation value per share because it's a theoretical calculation on what each class of stockholder would receive in liquidation. And I'm saying if this corporation were to ever liquidate, preferred stockholders would demand their par value and they'd get it. Another legal claim they have is dividends in arrears. If preferred stock is cumulative, they're also entitled to dividends in arrears. And notice in this problem, preferred stock is cumulative, and they said dividends are in arrears and amount to $25,000. We're going to pick that up also. I'm saying if this corporation were to ever liquidate, preferred stockholders would go to a bankruptcy court, demand that $25,000, and they get it. That is a legal claim they have in liquidation. Now, there's one more thing to be careful about. Always watch out for a liquidation premium or a redemption premium. And they said if Hoyt is ever liquidated, preferred stockholders get their par plus a premium of $50,000. They get that also. Let's put that in our list. We're saying if this corporation were to ever liquidate, preferred stockholders would demand that $50,000, that premium, and they'd get it. And the reason they get that is bankruptcy courts see that as a contractual claim. When we bought the preferred stock, the corporation said, in the unlikely event we ever liquidate, you get a $50,000 premium. Well, bankruptcy courts would honor that as a contractual claim. So you pick that up as well. All right, so if you add it up, what are preferred stockholders' legal claims? The par of $250,000, the dividends in arrears of $25,000, the liquidation premium of $50,000, preferred equity adds up to $325,000, and now we can solve it. If the total book value of the corporation, which is given, is $1,025,000, and we just proved that preferred stockholders have a legal claim on $325,000 of that, what does common get? The rest. The common equity must be $700,000. That's my point. You can plug the common equity, and that saves time. So now we can solve it. If I take the common equity, $700,000, divide by the 100,000 common shares outstanding, book value per common share would be answer D, $7. You've got to be ready for that. Same problem. What if they wanted book value per preferred share? Because they could ask you for that. If they want book value per preferred share, you'd start the same way, work out preferred stockholders' legal claims. They add up to $325,000. So take the preferred equity, $325,000, divide by the 2,500 preferred shares outstanding, and book value per preferred share comes out to $130. You've got to be ready to do both. Book value per common share, book value per preferred share. I'd like you to try some questions. I'd like you to shut the class down, do 25 to 28. 25 to 28, and then come back. Welcome back. 25, 26, and 27 are a set. In number 25, they say the accounts receivable turnover was 5 times. What was net credit sales? Well, as we've already said, with ratio questions, you really have to have memorized the formula, and hopefully by the time the exam comes, you've memorized the formula for accounts receivable turnover. What is it? In the numerator, we want net credit sales, and in the divisor, we want average receivables. All right, now, what is it we know here? Well, we know the accounts receivable turnover is 5. We know that. We can also figure out average receivables. Average receivables would be the beginning receivables, 20,000, plus the ending receivables, 22,000, divided by 2. Let's agree that average receivables comes out to 21,000. All right, so I know the divisor, 21,000. I know the accounts receivable turnover is 5 times. What I don't know is net credit sales. So let's back into it. 5 times 21, net credit sales must have been 105,000. Answer A. So notice, the exam is unlikely to give you something just straightforward. Here, if you knew the formula, you could figure out the divisor, 21,000, average receivables. You knew the account receivable turnover is 5, so net credit sales had to be 5 times 21, 105,000. But it does, as always, come down to knowing that formula. Same thing with number 26. They want to know inventory turnover. Well, you start by the fact that you've memorized the formula. In the numerator, I want cost of goods sold. They gave us that. Cost of goods sold is 18,000. I divide by average inventory. Average inventory is beginning inventory. That's 6,000. They gave us that. Plus ending inventory divided by 2. But I don't know ending inventory. That's what's missing. And I always tell my students, anytime something is missing from cost of goods sold, you want to go right to your scrap paper and put the skeleton down of cost of goods sold. Use what you know. You know cost of goods sold is beginning inventory plus purchases equals goods available for sale minus ending inventory equals cost of goods sold. You know that. It's in your head. So you go to the scrap paper, write it down, and then let's fill it in. Do we know beginning inventory? Yes, it's given, 6,000. Do we know purchases? Yes, given, 24,000. So we know goods available for sale, 30,000. Now we don't know ending inventory, but we know cost of goods sold is 18,000, so now you can plug it. What from 30,000 gives you 18,000? Ending inventory had to have a value of 12,000 because we knew goods available added up to 30,000. Cost of goods sold was 18,000. Ending inventory had to have a value of 12,000. So now we can solve it. If I take the cost of goods sold in the numerator, 18,000, divide by average inventory. What's average inventory? The beginning inventory, 6,000, plus the ending inventory, 12,000. That's 18,000 divided by 2 is 9,000. Divide 9,000 into 18,000. Inventory turned over 2 times. And the answer is C. Now, number 27 is a ratio that you may not have memorized, but you can kind of figure it out. Here's one they could ask for. They say in number 27, what would be the formula to determine the average day sales in inventory? To work out the average day sales in inventory, it'll make sense when you see it. In the numerator, you want the number of days in a year, 365, and you divide by inventory turnover. Answer B. I mean, if you take the number of days in a year, 365, divide by the inventory turnover, which in this problem is 2 times, on average, they have 180 days sales, 182 and a half days sales in inventory. What that tells you is they must be selling some really big ticket item. If on average they've got 182 and a half days sales in inventory, they must sell cabin cruisers. Some big item is probably what they sell. Now in number 28, we have another book value per share problem. But notice what they want is book value per preferred share. So you know what to do. If you want to work out book value per preferred share, first you have to add up preferred stockholders' legal claims. What legal claims do preferred stockholders have? Well, they're entitled to their par, 100,000. They're also entitled to dividends and arrears if the preferred stock is cumulative, and this preferred stock is cumulative. Notice that the corporation was just organized January 2nd. They say no dividends have been declared. Well, if the corporation was organized January 2nd and we're now at December 31, according to the problem, and no dividends have been declared, then the current year's preferred dividend is in arrears. So let's work that out. Take the fixed dividend rate for preferred, 10%, times the par, 100,000. The preferred dividend for the current year is 10,000. That's in arrears, and that's a legal claim. They have in liquidation, so pick up that 10,000 in dividends and arrears. Now, the last thing you always look for is a liquidation premium or a redemption premium, because that's another legal claim that they have in liquidation. And did you notice they said that the preferred stock has a par of 100 but a liquidation value of 105? That's their way of telling you there's a $5 per share liquidation premium. So I'm going to take that $5, if the par is 5 and the liquidation value is 105, they're telling you that there's another $5 per share liquidation premium. And that's another legal claim they have in liquidation. So I'm going to take that $5 times the 1,000 preferred shares outstanding, add another 5,000 to the preferred stockholders' legal claims. So what are preferred stockholders' legal claims? The par 100,000, dividends and arrears 10,000, liquidation premium 5,000, 115,000 would be the preferred equity. Divide by the 1,000 preferred shares outstanding, and book value per preferred share would be answer D, $115. Now, the seventh and final ratio of what I call the Big Seven is the most heavily tested of the ratios by far, and the most complicated ratio by far. And what I'm talking about is earnings per share. And I want you to know that when we start talking about earnings per share, I know to some extent you're already ahead of me. I know you're probably thinking, I know where Bob is going to go with this, basic and diluted earnings per share. And of course you're right. But my first piece of advice is not to go too fast. The secret to earnings per share, if there is one, is to slow down and master basic earnings per share. Do you think the exam ever asks for basic earnings per share? Yes, a lot. So don't think they don't test basic earnings per share. They don't always ask for diluted. A lot of times all the exam wants is basic earnings per share. So that's my first piece of advice on this. Slow down. Don't go too fast. You want to start by mastering basic earnings per share. So let me give you the formula for basic earnings per share. Now be careful. When you calculate basic earnings per share, in the numerator, you don't just want the company's net income. No. In the numerator, you want net income applicable to common stockholders. Now let me define that. What is net income applicable to common stockholders? It's the corporation's net income minus the current year's preferred dividend. That's how we define net income applicable to common stockholders. It's the corporation's net income minus the current year's preferred dividend. And listen carefully. If preferred stock is cumulative, and no doubt it would be, if preferred stock is cumulative, you're going to back out that current year's preferred dividend, whether it's declared or not. Remember that. If preferred stock is cumulative, you're going to back out that current year's preferred dividend, whether it's declared or not. All right, so in the numerator, we want net income applicable to common stockholders. And be careful, you don't just divide by the number of common shares outstanding. A lot of students do that. Don't just divide by the number of common shares outstanding. No, you divide by the weighted average common shares outstanding for the period. Don't forget, in the divisor, we divide by the weighted average common shares outstanding for the period. So you have to remember, in the divisor, you have to weight the shares by how many months they've been outstanding, and that's what I want to show you next. What I want to show you next is how to weight shares. Let's go to question number 29. 29 says, Rand had 20,000 shares of common outstanding January 1, year 6. On May 1, year 6, they issued another 10,500 shares of common. Outstanding all year were 10,000 shares of non-convertible preferred, on which a dividend of $4 a share was paid in December of year 6. The net income for year 6, $96.7. And what is earnings per share? Notice, they're not asking for diluted. They just want basic earnings per share, which I'm suggesting is not that basic. You've got to be careful. All right, so together, let's work out basic earnings per share for Rand. Well, we know in the numerator, we want net income applicable to common stockholders. So we're going to take Rand's net income for year 6, $96,700, and subtract the current year's preferred dividend. The current year's preferred dividend was $4 a share times 10,000 preferred shares outstanding. The current year's preferred dividend was $40,000. So back that out. Let's agree that net income applicable to common stockholders would be $56,700. Now, how about the divisor? We divide by the weighted average common shares outstanding for the period. How do we weight the shares? Well, let me just say that in terms of weighting shares, there's a long approach and there's a shortcut. I'm just going to show you the shortcut, which is the fastest way to do this. Here's the quick way to weight shares. Don't we know that in this problem, they had 20,000 shares of common outstanding January 1, year 6. Well, my thinking is those 20,000 shares were outstanding for all of year 6. They were outstanding for the full year. They were outstanding for the 1 full year. So give them a full weight of 1. That's 20,000 weighted shares. Again, because those 20,000 shares were outstanding for all 12 months of year 6, we give them a full weight of 1. They were outstanding for the complete year. Give those a full weight of 1. That's 20,000 weighted shares. Now, they also issued another 10,500 common shares on May 1st. How many months have they been outstanding? Well, May, June, July, August. Don't be ashamed to use your fingers. I do. May, June, July, August, September, October, November, December. They've been outstanding for 8 months. So give them a weight of 8/12. That's another 7,000 weighted shares. You have to weight the shares by how many months they've been outstanding. Since those 10,500 shares have been outstanding for 8 months, we give them a weight of 8/12, or 2/3. That's another 7,000 weighted shares. So what's the weighted average common shares outstanding for the period? 27,000. If you take the net income applicable to common stockholders, 56,700, divide by the 27,000 weighted average common shares outstanding for the period, basic earnings per share comes out to answer A, $2.10. You have to be able to do that. Let's go to number 30. In number 30, notice Fay Corporation's capital structure. They had 200,000 common shares outstanding January 1. Then they also have 50,000 shares of non-convertible preferred. On October 1, they issued a 10% stock dividend on the common, paid 100,000 cash dividend on the preferred. Net income for the year, 960,000. And they want, again, just basic earnings per share. They don't want diluted, just basic earnings per share. So let's work it out. We know when we calculate basic earnings per share, in the numerator, we want net income applicable to common stockholders. So we're going to take Fay's net income, 960,000, minus the current year's preferred dividend, 100,000. Let's agree that net income applicable to common stockholders would be 860,000. Now we divide by weighted shares. Now since they had 200,000 common shares outstanding for the entire year, give those a full weight of 1, that is 200,000 weighted shares. Now you know why we're doing this problem, because of the stock dividend. On October 1, they issue a 10% stock dividend, and you know what that means. If you issue a 10% stock dividend, it means you have literally increased your shares outstanding by 10%. You've sent out another 10%. You've sent out another 20,000 shares. How many months have they been outstanding? Well, that was October 1. So haven't those shares been outstanding for October, November, December? 3 months. Give them a weight of 3/12, or 1/4. That's another 5,000 weighted shares. And if you take the net income applicable to common stockholders, 860,000, divide by the 205,000 weighted shares, there's no answer there for you. There is no answer for that, because there's a little trick here, and they love it, and you have to remember it. Please remember, when you're doing basic or diluted earnings per share, when you're doing basic or diluted earnings per share, stock dividends and stock splits are retroactively weighted. Again, when you're doing basic or diluted earnings per share, stock dividends and stock splits are retroactively weighted. Here's my point. You will always bring a stock dividend or split back to the beginning of the year, and you'll be fine. If you always bring a stock dividend or split back to the beginning of the year, usually January 1, you'll be fine. So the way we're supposed to look at this, it's as if, we're going to look at this as if what? They had 220,000 shares outstanding for the entire year. Just bring the stock dividend or split right back to the beginning of the year. So we're going to look at this just as if they had 220,000 shares outstanding for the entire year. Give them a weight of 1, a full weight of 1. So if you take the net income applicable to common stockholders, 860,000, divide by 220,000 weighted shares, the answer is A. Basic earnings per share comes out to $3.91 a share. Answer A. I'd like you to try a couple of questions, 31 and 32, and then come back. Welcome back. Let's do these questions together. In number 31, we have to work out the weighted average common shares for the period. Well, we know they had 100,000 shares outstanding for the entire year. They're going to get a full weight of 1, and you've also got this stock dividend. But we know when we do basic or diluted earnings per share, stock dividends, stock splits are retroactively weighted. Doesn't matter that the dividend was on March 31st. We're going to bring it back to the beginning of the year. In other words, the way we're going to look at this, it's just as if they had 124,000 shares outstanding for the entire year. Give those 124,000 shares a full weight of 1. That's 124,000 weighted shares. And then they have the 5,000 shares they issued on June 30th. Well, they've been outstanding for a half a year, 6 months. Give those a weight of a half. That's 2,500 weighted shares. And the answer is C, 126,500 weighted average common shares outstanding for the period. And one small point I want to make, if they had just said on March 31st there was a 10% stock dividend, here they gave you the number of shares. So it was harder to mess up here. They gave you the number of shares, 24,000, and you just brought those back to January 1. But if they had said on March 31st there was a 10% stock dividend, well, I still bring it back to January 1, that's true, but the 10% stock dividend wouldn't have been on the 5,000 shares because those 5,000 shares were issued on June 30th after the dividend. You got to be careful of dates. If shares are issued after a stock dividend or after a stock split, the dividend or split wouldn't be on those shares. So yes, you always bring a stock dividend or split back to the beginning of the year, but be careful. As I say, if they just said there was a 10% stock dividend, the 10% stock dividend would be on the 100,000 shares outstanding January 1. So it'd be like you had 110,000 shares outstanding for the entire year. But the 10% stock dividend wouldn't be on the 5,000 shares because they were issued after the stock dividend. I'm just making the point that you have to be careful about dates. But in this case, they just gave us the number of shares, so it was a little easier to say, well, then it's as if I had 124,000 shares weighted at 1 and 5,000 shares weighted at a half, giving me answer C. In number 32, again, notice they don't want diluted earnings per share. They just want basic earnings per share, and you've memorized the formula. In the numerator, you want net income applicable to common stockholders. So you're going to take the company's net income, $500,000, back out that current year's preferred dividend, $16,000. So net income applicable to common stockholders would be $484,000, and you divide by weighted shares. Since they had 200,000 shares outstanding for the entire year, give those a full weight of 1. And if you take 484,000, divide by 200,000 weighted shares, that gives you answer A, and answer A is wrong. But it's tempting. A lot of people would pick answer A. And I don't know if you picked answer A or not. I know a lot of students do. And this is a lesson you really have to learn. Let's go back to the definition. How did we define net income applicable to common stockholders? Didn't we say that net income applicable to common stockholders is defined as the company's net income minus what? The current year's preferred dividend. Back out the current year's preferred dividend. What is the current year's preferred dividend? 4% of 250, 10,000. You don't necessarily look at what they paid because they could be paying off some arrears. See, every year you back out 4% of 250. It's a lesson you have to remember. What you're always backing out is the current year's preferred dividend, not what they paid in the current year. What's the current year's preferred dividend? Every year, it's 4% of 250. Last year, you would have backed out 4% of 250. The year before, you would have backed out 4% of 250. So be careful. So if I take the company's net income, $500,000, back out the current year's preferred dividend, 4% of 250, 10,000, divide by the number of weighted shares outstanding for the period, 200,000, that gives me answer B. So be careful of that lesson. You don't necessarily look at what they paid. It could be the same, but in this problem there's a difference because they could be paying off some arrears. We don't really know. All we know is every year we back out the current year's preferred dividend. Every year we back out 4% of 250. Now, I want you to also remember that we use basic earnings per share when a corporation has a simple capital structure. Again, we're going to use basic earnings per share when a corporation has a simple capital structure. In other words, all they have are common shares outstanding. What we're going to get into next is what we do with earnings per share when a corporation has a complex capital structure. Now listen carefully. For earnings per share purposes, a corporation has a complex capital structure when, besides common shares outstanding, in addition to common shares outstanding, the corporation has other securities outstanding. that are not legally common stock, but these securities have the potential to become common stock. They are potentially dilutive securities. That is what makes a complex capital structure for earnings per share purposes. When a corporation, in addition to common shares outstanding, they have other securities outstanding that have the potential to become common stock. These securities are potentially dilutive. When a corporation has potentially dilutive securities outstanding, that corporation has a complex capital structure. And when a corporation has a complex capital structure, now earnings per share becomes the dual presentation. Now you must present both. You must present both basic and diluted earnings per share. So that's how you get into this. When a corporation has a complex capital structure, now you must present both basic and diluted earnings per share. And what I'm going to give you next is the formula for diluted earnings per share. Here we go. It's going to be pretty familiar. When you calculate diluted earnings per share, in the numerator, you still want net income applicable to common stockholders. By the way, defined exactly the way we always have. It's the company's net income minus the current year's preferred dividend. So in the numerator, I still want net income applicable to common stockholders. In the divisor, I still divide by the weighted average common shares outstanding for the period. Don't forget your basic lessons. In the divisor, you still have to weight the shares by how many months they've been outstanding. But the difference is, when you do diluted earnings per share, in the divisor, you would also include these dilutive securities. That's the difference. When you calculate diluted earnings per share, in the divisor, you would also add any dilutive securities. Now, please listen. Only put these securities in the calculation if they cause earnings per share to go down. They have to dilute the picture. Remember, dilutive means down. The D's go together. So you're only going to put these securities in the calculation if they cause earnings per share to go down. Dilutive means down. The D's go together. Now listen carefully. If you were to put these securities in the calculation and they caused earnings per share to go up, well, then they would be anti-dilutive, and they don't belong in the calculation. So that's how it works. You're only going to put these securities in the calculation if they cause earnings per share to go down. Dilutive means down. But if you put these securities in the calculation and they cause earnings per share to go up, they are anti-dilutive. They don't belong in the calculation. So keep that in mind. All right, now, with all that said, what are these potentially dilutive securities? Let's go over the ones to look out for. First, watch out for stock options or stock warrants. Now, you know this. If a company has stock options outstanding or stock warrants outstanding, they're really the same thing. Are stock warrants, stock options, are they legally common stock? No, but they have the potential to become common stock. They are potentially dilutive. Also, watch out for convertible preferred stock. You know what that is. Convertible preferred stock is preferred stock that can be converted into common stock. And convertible preferred stock is not legally common stock, but it has the potential to become common stock. It's potentially dilutive. And then also watch out for convertible bonds. Convertible bonds are bonds that you can convert into stock. Are convertible bonds legally common stock? No, but they have the potential to become common stock. So they are potentially dilutive. So that's what you're looking out for. Watch out for stock options or warrants, convertible bonds, convertible preferred stock. When you see a corporation that has any of these securities, stock options, stock warrants, convertible preferred stock, convertible bonds, you see a corporation with any of these securities, that is a complex capital structure because those securities are potentially dilutive. All right, so let's start with that in mind. Let's start with stock options or warrants. Now, I think you know my point. If you're in the exam and you see a corporation that has stock options, stock warrants outstanding, are they automatically dilutive? Are they? Are they automatically dilutive? No, they're potentially dilutive. So your job in the exam is to test the options to see if they're dilutive or not. See, that's your job in the test. You have to test those options to see if they're dilutive or not. How do you do that? With the treasury stock method. That's what you need. You need the treasury stock method to test the options to see if they're dilutive or not. And that's what I want to show you next. What I want to show you next is the treasury stock method. Let's go to questions 33 and 34. It's a set. Let's do 33 and 34. 33 says, man had 300,000 shares of common issued and outstanding December 31, year 1. Then on July 1, year 2, they issued another 50,000 shares of common for cash. Man also had unexercised stock options to purchase 40,000 shares of common at $15 a share. Why don't you circle that 15? That's your option price. People have the option to buy the shares at that fixed price. It's called the option price or the exercise price, $15 a share. They were outstanding at the beginning and the end of the year, so none were exercised. Then they say the average market price of man's common was $20 during year 2. I want you to underline average market price, underline that, and circle the number 20. Number 1 says, what is the number of shares that would be used in computing what? Basic earnings per share. And number 34 says, what is the number of shares that would be used in computing diluted earnings per share? So 33 wants to know, hey, what would be the number of shares you would use in the divisor, calculating basic earnings per share? And number 34, what is the number of shares that you would use in the divisor if you're computing diluted earnings per share? All right, let's do basic together. You know, if I were calculating the weighted average shares for basic, I would say, well, there were 300,000 shares outstanding for the entire year, so I'd give those 300,000 shares a full weight of 1. That's 300,000 weighted shares. And then they issued another 50,000 shares on July 1. Well, they've been outstanding for 6 months or a half a year, so I'd give those a weight of a half. That's another 25,000 weighted shares. I think we agree. If we were doing basic earnings per share, we would divide by answer A, 325,000 weighted shares. So the answer to number 33 is A. That's basic earnings per share. And notice, when I do basic, I don't worry about the stock options. I ignore them. But now in number 34, they want to know the number of shares we would use in computing diluted earnings per share. Now I have to consider the options. Now, listen carefully. When I figure out the number of weighted shares for diluted, I start the same way. I still say, well, there's 300,000 shares outstanding for the full year. Give those a full weight of 1. That's 300,000 weighted shares. I still say there's 50,000 shares outstanding for 6 months. Give those a weight of a half. That's 25,000 weighted shares. I still start the same way. But the difference is I have to test the stock options. These options are not automatically dilutive, but they're potentially dilutive. So I have to test the options to see if they're dilutive or not. And the way I do this is with the treasury stock method. And I'll tell you that with the treasury stock method, there's a long approach and there's a short approach. I'm not even going to show you the long approach. I'll just show you the shortcut because it's fast. Here's the fastest way I know how to do the treasury stock method. In this problem, what's the average market price for the period? $20. What's the exercise price? 15. So let's do it. I'm going to take the average market price for the period, 20, minus the exercise price, 15, over the market price, 20. That's how you set it up. Take the average market price for the period, 20, minus the exercise price, 15, over the market price, 20. 20 minus 15 over 20. That factors down to 5 over 20, which is 1/4. 1/4 of those 40,000 options would be dilutive. So when I do diluted earnings per share in the divisor, I would add another 10,000 diluted shares. Add another 10,000 dilutive shares. So when I do diluted earnings per share, I'm going to divide not by 325,000 shares. I'll divide by answer B, 335,000 shares. I take the average market price for the period, 20, minus the exercise price, 15, over the market price, 20. That factors down to 5 over 20, which is 1/4. 1/4 of those 40,000 options would be dilutive. So in the divisor, add another 10,000 shares. So when you calculate diluted earnings per share, you won't divide by 325,000 shares. You'll divide by 335,000 shares. Answer B. Now, a couple of points. Notice in this problem that the average market price, 20, is above the exercise price, 15. I want you to notice that. Notice in the problem, the average market price for the period, 20, is higher than the exercise price, 15. And I want you to know, as long as the average market price is above the exercise price, you know they're dilutive. So go through the calculation. But listen carefully. If you ever see an average market price below the exercise price, those options are anti-dilutive. Ignore them. I'll say that again. As long as the average market price is above the exercise price, you know they're dilutive. So go through the calculation as we did here. But if you ever see an average market price below the exercise price, Those options are anti-dilutive. Ignore them. I'm not sure the exam would do that because I think they're more interested in seeing if you know how to do the treasury stock method. Another point I want to make. When you apply the treasury stock method, always use the average market price for the period. Notice I use the 20. And I want to mention that because they could throw in the ending market price also, and that would mess up a lot of people. No, in the treasury stock method, we always use the average market price for the period. As I say, they could just throw in the ending market price to see if you'd grab for it. A lot of students would. No, in the treasury stock method, we always use the average market price for the period. All right, so if you're in the exam, you see stock options, you have to apply the treasury stock method to see if the options are dilutive or not, so make sure you know that shortcut. Now let's get into convertible preferred stock, convertible bonds. Now it's the same thinking. If you're in the exam and you see a company that has convertible preferred stock, convertible bonds outstanding, are convertible preferred shares, convertible bonds, are they automatically dilutive? No, they are potentially dilutive. So your job in the exam is to test that convertible preferred, test those convertible bonds to see if they're dilutive or not. How do you do that? With the if converted method. That's what we're going to get into next. This is sort of how earnings per share breaks down. We apply the treasury stock method to options and warrants to see if they're dilutive or not. We apply the if converted method to convertible securities to see if they're dilutive or not. Let's go to a problem. Number 35. Dunn had 200,000 shares of $20 par common and 20,000 shares of $100 par, 6% cumulative convertible, you might want to circle that word, convertible preferred, outstanding for the entire year, ending December 31. Each preferred share is convertible into 5 shares of common. I want to stop here. Let's do a calculation. You might want to just show this below the question. We know what? There are 20,000 shares of convertible preferred. Each share of preferred is convertible into 5 shares of common. So show this calculation. Show the 20,000 shares of preferred times 5. I want you to show that the preferred is convertible into 100,000 shares of common. So keep that in mind. In this problem, the preferred is convertible into 100,000 shares of common. Let's read on. Dunn's net income for the year, $840,000. For the current year, ended December 31, what is diluted earnings per share? Before we do diluted, let's figure out basic. Let's do it together. You know the formula for basic. When we calculate basic earnings per share, in the numerator, we want net income applicable to common stockholders. So we're going to take the company's net income, in this case $840,000, minus the current year's preferred dividend. What's the current year's preferred dividend? Isn't it 6% of 100, $6 a share, times 20,000 preferred shares outstanding? Let's agree. The current year's preferred dividend is $120,000. If I take the company's net income, $840,000, back out the current year's preferred dividend, $120,000, net income applicable to common stockholders is $720,000, and I divide by weighted shares. Since they had 200,000 common shares outstanding for the entire year, give those a full weight of 1, divide by 200,000 weighted shares, basic comes out to answer C, $3.60 a share. You might want to, just for your own purposes, right next to answer C, basic. There's basic earnings per share. Now, they don't want basic. They want diluted earnings per share. Now, you'll notice in this problem, we have one potentially dilutive security, the convertible preferred. Is it automatically dilutive? No, it is potentially dilutive. So our job is to test that preferred, see if it's dilutive or not. How do I do that? The if converted method. Here we go. Under the if converted method, we just assume, you just assume that the preferred was converted to common at the earliest possible point. Again, I'm just going to assume the preferred was converted to common at the earliest possible point. That would be January 1 here, because it was outstanding all year. So think what would happen. If the preferred was converted to common back on January 1, how many more common shares would I have in the divisor? Another 100,000, right? Isn't the preferred convertible into 100,000 shares of common? So if the preferred was convertible into common, if the preferred was converted to common back on January 1, my divisor would go from 200,000 weighted shares up to 300,000 weighted shares. True? I'd have another 100,000 shares in the divisor. Would anything else change? Sure. Now I don't have to pay anybody a preferred dividend. There is no preferred dividend. If the preferred was converted to common back on January 1, I don't have to pay anybody a preferred dividend. There is no preferred dividend. So I'm just back to net income, $840,000. You have to be consistent. If the preferred was converted to common back on January 1, I don't have to pay anybody a preferred dividend. It can't be common and preferred stock at the same time. You have to be consistent. So I'm just back to net income. There is no preferred dividend. So if I take the net income, $840,000, divide by 300,000 shares, that comes out to $2.80. Now listen to my questions. Listen carefully. What was earnings per share before I considered the preferred? $3.60. Answer C. That's basic, right? What's earnings per share when I consider the preferred? $2.80. Notice it went down. What we just proved about that preferred, it's dilutive. It stays in the calculation, and that's why the answer is B, because it dilutes the picture. Dilutive means down. It caused earnings per share to go down. Now, the answer is B here, and I don't know if you're with me or not, and I don't know if this is subtle or not, but let me say it. I'd always calculate basic first, because I'm only going to put the preferred in the calculation if it causes earnings per share to go down. Down from what? Basic. See, what I'm saying is, if we did this calculation, when I took out the preferred, and if that came out to $3.81, the answer is C, $3.60, right? If I took out the preferred, if I applied the if converted method to the preferred, and it came out to $3.81 a share, well, that preferred is anti-dilutive. So diluted earnings per share would be answer C, $3.60, because the preferred doesn't belong in the calculation. All I'm saying is I don't trust them. I would always calculate basic first. How long does that take? I think, maybe you're not used to it yet, but when you get used to it, basic will just take 30 seconds. And it's just good to know, because now you're going to test the preferred to see if it brings you below 360, whether it's dilutive or not. So I'm just saying, for me, because I don't trust them, I'd always calculate basic first, so I know what dilutive is. But in this case, basic was $3.60. When I figure out the preferred, when I figure that into the calculation, it comes out to $2.80 a share. That preferred is dilutive. It stays in the calculation, and that's why the answer is B. Now, you also may notice that up until this point, what we've talked about is earnings per share. What if you're doing a loss per share? Now, just listen carefully now. If you're doing a loss per share, there's two things to be careful about. You see how when we do basic earnings per share, we take the company's net income minus the current year's preferred dividend, right? Well, if you're doing a loss per share, the current year's preferred dividend is added to the loss. I hope that makes sense to you. If you're doing a loss per share, the current year's preferred dividend is added to the loss because the current year's preferred dividend makes the loss worse for common shareholders, doesn't it? The current year's preferred dividend makes the loss worse for common shareholders. So the current year's preferred dividend would be added to the loss. Now, another point to remember, how about potentially dilutive securities? Ignore them. When you're doing a loss per share, don't put potentially dilutive securities in the divisor, because if you put more securities in the divisor, it would cause loss per share to shrink. That improves the picture. That makes things look better. So potentially dilutive securities are anti-dilutive to a loss per share. I hope that makes sense to you. Potentially dilutive securities can just be ignored with a loss per share because potentially dilutive securities are anti-dilutive to a loss per share. You put more securities in the divisor, it would cause loss per share to go down. That actually makes things look better. So ignore them. So those are the two things you have to be careful about with a loss per share. The current year's preferred dividend is added to the loss, and then ignore potentially dilutive securities. Just divide by weighted average common shares outstanding for the period. Let's do 36 and 37. It's a set. You'll see in 36 and 37, we have two potentially dilutive securities. We have some convertible preferred. We also have some convertible bonds. Now, in number 36, they say for the current year, what is basic earnings per share? And number 37 says, for the current year, what is diluted earnings per share? I'd like you to shut the class down. Just do basic. We'll do diluted together. But just, why don't you take a minute, get basic, and then we'll do diluted together. I know that you're getting better and better at basic. When you do basic earnings per share in the numerator, you want net income applicable to common stockholders. So you're going to take, in this case, the company's net income, $980,000, back out the current year's preferred dividend, $45,000, and divide by weighted shares. And since they had 90,000 common shares outstanding for the entire year, you give those a full weight of 1, divide by 90,000 weighted shares, and the answer for basic is answer B, $10.39 a share. And I know you just ate that up. At least I hope you did. Hope you're getting more and more comfortable with basic. And notice, when I do basic earnings per share, I ignore the convertible preferred. I ignore the convertible bonds. I don't worry about potentially dilutive securities when I'm doing basic earnings per share. Now, when I do diluted earnings per share, question number 37, now I have to worry about these potentially dilutive securities. But as you know, they're not automatically dilutive. They are potentially dilutive. So I have to test these securities to see if they're dilutive or not. I have some convertible preferred stock here. Let's test that preferred. See if it's dilutive or not. Let's apply the if converted method. You know what to do. Under the if converted method, we just assume that the preferred was converted to common at the earliest possible point. And here it would be January 1 because it was outstanding for the entire year. So we just assume the preferred was converted to common at the earliest possible point, in this case, January 1. Now think about it. If the preferred was converted to common back on January 1, how many more shares would I have in the divisor? Wouldn't I have another 30,000 shares in the divisor? Wouldn't my divisor go from 90,000 up to 120,000? I'd have another 30,000 shares in my divisor. Would anything else change? Sure. Now there is no $45,000 preferred dividend. If the preferred was converted to common back on January 1, I don't have to pay anybody a preferred dividend. It can't be common and preferred stock at the same time. It's either common or it's preferred. If we assume it's now common, there's another 30,000 common shares in the divisor, I don't have to pay anybody a preferred dividend, so I'm just back to net income, $980,000. And if you take that net income, $980,000, divide by 120,000 weighted shares, that comes out to $8.17 a share. And you know my thinking. What was earnings per share before I considered the preferred? $10.39 a share. That was the answer to number 36, basic. What's earnings per share when I consider the preferred? $8.17 a share. What we just proved about that preferred, it's dilutive. It's dilutive. It caused earnings per share to go down, so it stays in the calculation. We know the preferred is going to stay in the calculation. Now we're going to test the bonds. We also have some convertible bonds. Now before I test the bonds, before we apply the if converted method to the bonds, I want to emphasize that our new measuring point now is $8.17 a share, not $10.39 a share. In other words, I'm going to test these bonds to see if they bring me below $8.17 a share, not below $10.39, right? See, I now have a new measuring point. I'm going to test these bonds to see if they bring me below $8.17 a share, not below $10.39 a share. That's my new measuring point. And by the way, in terms of the order you test the securities, just test them in the order they give them to you. It should not make a difference. Just test them in the order they give them to you. So now let's test the bonds. As you know, these convertible bonds, they're not automatically dilutive. They are potentially dilutive. So we have to test the bonds to see if they're dilutive or not. How do we do that? The if converted method. Let's apply it. Under the if converted method, we just assume the bonds were converted to stock at the earliest possible point. And that would be January 1 here because they were outstanding all year. So think about it. If the bonds were converted to common at the earliest possible point, January 1, how many more shares would I have in my divisor? Another 20,000. Wouldn't my divisor go from 120,000 up to 140,000, right? Would anything else change? Sure. If the bonds were converted to stock back on January 1, now I'd have no interest expense on my income statement. I don't have to pay anybody any interest. There'd be no interest expense on my income statement because it can't be bonds and stock at the same time. If the bonds were converted to stock back on January 1, I don't have to pay anybody any interest. So what I have to do now is add that interest back to my net income. And I have to add it back net of tax because interest is deductible for tax purposes. So let's work it out. The interest rate on the bonds here is 10%. I'm going to take the 10% times the million. Let's agree the bonds paid $100,000 in interest. 10% of a million. But I'm going to add it back net of tax. Interest is deductible for tax purposes. So because they have a 40% tax rate, I add back 60% of the interest, or $60,000, to my net income. By the way, that's always a function of 100. If the tax rate is 34%, add back 66% of the interest, right? It's always a function of 100. If the tax rate is 32%, add back 68% of the interest. In this case, the tax rate is 40%, add back 60% of the interest, or $60,000. So if you take the net income, $980, add back that interest, net of tax, $60,000. Now the income is $1,040,000. Divide by 140,000 weighted shares. That comes out to $7.43. And you know what my thinking is. What was earnings per share before I considered the bonds? $8.17 a share. What's earnings per share when I consider the bonds? $7.43 a share. What we just proved about those bonds, they are dilutive. They caused earnings per share to go down. They stay in the calculation, and the answer is D. I hope you follow that if converted method. Now, another point. You may have noticed that I keep using a phrase, and it may be something you've been thinking about. I keep using the phrase, assume the bonds were converted to stock at the earliest possible point. I keep saying that, don't I? You assume the bonds were converted to stock at the earliest possible point. At the earliest possible point. Here the bonds were outstanding for the entire year, so that was easy. January 1. Let me ask you a question. What if the convertible bonds had been issued on July 1? Think about this, please. What if the bonds had been issued on July 1? When is the earliest they could have been converted? July 1. So those extra 20,000 shares in the divisor would have to be weighted at a half. Be careful. You assume the bonds are converted to stock at the earliest possible point. So if the convertible bonds had been issued on July 1, the earliest they could have been converted is July 1. So you'd have to weight those extra 20,000 shares in the divisor at a half, and, right, in the numerator, only add back a half a year's interest, net of tax. Only a half a year's interest. So dates do matter there. So that's why I keep saying you assume the bonds were converted to stock at the earliest possible point. It's not necessarily January 1. If the convertible bonds had been issued on July 1, then the earliest they could have been converted is July 1. So those extra 20,000 shares in the divisor would have to be weighted at a half. And I'd only, in the numerator, add back a half a year's interest. So always be careful of dates as well. Well, that concludes our discussion on stockholders' equity and partnership accounting and foreign operations and ratio analysis from all of us at the Bisk Review. We want to wish you the best of luck on the exam. Study hard.
Welcome to CPA Ready, comprehensive review materials for the computer-based CPA exam that lets you customize your own review program to meet your individual learning style and ensure your success. Thank you for selecting this hotspot video, which contains a targeted, intensive review of the specified topic area. We hope you find this video to be an effective tool in your CPA exam preparation. Bisk Education.
Hello, and welcome to the Bisk CPA Review's coverage of the Financial Accounting and Reporting section of the CPA exam. My name is Bob Manette, and I'll be your instructor for this class. And in this class, we're going to be covering a very important topic, and that is how you prepare a statement of cash flows. And as you'll see as we go through this, statement of cash flows makes a great multiple choice question, and it certainly has the potential to be a simulation as well. So going into the exam, you've got to be ready for this topic. You have to be comfortable with how you prepare a statement of cash flows. Before we begin, let me just give you some quick advice about the best way to use this class. The important thing is to treat this like any other class. Take good notes. Really participate. Try to avoid sitting back passively and just watching the class. Do problems with me. There'll be times in the class where I'll ask you to shut the class down, solve the problem, get your answer before you come back and we solve the problem together. And I really want you to do those things. And I think you'll find that if you do these things, you'll get the most that you can from this class, and that's certainly what we both want. So with that said, let's get into how you prepare a statement of cash flows. Let's dive right in. A statement of cash flows has three separate and distinct sections. Let's go over them. Section number one would be cash flows from operating activities. That's cash flows from operating activities. And you want to always think of this as your income statement section. That's what this is. It is your income statement section. My point is, as you go through a problem, if you see any item that affects revenues, expenses, gains, losses, right away you think of this section because it is your income statement section. It's cash flows from operating activities. Now, there's also one more thing that goes in this section, and it's important that it's in your notes, and that is if a company buys or sells trading securities, that's cash flows from operating activities. Let's go to the second section. The second section is cash flows from investing activities. Now, what goes in here? Several things. First, if a company buys or sells held-to-maturity securities, buys or sells available-for-sale securities, that's cash flows from investing activities. Again, if a company buys or sells held-to-maturity, buys or sells available-for-sale securities, that's cash flows from investing activities. There's more. If a company buys or sells property, plant, and equipment, that's cash flows from investing activities. And one more thing. If a company buys or sells equity investments, that's cash flows from investing activities. Now, what I'm going to say next is probably obvious, but let me quickly say this. Very often, what the exam is testing in multiple choice in this topic is whether or not a student is comfortable about where cash belongs in the statement. And one of the things I want us to accomplish in this class is to make that as automatic as possible. So I'm going to give you a memory tool here. And it might sound silly, but it works. Just remember, investing always makes you happy. H-A-P-P-E-E. Investing always makes you happy. H-A-P-P-E-E. You see what it stands for? If I buy or sell held to maturity, H. Buy or sell available for sale, A. If I buy or sell PP&E, property, plant, and equipment, or I buy or sell equity investments, that's when I go to this section, because investing always makes me happy. Just a quick way to remember what goes in that section. The third section is cash flows from financing activities. Now, what goes in here? Several things. First thing you want to remember is debt principal. If a company borrows debt principal, that's cash provided by a financing activity. If the company pays down debt principal, that's cash used in a financing activity. Well, there's more. If a company pays a dividend, I don't care if they pay a dividend on common stock, if they pay a dividend on preferred stock. When a company pays a dividend, that's cash used in a financing activity. If a company issues stock, if they issue common stock, if they issue preferred stock, that's cash provided by a financing activity. And one more thing, don't forget treasury stock. If a company buys treasury shares, that's cash used in a financing activity. If they sell off treasury shares, that's cash provided by a financing activity. That's what goes in this section. Now, I'm going to give you a memory tool on this one as well, because as I say, we want this to be automatic. Now, we already know investing makes you happy. Buy or sell held to maturity, buy or sell available for sale, buy or sell PP&E, buy or sell equity investments. That's when I go to that section. Well, just remember, you're always financing for Prince divots. Oh yeah, you're always financing for Prince divots. Prince is debt principal, div is paid dividends, I is issue stock, and TS is treasury stock transactions. So investing makes you happy, but you're always financing for Prince divots. You have to know where cash belongs in the statement. Now, once we get that down, now we're ready to attack a problem. Now, before we start the problem, there's something else we need to say. And that is that there are two acceptable methods of preparing a statement of cash flows. There is the direct method and there is the indirect method. You have to know this. There are two acceptable methods of preparing a statement of cash flows. We've got the direct method and we also have the indirect method. And I want this clear in your notes. The direct method is theoretically preferred. And they could ask you that. The direct method is theoretically preferred, but I want you to listen carefully. Even though the direct method is theoretically preferred, and it is, the CPA exam has tested the indirect method far more often. That might seem odd, but that's just a fact of the matter. That even though the direct method is theoretically preferred, the CPA exam has tested the indirect method far more often. And I'll tell you why that is. What you're going to see later in this class is that when they talk about the direct method, it's not really a different method of solving statement of cash flows. The direct method is really just a presentation difference. You'll find in the direct method, one of the sections, operating activities, gets presented differently. I honestly don't think of it as a different method. It's really just a presentation difference because one of the sections, operating, gets presented differently. But let me make my point. There's only one method of breaking down a statement of cash flows problem, and that is the indirect method. So let me put it this way. When you're in the exam, the only time you're going to worry about the direct method is if the CPA exam specifies, solve this problem under the direct method. That's the only time you have to worry about it. If they say, solve this problem under the direct method, then you'll worry about it. But if they're silent, what would you do? You'd solve the problem under the indirect method, because that's really the only method of breaking the problem down. And you'll worry about the direct method if they specify, and we'll look at the direct method in more detail later on in this class. But my point is, I want to begin by going over the indirect method. And I'll tell you what my personal goal is in this class. My personal goal is to show you a technique. And I'm not exaggerating when I tell you that this technique is foolproof. You know, once you get it down, it takes a little getting used to, but when you get this technique down, it's really a good method to know, because if you get this technique down, I don't care how they test this. I don't care whether it's multiple choice or a simulation. You can always break it down. It is a very valuable technique to have down. And I'll tell you that my technique involves two things. It involves two of my favorite things, journal entries and T accounts. That's how we're going to break cash flows down. Let's go to some questions. If you look in your viewer's guide, you will see Farrell Corporation. And that's the problem we're going to be working on. And you'll see in Farrell Corporation, we're given comparative balance sheets at the end of year 4 and the end of year 5. Now, the first thing we're going to do, step 1, go right to cash. Notice in the last year, cash went from $180,000 to $275,000. So in the last year, cash has increased by a $95,000 debit. And you want to make note of that. Hey, in the last year, cash has increased by a $95,000 debit. And I'm sure you know this. When we're done with our statement of cash flows, it has to prove why cash increased by a $95,000 debit. In other words, this is one of those odd accounting problems where you start by knowing the answer, because your statement has to prove why cash increased by a $95,000 debit. So they give us the comparative balance sheets. On the next page, we have the statement of income and retained earnings for Farrell for the year ended December 31, year 5. And also there are 6 bullets of additional information. All right, so when you're faced with a problem like this, and of course, this could be a simulation. There's a lot going on here. This is detailed enough where it's more like a simulation. There's so much that has to be done here. And when you're faced with something like this, as I said, I like you to use my technique, which involves journal entries and T accounts. So the first thing we're going to do, right off the bat, is set up 3 big T accounts. And I'm sure you guess what they are. We're going to set up a T account for operating activity. And right in the heading, you can put I/S. That's your income statement section. As I say, you're going through a problem, you see any item that affects revenues, expenses, gains, losses. Right away, you think of this section because it is your income statement section, cash flows from operating activities. The second T account, investing activities. And you can put right in the heading, happy. Always makes me happy. Buy or sell held to maturity. Buy or sell available for sale. Buy or sell PP&E. Buy or sell equity investments. That's when I go to that section. And then finally, financing activities. And I'm always financing for Prince dividends. Prince is debt principal. Div is pay dividends. I is issue stock. TS is treasury stock transactions. So you get those 3 big T accounts set up. So you have those set up. Now what's the next step? Now you put down a small T account. For every account they give you in the balance sheet, except for cash, and put the net change in each one of those accounts. So that's my next step. Now we're going to put down a small T account for every account they give us in the balance sheet, except for cash, and put the net change in each one of those accounts. And you see what we're about to do. What we're about to do is explain the change in cash by looking at the net changes in all the other accounts except for cash, because that's where the answer has to be. True? You have to look at the net changes in all the other accounts except for cash to explain the change in cash. All right, so if you look in your viewer's guide, we've set up all those T accounts for you, but we have to put the change in each account. Let's start with accounts receivable. In the last year, accounts receivable went from $305,000 down to $295,000. That is a net $10,000 credit decrease to that account. So what you want to do is put a $10,000 credit change in that account and double underline it, because that account changed by, it went down by a credit of $10,000. So put that $10,000 credit change in that account, double underline that. Inventory went from $431 to $549. Well, that's a net debit increase to that account of $118,000. So put that $118,000 debit increase in that account, double underline that. Investment in Hall under the equity method went from $60,000 a year ago up to $73,000. That's a net debit increase to that account of $13,000. Double underline that. Land went from $200,000 to $350,000. That's a net debit increase to that account of $150,000. Plant and equipment went from $606,000 to $624,000. That's a net debit increase to plant and equipment of $18,000. Put that debit change in that account. Double underline that. Accumulated depreciation went from $107,000 up to $139,000. That's a net credit increase to that account of $32,000. So put that $32,000 credit change, that credit increase in that account, double underline that. Goodwill went from $20,000 down to $16,000. That's a net credit decrease to that account of $4,000. We double underline that. Accounts payable, we have to do them all. Accounts payable and accrued expenses went from $563 up to $604. That's a net credit increase to that account of $41,000. Notes payable went from nothing up to $150, a net credit increase of $150,000. Bonds payable went from $210 down to $160. That's a net debit decrease to that liability of $50,000. Deferred tax liability went from $30,000 up to $41,000, a net credit increase of $11,000. Common stock increased by a credit of $30,000. APIC increased by a credit of $51,000. Retained earnings increased by a credit of $98,000. And then finally, treasury stock. It's a little tricky. Treasury stock, remember, gets reported on a balance sheet as a debit in stockholders' equity. That's why there's a bracket around that $17,000 at the end of year 4, because it's a debit in stockholders' equity. It's a reduction of stockholders' equity. Remember, treasury stock is a contra-equity item. That's why there's brackets around it. So what happened in the last year is that went from a debit in stockholders' equity down to nothing, down to zero. So that would be a credit decrease to that account of $17,000. So put that credit change in that account and double underline that. All right, so we've got that step done. So what are my steps so far? What was the first thing we do? Find the change in cash, because that's what we're proving out to. And we know right off the bat that in the last year, cash increased by a $95,000 debit. Always good to have that in your mind. What's the second step? 3 big T accounts. One for operating, one for investing, one for financing. And then my third step, I put down a small T account for every account they gave us in the balance sheet, except for cash, and put the net change in each one of those accounts. So we have done that. Now, I know you're with me. We haven't started our analysis yet. All we've done is set up this simulation preparing for our analysis. Now we're going to begin our analysis. And let me say that there is a way that I always begin an analysis of cash flows, and you don't have to start this way. And I'll quickly say that no textbook is going to tell you that you have to start this way, because you don't. But I want you to trust me that this is the most logical place to start. Really, the best way to start your analysis is to prove out the retained earnings. So let's do that first. Let's prove out the retained earnings. If you look at your T account, we know in the last year, retained earnings increased by a $98,000 credit. We've double underlined that. That was the net increase to retained earnings. Can we prove that out? Let's prove that out. If you go to the second page of this problem, we have the statement of income and retained earnings. I want you to find the net income for the year for Farrell. Notice the net income for the year for Farrell was $141,000. So let's post that. I'm going to go to my first big T account, which is operating activity. This is income statement. That's my income statement section. I'm going to go to my first big T account, operating activity, and I'm going to put that $141,000 net income in as a debit to that account. Now, why is it a debit? Because what you're going to see as we go through this is that in your 3 big T accounts, operating, investing, and financing, the debit side is provided, the credit side is used. Always remember that. In your 3 big T accounts, operating, investing, and financing, think of the debit side as provided, the credit side as used. And the point is, net income provides cash from operations, doesn't use it. So we're going to put net income in, the $141,000, as a debit to operating activity. And what was the credit? Presumably to retained earnings. Net income would have been posted as a credit to retained earnings of $141,000. So you want to put that in your T account. Make sure you're doing this problem with me, step by step. So that $141,000 of net income would be credited to retained earnings. All right, now let's find the dividend. If you go back to page 2, towards the bottom of the statement of income and retained earnings, you see there was a cash dividend paid August 14th, year 5, of $43,000. Now remember I said that my technique really involves two things: T accounts, journal entries. Now we've got all our T accounts. We've got those all set up. And the habit I'm in, I always make the dividend my first journal entry. When I see that dividend, I have to assume that Farrell would have made the normal entry. They would debit retained earnings, $43,000. Remember, dividends come directly out of retained earnings. They're not on the income statement. They come directly out of retained earnings. So I'm going to debit retained earnings, or they would have debited retained earnings, $43,000, and credit cash, $43,000. I'm assuming they would have made the normal entry for a dividend. Now, what's the first thing you notice about that entry? Oh, there's cash. The minute you see cash in any entry, it has to go somewhere. It's either operating, investing, or financing. So here's my question. What kind of cash is that $43,000? Is it operating? No. Is it happy? No, it's not happy. It's prints divots. Remember, the div in divots is pay dividends. So we're going to go to our third big T account, which is financing activity, and we're going to post that $43,000 credit right there. The fact is, that's $43,000 of cash used in a financing activity. We're always financing for prints divots. Prints is debt principal. Div is pay dividends. I is issue stock. TS is treasury stock transactions. So we posted that dividend. Now I want you to find the net income for the year. We know the net income was $141,000. That's been posted. We know that the dividend, we've taken care of that. Look at your retained earnings T account. Have we proven why retained earnings increased by a net credit of $98,000? We have, because net income would have caused retained earnings to go up $141,000. The dividend would have caused retained earnings to go down $43,000. Haven't we proven why retained earnings increased by a net credit of $98,000? Put an X through it. That's kind of the process. Once we've proven the change in an account, you want to exit out. You never want to look at it again. And as I said, I think that proving out retained earnings is the most logical place to begin. You don't have to, but I think it is sensibly where you should start your analysis of cash flows. All right, so we've done that. Now what's my next step? Now we go down the additional information. There are 6 bullets of additional information. And we're going to put down a journal entry for every transaction they describe. I think it's always good to start with an entry to get you organized. Let's look at the first bullet. They say on January 2nd, year 5, Farrell sold equipment costing $45,000 with a book value of $24,000 for $19,000 cash. Well, let's put an entry down. We know they would have debited cash, $19,000. We know they would have credited the equipment for its original cost, $45,000. And because they said the equipment has a book value of $24,000, presumably there's what? There's $21,000 of accumulated depreciation on that equipment. If the original cost is $45,000, but book value is $24,000, there must be $21,000 of accumulated depreciation on that equipment. So I'm going to debit accumulated depreciation, $21,000. Notice the entry doesn't balance. We need a $5,000 debit to balance the entry out. That's because there was a loss on sale. So you get the entry down. Now, what is the first thing you notice about that entry? Well, there's cash. The minute you see cash in any entry, it has to go somewhere. What kind of cash is that? Is it operating? No. Is it happy? It is. It's PP&E. So we're going to go to our second big T account, which is investing activity. And we're going to post that $19,000 debit right there. The fact is, that is cash provided by an investing activity. Investing always makes me happy. Buy or sell, held to maturity. Buy or sell, available for sale. Buy or sell, PP&E. Buy or sell, equity investments. So when I go there, let's post the rest of it. I go to plant and equipment. I post that $45,000 credit. Have we explained the change in that account? No, we leave it open. There's still more to do. I go to accumulated depreciation. I post that $21,000 debit to accumulated depreciation. Have we explained the change in accumulated depreciation? No. We have more work to do. How about the loss on sale? Oh, that's an income statement. That goes to operating. Remember, once you put an entry down, Everything gets posted somewhere. That's the thing about cash flows. You have to be meticulous. It's the kind of, if you forget to post something, it's going to mess you up. So remember, that's when you start with an entry, and everything in that entry has to be posted somewhere. The loss would be posted, of course, as a debit to operating activity. Now, you say, well, Bob, why are we doing this? Well, the reasoning behind that going to operating is simply this. When we're all done, what that operating section is going to do, what that operating T account is going to do is convert income on the accrual basis to income on the cash basis. That's the purpose of the operating T account, really to convert net income from the accrual basis to the cash basis. And the point is that loss did not require the outlay of cash. Another way to look at this, you can't show this both as a loss on your income statement and also $19,000 cash provided by an investing activity. You'd be double counting it. So that's another thing that's going on there. You can't show this both as a loss on your income statement and $19,000 of cash provided by an investing activity. You'd be double counting it. But you don't have to worry about all that. Don't worry about remembering all that reasoning. Just post it. Get an entry down, and everything in the entry has to be posted somewhere. Let's do another one. Second bullet. On April 1, year 5, Farrell issued 1,000 shares of stock for $23,000 cash. Well, we have to assume they'd make the normal entry. They would debit cash, $23,000. They would credit common stock for par value. And if you look at the balance sheet, the par is $10 a share. So credit common stock for 1,000 shares at $10 a share, or $10,000, and credit APIC, additional paid-in capital, for the rest, $13,000. What's the first thing you notice about that entry? There's cash. It's got to go somewhere. So help me on this. What kind of cash is that? Is it operating? No. Is it happy? No. It's Prince Divots. Remember, the I in its is issue stock. So we're going to go to our third big T account, financing activity, and we're going to post that $23,000 debit right there. That is cash provided by a financing activity. We're always financing for Prince Divots. Prince is debt principal. Div is paid dividends. I is issue stock. TS is treasury stock transactions. Let's post the rest of it. We're going to go to common stock and post a $10,000 credit to common stock. Have we explained the change in common stock? No, we haven't. So leave it open. We have more work to do. We're going to go to APIC, post a credit of $13,000. Have we explained the change in APIC? No, we haven't. Leave it open. Let's do another one. Third bullet. On May 15th, Farrell sold all of its treasury stock for $25,000 cash. They sold all of their treasury stock, all of it, for $25,000 cash. So what's the entry? Well, of course, you're going to debit cash, $25,000. What should I credit to treasury stock? Well, don't we know, if you look at your T account, that the treasury stock account went down by a credit of $17,000. This must have been the transaction because they sold it all, so they must have credited treasury stock $17,000 because we know that account dropped by $17,000. They sold all of it. And I'm hoping you remember this. Anytime there's a gain indicated in any type of treasury stock situation, what do we always credit? APIC. They would have credited APIC for $8,000. Anytime there's a gain indicated in any type of treasury stock situation, it's always a credit to additional paid-in capital, in this case for $8,000. So, of course, the first thing we notice about this entry is cash. It's got to go somewhere. Is it operating? No. Is it happy? No, it's Prince Divots. The TS on Divots is treasury stock. So you go to your financing T account, post that $25,000 debit because we know that's $25,000 of cash provided by a financing activity. Let's post the rest of it. We go to treasury stock. We post that $17,000 credit. That explains the change in that account. Just exit out. Don't want to look at it again. Go to APIC. Post that $8,000 credit. Have we explained the change in APIC? No. We have more work to do. Let's do another one. Fourth bullet. On June 1, year 5, individuals holding $50,000 face value of Farrell's bonds exercised their conversion privilege. So what we have here are some convertible bonds. Each of the 50 bonds was converted into 40 shares of stock. So that's the conversion ratio. Every bond you turn in, you get 40 shares of stock. So how many shares are going out? Well, 50 times 40, 2,000 shares of stock are going out, right? 50 bonds came in. The conversion ratio is 40 to 1. 40 times 50, 50 bonds came in. The company issues 2,000 shares of stock. So as always, let's start with the entry. We know that if you're Farrell, you would debit bonds payable for $50,000. The bonds are turned in. They're legally retired. That debt is retired. So you're going to debit bonds payable $50,000. You're going to credit common stock for the 2,000 shares at par 10, $20,000, and credit APIC for the rest, $30,000. Now, I don't know how much you recall about convertible bonds at this point. I don't want to dwell on it, but there are two ways you can do convertible bonds. There's the book value method, there's the fair value method. I know they didn't want the fair value method here because I don't know the fair value of the stock. I mean, in case you thought of that issue, we don't know the fair value of Farrell stocks. We couldn't have used the fair value method anyway, so I just used the book value method, where we get rid of the debt, debit bonds payable $50,000, and we issue the stock. Credit common stock for 2,000 shares at par 10, $20,000, and credit APIC for the rest, $30,000. Now, when you look at that entry, the first thing you notice, there's no cash. There's no cash. Do I post it? Yes. Everything gets, when you put an entry down, everything gets posted. Otherwise, you're going to mess things up. So even though it doesn't involve cash, it's got to be posted. So let's post it. We're going to go to bonds payable. Post that $50,000 debit to that account. Have we explained the change in bonds payable? Yes, we have. Exit out. Don't want to look at it again. Go to common stock. Post that $30,000 credit. Have we explained the change in common stock? We have. Exit out. Go to APIC. Post that $30,000 credit. Have we explained the change in APIC? We have. You can X that out as well. We can do another one. The fifth bullet down. On July 1, year 5, Farrell purchased equipment for $63,000 cash. So we assume they made the normal entry. They would debit equipment for $63,000 and credit cash $63,000. Well, there's cash involved. Is it operating? No, it's happy. It's PP&E. So we go to our second big T account, investing. We post that $63,000 debit right there. Excuse me, that $63,000 credit. That is cash used in an investing activity. Have we explained the change in plant and equipment? We have. Now we've explained it. Exit out. Don't want to look at that again. Because when we post that $63,000 debit to plant and equipment, we have now explained the change to plant and equipment. We can X that out. And the $63,000 cash, as I say, is a credit to investing activity because it's PP&E. That's cash used in an investing activity. The final bullet. On December 31, year 5, land with a fair market value of $150,000 was purchased through the issuance of long-term debt, a long-term note in the amount of $150,000. Note bears interest at 15%, is due in 5 years, and all of that. Well, what's the entry? Well, if you buy land by issuing a note, you're going to debit land, in this case $150,000, and credit notes payable $150,000. Now, once again, notice it doesn't involve cash. Now, I'm going to say more about these later, but what this represents is a non-cash investing and financing activity. That's what this is. Notice no cash is involved. It was a straight exchange of debt for property. That's what this is. It's a straight exchange of debt for property. It's what they would call a non-cash investing and financing activity. And we'll talk about these later, but this non-cash item, it's not in the statement of cash flows. It gets footnoted at the bottom of the statement as a supplemental disclosure. So that's what this is going to be. It's a supplemental disclosure. I'll say more about that later. But even though it's not in the body of the statement, we have to post it. You put an entry down, everything gets posted somewhere. So we're going to go to land. Post that $150,000 debit. To land, we've explained the change in land. Exit out. We go to notes payable. We credit notes payable for $150,000. We've explained the change in notes payable. We exit out. We don't want to look at that again either. So my point is, Now we are done with the additional information. Now, once you're done with the additional information, there's only one step left. What I want you to do is circle, right in your viewer's guide, circle all the accounts we have not explained. That's what I want you to do. Circle all the accounts you've not explained. Take a moment to do that, and then we'll do the final step. Now, if you have circled all the accounts that we have not explained, you should have 7 that we have not explained. Accounts receivable, inventory, investment in Hall, accumulated depreciation, goodwill, accounts payable, and deferred tax liability. There are 7 accounts we have not explained. Now, before I show you the way I'd like you to do this last step, and I hope this is clear, once we've explained all the accounts, we're basically done. And before I show you this last step, I want to quickly say that there are good, solid accounting reasons for everything we're about to do, and I'm not going to dwell on the reasons why, because some of them get involved, and to me, if you just do this in a mechanical way, in other words, if when we're done with this class, your basic thinking is, well, if there's a debit here, I credit this. If there's a credit here, I debit that. That's fine. I want you to know that I have deliberately chosen a method that is somewhat mechanical. Now, why do you think I did that? Because I'm always afraid that you could be in the exam, you have perhaps a simulation to do on this, and time is short. I'm always worried about timing of the exam. And that's one of my main concerns, that you have perhaps a simulation to do on cash flows, you're a little bit short on your time. So I'm trying to show you a technique that, as I say, is somewhat mechanical so that you can do it more quickly. So if at the end of all this, you just do this in a mechanical way, that's no problem at all. Let me show you the mechanical approach. The first item, accounts receivable. Now, you have to look at each item and ask, well, is it an operating item? Is it an investing item? Is it a financing item? Because when you get to the end and you have these accounts that have not been explained, you could have operating items that have not been explained, investing items that have not been explained, financing items that have not been explained. Here they happen to all be operating, but that's unusual. You could have all 3 types. Here they're all operating. But anyway, you look at the first item, accounts receivable. It's an operating item. It has to do with sales and getting the cash sales. But here's the mechanical approach. Since accounts receivable went down by a credit of $10,000, then we're going to go to operating and do the opposite. See, at the end, you just do the opposite. I'm going to debit operating, $10,000. Just do the opposite. Accounts receivable went down by a credit of 10, go to operating, debit operating, 10. Inventory. It's an operating item. Has to do with cost of goods sold. Inventory increased by a debit of 118. It increased by a debit of 118,000. I go to operating, I do the opposite. Credit operating, 118,000. Investment in Hall under the equity method. You might be, well, Bob, isn't that the E on happy? Buy or sell equity investments? Got to be careful. They didn't buy or sell an investment in Hall. Why did investment in Hall go up 13,000? Because Farrell picked up their share of Hall's income. In other words, they must, if you remember the equity method, they must have debited investment in Hall and credit equity and sub-earnings, 13,000. And if you look on page 2 in the problem, look on the statement of income, you'll see that equity in the earnings of Hall is there. So that, remember, the E in happy, the second E in happy, is buy or sell equity investments. They didn't buy or sell an equity investment here. They picked up their share of sub-income. So investment in Hall increased by a debit of 13,000. Go to operating, do the opposite. Credit operating, 13,000. And I think you see the reasoning there. There wasn't any cash. We just simply picked up our share of sub-income. We didn't get the cash. So it has to be backed out. As I said earlier in the class, what the first big T account does, operating, is convert income on the accrual basis to income on the cash basis, and the fact is we didn't get that cash. Not yet. So that's going to be a credit to operating, 13,000. Now, accumulated depreciation. The reason this is an operating item is we have to find the depreciation expense for the year. Do this analysis with me. Don't we know that accumulated depreciation increased by a net credit of $32,000, right? That was the bottom line. During the year, accumulated depreciation increased by a net credit of $32,000. And yet, all we saw in our journal entries was a debit to that account of $21,000. My point is this: the only way that account could have increased by a net credit of $32,000, we infer there had to be another credit in that account to make it balance of $53,000. Let me go over that again. I know accumulated depreciation increased by a net credit of $32,000 during the year. We had double underlined that. All we saw in our journal entries was a debit to that account of $21,000. There had to be another credit in that account. For it to increase by a credit of $32,000, there must have been another credit in that account of $53,000. That must have been the depreciation expense for the year. So because that's a credit to accumulated depreciation of $53,000, go to operating, do the opposite. Debit operating, $53,000. We're adding back the depreciation expense because it didn't involve the outlay of cash. I'm sure you know that when you debit depreciation expense, you don't credit cash. You credit accumulated depreciation. It is an expense that does not require the outlay of cash. Now, I know you might be saying, well, Bob, if you look on page 2 and you look at the income statement, they gave you the depreciation expense for the year. It was $53,000. I know that, but very often they don't give it to you. That's why I showed you how to find it. Because very often in the exam, they want you to find the depreciation expense. In this problem, it turns out they gave it to us. It is on the income statement. You can see it. But as I say, so often in the exam, they won't tell you the depreciation expense for the year, so you have to find it. I want to make sure you know how to do that. How about goodwill? Why did goodwill go down by a credit of $4,000? Amortization? Did goodwill go down by $4,000 because of amortization? Well, I hope you remember, goodwill is not amortized. It's tested for impairment, at least annually. If goodwill went down by $4,000, there must have been an impairment loss on the income statement. Again, we don't amortize goodwill. We test it for impairment, at least annually. And if goodwill went down by $4,000 by a credit, it must be because there was an impairment loss on the income statement. So that was a credit to goodwill of $4,000. Go to operating, do the opposite. Debit operating, $4,000. Accounts payable. It's an operating item because it has to, again, to do with figuring out cost of goods sold. Accounts payable increased by a credit of $41,000. Go to operating, do the opposite. Debit operating, $41,000. And then finally, deferred tax liability. Deferred tax liability increased by a credit of $11,000. Go to operating, do the opposite. Debit operating, $41,000. Excuse me, in this case, $11,000. You would debit operating $11,000. Again, deferred tax liability increased by a credit of $11,000. You're going to go to operating, do the opposite. Debit operating, $11,000. And of course, the reason we're doing that is because not all their income tax was paid in cash. Some of it was deferred. So the deferred portion gets added back. As I said, there are good, solid accounting reasons for everything we're doing. But the mechanical approach is just fine, too. Hey, deferred tax liability went up by a credit of 11. Go to operating, debit operating, $11,000. And as I say, the reason you're doing that is because not all their income tax was paid in cash. Some of it they deferred. So the amount that's deferred gets added back. All right, so if you add it all up, now you have all the information in your T account, it turns out that cash provided by operating activity, if you add it all up, was a $134,000 debit. Remember, the debit side is provided, the credit side is used. And the net cash provided by operating activity is $134,000. Look at investing activity. We had $19,000 cash provided by selling equipment, $63,000 cash used to buy equipment, net cash used in investing activity, $44,000. How about financing activity? We had $43,000 cash to pay a dividend, $23,000 cash provided by selling stock, $25,000 cash provided by selling treasury stock, net cash provided by financing activity, $5,000. Now, if you look at the next page, you'll see the actual statement of cash flows for Farrell. And I want to show you this because if in the exam, perhaps in a simulation, you actually had to do the statement of cash flows or fill it in, you just take the information right out of the T account. Look at the first section, cash flows from operating activities. We start with the net income, $141,000. We add back the decrease in receivables. We take out the increase in inventory. We add back the increase in payables. We add back the depreciation expense. We add back the impairment of goodwill. We add back the loss in the sale of equipment. We subtract the equity and earnings of sub. We add back the increase in deferred tax liability. Net cash provided by operating activity right out of your T account, $134,000. So if you actually had to do the statement or fill in the statement, you have all the information you need in your T account. Cash flows from investing activities. We have proceeds from the sale of equipment, $19,000. Payments to acquire equipment, $63,000. Net cash used in investing activity, $44,000. And then finally, cash flows from financing activity. We have proceeds from the issue of stock, $23,000. Proceeds from the sale of treasury stock, $25,000. And a cash dividend paid of $43,000. Net cash provided by financing activity, $5,000. And did you notice this? If I take a $134,000 debit and a $44,000 credit and a $5,000 debit, what's it all come out to? A $95,000 debit. And didn't we know when we started the problem that cash increased by a $95,000 debit? Notice it does reconcile. If you take a $134,000 debit, a $44,000 credit, and a $5,000 debit, it all does come out to a $95,000 debit. And wasn't that the change in cash for the year? So it does reconcile. And then the way you finish the statement, you show cash and cash equivalents January 1, and then cash and cash equivalents December 31. So if you actually have to do the statement, or as I say, fill in the statement, well then you just go right to your T accounts. You have all the information that you need. All right, now I think it's important that you get some practice on this technique. And in your viewer's guide, you'll see Dice Corporation. I want you to try that on your own. Now you notice there's 3 questions you have to answer. We have to know the cash provided by operating activity. We have to know the cash used in investing activity, the cash provided by financing activity. So I want you to shut this class down. Give yourself, don't try to do this in 2 minutes. You have to get used to this technique. Give yourself 15 minutes, maybe 20 minutes. See if you can answer those 3 questions, and then come back, and we'll go through it together. Welcome back. Let's turn our attention to the set of questions on Dice Corporation. And I really hope that you did what I asked, that you took the time, 15, 20 minutes, to try the technique that we've gone over and try to come up with the answers yourself. You'll find that the more you work with this technique, of course, you get more comfortable with it, and it might be a lot faster than you think that it is when you first see it. You might think it's slow, but when you get used to it, it's also a fairly quick technique as well. All right, what's the first thing you do with Dice? Well, they gave you comparative balance sheets. You go right to cash. Notice in the last year, cash went from $100,000 to $230,000. So we know in the last year, cash has increased by a $130,000 debit. And as you know, it's good to know that because that's what our statement of cash flows has to prove out to. Why did cash increase by a $130,000 debit? Now, the next step is to put down your 3 big T accounts. One for operating, that's your income statement section. One for investing, hey, investing makes you happy. And one for financing activity. You're always financing for Prince Divots. You get those 3 big T accounts set up. The next step, you put down a small T account for every account they gave you in the balance sheet, except for cash, and put the net change in each one of those accounts. So let's do it. Accounts receivable. No, the first one is available for sale securities. Available for sale securities went from nothing a year ago up to $300,000. So there's been a net debit increase to that account of $300,000. You put that $300,000 debit change in that account, double underline it. Accounts receivable. Notice that there was no net change to accounts receivable during the year. The net change was 0. Because there was no net change, we're not even going to set up a T account for it. Inventory went from $600,000 to $680,000. That is a net debit increase of $80,000 to that account. Held to maturity securities went from $300,000 down to $200,000. That's a net credit decrease to that account of $100,000. Plant assets went from $1 million to $1.7 million. That is a net debit increase to that account of $700,000. Now, if you look at accumulated depreciation, there was no net change to accumulated depreciation. But even though there was no net change to accumulated depreciation, we are going to set up a T account for it. Because as you're going to see fairly soon, and as I'm sure you did see, there's some activity in that account. So we're going to set up a T account for accumulated depreciation, but there was no net change. Goodwill went from $100,000 down to $90,000, a net credit decrease to that account of $10,000. Accounts payable went from $720,000 to $825,000, a net credit increase of $105,000. Short-term debt went from nothing to $325,000. That's a net credit increase to that account, $325,000. And then finally, common stock increased by a credit of $100,000. APIC increased by a credit of $120,000, and retained earnings increased by a credit of $450,000. So hopefully you got all those T accounts set up. Now you're ready for your analysis. And I hope you remembered where I think you should start your analysis, by proving out the retained earnings. Let's do that first. It's the logical place to start. Go to the additional information. They said net income for the year was $690,000. So let's post that. We're going to go to our first big T account, operating activity, and remember we post that in as a debit for net income, $690,000. And you know why it's a debit? Because net income provides cash from operations, doesn't use it. And we go to retained earnings and post that credit of $690,000. Presumably, net income was posted as a credit to retained earnings of $690,000. Next bullet, cash dividends of $240,000 were declared and paid. Well, I like to make that my first journal entry. When I see that dividend, I assume they would have made the normal entry. They would have debited retained earnings, $240,000, credit cash, $240,000. And of course, the first thing we notice about that entry, there is cash. So it's got to go somewhere. So the question is, what kind of cash is that? Is it operating? No. Is it happy? No, it's not. It's prints divots, because the div in divots is pay dividends. So we're going to go to our third big T account, which is financing activity. We're going to post that $240,000 credit, because that's cash used in a financing activity. We're always financing for prints divots. Prints is debt principal, div is pay dividends, I is issue stock, TS is treasury stock transactions. We go to retained earnings. We post that $240,000 debit. Notice we've explained the change to retained earnings, so we can just X that out. We don't want to look at it again. Now we turn our attention to the rest of the additional information, because notice we have proven out the change in retained earnings. We're done with that. So now we want to go down the additional information, one item at a time, put a journal entry down for every transaction they describe, and post everything in those entries. Next bullet says, equipment costing $400,000 with a carrying amount of $150,000 was sold for $150,000. So let's start with an entry. We know they would have debited cash for that $150,000. We know they would have credited equipment for its original cost, $400,000, and if the equipment had a carrying value of $150,000, there had to be $250,000 of accumulated depreciation on that equipment, so we're going to debit accumulated depreciation, $250,000. That's the journal entry they must have made. And notice, there was no gain or loss on sale. Of course, the first thing that's obvious about that entry, there's cash, so we know it has to go somewhere. Is it operating? No, it's happy. It's PP&E. So we go to investing activity. We post that $150,000 debit because we know that's $150,000 of cash provided by an investing activity. We go to plant and equipment. We post that $400,000 credit. We have not explained the change in that account. We leave it open. We go to accumulated depreciation, and we post that debit of $250,000. So now we know there is some activity in that account, and there's going to have to be more activity later because the net change to that account was 0. Let's go to the next one. A held-to-maturity security was sold for $135,000. There were no other transactions that affected held-to-maturity securities. So let's put the entry down. We know they would have debited cash for what they collected, $135,000. What did they credit to investment in held-to-maturity? Well, it must have been $100,000 because if you look at your T account on held-to-maturity, that account did go down by a credit of $100,000, and they said there were no other transactions that affected held-to-maturity securities. This must have been it. So we're going to credit investment in held-to-maturity for $100,000, and the point is we're going to credit gain on sale, $35,000. There was a gain on sale. Now we put that entry down. There is cash. What kind of cash is it? Is it operating? No. It's happy. It's investing, isn't it? Investing makes you happy. And the H in happy is buy or sell, held to maturity. So we're going to go to our second big T account, investing activity. We're going to post that $135,000 debit because that is cash provided by an investing activity. Investing always makes us happy. Buy or sell, held to maturity. Buy or sell, available for sale. Buy or sell, PP&E. Buy or sell, equity investments. And we go there. We go to investment in held to maturity. Post that credit of $100,000. Notice we've explained the change in that account. Wipe it out. We don't want to look at it again. Just X it out. How about the gain on sale? It's an operating item. Go to your operating T account and post that $35,000 credit as a gain. That gain goes to operating. And you know why it goes to operating? Because we can't show this both as a gain on sale on the income statement and $135,000 cash provided by an investing activity. Can't show it in both places. You'd be double counting it. But as I said earlier in this class, you don't have to think all that through. Just post everything. Once you put an entry down, post everything in that entry. Everything's got to go somewhere. The last bullet, 10,000 shares of common stock were issued for $22 a share. Well, we have to assume they would have made the normal entry. They would debit cash for 10,000 shares at 22, $220,000. They'd credit common stock for par value. 10,000 shares at par 10. That's in the balance sheet. That's $100,000. And credit APIC, additional paid-in capital, for $120,000. So once again, you get that entry down. Hey, there's cash. What kind of cash is it? Is it operating? No. Is it happy? No. It's prints divots. The I in its is issue stock. So we're going to go to our third big T account, financing activity. We're going to post that $220,000 debit to that account because the fact is that's cash provided by a financing activity. Let's post the rest of it. We go to common stock. We post that $100,000 credit to that account, and that explains the change in that account. X it out. We go to APIC. Post the $120,000 credit. That explains the change in that account. We can X that out. And the additional information is done. Now, when you get done with the additional information, there's only one step left. Now you circle all the accounts you've not explained. Because, as you know, the last phase, the last step in this technique is to now deal with all the accounts you've not explained, and we're just going to do this in a mechanical way. Let's go to the first one. Available for sale securities. Tell me, operating, investing, or financing? You're right. It's the A in happy. It's investing. So it's an investing item. Don't we know that available for sale securities increased during the year by a net debit of $300,000? So you're going to go to investing, do the opposite. Remember, at the end, do the opposite. I'm going to credit investing $300,000. I'm going to assume that was $300,000 of cash used in an investing activity. Let's go to inventory. Operating, investing, or financing. It's an operating item. It has to do with cost of goods sold. Since inventory increased by a debit of $80,000, I go to operating, do the opposite. Credit operating, $80,000. Held to maturity, well, we've explained that. Now here's an interesting one, plant assets. Don't we know that property, plant, and equipment, plant assets, during the year increased by a net debit of $700,000. That was the net change to that account. But all we saw in our journal entries was a credit of $400,000 to that account. That should be all you have. My point is this. The only way that account could have increased by a net debit of $700,000 is if there was another debit in that account. We infer there must have been another debit in that account of $1,100,000 to make it come out. That's why you need this technique. Because in the exam, they hide things. They play games with you. We didn't know anything about that. We had to find it. That's why the T-account approach, I think, really helps you. Because you're taking an exam. They're not going to be above board about everything. They hide things. You have to find it. So again, all I know is that planned assets increased by a net debit of $700,000 during the year. All we saw in our journal entries was a credit to that account of $400,000. We had to infer there must have been another debit to that account to make it come out of $1,100,000. Is it operating, investing, or financing? Well, you know, it's PP&E. It's happy. It's investing. So that was a $1,100,000 debit to planned assets. Go to investing, do the opposite. We're going to credit investing, $1,000,001. I have to assume that was $1,100,000 of cash used in an investing activity because it's PP&E. All right, now if you look at your investing T account, now we have one. They had $150,000 of cash provided by selling equipment, $135,000 cash provided by selling held-to-maturity securities, $300,000 cash used to buy available-for-sale securities, and $1,000,001 cash used to buy equipment. If you do out the math, the net cash used in investing activity, $1,115,000. So the answer to the second question, number 2, net cash used in investing would be answer B, $1,115,000. You just have it in your T account. Net cash used in investing, $1,115,000. All right, here's another one. Accumulated depreciation. Tell me, is it operating, investing, or financing? It's an operating item. We're trying to find the depreciation expense for the year. Now look at your accumulated depreciation account. Don't we know that the net change during the year to accumulated depreciation was 0? There was no net change to that account. And yet, in our journal entries, we posted a debit to that account of $250,000. The only way the net change to that account could be 0 is there had to be another credit in that account. There had to be a credit in that account of $250,000. We infer that must have been the depreciation expense for the year. So that was a credit to accumulated depreciation, $250,000. Go to operating, do the opposite. I'm going to debit operating, $250,000. So often in the exam, you have to find that depreciation expense. So I hope that made sense to you, because you may be in that position in the exam where you have to, as we did here, infer what the depreciation expense for the year must have been. How about goodwill? Goodwill went from $100,000 down to $90,000. What does that tell you? There must have been an impairment loss. We test goodwill for impairment, at least annually. And if that account went down, there must have been an impairment loss on the income statement of $10,000. It's an operating item. So because goodwill went down by a credit of $10,000, we're going to go to operating, do the opposite. Debit operating, $10,000, because of that impairment loss. Accounts payable went from $720 to $825, a net credit increase of $105,000. Is that operating, investing, or financing? It's an operating item. Again, it has to do with cost of goods sold. So that increase by a credit of $105,000, go to operating, do the opposite. Debit operating, $105,000. And we have another one. If you add it all up, net cash provided by operating activity, $940,000. So the answer to number 1, net cash provided by operating activity, would be answer C. We've got that one. Now, there's only one account left. The only account we have not explained is short-term debt. Short-term debt increased by a net credit of $325,000. Operating, investing, or financing. Is it operating? No. Is it happy? No. It's Prince Divots. It's the prince in Prince Divots. We haven't really seen a lot of that. But if short-term debt went up by a credit of $325,000, we must have borrowed some debt principal. That's the prince in prince divot. It is a financing item. So because short-term debt increased by a credit of $325,000, we're going to go to financing, do the opposite. Debit financing, $325,000. And we have the other one. Net cash provided by financing activity is $305,000. So the answer to number 3 is A. Now, if you're with me on how we arrived at those answers, if you look at the next page, you'll see the actual statement of cash flows for Dice Corporation, and you can see that we just pull the information right out of the T account. If I have to do net cash from operating activities, I've got the net income, $690. I take out the gain on sale of held to maturity. I take out the increase in inventory. I add back the depreciation expense for the year. I add back the goodwill impairment loss. I add back the increase in payable, increase in accounts payable. Net cash provided by operating activity, $940,000. Just take the information right out of your T account if you actually have to do the statement, or fill it in, say as part of a simulation. How about cash flows from investing activity? Again, you take it right out of your T account. We have proceeds from the sale of equipment, $150,000. Proceeds from the sale of held to maturity, $135,000. Payments to purchase available for sale securities, $300,000. Payments to purchase property, plant, and equipment, $1,000,001. Net cash used in investing, $1,115,000. And then finally, cash flows from financing activities, right out of your T account. I have $240,000 cash paid for a dividend. I have $220,000 proceeds from the sale of stock, $325,000 of proceeds from issuing short-term debt. Net cash provided by financing activities, $305,000. And again, you notice, if I take a $940,000 debit and a $1,115,000 credit and a $305,000 debit, it all comes out and nets out to a $130,000 debit. And didn't we know when we started the problem that was the increase in cash for the year? During the year, cash increased by a $130,000 debit. So it does reconcile. And then, as we pointed out earlier, the way you finish the statement is to show cash and cash equivalents January 1, and then cash and cash equivalents December 31. So if you actually have to, as part of a simulation, fill out a statement, just take the information right out of the T accounts. You should be able to fill it in. I want you to get some more practice on this technique. Now I want you to shut the class down and do questions 4 and 5. It's a set of multiple choice questions on cash flows for CAFR Corporation. So please get your 2 answers, come back, and we'll go through them together. Welcome back. Let's do this set of questions on CAFR Incorporated together. And I'm hoping that as you work with this technique more and more, you find that you're getting faster at this technique and more comfortable with it. Now, in this set, they're asking 2 questions. They want to know the cash used in investing activity, and they want to know the cash provided by operating activity. So right away, you set up 2 T accounts. One for investing, and you know investing makes you happy. Buy or sell held to maturity, buy or sell available for sale, buy or sell PP&E, buy or sell equity investments. That's when we're going to go there. You set up a T account for operating activity. And don't forget, what starts off that T account is net income. They gave you the net income for the year, $300,000. And that would go on the debit side because, as you know, net income provides cash from operations, doesn't use it. So you get that set up. Now, what's your next step? Did you remember? Did you know what to do next? You set up a small T account for every account they give you in the balance sheet, except for cash, and put the net change in each one of those accounts. So we only have 3. Equipment increased during the year by a net debit of $25,000. Put that debit change in that account, double underline it. Accumulated depreciation increased by a net credit of $40,000. So put that $40,000 credit increase in that account, double underline it, and notes payable increased by $30,000. So put a $30,000 net credit increase to notes payable. Double underline that for $30,000. So we've done that. Now what do you do next? Are you getting used to the process? That's right. Now you put down a journal entry for every transaction they describe. There's a couple of them here. First, they say, during the year, cars sold equipment costing $25,000. So we know they would have credited equipment $25,000 with accumulated depreciation of $12,000. So we know they would have debited accumulated depreciation $12,000. There was a gain of $5,000. So we know they would have credited gain on sale $5,000. The entry doesn't balance. We need an $18,000 debit to balance the entry out. It's a plug. That must have been the cash. See, that's the thing about the exam. There are missing pieces. That's why journal entries, T accounts help you, because they're not going to necessarily tell you everything. What was missing here is the cash. You had to find it. Now, what kind of cash is it? Well, you know it's PP&E. It's happy. So you're going to go to investing. You're going to post that $18,000 debit because we know that's cash provided by an investing activity. Let's post the rest of the entry. We're going to go to equipment. Post that $25,000 credit. Have we explained the change in that account? No. We know that that account increased by a net debit of $25,000. All we've seen is a credit increase to that account of $25,000. We still have more work to do. We go to accumulated depreciation. We post that $12,000 debit. We have not explained the change in that account. We leave it open. And we also have a gain. That's an operating item. Remember, once you put an entry down, everything gets posted somewhere. So we're going to go to operating activity and post that $5,000 credit to operating because of the gain on sale. That's an operating item. And again, the reason that has to be done is because we can't show this both as $18,000 cash provided by an investing activity and a gain on our income statement. You'd be double counting it. But as I said earlier in the class, you don't really have to think it all through, just post it. Get an entry down, everything gets posted somewhere. Now there's another transaction. They say in December, car purchased equipment costing $50,000 for $20,000 cash and a $30,000 note. Well, the entry, of course, would be debit equipment, $50,000. You'd credit cash, $20,000, and you'd credit notes payable, $30,000. Well, there's cash involved. It's PP&E. So you go to investing activity, post that $20,000 credit, and now we can answer one of the questions. Net cash used in investing activity, $2,000. So the answer to number 4 is A. Let's post the rest of it. We go to equipment. We post that $50,000 debit. We've explained the change in that account. Exit out. Don't want to look at it again. We go to notes payable. We post that $30,000 credit. We've explained the change in that account. Exit out. Don't want to look at it again. All right, so we're done with the additional information. Now what do? You circle all the accounts you've not explained. There's only one account we have not explained, accumulated depreciation. And you know it's an operating item. We're trying to find the depreciation expense for the year. Now let's look at this T account. Don't we know that accumulated depreciation during the year increased by a net credit of $40,000? And yet all we saw in our journal entries was a debit to that account of $12,000. The only way that account could have increased by a net credit of $40,000 is if there was another credit to that account of $52,000. That must have been the depreciation expense for the year. Accumulated depreciation increased during the year by a net credit of $40,000. Yet all we saw in our journal entries was a debit to that account of $12,000. There must have been another credit to that account to make it come out of $52,000, and presumably that would be the depreciation expense for the year. So that was a credit to accumulated depreciation, $52,000. Go to operating, do the opposite. Debit operating, $52,000. And now we can answer the other one. Net cash provided by operating activity would be $347,000. So the answer to number 5 is B. And I know you might be saying, well, Bob, they gave us the depreciation expense for the year anyway. It was given. It was $52,000. I know that. But so often in the exam, they will not give it to you. That's why a couple of times in this class, I've made you analyze that accumulated depreciation account so you could find the depreciation expense if you have to. Because in the exam, they may not give it to you. It could be a missing piece of information. Let's get some more practice on this method. I'd like you to try number 6, tab, and then when you get your answer, come back. Welcome back. Let's do number 6 together. In number 6, they're asking in TEBS Year 5 Statement of Cash Flows, what was the net cash used in financing activity? So one way you could approach this, you could set up a quick T account for financing activity, and you know you're always financing for Prince Divots. Prince is debt principal, Div is paid dividends, I is issue stock, TS is treasury stock transactions. Let's look at the list. They have payment for early retirement of long-term bonds. Is that part of Prince Divots? Sure. If you retire bonds, aren't you paying off debt principal? That's the Prince in Prince Divots. We haven't seen a lot of that. But remember, bonds are a debt security. So anytime you retire bonds, what you're doing is paying down debt principal. That is the Prince in Prince Divots. Let me ask you this. Would I use the 740 or the 750? We don't care about the carrying value of the bonds, the 740. We are analyzing cash. All we care about is the cash that went out to retire the debt. That's the $750,000. That's cash used in a financing activity. Next, distribution in year 5 of a cash dividend that was declared in year 4. We know that dividends would be the div in Divots. So we know it's a financing item, and you know this. It doesn't matter that it was declared in year 4. If the cash went out in year 5, that's cash used in year 5 for a financing activity. So we know that's $62,000 of cash used in a financing activity. How about the carrying amount of convertible preferred stock converted into the carrying amount of convertible preferred stock converted into common stock? Well, preferred stock converted to common stock, that doesn't affect cash. You want to just write next to that, that's a non-cash item. Non-cash, doesn't affect cash. You have convertible preferred stock being converted into common stock. Doesn't affect cash. It's a non-cash item. I'll say more about that in a minute, but we don't have to worry about that. No effect on cash. And then finally, the proceeds from the sale of treasury stock. Well, we know that treasury stock is the TS on Divots. It is financing. Would I use the $86,000 or the $95,000? You're right. I don't care about the $86,000. I don't care about the carrying value of the treasury stock. All I care about is cash. Cash flows is an analysis of cash. And if I collected $95,000 cash from selling my treasury stock, that's cash provided by a financing activity. So put that $95,000 debit in that account, and we can answer the question. Net cash used in financing activity, $717,000. Answer A. I'm hoping that you eat up a question like that. If you know Prince Divots, I'm hoping you go right through it. Now, I want to go back to this non-cash item, the carrying amount of convertible preferred stock converted into common stock. As I mentioned a little earlier in this class, these are called non-cash investing and financing activities. Again, these are all called non-cash investing and financing activities. There are 4 big ones, and you've got to know them. Let's go over the 4 big ones. Number 1 is this one, preferred stock converted to common stock. That is a non-cash investing and financing activity. Number 2, one we saw earlier, convertible bonds converted into stock. If you see convertible bonds converted into stock, that is a non-cash investing and financing activity. Number 3, another one, if you see a straight exchange of debt for property. Again, anytime there's a straight exchange of debt for property, you see a company issue a note for an asset. That is a non-cash investing and financing activity. It's a straight exchange of debt for property. That's a non-cash investing and financing activity. And then finally, a straight exchange of stock for property. If you see a company issue stock for an asset, hey, that is a non-cash investing and financing activity. And let me just give you a quick note here. These non-cash investing and financing activities are not in the statement of cash flows. They're not in the body of the statement. However, they get footnoted at the bottom of the statement as a supplemental disclosure. That's what these are. They're not in the body of the statement, but they do get footnoted at the bottom of the statement as a supplemental disclosure. A couple more points. Again, those are all supplemental disclosures in a statement of cash flows. Now, stock dividends, stock splits. Again, stock dividends, stock splits, retained earnings appropriations, stock dividends, stock splits, retained earnings appropriations. They're not in the body of the statement of cash flows, and they're not a supplemental disclosure in a statement of cash flows. Stock dividends, stock splits, retained earnings appropriations, they're not in the body of the statement of cash flows, and they're not a supplemental disclosure in a statement of cash flows. And just one other quick point. There's no requirement that a company footnote cash flow per share. I know they've asked that. There is no requirement that in a statement of cash flows they footnote cash flow per share. That is not a requirement. Let's go to number 7. It's a question that would bother a lot of people. 7 says, Mend purchased a 3-month treasury bill. Mend's policy is to treat as cash equivalents all highly liquid investments with an original maturity of 3 months or less when purchased. It was kind of nice of the exam, wasn't it, to remind you of that 3-month rule. We have a security with, either a certificate of deposit or some kind of commercial paper with an original maturity of 3 months or less. It's the same as cash. It's a cash equivalent. And they say, how would the purchase of this cash equivalent be reported in the statement of cash flows? And I wanted you to look at this question because a lot of students would say it is answer A. In other words, they might go, well, I remember what Bob said. Bob said if you buy or sell trading securities, that is cash flows from operating activity. I remember Bob saying that. If you buy or sell trading securities, hey, that's cash flows from operating activity. So they go for A. It's not A. Why? Is this a trading security? No, it's a cash equivalent. It's not a trading security. It's a cash equivalent. And what might help you is just think for a moment, what is the entry that we make if we go out and purchase a cash equivalent? Just think what the entry is. When you purchase a cash equivalent, what would be the entry that you'd make? You would debit cash, credit cash. It's not reported at all. The answer is D. You're just moving around different parts of cash. That's all you're doing. Remember, cash equivalents are the same as cash. This is no different than moving your cash from one bank account to another bank account. It's the same idea. So you go out and buy a cash equivalent. That is not reported in a statement of cash flows. I'd like you to try another set. I'd like you to try 8 and 9 and then come back. Welcome back. Let's look at this set together. In number 8, they want to know the cash used in investing activity, and in number 9, they want to know the cash provided by financing activity. So you could set up right away 2 T accounts. You have a T account for investing activity, it makes you happy. You have a T account for financing activity, always financing for Prince Divots. Now they gave us a list of items to consider here. Here's what I'd like to do. Let's go down this list together and let's label each item on the list. O for operating, I for investing, F for financing. How about the gain on equipment? That's an operating item. Put an O there. Proceeds from the sale of equipment. Well, that's PP&E. That's happy. That would be investing. An I there. Purchase of an investment in bonds that are available for sale securities. Well, that's the A in happy. That's an investing item. Amortization of a bond discount. That's an operating item. Now, with dividends, we know that's the div and divots. It's a financing item. Do we care about what they declared or what they paid? I'd put a line through declared. All we're analyzing is cash. So next to the $38,000 they actually paid for dividend, that would be cash used in a financing activity. And then finally, the proceeds from the sale of treasury stock. We know that treasury stock would be the TS on divots. That's a financing item, $75,000. Now, if you did that, it turns out we have 2 investing items. We have $10,000 cash provided by selling equipment, $180,000 cash used to purchase available for sale securities. Net cash used in investing is $170,000. A for number 8. We have 2 financing items for number 9. $38,000 cash used to pay a dividend, $75,000 cash provided by selling treasury stock. Net cash provided by financing activities would be $37,000. Answer D. You know what I'm hoping? I'm hoping that if you know Happy and Prince Divots, you just hopefully just go right through a set like that very quickly. That's what I'm hoping. Now, you'll notice that up until this point in class, all we've talked about is the indirect method of preparing a statement of cash flows because, as I said at the beginning of class, it is by far the most heavily tested method. Let's get into the direct method. First of all, if you see the direct method in the CPA exam, remember, investing activity is exactly the same. You're still investing to make you happy. Buy or sell held to maturity, buy or sell available for sale, buy or sell PP&E, buy or sell equity investments. I want you to know that'll all still work for you. Investing still makes you happy. Financing activity in the direct method is exactly the same. We're still financing for Prince dividends. Prince is debt principal. Div is paid dividends. I is issue stock. TS is treasury stock transactions. Investing activity, exactly the same. Financing activity, exactly the same. The only thing that's different in the direct method is that the operating section has to be presented differently. And that's what I want to get into next. I want to show you how we have to present the operating section under the direct method. You really have to know this. When you're doing cash flows from operating activities under the direct method, you're going to start with cash sales. In other words, you don't start with net income. You start with cash sales, what they sometimes call cash collected from customers. And then you put in 4 categories of cash expenses. First, you have cash cost of goods sold. Sometimes they call it cash paid to suppliers. So again, you have 4 categories of expenses. First, cash cost of goods sold, cash paid to suppliers. Second one, cash for selling and administrative expenses. It's primarily salaries and wages, but it would be cash paid for selling and administrative expenses. And then cash paid for interest. And then finally, cash paid for taxes. And it comes out the same. That's what they mean by the direct method. You show cash sales, cash collected from customers, and those 4 categories of cash expenses. Now, remember I said earlier that the exam has tested the indirect method far more often, and you might be wondering, well, do they ever test the direct method? They might. And if the exam hits you on the direct method, you know, they could ask you to figure out cash sales, figure out cash cost of goods sold. Let me show you what I mean. If you go to question number 10. It says Duke Company reported cost of goods sold of $270,000 for the current year. That would be on the accrual basis. The income statement should be on the accrual basis. And on the accrual basis, they're showing cost of goods sold of $270,000. At the bottom it says, if Duke uses the direct method, notice they're specifying, as I said earlier in the class, only worry about the direct method if they specify. And here they are. If Duke uses the direct method, what amount would Duke report as cash paid to suppliers for the year? In other words, what's cash cost of goods sold? And I wanted to show you this because this might be the one they test the most. How do you bring cost of goods sold on the accrual basis to cost of goods sold on the cash basis? Well, there's more than one way you can do this, but I want to show you the way I like to do this. We know that cost of goods sold on the accrual basis is $270,000. And for me, if I want to convert cost of goods sold from accrual to cash, I always start by figuring out purchases. I just think that's the best way to do it. It's not the only way to do it, but I want to figure out purchases. So think for a minute. How would I go from what they sold to what they purchased? You look at change in inventory. If you want to go from what they sold to what they purchased, go to the change in inventory. Notice in the last year, inventory went from $45,000 back on January 1 up to $60,000 December 31. Inventory has increased by $15,000. So think about it. The only way inventory could go up is I must have purchased a lot. I must have purchased enough merchandise to cover all the goods I sold, plus I added to inventory. Again, the only way inventory can go up is if I purchase a lot. I must have purchased enough merchandise to cover everything I sold, plus I added to inventory. So I'm going to add that. 270 plus 15, purchases must have been $285,000. Now, the reason I like to figure out purchases is because at that point, I can just do an entry. I'm going to debit purchases. I figured that this company, Duke, must have debited purchases $285,000. Now the question is, was it all cash? Well, what happened to accounts payable? In the last year, accounts payable went from $39,000 down to $26,000. It went down. So in this entry, they must have debited accounts payable $13,000 because it went down. And the credit to cash must have been $298,000. And the answer is D. That was the cash they paid for merchandise. That was the cash cost of goods sold. That was the cash paid to suppliers. That's the way I like to do that. Once you figure out purchases, you can just do an entry. What I'd like you to do is go back in your viewer's guide. I'd like you to go back to the first problem that we did in this class, Farrell Corporation. I want to show you a couple of things. If you go back to Farrell Corporation, now you remember that we solved Farrell Corporation under the indirect method. And if you go back to Farrell Corporation for a moment, look at the statement of cash flows that we did for Farrell under the indirect method. If you're back to there, you see that cash flows from investing activity was $44,000. That would be, in the direct method, that would be exactly the same. The cash flows from financing activities came out to $5,000. In the direct method, that would be exactly the same. You've got to remember that. Investing activity, exactly the same. Financing activity, exactly the same. All that would be different in the direct method, if I were to solve Farrell Corporation under the direct method, is how I would present the operating section. Now, we know from our earlier solution that the net cash provided by operating activity is $134,000. Let me show you how we would do that in the direct method. In the direct method, I want to start with cash sales. Now, look at the income statement for Farrell. What were sales on the accrual basis? $1,950,000. Well, let's think about an entry here. I always like entries. So if the sales were $1,950,000, I got that on the income statement for Farrell. We know they credited sales $1,950,000. Now, I know you know this. If I want to convert sales from accrual to cash, I look at generally what? Change in accounts receivable. In the last year, if you look at the balance sheet for Farrell, accounts receivable went from $305,000 a year ago down to $295,000. It went down 10. So in this entry, they must have credited accounts receivable $10,000. And the debit to cash must have been, just a plug, $1,960,000. So that tells me cash sales. That's how I figure out cash sales. So I'd have cash sales. If I were doing Farrell statement of cash flows under the direct method, I'd start with, when I do cash flows from operating activities, I'd start with cash sales or cash collected from customers, $1,960,000, and I'm hoping you see where I got that. Now I want to add in, I want to subtract 4 categories of cash expenses. First, cash cost of goods sold, cash paid to suppliers. Let's work that out together. If you look on the income statement for Farrell, what was cost of goods sold on the accrual basis? $1,150,000. I hope you see that. Now, you know the way I like to do this. I want to figure out purchases. How do I go from what they sold to what they purchased? I look at change in inventory. If you go to the balance sheet, you'll notice in the last year, inventory for Farrell went from $431,000 up to $549,000. Inventory in the last year went from $431,000 up to $549,000. Didn't inventory go up by $118,000? So think about it. What is the only way inventory can go up? I must have purchased a lot. I must have purchased enough merchandise to cover all the goods I sold, plus I added the inventory. So I'm going to add that 118. My total purchases must have been $1,268,000. So once I've got purchases, I can do an entry. I know that Farrell must have debited purchases $1,268,000. Now, was it all cash? We'll look at accounts payable on the balance sheet. In the last year, accounts payable increased by $41,000. So I know in this entry, they would have credited accounts payable $41,000, and the rest must have been cash. Credit cash, $1,227,000. That's cash cost of goods sold, cash paid to suppliers. So we put that in. So we have the cash collected from customers, $1,960,000. We have cash paid to suppliers, cash cost of goods sold, $1,227,000. How about cash selling and administrative expenses? Well, if you look on the income statement, the selling and administrative expenses for the year, $505,000. Now, is it all cash? Well, what you have to be careful about here, remember I said earlier that this is primarily salaries and wages. And you have to see if there's any wages payable. There isn't. If you look on Farrell's balance sheet, there's no wages payable. So it must be all cash. So cash paid for selling and administrative expenses, $505,000. Now cash paid for interest. If you look on the income statement for Farrell, cash paid for interest, or their interest expense for the year was $15,000. Was it all cash? Well, what you want to look for here is any interest payable. But if you look on the balance sheet, there was no interest payable, so it must be all cash. Again, what you have to be careful about with interest, you know, if interest payable went up, well, then some of it wasn't cash. If it went down, well, I paid my current expense in cash, plus I paid down the payable. You know, you have to watch out for interest payable, but on the balance sheet, there was no interest payable. So the $15,000 must have all been cash. And then finally, cash paid for taxes. Do I just pick up their total income tax expense, $90,000? No, not what they deferred. I just want what they paid in cash. So the increase to the deferred tax liability I don't care about. Just pick up the current portion, $79,000. So notice it all comes out the same. If I take the cash collected from customers, cash sales, $1,960,000, back out cash cost of goods sold, cash paid to suppliers, $1,227,000, cash selling and administrative expenses, $505,000, cash paid for interest, $15,000, cash paid for taxes, just the current portion, $79,000, you get the same answer. Net cash provided by operating activity, $134,000. That's what they mean by the direct method. Investing activity is exactly the same. Financing activity is exactly the same. But you have to present the operating section differently. You have to show the cash sales, cash collected from customers, and these four categories of cash expenses. Now, one other point. If you go back for a moment to the statement of cash flows we did earlier for Farrell, go back to their operating section under the indirect method. You see where we have net income 141, we add back the decrease in receivables, we take out the increase in inventory, we add back the increase in payables, we add back the depreciation expense, we add back the goodwill impairment loss, we add back the loss on equipment, we take out the subs earnings, we add back the increase in deferred tax liability. Now listen, even in the direct method, that schedule shows up at the bottom of the statement as a supplemental disclosure anyway. Let me say that again. Even, yes, in the direct method, you would present the operating section the way I said. Show cash sales and those four categories of cash expenses. But the schedule that we have under the indirect method, where you show the net income and you add back the decrease in receivables and so forth and so on, that shows up at the bottom of the statement as a supplemental disclosure anyway. That's why you can't get away from the indirect method. Because even in the direct method, you have to have a supplemental disclosure where you reconcile from accrual income to cash income anyway. So in reality, you can't get away from the indirect method. So I'll say one more time, you're only going to worry about the direct method in the CPA exam if they specify they want the direct method. Let me show you what they could do. I'd like you to go back to the multiple choice. We're going to do 11 to 15 flax. I'd like you to shut your tape down, try that set, 11 to 15, and then come back. Get your answers first. Welcome back. Let's do this set of questions together. They say Flax uses the direct method to prepare its statement of cash flows. As I've said all through this class, the only time you worry about the direct method in the CPA exam is when they specify. If they were silent, I'd always solve something under the indirect method. But when they specify, you have to worry about the direct method. It says we have the trial balances at December 31, year 7 and year 6. We have some additional information. Now they ask 5 questions, 11, 12, 13, 14, and 15. Now before we look at the questions, I want this to make sense to you. Remember we said that when you see the direct method, we know investing activity is exactly the same, no differences there. Financing activity is exactly the same, there's no differences there. All that's different in the direct method, as you know, is that the operating section gets presented differently. We have to show cash sales and 4 categories of cash expenses. And look at these 5 questions. Question number 11, what's cash collected from customers? What's cash sales? 12, What's cash cost of goods sold? Cash paid to suppliers. 13, cash paid for interest. 14, cash paid for taxes. 15, cash for selling. Really, what else can they do with this? I mean, they could ask for investing activity. They could ask for financing activity, but it's the same. This is pretty much what they can do with the direct method. I hope you tried these. 11 says, all right, what's cash collected from customers? Well, if you go to the comparative trial balances, go to the credit side, the last credit listed. We know the sales for year 7, $538,800. Now, you know me. I like an entry. So don't we know they credited sales? $538,800. Now, was it all cash? What do you want to look at? Accounts receivable. Go to the debit side. In the last year, accounts receivable went from $30,000 up to $33,000. So in this entry, they must have debited accounts receivable $3,000 because it changed. It went up. And the rest must have been cash. You would debit cash for $535,800, and the answer is D. Entries, I think, help you a lot. Just try to get an entry down, and I hope you get to answer D very quickly. That's cash collected from customers, cash sales, $535,800. Now, I really hope you did well on number 12, because it's probably the one they asked the most. Cash paid to suppliers, cash cost of goods sold. Well, let's do it together. What was cost of goods sold on the accrual basis? If you go to the debit side, about halfway down, cost of goods sold for year 7, under the accrual basis, $250,000. Now, you know what I like to do? I want to go from what you sold to what you purchased. I want to figure out purchases, because then I can just do an entry. How do you go from what you sold to what you purchased? Look at the change in inventory on the debit side. In the last year, inventory went from $47,000 down to $31,000. Didn't it go down $16,000? If inventory went down $16,000, I didn't purchase all the goods that I sold. I took $16,000 out of my inventory. I backed that out. Then I purchased the rest. $250 minus 16, $234,000. Again, if inventory went down, I didn't purchase all the goods I sold. I took $16,000 out of my inventory. So take the $250,000, back out $16,000. I must have purchased the rest, $234,000. Now, as I keep saying, once you've got purchases, now it's just a matter of doing an entry. We know they debited purchases, $234,000. Was it all cash? Go to the change in payables. On the credit side, the trade accounts payable in the last year went from $17,500 to $25,000. So in this entry, didn't they credit accounts payable $7,500? And the rest must have been cash. Plug it. Credit cash, $226,500, and the answer is D. I want you to be really comfortable with converting cost of goods sold from accrual to cash. Might be the most common one they ask. How about cash paid for interest? Well, if you go to the debit side, towards the bottom, notice the interest expense for year 7, $4,300. So we know they debited interest expense, $4,300. Now the question is, was it all cash? Now I really mean this. Give yourself credit, give yourself a gold star if you thought of interest payable. That's normally what you have to be careful about. Was there any interest payable? You know, if interest payable has gone up, I credit interest payable for the increase, the rest presumably is cash. If interest payable has gone down during the year, then I debit interest payable for the decrease, and the rest must have been cash. But notice on the credit side, there is no interest payable. There's no interest payable to worry about. So is it all cash? No, because you have to look at everything they give you on the debit side, about halfway down. Notice they had an unamortized bond discount that in the last year went from $5,000 down to $4,500. So in this entry, they must have credited discount $500. Again, you have to look at everything they give you here. In the last year, unamortized bond discount went from $5,000 down to $4,500. They must have amortized some of the discount. That's part of your interest adjustment. So in this entry, they must have credited discount $500, and the rest must have been cash. Credit cash $3,800. The answer is C, because there is no interest payable. Number 14. How about the cash paid for taxes? Well, let's do an entry. Entries really help. Go to the debit side. The last debit listed, income tax expense. For year 7, $20,400. Last debit listed. Your income tax expense for year 7, $20,400. So we know they would have debited income tax expense $20,400. Now, is it all cash? No. Got to look at everything they give you. On the credit side, didn't they have a deferred tax liability that went from $4,600 up to $5,300? So in this entry, they would have credited deferred tax liability $700. What else? Watch out for income tax payable. In the last year, income tax payable went from $27,100 down to $21,000. So in this entry, they must have debited income tax payable $6,100. Now you need a credit to balance the entry out of $25,800, and it must have been to cash. That must have been the cash they paid for taxes. And the answer is A. Always come back to entries. They usually help you clarify something. And then finally, what was the cash paid for selling? Well, if you go to the debit side, about halfway down, the selling expense for year 7, $141,500. So we know they debited selling expense $141,500. Now the question is it all cash? Well, here again, give yourself credit if you thought of wages payable. That's mostly wages. And you want to look on the balance sheet and see if there's any wages payable related to selling. They'd have to specify wages payable related to selling. There isn't any. Since there are no wages payable related to selling, is it all cash? Well, again, you've got to read everything they give you. In the additional information, the second bullet says Flax allocates 1/3 of their depreciation expense to selling. Well, if they allocate 1/3 of their depreciation expense to selling, depreciation is a non-cash expense. It is an expense that does not require the outlay of cash. So the question is, do we know the depreciation expense for the year? We can figure it out. Go to the credit side. Find accumulated depreciation. In the last year, accumulated depreciation went from $15,000 up to $16,500. We infer that the depreciation expense for the year must have been $1,500. Again, in the last year, accumulated depreciation went from $15,000 to $16,500. We have to infer that the depreciation expense for the year must have been $1,500. Since 1/3 of that went to selling, in this entry they would have credited accumulated depreciation for 1/3 of $1,500, $500, and the rest must have been cash. Credit cash, $141,000. The answer is C, because there is no wages payable related to selling, or other possible non-cash expenses that we know about. I hope you did well on that set. And as I say, what should make you feel good about that set is that there's really not that much they can do with the direct method. They may ask you to figure out cash paid to suppliers, cash cost of goods sold. They may ask you to work out cash collected from customers, cash sales. But when you get right down to it, not much they can do with the direct method. And as long as you can get back to an entry and work it out, I think you'd be fine with whatever they come up with. Why don't we do one more thing on the indirect method? If you look in your viewer's guide, there is a simulation on the indirect method, ZAC Corporation. I'd like you to shut the class down. Give yourself about 20, 25 minutes. There are 5 questions that you have to answer. Please answer those 5 questions and then come back. We'll go through them together. Welcome back. Let's take a look at this simulation together. And it's a little bit different, isn't it? It says the following are selected balance sheet accounts of ZAC Corporation at December 31, year 9 and year 8, and increases or decreases in each account from year 8 and year 9. Also presented is selected income statement information. So we only have selected information. And if you look at it, we have selected balance sheet accounts, we have selected income statement information, we have some additional information as well, and it says items 1 through 5 represent activities that will be reported in ZAC's statement of cash flows at December 31, year 9, and the following 2 responses are required for each of them. You have to determine the amount, the dollar amount that would be reported in the statement of cash flows, and also the category which it falls in, operating, investing, or financing. All right, so you know the first thing we like to do is go to the change in cash, because we prove out to that. I don't know cash. right? I only have selected balance sheet accounts. And cash just isn't one of the ones they selected. So I don't know the change in cash. So let's go to my next step. I put down 3 big T accounts. I'm going to set up a T account for operating activity. I'm going to set up a T account for investing activity and a T account for financing activity. Get that done. Then we put down a small T account. For every account they give us in the balance sheet, except for cash, we don't have cash anyway. Put the net change in each account. Let's do that. In the last year, accounts receivable went from $24,000 to $34,000. That's a net debit increase to that account, $10,000. Property, plant, and equipment went from $247,000 to $277,000, a net debit increase to that account of $30,000. Accumulated depreciation went from $167,000 to $178,000, a net credit increase to that account of $11,000. So you put those changes in those accounts and double underline them. Bonds payable went from $46,000 to $49,000. That's a net credit increase to that account of $3,000. Double underline that. There was also a net credit increase to dividends payable. Went from $5,000 to $8,000. A net credit increase to dividends payable of $3,000. Double underline that. And then finally, a $3,000 credit increase to common stock, a $6,000 credit increase to APIC, and a $13,000 credit increase to retained earnings. So we get that set up. Now, where do we begin our analysis? Well, I always say, prove out the retained earnings. We know that this past year, retained earnings increased by a net credit of $13,000. Let's see if we can prove it out. If you go to selected income statement information, we do know the net income for the year, $28,000. Let's post that. We're going to go to our first big T account, which is operating activity, post that $28,000 debit to that account. We know it's a debit because net income provides cash from operations, doesn't use it. And we post the credit to retained earnings. Presumably, net income is always posted as a credit to retained earnings, $28,000. Now, I want you to look at that retained earnings account. You have to infer something here. Remember, we only have selected information. Don't we know that retained earnings increased by a net credit of $13,000, and yet we know income was posted at $28,000, a credit of $28,000. The only way retained earnings could increase by a net credit of $13,000, there had to be another debit in that account. There had to be a debit to retained earnings. You plug it in, of $15,000. That must have been the dividend. You had to find the dividend here. So we're going to debit. Let's do our entry here. I always make the dividend my first entry. We know they're going to debit retained earnings, $15,000. Again, I had to plug that to make retained earnings prove out. They didn't give it to me. I only have selected information. So I'm going to debit retained earnings for that $15,000. So now I've proven the change in retained earnings, exit out. Don't want to look at it again. Now, should I credit cash, $15,000? Was it all cash? No. Look at dividends payable. During the year, there was an increase to dividends payable of $3,000. So in this entry, they must have credited dividends payable $3,000. So post that. That explains the change in that account. Exit out. And the rest must have been cash. Credit cash, $12,000. So now we can answer one of the questions. Remember, in a simulation like this, you are very driven to just answer the questions. In other words, don't do more work than you have to. You'll only work enough to answer these 5 questions. We can answer one. Number 4, what were the cash dividends paid? The answer was $12,000 from our entry, and we know it's financing. It's the div and divots. We're always financing for Prince divots. Prince is debt principal. Div is pay dividends. I is issue stock. TS is treasury stock transactions. It's a dividend. It's the div and divots. So it's $12,000 financing activity. So we found that. We've proven out retained earnings. What do we do next? Now we go to the additional information. And there isn't much. All they said in the first bullet was, well, first they said accounts receivable relate to sales of merchandise, which you'd assume. And then the second bullet says, during year 9, equipment costing $40,000 was sold for cash. So they didn't say much. They just said, during year 9, equipment costing $40,000 was sold for cash. Let's see if we can piece this entry together. We know they credited equipment $40,000. Do we know anything else about that entry? Sure. in the selected income statement information, don't we know there was a gain on sale of equipment of $13,000? So in this entry, they must have credited gain on equipment $13,000. Anything else? Do we know the accumulated depreciation that was on that equipment? We can figure it out, can't we? Go to your T account on accumulated depreciation. Don't we know that during the year accumulated depreciation increased by a net credit of $11,000? Now, do we know the depreciation expense for the year? We do. Look at selected income statement information. They gave you that. The depreciation expense for the year was $33,000. That was given. So during the year, they must have debited depreciation expense, $33,000, credit accumulated depreciation, $33,000, so put that in. There was a $33,000 credit because of depreciation expense, right? And here's my point. If accumulated depreciation increased by a net credit of $11,000, and yet the depreciation expense resulted in a credit of $33,000, there must have been another debit in that account. To make it come out, there must have been a debit to accumulated depreciation of $22,000. And as far as we know, this is the only entry that explains it. So back to our entry. They would have debited accumulated depreciation $22,000. There must have been $22,000 of accumulated depreciation on that equipment. The entry doesn't balance. I need a $31,000 debit to balance the entry out. That must have been the cash. And now we can answer another question. Number 3, what were the proceeds from the sale of equipment? Well, it must have been $31,000, and of course, investing, because it's PP&E, it's happy. It's PP&E. So $31,000 investing. We've got that one. All right, now go back to the additional information. It says, during year 9, $20,000 of bonds payable were issued in exchange for property, plant, and equipment, and there was no amortization of bond discount or premium. Well, if $20,000 of bonds payable were issued in exchange for PP&E, you know the entry, they would have debited property, plant, and equipment $20,000 and credit bonds payable $20,000. And you know what this is. This is a straight exchange of debt for property. It is a non-cash investing and financing activity. It's not going to be in the statement of cash flows. It's not in the body of the statement, but it is footnoted as a supplemental disclosure. But do I post this entry? Of course. Everything has to be posted. So we're going to go to property, plant, and equipment. We're going to post that $20,000 debit. We've not explained the change in that account. In fact, I want to make sure that we posted everything in our prior entry. Let me just go back to the prior entry where we sold the equipment. We should have gone to property, plant, and equipment and credit property, plant, and equipment for $40,000. We still have more work to do there. We have not explained the change in that account. We've proven out the change in accumulated depreciation. How about the cash, the $31,000? We know that would go to investing activity. It's PP&E. And how about the gain of $13,000? That's an operating item. So hopefully you went to your operating T account and credited operating for $13,000 for the gain on equipment. Get the entry down, post everything. So now we're posting this other entry where we debit property, plant, and equipment $20,000 and credit bonds payable $20,000. So we go to property, plant, and equipment, post a $20,000 debit. We still have not explained the change in that account, so we leave it open. We go to bonds payable. We post a $20,000 credit to that account. We have still not explained the change in that account. We have to leave it open. So that takes care of all the additional information. It's all they said. We've answered a couple of the questions. What's my next step? In fact, what's my last step? You circle all the accounts you've not explained. Let's go to the first one. We have not explained accounts receivable. Well, we know it's an operating item. If accounts receivable has increased by a net debit of $10,000, go to operating, do the opposite. Credit operating $10,000. Now look at the next one. Look at property, plant, and equipment. Don't we know that during the year, property, plant, and equipment increased by a net debit of $30,000. Now, what have we seen in our journal entries? We saw a credit of $40,000 when we sold the equipment. We saw a debit of $20,000 when we bought equipment. The only way the net change in that account could be an increase of $30,000, there had to be another debit in that account. We have to infer there was another debit in that account of $50,000. I'll do that again. We know that property, plant, and equipment increased during the year by a net debit of $30,000. And what have we seen in our entries? A credit of $40,000 and a debit of $20,000. There had to be another debit of $50,000. So we infer at some point during the year they debited property, plant, and equipment $50,000, and it must have been a credit to cash because there's no other account that makes sense. There's no debt, no mortgage. It must have been cash of $50,000. As I've said all through this class, the problem with the exam is they play games with you. There's missing information. We had to find that. Now we can answer another question. Question number 2. What were the payments for the purchase of property, plant, and equipment? $50,000. And of course, we know it's PP&E, it's happy, it's investing. We can label that one. Now, accumulated depreciation we've explained. Let's go to bonds payable. Don't we know that during the year, bonds payable increased by a net credit of $3,000, just $3,000. In our entries, we saw a credit to bonds payable when they bought the property, plant, and equipment of $20,000. The only way the net change to bonds payable could be an increase of just $3,000 is if there was another debit to that account. There had to be a debit to that account of $17,000. I hope you see that. We credited bonds payable for $20,000 when we issued bonds in exchange for a fixed asset. But the net change to that account was only $3,000. There had to be a debit in that account of $17,000. They must have redeemed some bonds payable. You had to find that. So they must have debited bonds payable $17,000, credit cash $17,000. So now we can answer another question. Number 5, the redemption of bonds payable must have been $17,000. Must have been. And of course, that's financing activity because it's debt principal. If you retire bonds, you're paying off debt principal, and as you know, that's the prince in prince dividends. Now that's as far as I wouldn't finish the problem, figure out cash flows from operating activity, investing activity, financing activity, because they didn't ask. As I say, in a simulation, you're very focused on just answering what they want, because you don't want to waste time. So we've answered questions 2, 3, 4, and 5. Now there's also question 1. What were cash collections from customers under the direct method? As I've said again and again, only worry about the direct method if they specify, and they are here. In questions 2, 3, 4, and 5, nothing was specified, and I just went with the indirect method. And of course, you also know that investing activity, financing activity, which is what questions 2, 3, 4, and 5 are all about, are exactly the same, whether it's direct method or indirect method. It doesn't matter. But anyway, in number 1, they are specifying. What were the cash collections from customers? What were, under the direct method, what were cash sales? Well, you know the way I like to do this. Let's do an entry. Look back in the information. Go to selected income statement information. In selected income statement information, we know the sales revenue, $155,000. So we know they credited sales, $155,000. And you know what to do. If I want to convert sales from accrual to cash, I look at what? Change in accounts receivable. Look at your accounts receivable account. That's one of the selected accounts they gave you. In the last year, didn't accounts receivable go from $24,000 up to $34,000? It increased. So think about our entry. We know they credited sales, $155,000. That was given. Sales revenue. But if accounts receivable went up $10,000 in this entry, they must have debited accounts receivable, $10,000. The rest must have been cash. Debit cash, $145,000. That must have been the cash collected from customers. So the answer to number 1 is $145,000, and obviously it is operating. I hope you're feeling good about this technique. I want to wish you the best of luck on the exam from all of us at Bisk CPA Review. We wish you the best of luck on the test. Study hard.